surge after Trump declares end of Iran peace deal. Brent crude climbs towards $79 per barrel on concerns over energy supplies from West Asia post the renewed strikes by US. Meanwhile, gold trades below $4,100 an ounce, intensifying inflationary pressures.
The International Monetary Fund lowers the global growth forecast for 2026 as renewed US-Iran conflict clouds economic outlook. For India, it has marginally lowered its GDP growth forecast for the 2026-2027 period to 6.4%, but projects India to remain one of the world's fastest growing major economies.
Earnings season kicks off today with IT major TCS expected to report a muted quarter. Dollar revenue to decline marginally, while EBIT margin will see a 120 basis point fall sequentially due to wage hikes. Okay, first up, let's take a look at the Asian markets. Let's start with Kospi. The standout up around 3% as chip and AI heavyweights rebound after the week's brutal tech rotation. This is after it briefly entered bear territory yesterday, now up about now it's up about only 300 points, but overall we saw the day's high being around 3%. Now remember, Seoul remains the region's semiconductor bellwether and it is leading the recovery. Mirroring that is Nikkei, which is also trading higher, up about 1.5% as you can see on your screen. It is also seemed to be participating in the chip snapback. Now the Japanese semiconductor names have been recovering alongside Korea's. And let's take a look at Hang Seng. What is happening in Hong Kong? Well, down about 300 points, but it has been a regional laggard, down close to 7% this year on its e-commerce and platform exposure, and was testing the 24,400 resistance zone earlier this week, but as you can see, it's now about 24,120. There's also Taiwan showing some gains. It's in the green, but barely, about not even 0.5%. Now remember what happened in the US after President Donald Trump said what he said about the MOU with Iran, but we will see an impact on the stock market as well as commodities. But to get an update on how will overnight Qs impact the Indian markets, we have our research team joining in with how the trade setup looks like and the stocks that are likely to be in news. And first up is Hormaz.
How one statement can change everything, right? We're back to square one for the index. We started off the July series on a very positive note. We were doing very well until yesterday afternoon, and in fact until the day before yesterday afternoon. But since then, back to square one. We closed the 30th of June at 23,865, and yesterday's close was 23,882, and we are just at the same levels at which we had closed the June series, and this is despite having made an intraday high of 24,530 earlier in the day. Now the GIFT Nifty as of now is indicating a fairly steady start, around about 50 points higher, is 55 points higher. It's been fluctuating between 80 points and 50 points, but for now you're most likely to open on a slightly positive note. The result season begins today. Of course, that was supposed to be the biggest trigger until yesterday afternoon when Donald Trump said what he did. The Sensex weekly expiry as well today. We need to watch out for that. The only positive, if you can call any, is the fact that the bulls yesterday managed to defend 23,800 on the downside. We have not closed below that 23,800 mark since the 12th of June, and reclaiming, of course, on the upside or going above 24,000 will hold the key for the index. That's going to be the important level to watch out for. For the Nifty Bank, unfortunately, there might be some distortion on the charts because the recent lows have been broken as well. The index closed below the mark of 57,000, so going back above that will be something that you need to keep an eye out for, because in case 56,000 breaks on the downside, the next support level is the June 12 low, which was 55,726. That are the two important levels to watch out for. Of course, the earnings of the day is going to be TCS. Numbers will be reported most likely after market hours, and the IT has been fairly volatile all through the week. There has been no clear decisive trend that you have seen in these IT names. Of course, along with that, Anand Rathi Wealth, GM Brewery is also reporting earnings in today's session. So for now, there is a lot to monitor for our own domestic markets, but of course the developments across West Asia and of course any further surge in oil prices with Brent remaining around $80 a barrel, that will also be a key monitorable to watch. Of course, over to Sudarshan now, who is here with all the important FNO cues. He had a busy afternoon yesterday as well with all the sell-off that you saw. Sudarshan, good morning. What is the kind of distortion that you are seeing in the FNO data?
Good morning, Harma. So till now we have read the madman theory only in the books. Now we are seeing practically it's in the play. And when that theory is in the play, you go into uncharted territory. And that's what we have seen in yesterday's trading day. How the Trump's basically statement has made the significant change in the market. At one point, till day before yesterday, Indian market was looking very healthy, and we were talking about the Nifty may climb to the levels of 24,600 or to even 25,000. Now we are talking about if Nifty manages to reclaim the levels above 24,000, we'll have to see. But if you talk about the indicators, you talk about 10-year bond yield, you talk about rupee, you talk about crude, these are the main indicators of our market, and everything has turned for the worse. For today, after yesterday's sharp fall, GIFT Nifty is indicating that we might open with a minor gain of around 50 to 60 points. But the main question would be, will we be able to sustain these gains considering all the factors that we have in the market? Talking about FIs flows, well, after the Trump statement, FIs have turned sellers in all the derivative markets you talk about, in the index futures, in the stock futures. They have reduced long position, they have added short position. So in the index futures, they have sold more than 4,800 crore. In the stock futures, they were seller and they have sold more than 1,500 crore. Longs, they have reduced by 2,500 contracts. On the short side, addition is more than 27,000 contracts. Now the long side exposure has reduced to 9%. Come to the options data. Major call writing that we have seen between 24,000 to 24,300. So on the put side, the two most active options, 23,600 and 23,300. On the call side, 24,200 and 24,300, and both these call options had seen a sharp fall in the premium. So now it tells you the range. So for Nifty, first support will be 23,800. If we fail to hold that, next support comes around 23,600. As far as resistance is concerned, everyone knows now 24,000 will be the major resistance or will be the major hurdle. Nifty Bank support would be 56,250 and resistance would be 57,264. These are also 100 DMA and 200 DMAs. If you talk about the stocks, all the EMS companies will be in the focus after government has announced about customs duty. Also Exide and Amar Raja will be in the focus. Shriram Finance, because after a sharp fall in the bond yield and the rupee, we have seen that stock has seen a sharp knock and has seen long unwinding. And keep an eye on all these OMCs companies and aviation companies because of sharp increase that we have been seeing in the crude price.
All right, Sudarshan, thank you so much for that exhaustive FNO update. But now let's go with what's next, and that is the International Monetary Fund releasing its July 2026 World Economic Outlook update. Now, the IMF has trimmed its global growth forecast and has raised its inflation projections. Ritu joins in with more from the report.
Well, let me start with India, which remains a bright spot in an increasingly divided global economy. The IMF says India will continue to be among the world's fastest growing major economies, even as it cut the overall global growth forecast. So the IMF now expects India's economy to grow 6.4% in FY27, which is 10 basis points lower than the April estimate, before the economy accelerates to 6.7% in FY28, which is a 20 basis point upgrade. Now, on a calendar year basis, India is projected to grow 7% this year and 6.4% next year, with growth supported by resilient private consumption and strong services activity. But the global picture is becoming more challenging. IMF has lowered the global growth forecast for this year to 3%, while raising the next year estimate to 3.4%. But even then, it says growth in the next 2 years remains below the 3.5% average that we saw in the preceding 2 years. The fund also says that the world economy has weathered this West Asia conflict better than initially feared, but the projections are also assuming that the Strait of Hormuz begins reopening sometime mid-July. Now, the report highlights there's also this growing divergence in the global economy, where countries that are plugged into the AI-driven tech cycle are outperforming the others, with the top 4 exporters of AI hardware, for instance, Taiwan, Korea, Thailand, and Malaysia, posting an average upside growth surprise to the tune of 440 basis points. Now, at the same time, World trade growth is expected to slow down to 3.5% this year before it recovers a little bit to about 4.3% next year. Among major economies, advanced economies are expected to grow by 1.7%, while emerging market economies grow a little faster. Now, IMF has also turned cautious on inflation, raising the global inflation forecast to 4.7% for this year before it cools down to 3.9% next year. So it expects energy prices to remain above the pre-war levels, with oil averaging about $89 a barrel this year, with crude oil, natural gas, fertilizer, food prices all expected to remain elevated. Overall, the risks are balanced compared to April, but they're still tilted very much to the downside. And IMF is urging policymakers to prioritize price stability, rebuild fiscal buffers, and invest in skills, energy, as well as digital infrastructure to be able to fully capture the benefits of artificial intelligence.
Ritu, thank you for that update there. Take a short break. All the cues from Wall Street on the other side. Stay tuned.
Welcome back. You're watching Power Breakfast on CNBC TV 18. Now, Fed minutes for the June meeting show that officials were split on direction of interest rates. Officials offered competing cases for hikes or cuts. Steve Leisman gets us more on the minutes released.
All members supported no change in the policy rate. Upside risk to price stability was seen as elevated. Downside risk to job growth had moderated. A few saw a case at this meeting for raising the target rate, but ultimately supported no change at this meeting. Before I say the rest of these minutes, I want you to remember, at this meeting from the dots or the forecast, 8 had a hold or a cut, and 9 had a hike. What that tells you is this was a divided committee. The rest of these minutes will reflect that division. So if it sounds like I'm contradicting myself, it's because the committee has different ideas. Several did not see current policy as restrictive. A few saw it as slightly restrictive. Most talked about a scenario where inflation would come down and return to 2%. In that scenario, all of these said it would be appropriate to maintain or eventually lower the target rate. Most also saw scenarios where inflation would remain elevated because of stronger AI demand, tariffs, Middle East, and the Middle East conflict. In those scenarios, all of these said some policy firming would likely be warranted. So if this happens, then they'll be hiking. If that doesn't happen, they can lower the rate or keep it the same. A majority highlighted the possibility that continued inflation above 2% could begin to infect inflation expectations and color wage and price decisions. That's an important factor from this, that there is that concern. Many saw the current rate at or slightly below neutral rate. Many also saw the current rate above target by the end of the year. Most agreed removing the easing bias from the statement. I'll leave it there, Brian, except to say that several saw price pressures had become more broad-based and price inflation ex-housing had declined little and remained stubbornly high. So these minutes, they don't sound like they're a monolith giving you a clear idea of which way the committee is going. They reflect a divided committee that reflects different concerns about inflation and where they should go with rates as a result.
Steve Leisman, thank you for those updates there. Now, in the U.S. markets, of course, it was a mixed session after U.S. President Donald Trump pulled the plug on the MOU with Iran. The Dow Jones was down close to 600 points, of course, recovering slightly from the day's low, but the Nasdaq was the outperformer, ending in positive territory. CNBC's Angelica Peebles gets us a wrap of all the action on Wall Street.
U.S. markets were mixed across major indexes in Wednesday trading after President Trump declared the ceasefire with Iran is over. The Dow was down more than 1%, losing 577 points. The S&P 500 fell 21 points, and the tech-heavy Nasdaq gained 52 points. The Federal Reserve on Wednesday released the minutes from last month's interest rate meeting. That was Kevin Warsh's first as Fed chairman. The minutes revealed members of the committee were split on the direction of interest rates, with some predicting inflation could ease to allow interest rate cuts, while others saw a scenario where prices stay elevated, necessitating hikes. In his post-meeting news conference, Warsh had called the debate a family fight that ended with a central bank holding rates steady. And a federal judge on Wednesday ordered that E. Jean Carroll be paid the $5 million set aside after a jury found President Trump liable for sexual abuse and defamation. Judge Lewis Kaplan ruled the money plus interest must be paid after the Supreme Court last month declined to hear the president's appeal of the 2023 civil verdict. He has denied all of Carroll's claims. That's what's happening here in the U.S. Back to you in Mumbai.
All right, thank you so much, Angelica, for that update. But now getting you the latest on Trump-related developments, we have Vinny joining us in our special segment, Trump Watch.
Hi, thanks so much for that. So first up, US President Donald Trump says that the United States has effectively won its military confrontation with Iran and claims Tehran has now reached out looking to make a fresh deal. Speaking to reporters aboard the Air Force One as he flew back from the NATO summit from Turkey, the president said Iran has a little left in terms for military capacity and suggested that Tehran is now eager to negotiate. He also issued a stark warning on retaliation, saying that Washington strike have been running at a ratio of 20-1 and that any further Iranian attack would be met with an even heavier response. Let's in fact listen in to his commentary.
And I say we hit up 20-1. Every time they hit us, we're going to hit them 20. And we did it last night. It did a little something today, but it was really retribution for last night. They hit actually 3 boats, not 2. And when they hit, we hit back much harder. We have many ways we can win, but we've already won militarily. They have very little left, and they want to make a deal so badly. They called a little while ago, they want to make a deal so badly. I just don't know if they're worthy of making a deal. I don't know that they're going to honor the deal. That's the problem.
Moving on from West Asia commentary to Europe. President Donald Trump also confirmed that he had ordered an immediate halt to all U.S. trade with Spain, a NATO ally, and escalating a long-running row over defense spending, and said that Spain's reluctance to fully back the Iran campaign is something that he did not like. Now, this comes despite EU rules requiring trade matters to be negotiated as a single bloc, not with individual member states. He renewed the criticism of Spain as a poor NATO partner and reignited his claims over Greenland before appearing to soften his tone, saying that there had actually been a lot of unity at the summit. Later on, he claimed that Spain had since come back and been more forthcoming, though he offered no specifics beyond saying that Spain had agreed to make certain payments. The claim that claim has not been confirmed by the Spanish government as of now. Now, finally, on to the last update, the future of U.S. troop levels in the European side. The president stopped the shot of committing either way and didn't comment whether he would take the troops back, said no final decision has been made yet, and tied the outcome directly to the talks over Greenland, play out how that is going to be moving forward, and suggesting if Washington does not get the kind of deal they want there, then troops drawdown from Europe could follow that as well. And that's all we have in today's edition of Trump Watch.
Thank you for that update there, Vinny. Take a short break. All the updates from the world of technology and AI on the other side. Stay tuned. Welcome back. On to the latest from the world of tech and AI. Rachna has hopped across to the wall for the AI Pulse. Rachna.
Well, first up is OpenAI that has confirmed that its GPT 5.6 models go public on Thursday, ending a 2-week rollout that was restricted to a handful of trusted partners at the request of the US government. Now, the Washington Review was the first time a US lab gated a frontier model behind a government-approved list, and OpenAI has said it does not want what is becoming the norm. A White House official has pushed back on the idea that it cleared the launch, saying no such permission is required. Then there's Bank of America that has extended a $520 million credit line to OpenAI, its first loan to the company. As per Reuters, banks are now competing to lend to AI firms to win roles on their listings. OpenAI filed confidentially last month, targeting over $1 trillion. Staying with the models, then SpaceX has released Grok 4.5, which Elon Musk describes as an Opus-class model, putting it in the same bracket as Anthropic's top systems. That comparison rests on the company's own benchmark, where Grok actually falls just short of the leaders. In what can be seen as a sharp reversal, then China is now planning to let its top AI firms buy a limited number of NVIDIA H200 chips, as per the information. Now, this is after we told you that China is restricting that, but now it seems it is allowing. Now, Beijing has blocked those purchases to push domestic chip makers, but a compute shortage is now forcing a rethink. Alibaba, ByteDance and DeepSeek have been told they may soon get permission. Continuing with chips, Apple is committing more than $30 billion to Broadcom, its largest US manufacturing deal so far. It covers $15 billion American-made chips through at least 2031. Part of Tim Cook's push to build domestic silicon supply chain, which is also a priority for the Trump administration. Overall, this Broadcom closed nearly 5% higher. Blue Origin is reportedly raising $10 billion at a $130 billion valuation, as per the New York Times. It is not confirmed by the company yet, but it seems like Jeff Bezos is chasing what Elon Musk did with SpaceX when it listed above $2 trillion. Then there's Meta that's building its first Canadian data center in Alberta, a 1 gigawatt site worth over 13 billion Canadian dollars. It will draw as much power as 800,000 homes running on cheap local natural gas. And lastly, US regulators have told driverless car companies to stop blocking emergency crews. Robotaxis have repeatedly stalled at accident scenes and driven through fire lines. And federal officials now want to fix this problem. That's all we have from the world of AI and tech for now.
Rachna, thank you for that update there. And of course, the big trigger for the day, earnings season is back, and TCS is going to begin that with the numbers being reported later this evening. Rima is joining us to tell you what the street is anticipating. Rima, morning.
Hi, good morning. So first, the quick numbers. Expect a muted quarter, no growth, flat kind of a top-line revenue growth. Constant currency growth, the broad range the analysts are working with is minus 0.5 to plus 0.4%. Margins for TCS will come under pressure on account of the wage hikes. Now, typically, wage hikes shave off 150-200 basis points in the top line. But because there was a currency tailwind, currency depreciated sharply in the quarter, it will partly offset that. So we're working with a 120 basis points reduction in the company's margins to 24.1%. Remember, there could be a one-time impact, a legal expense of $70 million that the company had to make. So that could come in below the line. So, broadly, the stock has been under pressure. It's down 35% on a year-to-date basis from commanding premium valuations. Valuations for TCS are now at 13-14 times, in line with the large cap average, perhaps even below. The question is, what can the company say now to change the narrative? I think no one expects growth to come back for large cap IT companies in a quarter or two, but what are the steps that they're taking, and how soon will the new work from AI offset the loss of work due to AI? And I think the graph of recovery is what the street is trying to assess at this juncture. But generally for Q1, expect a muted quarter.
Expecting a muted quarter. Rima, thank you for that update there. We take your leave on this edition of Power Breakfast from Rachna and me. Thank you for watching. Bazaar Morning Call sets you up for the day's trade, and we count down to the result season.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition. Thursday morning, we are coming to you live from the CNBC TV 18 Motilal Oswal studios. The situation has not changed very much. Oil still under 80. I think we got to about 80 on Brent oil last evening, but we're at about 78, between 78 and 79. So lots to talk about, but I guess that will dominate things. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi, morning.
Hi, morning.
Hi, good morning. But I thought when I looked at the US market action and the way it closed, and there was a bounce back in the last hour. So they closed off the lows. In a way, you get the sense that the US equity markets didn't react so much or shrugged it off. The reaction was there in crude prices, and at one point, it even topped that $80. So for us, it matters. But let's see how equities perform from here.
Well, that's right. You can read it anyway, right? You don't know what the man is going to do next. Ideally, he shouldn't be in this sort of a situation. Now, going by the yields, going by the deficit number out there, and going that midterms are there. But you can't say no to Trump, and he can do anything. So last night, a lot of commentary came in. And, you could lean to either direction. Either it's a de-escalation or it's an escalation. Yeah. Crude below $80 a barrel, that's a crucial
Or it's no war and no peace.
Yeah.
It's like a strange situation where there's no fighting, but there's kind of no clarity as well.
There's one opinion that I heard from the US markets yesterday. They were like, oh, war is on today, not on tomorrow. He's like, when that happens to such an extent, it just becomes white noise in the background and you can move on. So in a way, it helps.
That's what happened, right? I mean, I think towards the market started to look beyond. To the point, Reema, the US was largely unaffected even last time when there was actual. I mean, the underperformance was in oil importers like India. So, it matters. Well, let's just take a quick look at the setup as we start this morning. So, US launched further strikes against Iran. This was, of course, announced in a way, pre-announced yesterday in the evening when Trump said, well, we may strike Iran once again tonight. That was last evening. And of course, further strikes have happened. Oil's at about 78 odd dollars, actually closer to 79 than it is to 78. The 10-year yield is up another 3 basis points to about 4.58%. It's been moving up slowly, steadily. I mean, there was a big 9 basis point reaction and then another 3 last night. So this is the U.S. Central Command, and this is just a confirmation of the strikes and how we know that the strikes happened. At the direction of the Commander-in-Chief, U.S. Central Command forces have started conducting additional strikes against Iran to further degrade their ability to threaten freedom of navigation through the Strait of Hormuz. That was the statement. Trump, of course, said this yesterday, and that is essentially what caused this dire sell-off. Basically, he said the ceasefire is over as far as I'm concerned. It's just a waste of time. But then, of course, I mean, he also went on to say that, I would let the negotiations go on, although it's a waste of time and things like that. So he didn't really say that, this is the start of hostilities and start of fighting, etc. Again, he kind of sort of emphasized that whatever happens, it'll be quick. We don't want to prolong it. I mean, so all the indications seem to suggest that, this is, I mean, look at all of this as not the beginning of something completely new, but perhaps, the start to the final end. Now, the problem is the start to finish. How long will that take is the question. Because, as Pramit Pal Chaudhary of Eurasia Group said, well, and you've heard from him over the last many months that this in a way was to be expected. It was not supposed to be clean, MOU signed and, I mean, that's it. There were supposed to be bumps in the road, flare-ups, and perhaps this is that flare-up that we are talking about, the first of the flare-ups that we are looking at. But as beyond a point, no one knows, and we'll just have to sort of live with that uncertainty. You also had FOMC minutes, which were largely looked through, ignored. I mean, not really paid attention to, because I guess the attention was on a lot of this stuff. U.S. equities in the back foot. S&P was down about 0.25%. Nvidia ended about 4%. That helped Nasdaq, which was up about 0.25%. So tech actually outperformed what the broader markets did. And the report from the Information, which is a news outlet, essentially said that companies like Tencent, Alibaba, and others, ByteDance, etc., could start to buy NVIDIA's H200 advanced chips. Now, remember, Trump had allowed NVIDIA to sell these chips, but the Chinese government was stopping these companies from buying US chips because they want the local chip industry to develop. But I guess, I mean, I think it's for a limited quantity, some 200,000 chips is what the report says. So this is interesting in a broader context as well, beyond just what it meant for NVIDIA and, of course, for the Nasdaq last night. I'll just leave you with the levels. And, the market, of course, sold off aggressively, right? I mean, starting at about 1:50 p.m., from 1:50 p.m. to 3:30, in the 40 minutes, the Nifty sold off almost about 300 points, and we ended 2% lower yesterday. So 23,000. 880 or so is where we finally left off. 23,800 is the first support. And I don't need to mention that because that's the support that we looked to last time the market bounced these 500-600 points. It was respected and the market bounced from there. Now, if 2300 goes, because we're so close to it, then you're looking at the next support levels at about, it's a retracement level, but 23,400 roughly is the next leg lower. Sometimes what happens is, even if this is the start to the finish, the market tests these goes through some of these levels, makes a lower low, and then, there is a rebound once again. So will we turn right from here, from the 23,800, or is there another 400 odd points on the downside before the market starts to trade through all this noise is the question, really. GIFT Nifty, I think, is indicating a 0.25% higher start. It's about 60 odd points this morning in the green, so to speak. Well, Nigel has walked across to the wall with the F&O cues, the positioning. Nigel, take it away.
Well, first up, the Troika. That comes up for you on the screen. The dollar index is holding steady at around 101 odd. The good news is crude oil prices that briefly went over $80 per barrel mark, that's cooled off a little bit. However, the elevated US bond yields, that's normally caused Mr. Trump to step back. And this time around, that's the hope, because the US bond yields at around 4.58% odd. That's something that's going to be a little bit challenging. So that's going to be important to track from here on, whether or not that's the factor that causes him to pull back yet again. Well, our markets reacted yesterday to the re-escalation of a probable full-blown war. So you saw the markets that pulled back, the Nifty pulled back close to 500 points. Towards the end of trade, we popped up close to 80 points from the day's low. And the India VIX as well, popped up big time, more than 25% odd. Though it's still above that 15 odd mark. And also in the near term, if it doesn't get past that 18 to 20 odd mark, you'll be pretty okay out there. But you do want the India VIX to jump up from here on as well. So today, you'll be hopeful that actually the Nifty pulls back a little bit and the India VIX cools off as well. What has been encouraging in the last few trading sessions is the FIs, particularly from the latter half of June. They have turned mild buyers or they've been lower sellers. In yesterday's trade, from the institutional perspective, there was no big worry out there because there was that fear that we could see a big institutional number. However, it was only around 100 minutes of trade that they had to react to with regard to the negative news flow. So for yesterday, no worries on that. However, the FI positioning on index futures turned again very, very defensive or cautious. So they added, shorts in yesterday's trading session, and the FI net short positions, well, now they're the highest we've seen in the last 1 month or so. And the swing factor was close to around 30,000 contracts because they unbound some longs and they added some short positioning, which took the short positions to around 91% or thereabouts. And it appeared on stock futures, well, there was massive unwinding of long positions, and that could have put some pressure on individual stocks in yesterday's trading session. So massive unwinding of longs, so there were some shorts as well that covered out, but the larger, volume came in on the long side, but the FIs unbound some shorts. Not just that, besides what they did in the future space, they went ahead and they wrote calls yet again, telling you in the near term they expect some kind of resistance at higher levels. And because there was such aggressive call writing, the PCR is moving gradually down to the lower end of the range. The lower end of the range is around 0.65 to around 0.68 or thereabouts. Yesterday, the PCR ended at around 0.81 odd. So it came down drastically from around 1.1 all the way to around 0.8. Individual strikes that come up for you on the screen. 24,000 call, that was active, 50 lakh shares getting added there. On the downside, the 23,600 put, well, that as well was fairly active. So just looking at this put and looking at the premium out there, you'll have to say that in the near term, the support you're looking at is at around this 23,500 odd mark. On the upside, well, the resistance comes in at around the 20 DMA as well as the 100 DMA. That's going to be a bit of a resistance zone from the Nifty perspective. So in the near term, that's the range. If you move into the green today, you want to get past this band. You want to conquer this, which now becomes a bit of a resistance mark. The Nifty bank, well, at around 200 DMA, that's going to be the important mark. On the downside, it comes in at around 57,260. Extremely important mark. That's the mark that you're looking at on the Nifty bank as well. So keep an eye out on that level. So it's going to be an interesting trading session. The 200 DMA actually is the one that's going to be important from the Nifty bank. Let's see whether or not there's a pullback in the near term. Mr. Trump has all the cards.
Thank you. He's got the trump cards as well. Thank you very much for that. We'll watch for the IT sector as well because TCS comes out with numbers, though that's post-market hours. A quick check on Asia before we get things going. There was a little bit of rebound. Yesterday was a down day across global markets. There was risk off. But this morning, the Korean markets are up close to about 0.5%. The Japanese markets have a gain of nearly 2%. And the Taiwanese markets, too, are holding up in the grain. But let's get back to the big story, and that's the tensions in West Asia, and they continue to flare up. U.S. President Donald Trump has said that Iran has little left in terms of military capacity, and added that Tehran is now eager to negotiate. He also issued a stark warning on retaliation, saying Washington's strikes have been running at a ratio of 20-1, and that any further Iranian attack would be met with an even heavier response. Listen in.
And I say we hit up 20-1. Every time they hit us, we're going to hit them 20. And we did it last night. It did a little something today, but it was really retribution for last night. They hit actually 3 boats, not 2. And when they hit, we hit back much harder. We have many ways we can win, but we've already won militarily. They have very little left, and they want to make a deal so badly. They called a little while ago. They want to make a deal so badly. I just don't know if they're worthy of making a deal. I don't know that they're going to honor the deal. That's the problem.
Okay, the other big event on Wall Street was the minutes of the previous FOMC minute. They were for the month of June, but after that, we got the very weak jobs data. So in a way, the minutes of the June Fed meeting are a little backdated. But here's what they said. Officials were split on the direction of the interest rates. Officials offered competing cases for hikes or cuts, basically not giving you any indication of what the way forward is going to be. CNBC Steve Leisman gets us more on the minutes released.
All members supported no change in the policy rate. Upside risk to price stability was seen as elevated. Downside risk to job growth had moderated. A few saw a case at this meeting for raising the target rate, but ultimately supported no change at this meeting. Before I say the rest of these minutes, I want you to remember, at this meeting from the dots or the forecast, 8 had a hold or a cut, and 9 had a hike. What that tells you is this was a divided committee. The rest of these minutes will reflect that division. So if it sounds like I'm contradicting myself, it's because the committee has different ideas. Several did not see current policy as restrictive. A few saw it as slightly restrictive. Most talked about a scenario where inflation would come down and return to 2%. In that scenario, all of these said it would be appropriate to maintain or eventually lower the target rate. Most also saw scenarios where inflation would remain elevated because of stronger AI demand, tariffs, Middle East, and the Middle East conflict. In those scenarios, all of these said some policy firming would likely be warranted. So if this happens, then they'll be hiking. If that doesn't happen, they can lower the rate or keep it the same. A majority highlighted the possibility that continued inflation above 2% could begin to infect inflation expectations and color wage and price decisions. That's an important factor from this, that there is that concern. Many saw the current rate at or slightly below neutral rate. Many also saw the current rate above target by the end of the year. Most agreed removing the easing bias from the statement. I'll leave it there, Brian, except to say that several saw price pressures had become more broad-based and price inflation ex-housing had declined little and remained stubbornly high. So these minutes, they don't sound like they're a monolith giving you a clear idea of which way the committee is going. They reflect a divided committee that reflects different concerns about inflation and where they should go with rates as a result.
We'll have some global opinion perhaps in a bit as well. But let me just quickly use the time to run you through some interactions which are lined up on the program. 8:35, the management of Silver Touch Tech is joining us on the back of the order wins from Rights to develop an AI native platform. 9:20, Vikash Kumar Jain of CLSA is a market master of the day. 9:35, primary market rush and what to expect going forward. So we've got some guests joining us for that. HSBC's Yogesh Agarwal will be chatting with us, putting the spotlight on the auto and the IT sector at 9:40, 9:50. Capital markets and what to expect from their first quarter earnings with Jefferies' Supratim Datta. It's leaning towards more market and sector conversations through the course of the next 2 hours. And Lata, of course, at 10:15 discusses, has Somikanti Ghosh of SBI and veteran banker Rajkiran Rai on priority sector rules on banks and whether they need to be tweaked.
Okay, let's get in on the show. Hartmut Issel, head of APAC Equities Global Wealth Management and the CIO, Chief Investment Officer at UBS. Hartmut, thank you very much for joining in. How would you characterize the latest flare-up in the Middle East conflict? How serious is it, to your mind?
In my mind, we have seen a couple of those already. That doesn't really change the view. Right? If I think about both parties that are discussing, right? So you have about 3.5 months, you have a midterm election in the US. Do you want a high oil price? I think we all know the answer. And then also for the Iranian side, do you really want to, forego revenues via oil? Right? You also don't. So, it is a rocky path, no question about it. But, our base case is still, of course, it is working towards an outcome.
Okay, so you're not too worried about the statements that we've heard from Donald Trump or the fact that strikes have continued even this morning. So local media authorities are reporting that in Iran there are sounds of explosions being heard, but you think it's not going to change the narrative of and the investment approach to markets this time. So there is no risk of crude going back to what it was or escalation in terms of Iran taking a step to close the Strait of Hormuz. You don't see that happening.
Well, as an investor, you can never see there's absolutely no risk. But generally speaking, as long as the trend is clear, right, from both sides that are discussing now, and also with a bit of a timeline, right, because midterm election, as I mentioned, then I would say, yes, the base case for an investor should be or should remain that, yes, the strait goes open and you will see more flows.
Okay. What's your view on what the second half of the year is going to look like for the AI trade? Because what we've seen in the last 2 months is the Magnificent Seven and the hyperscalers have given way to the picks and shovels. So we've already seen the rotation within the AI ecosystem. And even at UBS, you have brought down to some extent your exposure to semiconductors, given how much they've risen. So in the second half of the year, how are you going to lean into the AI trade?
Yeah, I think it will probably continue a little bit the way we have recently positioned ourselves, which then also means it will go different from what we have seen so far in the markets completely. Right? So you will see, especially the hyperscalers, let's say in the US, to look at that place. Yeah, I mean, they still have some money, but they already moved from free cash flow to bonds, or to issuing bonds, and to some extent even equity. Right? So you do that when you going more on the later leg of your spending cycle. And of course, the market will also over time. It's not something you see not naturally materializing this year, but of course, everybody already starts thinking about next year, maybe the year after. So by and large, we haven't completely changed our view. But yes, as you rightly mentioned, the semiconductor side has come down recently in our selections, and hyperscalers starting to come up a little bit. I wouldn't be surprised if we do more of such steps than during the second half.
Hartmut, hi, good morning. Good to see you, Ben. Now, what about India? I recall in the past you've been fairly optimistic on prospects of India, but in the last 12 months to around 24 months, we've actually underperformed. Now, the scenario is such that, when the war broke out, crude oil prices spiked up and Indian markets underperformed. But now we have a bit of a stalemate that's going on. Crude oil prices still at very, digestible levels of around $80, $85 per barrel odd. Do you believe that India can actually outperform from here on? I ask this because we have been underperformers. The weightage on India in most parts of most global funds are actually relatively underweight. And now the hope is that earnings come back. So do you think there is a case?
I certainly think that there's a case to see some upside here for the Indian levels. And next to the Strait of Hormuz, of course, that's not, traditionally also, historically also for the Indian market, particularly positive. But I hope my view was also clear, and we're seeing the base case that it ultimately opens. But if I go even beyond that, I see two important points here for the Indian market, let's say in Nifty. One is the GDP side, right? So we have downgraded our GDP growth estimates, especially for the current fiscal year, naturally because also of the Strait of Hormuz. But now that it turns, we've actually upgraded it already a little bit. But more importantly, it sets a low bar. So it comes from a high level last year. It goes to we have a 6.7 right now. It goes back in our view for the subsequent 2 years to 7% point, right? So as an investor, do I want to wait a long time to maybe also take some advantage here? And then the other side, as you also rightly mentioned, earnings. And so we had 2 years in a row, fiscal years up until March, where basically you're growing 6-7%, and my number is close to 7%. That's not very high, especially not 2 years in a row for the Indian market. However, we believe we're going back to double digits. And that means investors will also take notice. And I think in the March quarter, we've already seen some evidence that it's happening. If I look at the loan growth in India and on the banking side, right, over 17% now. It's accelerating, right? So also here, I think there are reasons to believe that in terms of upside, India should also be part of. That doesn't mean necessarily other markets have to come down or not. I don't even think so. But India would be one of those where you can also see upside for the second half.
Got that. Hartmut, we'll leave it there. Thank you very much for joining us. Good speaking with you. It's a pleasure and a good conversation as always. Let's just quickly sort of, recap some of the stock action you will see on the other side on our top 10 segment with our research team. So Reliance Industries is right there. There's Exide, there's Amar Raja, Tata Steel, JSW Energy, IRB Infrastructure, Mahindra & Mahindra, there's Phoenix Mills, there's Ventif Hospitality, which are on the radar on the back of positive news flow. There's Danfac Industries, was the only one perhaps likely to open in the red, at least with regards to what is news related. We'll take that break. We are back with the top 10 segment on the other side. Stay tuned.
Welcome back. Yesterday, markets sold off nearly 500 points on the Nifty ending around that 23,900 mark, selling off in the second half of the trading session. But this morning, the GIFT Nifty is suggesting a slightly flatter side, even as crude prices have come up to levels of 79. Research team is standing by with CNBC TV 18's list of top stocks for the day. Good morning, everyone. We kickstart the earnings season, but at least from tomorrow. But at least for today, let's talk about the news flow. So Sudarshan, you go first. And you've got a mix of stocks, Sudarshan, Reliance, Exide and Amara Raja.
So it's in the back of news flow that government has reduced the customs duty for goods used in the manufacturing of lithium ion cell, and what it will do is it will reduce the input cost, and three biggest beneficiaries can be Reliance Industries, Amara Raja and Exide Industries. Why? So first, Reliance Energy's subsidiary Reliance New Energy is setting up a 10 gigawatt battery gigafactory in Jamnagar. If you remember, company had announced even the AGM of the same as well, and it's also one of the winners of government's ACC PLI scheme. So it stands to benefit. Second one is Amara Raja. It's a major player in the lead acid space, and it is also setting up a 16 gigawatt lithium ion cell in Telangana. Now Exide Industries, its subsidiary Exide Energy Solutions, is building a multi-gigawatt lithium ion cell manufacturing plant in Bengaluru, and which will lower the cost of importing and also will aid their commissioning phase if all these input costs come down. So these three companies are expected to benefit.
Got it. Thanks a lot for that, Sudarshan. Well, I'm looking at Tata Steel. It doesn't move the needle normally too much with regard to their operational update, but it appeared fairly good because the domestic volume growth was good at around 11%, while the European business operations are more or less in line. These are provisional volume numbers, remember. Let's break it up geography-wise. Tata Steel India, production was driven by higher output, both at Jamshedpur as well as at Kalinganagar, and the delivery was supported by better product mix. In fact, if we look at the automotive and special products vertical, that achieved the best ever Q1 volumes at around 0.9 million tons odd. So India was the driving force in terms of their numbers, and India is the driving force as well in terms of the operational performance. In terms of the European business, well, you have the Tata Steel Netherlands business, production as well as deliveries, they were impacted because there was a bit of a shutdown at the Drex steel plant in April 2026, but the market was aware of that. Moving to the UK business, well, remember Tata Steel UK, they are serving their customers basically by purchasing the raw material and supplying them the finished steel just to maintain the customer relation. So that's not really a big mover as of now. The big focus is going to be the work that is progressing with respect to the setting up of the 3 million ton EAF electric arc furnace facility at Port Talbot. So put everything together. India is the one that drives the numbers. India is the one that drives the earnings as well as the stock. So it looks fairly okay with regard to these provisional numbers that did come in. But going across to Vivek, he's here to tell us about JSW Energy as well as IRB Infra. Morning, Vivek.
Well, good morning. Two operational updates coming in from JSW Energy as well as IRB Infra. So JSW Energy has gone ahead and said that in Q1 FY27, the company has gone ahead and commissioned over 1 gigawatt or 1,081 megawatt to be precise of renewable energy capacity. The operational capacity of the company has now crossed 14 gigawatt, which is 14,535 megawatt to be precise. Now, in terms of the breakup, in terms of how exactly the capacity addition has been done, 442 megawatt of solar, 108 megawatt of wind, 381 megawatt of hybrid, as well as 150 megawatt of hydropower projects. Along with that, the management also says that renewable energy now constitutes 61% of the company's total installed capacity. Along with that, the company says that they are on track to achieve the FY27 renewable capacity addition target of 3 gigawatt. Within the first quarter itself, they gone ahead and achieved over 1 gigawatt. Now, along with that, an important update, the company has gone ahead and commissioned the wind blade manufacturing facility. It has a capacity of 450 blades per annum. On the other hand, have a look at IRB Infra as well. IRB Infra, its private InvIT as well as its public InvIT together have seen June 2026 toll collections at 808 crore versus a 631 crore figure on a year-on-year basis, which implies that there has been a robust 28% growth as far as toll collections are concerned.
Got that, Vivek. Thanks very much for that. Well, Mahindra & Mahindra is next in focus and Sud is back. Sud, morning.
Morning, Prashant. So after the monthly sales for the month of June, Mahindra & Mahindra management had come on the channel and said that company will be taking price increase very soon. It might happen in a week or two. So yesterday, finally, Mahindra & Mahindra has announced the second price increase of 2026. For the SUV segment, price increase is 2.7%. For the commercial vehicle segment, price hike is 2%. And the price increase is effective 10th of July. Remember, all the inventory that all these auto companies have, they have the inventory of the higher input cost, and that's the reason they are forced to take the price increase. And if you talk about all in the recent past, over the last few weeks, commodity prices have come down, but impact of those can be seen only after 3 months. So because of higher input cost, all the companies have gone ahead and taken the price hike, and recent one is Mahindra & Mahindra.
Thank you very much for that. Sonal now joins in to tell us why she's watching Phoenix Mills and Tanfac Industries.
Well, let me start with Phoenix Mills, where the quarterly update has come by and it was strong. We've been talking about consumption companies doing well. Well, the consumption at the mall for the company was up 32% on a YOY basis to come in at 4,700 crore rupees. They say that performance was supported by healthy consumption across the portfolio, and they saw double-digit growth across most of their assets as well. Their commercial property saw an occupancy of 72% versus 70% on a sequential basis, and their hospitality segment did well as well. Their St. Regis property saw a RevPAR growth of 15%. Their Agra property, which is Courtyard by Marriott, saw a growth of around 23% on a YOY basis. So going with green for Phoenix Mills. As far as Tanfac is concerned, now remember they had announced a preferential issue of around 173 crore rupees a while back. Yesterday they informed the exchanges that they're reducing that. The proposed size will now be 99 crore rupees and the price remains the same. It will be at 2341 rupees a piece. They had done it for a capex, but this time around they think the capex, lesser capex will be required, and hence this cut in preferential issue.
Thank you very much for that. Now over to Vinny to tell us why Ventive Hospitality should be on your radar this morning.
Hi, good morning. So we'll keep an eye out on Ventive Hospitalities. They've actually bought 420 acres of a restaurant property, and this is in the Mumbai region. This is for 282 crores. They'll be paying 100% for equity share as well as preference shares, which is going to be an enterprise value of 466 crores. So this is a resort that they are buying. Now, what does this resort do for them? This acquisition will increase their footprint, especially in the luxury resort as well as branded villa segment as well. And the timeline for completion of this acquisition is 3 months. An interesting one there. Furthermore, on the premium side of the properties, and that is why we could see some bit of a green here.
Thank you very much for that. Let's do a quick recap then. Stocks with positive news flow are Reliance Industries, Exide, Amara Raja, Tata Steel, JSW Energy, IRB Infra, M&M, Phoenix Mills, Ventive Hospitality. Tanfac could be the only stock that will open up in the red. Get into a break. On the other side, the management of Silver Touch Technology. It's a small IT company. Market capitalization is less than 2,500 crore rupees, but they won an order from RITES, and it's an LLM order. so to develop a sort of an AI product using LLM for rights. And the stock got excited yesterday. So we'll touch base with the management.
Welcome back. Hope you're having a good morning. Well, to help us out with some fundamental analysis, we have Dipan Mehta, Director at Elixir Equities, who joins us on the show. Hi, Dipan. Good morning. Good to see you win. Well, Dipan, Mr. Trump can pull anything out of anywhere. Yesterday, he said so many statements. One could, talk about de-escalation or escalation. So let's see how that goes. As of now, hopefully it's not escalation for the good of humanity, for the good of markets as well. Let's talk about individual stocks then. IndiGlobe Aviation, that was one of the top losers in yesterday's trading session. Now, they're the leader by a big margin. However, the near-term headwind could be that crude oil prices spike, which as of now is still well-behaved. That in turn would put pressure on ETF prices. And also it could hit travel across the globe if in case this war re-escalates. How would you approach this stock? It pulled back 5% yesterday, but it seems to have tailwinds still with it. Your take.
Another good morning and thank you for having me on your show. See, I think first a disclosure, we are invested in Interglobe.
Yes.
And frankly, I think if you want to play the aviation investment theme, that's the only company available to you. I mean, it's a market leader, 60% plus market share is no longer under threat. It's got the best expansion plan in terms of fleet size, number of seats, number of seat kilometers in terms of growth for the next 2-3 years is the best ever. It's just that these kind of situations, especially geopolitical events, does cause a lot of volatility in their earnings. But if you have a 3-5 year type of a view, then this company, I think, has got great prospects. And if you kind of, account for blue sky scenario for this company, then the valuation also is not that expensive. So I think it's a game of patience. This stock certainly isn't for the weak-footed because the earnings can be anything. And once I think the rupee stabilizes, the oil stabilizes, they have the pricing power to get back to their kind of operating profit margins, which were there prior to the starting of this war and other challenges. So very positive on the company, but one needs to be a bit more patient and have a longer term view.
Got it. Patient and a longer term view. All right. Deepan, let's talk about a sector that traditionally hasn't been your favorite. The sector that I track closely, the commodity space. Tata Steel. At 220 people are very excited about the stock. It's pulled back to sub 190 rupees or thereabouts. The street is fearing that maybe in the near term, earnings could be peak because steel prices have moved up. Costs have been more or less, stable. What's your view on this stock? They came out with their operational numbers and the production and deliveries of the India business, which is the driving part of their business, well, that grew by 11%, which is heartening to see. Your view on the stock at around 188?
I think, Nigel, very positive on Tata Steel. And again, over here also, because of the volatility in end product prices, you need to be a bit patient. But what is working for Tata Steel is gradual expansion of capacity. A new greenfield project has been commissioned and it is gradually ramping up as well. And they're also setting up minor capacities based on electric arc furnace wherever it is possible, like the Punjab new plant which is coming in Punjab. So I think the focus of the management has now gone back to the India business. And by and large, the overseas businesses, I think their propensity to generate losses and kind of impact the performance that has got limited. So very positive on Tata Steel per se. But as I said, I think, that HRC prices, structural steel prices can go up, go down. But on a longer term basis, this company can still deliver very decent returns. And I think the track record also has been pretty impressive last few quarters or so. So I would remain invested. And specifically, I know, Nigel, you track commodities. If I may take just 30 seconds more, if you look at every commodity price for the last 30 days, we have seen a decline. And many of them have declined for the last 3 months as well. So maybe you should, as an investor, temper your expectation, and whether it's aluminum, zinc, copper, whatever it is, I think you should expect that they're going to hit a soft spot maybe this quarter or next quarter, and that's certainly going to impact the business of a whole host of commodity companies, ferrous as well as non-ferrous metals.
Well, Deepan, just to make a point on that, as you said, they've hit a soft spot. But the counter argument is, for example, aluminium prices, which went to around $3,800 per ton. The street anyway was factoring in $3,000, $3,200 per ton. So anyway, the earnings that were being estimated was in that range, which has come to that range now. The problem is if it dips another $150, per ton, then they will actually have to, instead, there will not be any upgrades and you'll have to be, par for the course. But the street was hopeful that there could be upgrades. But take that point as well. Prashant.
Absolutely. Deepan, morning. IT kicks off TCS today. Thoughts?
Fingers crossed.
I love it.
Because these are challenging times for software services companies. Just yesterday, I was talking to a unlisted software company, their CEO, and he told me something that, now one engineer can do the job of 5 engineers. So, and the whole thing is about productivity and how well that engineer can use AI to complete his task. So I think I've never seen this kind of a disruption for the industry. TCS, Infosys were all about putting more warm bodies to work, getting larger and larger contracts, annuity type of contracts, and smaller, high profitable, consulting type of projects. But I think the scenario for them has changed significantly. I know the management will come out, saying very positive that they are completely aligned towards AI and they can handle, and that X percentage of the revenues is coming from AI. But 2 concerns remain. One is that AI has become a big leveling field, and the cost edge which Indian IT companies had, that is not as strong as before, the competitive edge, because engineer from anywhere in the world now is as productive and as cost effective as one from India. And secondly, that these projects certainly are not as profitable as those large annuity-based projects, and the base effect is the big problem with large cap IT companies.
When you verbalize that fingers crossed, Deepan, it sounds like a no. It's not fingers crossed.
I mean, I see a lot of investors are there in TCS. It's one of India's most highly capitalized companies.
I'll tell you what, we had Sumit Jain of CLSA yesterday, and he simply put it in numbers. He said, well, IT stocks are factoring in 1% dollar revenue growth. Historically, they've done dollar revenue growth of about 4%. Right? So there's a gap. Now, that's the only thing. And he also but he likes the space. He's one of the few analysts who likes broadly the IT services space. And he says, Infosys is saying, and McKinsey also apparently has put out, this is according to Sumit, that the volume growth will outweigh deflation pressures in the next few years. It'll take a few years. So you are in that phase right now. So yeah, I mean, it's a tough phase, tough spot, whatever you want to, however you want to call it. But we'll see.
If I can just summarize selectivity in stock picking. 3 or 4 will be handsome winners over here. The rest will struggle. That is my view on this sector.
But you don't know which ones, right? And it's too hard to figure.
Idea. I think the likes of, say, Persistent Systems, Coforge, maybe Happiest Mind. Then we have the kind of product companies. Newgen is there. There is Orion Pro Solutions, Oracle. I think these companies are pretty, I would say, pretty well geared for this disruption. And then there are sector-specific companies like Tata Elxsi. I know KPIT has had a bad kind of a quarter and they have come out with a warning. But because they are in a specific vertical, once that vertical picks up, I think that they will start to get traction over there. So handful of companies, but large cap IT companies is where the problem is, because $30-40 million contract will not move the needle for them. But for a Coforge or for a Persistent System, $50-100 million contract still makes a big difference and gets you that additional 2-3% type of a growth rate, which is better than the industry.
You own these names, Deepan?
As I said, I think, again, with usual disclosures that we and our clients are invested, Persistent System, Coforge, Happiest Mind. I think these are the three kind of multi-vertical companies which I think may benefit. And then there is sector-specific companies, Tata Elxsi, KPIT, and product companies like Oracle. Even Ramco Systems came with very good set of numbers. And then there is Orion Pro and Newgen Technology. So this is my complete list which I'm watching. One or two companies may come and go, but I would say that they are going to be, my estimate is that they're going to be the kind of winners who will be able to manage this disruption better. But we should expect volatility in their earnings, and we should also expect that because the industry's P multiple is being downgraded, these companies also may face that headwind.
Got it. By the way, Ramco Systems, if you can pull that up, is one of the, I mean, the rest is widely discussed, but Ramco, I mean, it's basically doubled in the last 1 month. I think, as Deepan said, maybe numbers came, it was $400 at about 850 now. And 400 at the end of May. So in June and July, whatever, the few trading sessions we've had, it's essentially it's doubled and huge volumes as well. Well, Deepan, stay on. The big movers from yesterday, which saw heavy volumes. Hormuz has got that list. Hormuz, take it away.
Morning, Prashant. And after a pretty long time, HDFC Bank's delivery volumes yesterday were lower than their 20-day average. But of course, big contributor to the Nifty downside in yesterday's session. Yet again, was the top traded stock on the Nifty 500. Reliance Industries, though, saw healthy delivery volumes. Eternal saw healthy delivery volumes, as did BSC. You were talking about Kalyan Jewellers in specific. Of course, the stock was an outperformer yesterday in a weak market. Snapped a 3-day losing streak. The premiums on the 380 call option went up by 150% as well. Volumes were the highest in 5 months, with over 5.5 crore shares were traded. The 20-day average of less than 80 lakh shares. 17% of those shares were marked for delivery. So around 91 lakh shares for delivery. The 20-day average was 21 lakh shares. It was the third most traded on the Nifty 500 yesterday, but still down around 40% from its 52-week high levels of over 600 rupees. Balkrishna Industries is one such name, was down around 4% yesterday. They're bringing this up because of the delivery volumes. 3.8 lakh shares were traded yesterday. The 20-day average is 1.5 lakh, but 85% of those shares were marked for delivery. So 3.2 lakh shares for delivery. The 20-day average of 80,000 shares is still down around 22% from its 52-week high levels. And lastly, Indigo, our fourth straight day of losses for the stock. Of course, the biggest single day fall since March was the day when the Iran war began, the 2nd of March. Premiums on the 5,000 put option went up almost 350%. 21 lakh shares were traded. The 20-day average is 13 lakh shares. Half of those were marked for delivery. So 11 lakh shares for delivery. The 20-day average of 7.5. And again, featured among the most traded stocks on the Nifty 500 yesterday.
Got it. Okay, all right. Thanks a lot for that, Hormuz. Well, let's hop across to Sudarshan. He's here to tell us about the various brokerage calls that he's gone through in the morning, and he's selected a few to present to us. Morning, sir.
Good morning, Nigel. So first one is Sirma SGS. HSBC has initiated coverage with a buy call, and target here is 1,750 rupees per share. It's a leading EMS company with a diversified customers base and original design manufacturing expertise. Backward integration and inorganic expansions will be key to growth. As far as the long-term margin drivers are concerned, it has mentioned few. First one is high export mix, second high engineering and low volume product mix, and third vertical integration. It also says that while competition is increasing, companies is placed favorably. Next one is pharma space. Jefferies has come out with a note. It has underperformed call on Dr. Reddy's and Cipla with target price of 1,040 on Dr. Reddy's and 1,120 rupees per share on Cipla. But it has a buy call on Mankind with a target price of 3,000 rupees per share. It says bearish view on Dr. Reddy's and Cipla and bullish view on Mankind have been strongly debated for a long time. But even in a blue sky situation, Dr. Reddy's and Cipla offer only 14%, 12% upside respectively. In contrast, Mankind's rainy day scenario implies 11% downside. But probability of that downside is low given early signs of a turnaround that company is seeing. As far as Dr. Reddy's is concerned, its upside is modest even under stretched assumption. And for Cipla, bull case hinges on timely approval of 2 US drugs. But on those, Jefferies believes that it's very unlikely. Last one is Indus Towers. Nomura has come out with a note, maintains buy call target here is 505 rupees per share. It says sharp correction in the stock price on nervousness with respect to Jio's Tennessee renewal, and it sees value in the stock even in unlikely scenario of Indus losing all tenancies from Jio, and base case assumes no major shakeup in Jio's tendencies and share price correction. Nomura believes it's overdone, and stock buying, if any we see from Bharti, it might provide the support. And as far as the valuation is concerned, Nomura believes that it's very undemanding.
Thank you very much for that. We will get into a break. On the other side, we'll invite the management of Silver Touch Technology to talk about their order win from REITs. Welcome back. You're watching Bazaar Morning Call. Let's invite the first management of the show, and that is Silver Touch Technologies. Now, the company has won an AI native order from REITs. To talk about this, we have with us Minesh Doshi, Director of Silver Touch Technologies. Now, this is an Ahmedabad-based company, IT company. It's been around for more than 30 years. It listed in 2017, originally on the SME platform, and then it migrated to the main board. And yesterday, stock was very excited, up nearly 5%. So, Mr. Doshi, you won an order from REITs to build Parak, which I believe, from our understanding right now, you're going to be using AI, you're going to be using LLM to assess the viability of projects that REITs consults for. Is that the understanding? Because REITs is a consulting company, a PSU company, so it's going to assess whether the bridge is viable or not, and you will be helping the company with that appraisal using AI. Is that correct?
Yes, thank you. So, yeah, it's very exciting project for Silver Touch because this will be a first sovereign AI model we'll be building for infrastructure industry. So Silver Touch will become like one of the first Indian IT company to deploy full-scale hosted multi-mode AI platform for government in infrastructure projects. So infrastructure projects sector is about 110 lakh crore. And it works in various domains like railways, highways, bridges, ports, airports, metros, and tunnels. So we are going to build the AI brain to assess all the DPR reports, whether project feasibility or various parameters on top of the AI models. So it's very exciting to see that how AI can help assess the projects and its viability and feasibility on various grounds.
Got it.
And we'll be working on more than 500 rules, which will be applied on this platform.
Okay. So I get that it's exciting, but it's not very remunerative. What we can understand is that the size of the order is less than 6.5 crore, 6.27 crore over 24 months. So, in that sense, it's not a very large order.
Yes. So I think, what's happening now with IT is that, domain plus AI is becoming the new product. So we have been transitioning from IT service company to AI native first product company. And we have already identified more than 100 plus infrastructure company who want to deploy such model in their company to benefit from the AI.
So what's the AI pipeline? AI pipeline for similar projects with 100 plus companies that you've identified? Is there a number?
Yeah. So we are working on 5 domains right now. The first is defense. Second is infrastructure. Third is power and energy. Fourth is pharmaceutical. And fifth is transport. So we have a healthy pipeline about, 300 crore rupees plus, on the various projects we are bidding and which is in pipeline.
Okay, so 300 crore is the pipeline that you have or the opportunity. Is that the pipeline or the opportunity that you're targeting?
It's the opportunity.
It's the opportunity.
The opportunity is what we are targeting currently.
Got it. What percentage of your revenues come from the government, the state government, or the PSUs? And these would be bid via tenders. So how are the margins, I presume?
Yeah, so I think, we are doing about 55% revenue from the PSU and government sector. And we are operating at margins of about 18% margin on such projects.
Hi, sir.
And the AI...
Yeah. Please go ahead. Finish that point.
Yeah, and the AI projects will, bring margin up to 25 to 30%. So that will be a price. And most important is, the product transitioning of the company will bring in more repetitive revenue and annual recurring revenue for us.
All right. Hi, Mr. Doshi. People talk about the market struggling. You must be a happy man, right? Your stock price has moved up almost 2.5 to 3x in a matter of 18 months. So the investors clearly see something big happening in the company. So we'll have to see how you deliver on that front. Let's get a couple of numbers then. Earlier this year, I think your order book was around 650 crores. What is the updated number, if you could help us out? How much of it is in India? How much of it is out of India?
So as I said, we are about doing 85 to 90% business in India and about 10% in outside India. So that's the major reason we are not impacted much, on the order book and the revenue what we are receiving.
Okay, got it. Now, in terms of delivery, could you tell us what kind of target do you have in terms of a revenue number for this year? What kind of margin performance can you deliver? And since you have been talking about a pipeline, you must be having an ambition, right? The next 3 years, what could revenues look like and what can margins look like?
So I can only tell you that, the past performance of Silver Touch, you can see which we have grown like 18% CAGR on the revenue. And we have big jump in the EBITDA. So we have increased EBITDA from last year to this financial year was 47%. So we are very hopeful to increase the EBITDA numbers and revenue as per the past trends.
So revenue can continue to compound at 18 to around 20%, and margins from around 13% have moved to around 18%. You see it get to the mid-20s. Would that be possible?
Yeah, that's possible with increasing AI and product revenue and annual recurring revenue we are targeting.
All right, Mr. Doshi, final question. I started the conversation by talking about the way the stock price has moved. Sometimes the promoter entity could get a little tempted, right? The markets are so good, might as well raise some money via equity. There is 75% promoter holding in the company. Is there any kind of plan to dilute some kind of equity? Because that would be top of mind, right?
No, at the moment, we do not have any plan to dilute any equity.
Okay. So your revenue growth has been coming down though. Last year, yes, you did close to about 18%, my bad. But the year before, it was about 28.5%. The year prior, FY24, it was about 37% growth. So while you've been expanding your margins, and that will continue to 20% plus, the revenue growth rate has moderated. So how confident are you about sustaining this 18%?
Yeah, so the reason is, we have been transforming company to more product driven, and we have significantly invested in the research and development and product development. And some of the revenue which was from the products, which doesn't add much value to the company, has been strategically reduced. And that's why you see the growth, although we have grown, on the revenue numbers, but some of the revenue which is not bringing higher profit, we have tried to reduce that revenue.
Got it.
So we are very confident with this strategy to move up the EBITDA margins and revenue as well.
Right, Mr. Doshi, we'll wish you all the best of luck. Thank you very much. Ambitious targets, and we hope that you meet them. Well, let's just go back to the IT services broader space, right? We spoke with Sumit Jain of CLSA yesterday. And, this is, of course, around the IT results which are about to come through. So I just want to play out some sound bites here. We'll take that break and we'll see you on the other side.
In the near term, we do believe that the deflation argument or the narrative will be stronger than the volume opportunity. We are still not getting any valid data points which flag that IT service budgets are shrinking with the Fortune 500 or G2000 enterprises. Yes, the deflation to the base business of IT companies will hit for the next 2 to 3 years as and when the large deals come up for renewal. But mind you, in every deal, the scope of volumes are also increasing. So I failed to mention, but TCS and Tech Mahindra continue to maintain the stance that the volume opportunity is higher than deflation in the AI world. I think this quarter is going to be weak. Accenture laid out the lay of the land by cutting down their guidance by 50 bips. And in this currently negative narrative for IT services sector globally, any guidance cut will further fuel the narrative of deflation being very strong. Tech Mahindra stands out clearly in the large cap IT space where they have two large telecom deals which will ramp up, one in this quarter and one in next quarter. And that's why we see Tech Mahindra's growth to be relatively higher than rest of the large cap names. Whenever a technology disruption happens, the mid-tier operators are always a bigger beneficiary because they can disrupt their business model much more easily and shift towards the new age solutions. And that's what we are seeing with both Coforge and Persistent.
Welcome back. I think we're 4 minutes to go for the pre-open session, 18 to go for the market open at 9:15. Deepan Mehta is with us. Deepan, yesterday you had these Balaji amines and alkyl amines, both which shot up sharply. Do you track them? Have you owned them?
No, but I think that the specialty chemical industry is now in for a nice uptick. And it's not just these two companies, but if you see the quarterly numbers last 2-3 quarters for the specialty chemical companies is doing well. I think the dollar depreciation benefits them because a lot of their contracts are linked to international prices and they may face some input cost increases and eventually they will pass it on. And last but not the least, whether it's Balaji or alkylamines or a whole host of specialty chemical companies, in the last time when there was a boom 3-4 years ago, they have expanded capacity significantly. And all of those are now coming at stream, thankfully at the right time, and demand also is picking up. So I think, again, we will see a nice upcycle in the specialty chemical companies. And certainly, I think whether it's Balaji or alkylamines, one should look at them more closely. Of course, yesterday's uptick was because of anti-dumping duty. And typically, I don't like such, reasons for the stock price to go up because it shows that they need protection. But on the whole, that particular investment theme is something worth pursuing.
Got it. Got it. I just want to quickly also highlight the asset management space, right? If you can put up HDFC AMC, ICICI Pru, Nippon, UTI, those stocks. And the reason I mentioned these names, on your screen, HDFC AMC, there's UTI, Nippon, and Birla. I mean, they're all, of course, large, some of the larger players out there, ICICI Pru as well. SBI Mutual Fund, the company is called SBI Funds Management, IPO. The pricing has been announced this morning. The pricing basically means that SBI AMC IPO is coming to you at a market cap of about just under 1.2 lakh crores. It is the largest AMC, both on the overall asset side and, of course, on the equity AUM. a little over 3,000 crores in net profits in FY26, which is the last reported numbers that we have from the DRHP, and growing at 20-25 odd %. So it's going to be an interesting space. One more, actually, the leader this time, making it to the market. Deepan, any thoughts here?
No, I think it's a good business, but the best way to play the wealth management is through the actual wealth managers. 361, Nuvama, Anand Rathi Wealth Management. And I think that they are in for great times now that the market is picking up. So the beauty of these wealth managers is that they have nice, steady annuity revenues. They keep on growing the business because the wealth effect in India is looking up. And that's a secular kind of a tailwind for them. And then when the markets start to do well, they manufacture products or there are certain special products they can distribute, which are kind of a high margin business. And we're getting into that phase just now. So rather than buying the asset management companies where there are regulatory risks and intense competition, I would prefer to look at these three businesses. Again, a disclosure that we and our clients will be invested in.
All right, Deepan, I wanted to ask you about defense. Kotak has come out with a note and they have initiated coverage on 3 defense stocks. On HAL, they have an add rating, but they are having a sell rating on Mazagon Dock as well as Solar Industries as well. And on Solar Industries, I think the target price that they are talking about is close to around 10,000 rupees, 10,300 rupees, while on Mazagon Dock, it's around 1,950 rupees. What is your view on defense? What do you like most? They are optimistic on HAL, and that's why they have an add rating. 4,810 is the target price out there. Your view?
Nigel, I think we are continuously trying to find stocks in defense which are reasonably valued, because the real challenge over here is that the sector is kind of, gone to a different zone when it comes to valuation. Good quality companies, whether it is Paras Defense or Zen Technologies, they're all trading at very expensive multiples. And what typically happens is, although the growth comes through, they may have 25-30% top line growth, but a lot of that upside has been captured in the stock price. So it's a challenge to find good quality stocks. But nonetheless, it's a sector one should remain invested in. No doubt they may be highly, P multiple wise may be very high, but I wouldn't want to sell them because they are high P multiple per se, because surprises keep on coming over there. I wouldn't want to give any names just now, but yes, of course, I think the PSU defense companies have been moving sideways for some time. And we expect fresh orders to come through for a lot of these companies, especially the shipbuilders, where there are delays in getting new orders. So as and when those orders are announced, we may see the sentiment improving over there and maybe a nice trading rally as well.
Got it. 30 to 50 times, basically, on FY28 earnings. But, the first leg of the re-rating happened as ordering happened. And now, of course, the execution. Ordering is still happening, but the bulk of the ordering has happened. And now the execution, translating into revenues, etc., will perhaps be in focus. I think we are at, 9:01. So should we just do the technical trades? I think we have Sudarshan with us and Mitesh with us as well. Gentlemen, morning. Good to have both of you here. Sudarshan, take it away. What's the call? And once again, a bit tricky. No one thought we'd get a 500-point sell-off, but it's not in our hands with what President Trump says and does. But what would you recommend?
My recommendation is that stay away. There is absolutely no concept of what markets will do in the next 1 or 2 days. Let there be some stability in terms of news, in terms of market action. Till then, this is a choppy, random, unpredictable market since yesterday afternoon, not before that. So for today, there's a very clear idea. Do nothing in the Nifty.
Yeah, stay away. Sometimes that is also something to do, which is hard to do, actually. Sudarshan, so in terms of specific trades, what are the ideas?
Well, it's Wipro, which is a buy with a stop under 170. National Aluminium is a buy with a stop under 345. BDL, Bharat Dynamics, is a sell, stop above 1365. And Vishal Mega Mart is a sell with a stop above 120. It's a mix, but today is not a very good day in any case.
Okay, so not a very good day. Stay away from the headline index. But Sudarshan, if to look at the heavyweights, which chart is looking the best? HDFC Bank, Reliance Industries. I ask you this, because in case the markets have to hold their own, these guys need to actually do a relative outperformance. When everything is fine, if these guys are more or less flattish, it's okay. But if you markets have to hold their own, 20% of the weight comes in just from them. Your take?
My take is financials. That would be banks. Yes, that's right. That should lead the rally whenever it comes about.
Yeah. Whenever that comes about. IT is bounced off the low, Sudarshan, lately, and just, I mean, we're on the cusp of the earnings season kicking off. Any thoughts here? Anything?
It's an investment idea. Buy the IT ETFs. There are a number of them. Don't try to pick and choose the stocks. If you want to buy a stock, then Tech M is the only one that's worth buying directly. Otherwise, the ETF is a buy.
You know, Kotak Bank, Sudarshan, has seen a bit of a breakdown, isn't it, in the last 5-6 days since the CEO MD stepped down. Any thoughts here, chartically speaking?
I'm not very impressed by Kotak generally. I try to stay away from it.
Try to stay away from it. Got that. The two exchanges, BSE and MCX, which have bobbed up and down. I mean, down first and then yesterday up, and then, of course, as the market sold off, they also came off. But any thoughts here?
Both are going to outperform, but not now. We can see that there is a steady correction going on. Let this end. But I think in the next few days or weeks, both will give buying opportunities, but it's not there today.
Got it. Okay, all right. Thanks a lot, Sudarshan. We'll touch base at 9:10 a.m. Let's turn our attention into the metal space. We have Aditya Velikar, the Senior Research Analyst Metals at Axis Securities, who joins us on the show. Hi, Aditya. Good morning. Good to see you win. Well, Aditya, let's talk about Ferris first, and let's talk about Tata Steel, because they declared their operational numbers. The domestic business looked pretty good. Production and delivery growth of close to around 10%. However, I'm looking at an article as well with regard to there is a pollution charge on Tata Steel's Dutch plant over alleged air pollution offences. This is not a new case. It's a dated case to the last few years. So first, how do you read the operational performance? And second, with regard to this charge at the Dutch unit, do you think it will be a dampener, or this is one of the many you hear with regard to ferrous players all across the globe?
Good morning, Nigel. So I think we look at the Tata Steel Netherlands as a continuing issue.
Okay.
We have been seeing the issues of pollution being raised by the local community there. So that doesn't affect the long-term investment case of the stock. What I am concerned about is that we are now just coming off of a strong Q4, and the steel prices are now entering a seasonally weak monsoon season. So we may see some tactical short-term correction in most of the metal packs. So if you want to take a long-term view, this downward correction could be a buying opportunity. But I will just wait and halt to just initiate a fresh long position call, because I see headwinds, as I said, because the Q4 was exceptionally strong. So we could see some correction.
Okay, all right. So you'll be looking at it closely, but you won't be jumping in. But when you're looking at these ferrous names, either the large ones or the ones from the broader market, could you tell us what is, the top of the pack? Jindal Steel is going ahead adding big capacity. But have various issues out there. Some believe that the cost benefit is not yet flowing through. However, there could be operating leverage in the years to come, because now they've got sizable capacity. JSW Steel, they've done their deal. That's the largest player. Would you like that, Tata Steel, or would you go with SAIL?
Yeah, so Nigel, I think all these players, all the four names you have mentioned.
The pecking order is what I'm asking you for. The pecking order.
So in terms of pecking order, first will be the JSW Steel, followed by Jindal Steel and Power, then SAIL, and then Tata Steel. Why I'm saying SAIL? Because now if SAIL gives some more correction from this level, it becomes a value buy, because the valuations could become palatable if it corrects further from these levels.
Got it. Okay. All right. And SAIL has corrected a large deal, actually. It was more than 200 rupees. So SAIL would be a top pick, right?
Yeah, it has corrected a lot, and it has, in recent quarters, it has executed quite well. Means its production numbers were surprising. So if we get a deep in the next 9 months, we could see a rally again.
Okay, SAIL could be one of the stocks. Let's talk about the non-ferrous part of business, Aditya. Everyone's talking about aluminium prices coming down from $3,800 to around $3,100 per ton. The counter argument is no one's earnings were factoring in anything above $3,200 to $3,300 per ton. In the first half of the year, they would be enjoying an average price of more than $3,500 per ton. So even if it holds at around this $3,100 per ton, then on an average for the year, it'll actually be in line or maybe a little bit higher than what everyone was estimating. What is the aluminum price that you are building in, the copper price that you are building in as well?
Yeah, Nigel, so if you recall in our last conversation, Vince, I have written a very detailed note on this and expected that the prices could drop. But the drop, even if it drops, even if we say a scenario emerges where Indonesian supply comes, the supply will come at a higher cost. So the sustainable prices will settle somewhere in between $2,600 to $3,000 per ton, even if the excess supply comes. So we are working with a price assumption of $3,000 per ton for FY27, and it may taper down to $2,800, $2,900 per ton in FY29. But that's the sustainable outlook we can see.
Okay.
As far as copper is concerned, yeah.
Copper, go ahead, please.
For copper, for copper, the prices have corrected a bit. It becomes slightly tricky to take a call because of the macro volatility in that. But anywhere above $11,000 per ton, $10,000 per ton is a good sustainable level. There is an immense shortage in copper concentrate. So, but the valuations of Hindustan Copper, that is continuously at a higher level. So one can also take a bet on at a lower levels for Hindustan Copper. It's a strong fundamental play in the long term.
So so would you be positive because Hindustan Copper's corrected from $650 to less than 500 rupees? Is it providing an entry opportunity similar as the case with Nalco, 450 to 350, Vedanta, 530 to around 450 odd? Among all these stocks, just naming a few, Hindalco as well to throw in the list, which would be your top buy?
Hindalco followed by Nalco and then Hindustan Copper and then the Vedanta group. Maybe Vedanta Aluminium ahead of Hindustan Copper, but I'll just wait. As I said, Nigel, that we expect that Fed may go for a rate hike or it may go for a rate cut. We are not sure. So the inflation scenario is very tricky.
So before we wind up, Aditya, just wanted to ask you, you'll be in wait and watch mode as of now on metals, right? On all these frontline ferrous and non-ferrous names.
Yeah, waiting for lower valuations.
But sometimes you look at the broader markets as well, right? I mean, you look at some of these smaller metal companies or maybe the metal ancillaries. I don't know whether you're tracking the graphite electrodes, maybe a rain industry CPC player, or maybe the other not so widely covered names like a Sham Metallics, Sarda Energy, or a Godavari Power and Ispat. Any of these on your radar?
Yeah, I track all these companies on a soft coverage basis, Nigel. So all these companies definitely provide some or other opportunity. Most of these companies are going for expansion. Sham Metallics, stainless steel expansion, Godavari Power is going for expansion. So a lot of opportunities, but one has to take a positional call. Graphite could be a play because electric arc furnace, that story is still evolving, but no sustainable visible signs to. Yeah.
But you don't have official coverage on any of these names. We wanted a buy rate. What should our viewers, it's 9:12, but what should our viewers buy if you had to buy any of these stocks from the metals pack, the listed stocks? Anything?
We don't have the coverage. We have a coverage on one APL Apollo Tubes, which is very value buy at this level, as I think so.
Okay.
The stock has corrected a lot.
APL Apollo Tubes, a stock that's actually not done anything, I think, in the last 2 to around 3 years, but a leader by a large margin, and that's one of the top buys. Target price on this one?
2250 is our target price. The stock has corrected a lot. So it's a lean period, but we expect a comeback.
And what about a JTL? Do you track that one? Smaller player?
JTL,
that's a 52-week high after correcting a big deal, so I ask you.
Yeah, that's right. But the situation is very tricky in this quarter. So it's quite volatile. So stick with the larger ones.
Okay, got it. Thanks a lot, Aditya. Have a good remainder of the day. Good chat. You're sounding a little bit cautious in the near term, but you're saying in the longer term, maybe some of this weakness could provide an entry opportunity. Let's get in Sudarshan Sukhani back on the show. Sudarshan, what's your call?
It's National Aluminium, NALCO, a buy with a stop under 345.
All right, National Aluminium. So thanks a lot for that interesting one. You know, if the war is going to break out, may not be good for equity markets, but some of these were actually beneficiaries of that because aluminium capacity got hit. There was unavailability of gas as well. And that's why we saw aluminium prices spike up. So let's see how that goes.
Well, yeah, absolutely. I just hope what does not break.
Yeah.
I think,
that's better.
I don't think you know. Let's
just from a market perspective, you know, you need to look for tactical bounces.
Stocks will fall this side, that side. TCS, Rima, what are we expecting?
Well, we're expecting nothing, right? Flat revenue growth, constant currency revenue growth range between the various analysts that I looked at was between minus 0.1% to plus 0.4%. So basically, it's going to be a flattish quarter on the top line. Margins will come under pressure. There is a wage hike. So the company was one of the few IT companies to stick with their routine wage hikes. They've given it 1st of April. Now, typically, wage hikes shave off 150 to 200 basis points on the company's margins. But because rupee depreciated by nearly 2.5–3% in the quarter, that will offset some of the pain. So net, the street is working with a margin decline of 110–120 basis points. There could be a bottom line impact because of the company settling a legal case, and there could be a payout of about $70 million. But given the way the stock is corrected, 35% down from the start of the year, valuations, which at one point of time used to command premium valuations, during the heydays of COVID, valuations even went up to 32 times, now is down to 13–14 times. So what does the company say to change the narrative?
Well, we'll see. We'll ask them because we will get the opportunity to ask them a little later. Well, markets have started 23,950. It is not a bad start. It's about 1/3% higher. The Nifty Bank is also starting about 1/3% higher. The mid-cap index, small-cap indices, much better. The mid-cap index is up a full 0.6%. The small-cap index also comes up with, I think, about 0.4% gains this morning. It's a pretty normal kind of start. And it's a good start. You know, that's let's see. Will 23,800 come back into reckoning? Because if it comes back into reckoning, then you're looking at you know, some more correction in that sense. But if not, as has happened so many times in the past, you know, it could act as a bit of a level from where the market makes another U-turn. Adani Enterprises, Eternal, Shriram Finance, Bharti are some of the top gainers. On the other side, there is HCL, TCS, TechM, which are coming off. So that's the picture. It's overwhelmingly in the green. About 41 names are up and the remaining are lower. Rima.
Well, it's good. It's not a bad start, all things considered. The Nifty Sensex up close to about 0.3%. And the fact that the 23,800, which was seen as the last important support for our markets, has held on. So yesterday we sold off sharply, but it looks like maybe the sell-off for now is contained, and today markets have moved on. The mid-cap index is rebounding sharp. Mid-cap index is up close to about 2/3 of a percentage point. Eternal is your top gainer, so we'll get you more on that, the reasons behind it. Shriram Finance, banking names like HDFC Bank, ICICI Bank participating on the upside. Titan has had a strong week so far with a gain of nearly 4%. M&M is one of the big movers. Sudarshan was telling us about the price hike, so that's aiding positively. Trend, a stock which was under pressure on account of the subdued business update, that is rebounding today. So that's got a gain of nearly 1%. SBI, remember SBI Mutual Fund IPO will open up next week. And ahead of that, SBI share price is also seeing a bit of a lift. On the way down, it's IT correcting. IT stocks have been rebounding over the last couple of days, so some profit booking. Infosys the most, and plus there is once again noise surrounding H-1B visa. Well, the company's dependence on H-1B visa has come down, but that is noise in the background, and that is perhaps hurting sentiment. So the top 4 losers are the IT names, and then you go down the curve, you've got a Dr. Reddy's, Hindalco, NTPC. But all in all, I think I'd say not bad. The advanced decline ratio too has started off 3:1.
Well, that's right. You know, Eternal is the one that's going to be in focus as that MSCI August review comes up. Motilal Oswal, their alternate research, has put out a note. They say that if it returns to full weight because of the decline that you've seen or the headroom that's been created on the FI headroom side, then there could be passive flows that amount to around $520 million. So that's a stock that's excited. It's already seen a big rally from the recent low, though it's a distance away from the highs that we saw. Swiggy continues its winning ways as well. That stock is up close to 3.5% after correcting big time from the top. Kalyan Jewellers, second day running, the stock is up now close to around 5%. It pulled back a little earlier. Yesterday there was a note that came in, I think, from a leading brokerage. It was up close to around 5%. Today it's up another 5%. What else? So, on the losing end, you have a couple of other stocks. Vedanta Iron and Steel, the stock is down 3%. But last few sessions, it was moving from circuit to circuit on the lower side. Now, at least that is freed up a little bit. Physics Wala, I'm not sure whether there was a large trade over there, but that one as well is down close to around 3% or thereabouts. Keep an eye out on that one. Grow, holding with a gain of 2%. Unichem Laboratories yesterday was up 20%, today it's up another 2% or thereabouts. And Cupid, the stock that fell 10% in the final hour of trade yesterday, suddenly it appears that one as well has perked up a little bit. So keep an eye out on that. A good start. We're almost at around 24,000 odd. The Nifty Bank. You'll have to bet on that one to lead the way from here on. That's the one that's have to lead the charge. It's moving to that resistance mark of 57,250. So keep an eye out on that one.
Okay, well, that is the picture as we start another session. This is a Thursday morning, 23,990 with about a 0.45 odd percent. Again, that's about 100 points, what that translates into. Vikash Kumar Jain is India strategist and head of India research at CLSA. Vikash, good to have you with us here. Thank you for joining us. It's pretty tempting to ask you about this entire Iran situation, but who knows, right? Who would have thought we would see what we saw yesterday? But let me just start with where were we 24 hours back, maybe even 48 hours back. Slowly, there was that big foreign selling number was turning to slight positive, and perhaps was not having that much of an impact on the market, and large cap still not, catching up to what the broader market has done. So just talk to us a little bit about from that prism. What are you picking up in terms of foreign interest? Where are we at? We're speaking after a while as well. Go on.
Hi, Prashant. Thanks for having me. So, see, whatever we say about foreign interest in terms of my conversations from 2 days ago will appear a little stale at this juncture. I think the discussion needs to be around what has changed. And I believe that things have changed materially. So there are two extremes that we are talking about. First is, if you were at the extreme, you would want to compare the situation to maybe going back to where we were in March and April. I would not really do that. I think the difference is that perhaps better confidence and understanding how to deal with the problem that we might face in the Strait of Hormuz. So I will, maybe the market that is why it is less worried, because it has seen a period where it was able to deal with that situation, and now it knows that, and in fact India did a pretty good job in dealing with that situation. So that's a little bit of a relief, that we don't exactly think that we'll go back to where we were in March and April, the start of the war. But at the same point of time, there was this discussion and thought process about a week or so ago where things appeared like they were, all falling into place. Commodity prices were coming down, yields were coming down, and at the same point of time, you could get some incremental liquidity due to the FCNR deposits, and all of that was what was fueling the rally. I think some of those things definitely come under question mark. Simply put, we come back to a more equivocal market. Not as bad as March, April, but at the same point of time, not as good as what we were envisaging July to be. So that's really what has changed. And the big challenge is, this is now an unknown. Honestly, the intensity with which statements have changed make us, kind of worry on how to really see the end of this crisis in terms of end of this war. It's difficult to really see how peace can come back rather quickly and that discussions could come back rather quickly. So that's the big uncertainty. And uncertainty typically isn't really good for the markets. So that's something that one needs to bear in mind. So maybe not as bad as March, April, but definitely not as good as what we were expecting July to be.
Vikash, so were you very constructive 2 days back, and now that view has been muddled?
Absolutely. So, we actually turned pretty constructive at the start of April.
Okay.
And in fact, I would say that last quarter was actually a reasonably good quarter because India was nearly the best performing EM after Korea. And
So if I had, this is Thursday morning, if I'd spoken to you on Tuesday morning, you would have been very constructive. Right.
in fact, we wrote a note on Tuesday morning. That was very constructive.
No, so I just wanted to get that. So you're saying basically it's just uncertainty and that kind of holds you back in that optimism.
It's not just holding me back. It's basically how you deal with that in terms of your portfolio construction. You really need to hedge your portfolio because there could be days like yesterday, which could come back.
So how do you hedge your portfolio, Vikash?
Yeah, so luckily in our portfolio, we are still overweight commodities. I think that was an active discussion in my mind that should I be shedding that? Now I will clearly stay away from shedding that. I believe commodities, some of the commodities which are more global in nature, are at a point where some of these stocks have corrected to price in much lower than current market prices. There could be some upstream oil stocks. There could also be some non-ferrous commodity stocks, non-ferrous metals. And I believe that these are potential hedges that one should definitely not let go of in their portfolio. In the current environment, which very well, I don't know. I mean, if you overlay the fact that we have a US, we have elections for the Senate in November, and also overlay the fact that maybe response from Iran has been delayed because of the ongoing mourning. This thing can actually continue for far longer than what any of us or what markets are hoping for.
So now to align your portfolio to a less constructive view compared to what it was, what changes do you think you will be making?
No, that's what I'm saying, that luckily I was about to make a change to a more constructive view, which I will not be doing anymore, is the point that point I'm bringing on, that certain commodities, global commodities, need to be a must-have. Those are the must-have hedges in everybody's portfolio today, I think.
You know, Vikash, we spoke with somebody from Eurasia Group, and I'm sure that you'll get experts to talk to your clients as well, right, around this, what to make of this. And Eurasia is one of the foremost think tanks, and their view essentially was that their point was this was always expected to have flare-ups along the way. This was not like a one-road thing, but they still believe that nobody's got the stomach for a fight, and the midterms are still coming. Nothing has really changed. They want, so this is not going to blow up into like it'll keep maybe simmering a little bit, but perhaps the start at the end. How long that will take is anyone's question. So my only thing is that if yeah, sure, if oil spikes another $20, then yeah, all bets are off. But why turn? You got to be cautious and maybe hedge, etc. But does it really change one's view fundamentally in that sense?
So Prashant, while what you're saying is true, that most geopolitical experts expected something like this to happen. But if you look at the way markets have reacted, see, we are market people. We need to focus on how markets are reacting, what markets are assuming. And the way crude collapsed, clearly there was an expectation that things are clearly on the mend. It will not get worse. I think that whole thesis is getting challenged. While geopolitical experts obviously know a lot, but popular opinion may not really align with expert opinion all the time. And I think that's precisely what has been happening. But at the current juncture, what you are saying is exactly the way markets are possibly pricing in, that, yeah, it will not get really worse. But my simple measurement or barometer of whether it gets worse or not is if we see traffic in the Strait of Hormuz picking up to pre-war levels. The expectation was that it will happen sometime in July or so. I really doubt that's going to happen. Now, if it doesn't happen, why we could be more vulnerable is many of the developed markets which were kind of funding this supply deficit by releasing inventory, they are now quite squeezed. Those inventory levels are quite squeezed. So every day that this uncertainty continues and traffic sustains at the current, say, 20 to 25, 30% of pre-war levels, things will get more difficult. Plus, if you imagine those ships which move out of Strait of Hormuz, looking at the attacks, they might get very nervous to come back in to kind of pick goods back. So all of those things, I think markets will simply look at those numbers and react, because sometimes when there is so much complications around geopolitics, around currencies, etc., markets tend to just react to whatever it can see. And currently, in fact, the reaction of oil to what has happened has been lukewarm. Although it's gone up from those lows, it's been rather lukewarm, and that's why markets are still breathing a sigh of relief. But I am less sanguine about it.
Okay, with your permission, let's move on to some thematic kind of ideas, because so much has happened, right? So I want to ask you about IT, because we had Sumit with us yesterday, and we had an extensive discussion around it. But I want to talk about industrials, capital goods, the electrification theme. I want to talk about defense, where the index is basically charging ahead. There is autos, etc. as well. So let's start one by one. The electrification theme, power. The most visible, best performing part of that theme is these transformer names, right? They still are 10, 15, 20% below all-time highs. What's your view here, Vikash, and what do you recommend?
So, Prashant, we don't really have a very broad coverage of individual transformer names, but power as a theme is something where, if you remember, the period around March, April is the point where some of these stocks, power utility stocks, were doing pretty well. And then they have corrected quite a lot. So I would say they represent some kind of safety in the portfolio. And since we are getting into a bit uncertain times, they typically tend to do all right in uncertain times. So clearly, when uncertainty reduced is when they started underperforming. And I think if uncertainty is back, they could again be seen as places to hide.
But you don't like them. I mean, this is just a hedge. That's what you're saying.
Yeah, I mean, see, we have to think of things from a portfolio construct basis on what you're playing. See, simple theme-based plays work when you are in out-and-out bull markets. Like current theme-based plays defense is an easy theme-based play. That might still work. But normal economic growth theme-based play can work when you have more visibility in the markets.
I'm just when there is actual demand, there's no doubt about it, right? It's a demand-led thing, and then it turns into a narrative, and valuations, etc., are high, but the actual fundamentals of it are there. So not to take it away. Same thing with defense as well. Valuations are high, but I mean, it's not as if demand is not there. Got that. Do you have coverage on defense names, and what do you like there, Vikash?
No, so we like defense as a space. I will not get into stock specific, as we know that we have restrictions on that. But yes, we do cover defense names, and we like that space. And given the way conflicts are picking up globally, that's also a theme, since you were talking of themes.
What are the other themes, Vikash, that you like right now? So there are two ways, right? Your portfolio sounds like a bit of a hedge fund. You've got long calls and you've got a bit of short, which acts as a hedge. So on the way down, the hedge side are your commodity names and perhaps even power utilities. So fill in both those brackets. Where do we get growth from, and how do you protect the downside?
Yeah, so I think if this war doesn't really if the intensity picking up, it doesn't really get picked up that much, then some of these names which are beneficiary from falling commodity prices, like autos, could be clear gainers. And that's one area that we like selectively wherever we find valuations to be all right. But on the other hand, even if that scenario plays out, there are certain commodity names, particularly, like I said, non-ferrous metals and upstream oil names. Those stocks have corrected far more than where spot prices seem to kind of recommend. So essentially, even with commodity prices not heating up further, they appear to be attractive to us. So the way to think about it is to look at potential scenarios and then try and take your risks about it, to kind of position for such scenarios. All that I'm saying is that in both of those scenarios, some of these commodity names appear to be all right. But on the other scenario where things are more manageable and we can continue with our normal kind of growth play setup, I think certain consumer discretionary names is what I would want to focus on. That's where, some of the, I would say we have bets on some retail quick commerce names also. At the same point of time, you have autos. That's another area that we like, and certain other more FMCG kind of names. So those are some areas that we are focused on in terms of playing the upside, and the commodities provide us a hedge against a particular scenario and also good value in the current market.
All right, Vikas, just to take that point forward, in the non-ferrous space, aluminum is something that you like as a theme?
That's right.
Okay, got that. Okay, got that. Because it's corrected a fair deal, but we have been making this point and telling our viewers as well that no one was working with those elevated numbers on aluminum in the first place. And because supply could be restricted, maybe there is some kind of, support that comes in. However, the Fed hiking rates that could, inversely, unfortunately, affect some of these commodity prices. So we'll have to see how that goes. But we get that point. You like non-ferrous.
Basically, the way to think about it, aluminum and oil currently are at levels where we believe that even with the war cool off, they are within 10% of what we believe their downside scenario, for those commodities are.
Well put.
We like those sectors.
Got it. All right. Let's talk about financials, because that's a theme you like as well. But let's drill it a little bit more into it. What do you like? The private banks, the PSU banks, or is it the NBFCs? And if we talk about NBFCs, you could help us out directionally. Which one is it?
That's right. So I think we are in a scenario, we are in an interesting setup from a perspective of financials, where the RBI may keep rates low for longer. And at the same point of time, we have seen yields go up from worries of the war, and that cool off might also happen. So you have no further rate hikes or cuts, or at least no further rate cuts, and yields still cooling off. I think that is the kind of setup which might actually be good for both private banks as well as NBFCs. And interestingly, if you were to just look at which stocks have done very well during when this potential peace-related narrative became more popular, I think rate-sensitive and financials have really led that rally. And so essentially, if things don't go out of hand, financials and consumer discretionary remain our big bets.
And one final word, Vikash, what does the CLSA proprietary bull-bear indicator tell you as of today?
So I would definitely want to share that, Rima, but typically that data comes out with a couple of days of lag. Okay. So whatever I have is quite dated now, given the big move that we saw yesterday. So it will take 1 or 2 days time for me to give me how things were at the end of yesterday's move.
All right. Thank you. Great conversation. Look forward to the next one already. Thank you. Okay, that's Vikas Jain of CLSA, in a way playing for a barbell strategy, positioning for the fact that if things are manageable, maybe the war, is contained, crude prices don't go up too much, so then he's got consumption names on one side. But in the event that the situation remains tense, uncertain, then he's also playing for upstream non-ferrous names and power utilities. So that's the CLSA strategy, but he does believe that the uncertainty in the market has gone up after yesterday's events. Vivek now joins in to talk to us about the biggest gainer on the Nifty, that's Eternal, and now moving towards a 4% up move. Vivek.
Well, that's right. So, what's actually changed in Eternal overnight is that the company went ahead and uploaded the latest shareholding at the end of Q1 FY27. And this latest shareholding actually indicates that there is now foreign headroom or foreign ownership headroom, which is now above 25%. Now, why is this particular number important? Quant analysts estimate that in the upcoming August review, MSCI may go ahead and once again increase the weightage of Eternal. Remember, it was already there in the MSCI indices. They could increase the weightage of Eternal in the standard index, and analysts estimate there are varying estimates, but anywhere between $520 to $600 million is the kind of inflows that analysts are estimating could come in the August review itself. Now, why is this important? This indicates that almost 7 days worth of buying is what Eternal could see on the back of this particular development. At this point of time, it's still an assumption or it's still an estimate that analysts are making in terms of the weight being increased in Eternal in the upcoming August review. Now, just some context. Last year, once Eternal actually went ahead and became an IOCC or an Indian-owned company, the foreign headroom reduced because the foreign ownership limit was reduced from 100% to 49.5%. So MSCI went ahead and reduced the weight of Eternal in the indices by 50%. Now, post the latest shareholding, there is enough headroom, and you could see a weight up again coming in Eternal, almost $600 million of inflows, and which explains the kind of impact that you're seeing in the stock today.
Thank you very much for that. Let's move on now to our first discussion on the show, and that's about the IPO markets and pipeline. Remember, next week, the first $1 billion plus IPO of 2026 comes in with SBI Mutual Fund, and the market is readying for other big ones like NSE, Geo IPO, and perhaps Zepto as well. Bhavesh Jain, Managing Director, Head of Investment Banking at Equirus Capital, and Karan Marwa, Head of CFO Advisory and IPO Advisory, Grant Thornton Bharat, now joins in. Gentlemen, thank you very much for joining in. Bhavesh, if we could begin with you. For SBI mutual funds, we understand that the interest is very high in terms of the anchor book, and a lot of foreign marquee investors are queuing up for an investment. So take us through the IPO pipeline from here on and what the mood is.
Yeah, good morning, and thank you for having me on the show. So I think IPO markets, there was always doubts, given the geopolitical situation and what was happening around the crude oil prices and macro, whether this is going to be sustainable. We have seen a good amount of IPOs which have happened in the last 4 to 5 years. But there was always doubt at whether this trend is now broken. And, frankly, we've been very optimistic about the IPO, and it is now turning back again. So tactically, the first 2 quarters were kind of low, but still we saw something like a 29 IPOs happening, raising about 22,000 crores. And we did one of the IPOs in last 3 weeks back, which really saw the retail investors also starting to come in, which actually shows the resilience this IPO market has. And I stick to my estimate of $20 billion that will be raised to the IPO market this year. And I think, yes, starting with SBI Mutual Fund, and we have this NSE, we will have Geo, we will have Manipal, we might have a few others who themselves will raise about 80,000-90,000 crores in the next few months. And I think we should be home to kind of do $20 billion for this entire year.
This morning, Bhavesh, this latest flare-up, blip, whatever you want to call it, right, will not cause an issue if it sustains. I mean, let's hope it does not. I'm talking about the US-Iran thing. Our last guest was pretty worried. I mean, I was surprised, but he was kind of, he was saying, well, I've changed my view and a little less constructive. And I know a lot of these companies were holding back, saying, well, is this the right time? Because sentiment was slowly getting better. What's your sense, Bhavesh?
Prashant, you've been watching these markets for a long time, and we all know that there's a good amount of discounting which has already been happened with all these uncertainties. So the uncertainty is a certainty now, so then hence it is not an uncertainty anymore. So, I think markets have taken all these events in their stride. The momentum is strong. I feel the macro with the crude oil prices coming down, etc., is the rupee dollar hopefully stabilizing from here is becoming very strong. We are seeing some early shoots of foreign investors coming back, issues like SBI Mutual Fund, which attracts a good amount of foreign investor, and we'll see more of that coming in. So that's a kind of change that we have seen from the last 1.5 years, where FIs had been pumping out money. So I think this is a very, very positive trend, and I mean, some of these blips may occur now, maybe even in the next 1 or 2 months. But I think markets have taken this in their stride, and I think things will be back to normalize. I mean, the show will go on.
Yeah. The uncertainty is now the certainty, so it is not uncertainty. I think we should, I think it's well put, but it is true. That's where we are at. Karan Marva is head CFO advisory and IPO advisory at Grant Thornton. He's also with us. Karan, good morning. Good to have you here. Your first thoughts? I mean, it's all lined up. Lots of, and it's being dominated by, at least the conversation revolves around these 3-4 large issuances, right? All the way till Diwali. But I'm sure there are lots of smaller companies as well prepping.
Oh, yes. Good morning, and thanks for having me here again. I think I would possibly echo some of what Bhavesh said, and I have a slightly contrarian view to some of what he said, given the times we live in. But I think to your question, clearly the market's been waiting for some of the larger issuances, and it's about time that they come to market. But I think we see a very, very healthy pipeline of about, I would say, 250 plus companies that are in the pipeline waiting to launch. And as you know, we've been talking about uncertainty. I think that's been the norm for a while. Last year was a bumper year as far as IPOs were concerned, but we've taken a bit of a hiatus in terms of issuances. While some have happened, I think a large majority have been waiting for some level of certainty to come back, if that's possible in today's world. So the way I look at it, I think given what's happened just yesterday and in the last couple of days again with the Middle East, given what's happening with El Nino, I would possibly look at it as a bit of a wait and watch again in terms of when some of the the other issuances that you spoke of come to market. And I think the other interesting point also is that when larger issuances come to market, the amount of capital that they're looking to raise is quite significant. And what does that do to liquidity and the availability of capital for some of the not so large ones is also something that I think issuers will need to sort of plan around.
Yeah. As we talk about IPOs and fundraisers and all of it, there's a flash at the bottom of the screen. The NSE is, they've got their first observations from SEBI in terms of the filing which they've done. And these are procedural in nature. We should have Yash join us in just a bit, hopefully to talk to us about this. But basically what we understand, this source-based information is that first round of observations to NSE has come through. And they're likely to be procedural. The NSE is expecting the final IPO approval, the final observations from SEBI by August, and of course the launch in September. That's the timelines we put out earlier as well, and we kind of sort of, I think it's a iteration of what we've put out earlier. Bhavesh, you want to sort of respond to some of what Karan said?
No, I think Karan is absolutely right. I think what happens is any market, you need to be very, very tactical, so while, there will be a positive undercurrent in terms of in the market, but, you always need to make sure that you're timing the IPO right, and you're not kind of, going in when the waters are very, very kind of volatile. So definitely the companies, when we also advise them, we have to be very tactical in terms of what we expect in the next 1 or 2 weeks to happen, and then kind of, go ahead on that basis. But frankly, I think structurally, I mean, the trend is very, very strong, and there is a leeway which SEBI gives in terms of 1 year window for an IPO to happen. So if not tactically now, it's going to be in the next few weeks or maybe next 1 or 2 months. But the good companies, good business models, good performance will always be rewarded with money. And we will see, some of these IPOs going very successful.
Right. Sorry, Karan, are you saying we will see deferments by companies if this goes on?
Well, I'm not. I think their deferments have already happened, right? We've seen a number of companies push their plans. Given again.
No, and they were all coming back on track. That's what. But you're saying that may be pushed out again if this continues.
Wait and watch. Hopefully, if this gets resolved quickly, as we all hope, I think then we should be on course. But I'm just calling out the fact that the large liquidity sort of that gets taken out of markets with large issuances will also be a factor in terms of when some of these come back in terms of the specific timing. But I agree with Bhavesh. I think the outlook is fairly positive. In fact, I think we see a huge sort of premium on preparedness And I think companies that are using this time to, just get the house in order, whether it's governance, whether it's financial reporting, will receive more, interest from investors. And I think that's also a trend that's, I think we're picking up, of course, in the last, I would say 18 to 24 months, where there is value for being better governed, where there is value for being better prepared. And let's face it, investors are being discerning in terms of, where they choose to put their money.
All right, final word.
If I may add,
Please go
I
ahead.
think on the preparedness, I think some of the companies in the private space were, in fact, even calling the preparedness, action off, given the uncertainty that they were witnessing in the market. But we are starting to see that, that at least that the fear that whether we should even start the work for an IPO, or whether we should start even the preparation for the work of an IPO, that has subsided a lot, and the activity which was on pause, so to say, for the last maybe 3-4 months has started to come in, so has started to pick up. So yeah, I mean, I think the companies, you cannot time the IPO, you cannot know when exactly your IPO will happen. You need to be prepared. So I think at least the extreme fear which the companies had is now out, and then they've now started preparing.
Okay, all right. Bhavesh, just a closing comment before we let you all gentlemen go. FIs have been sellers in the Indian markets, and that's well known, right? But they seem to have turned around a little bit towards the end of June. And the hope is that they don't sell as much as what they've been selling in the past. However, with these new insurances that are coming in there, one fear is that the domestic liquidity will get sucked up. But do you see a case where the FIs don't like what they have on offer right now, but probably some of these issuers will attract a good amount of money, so that may not be such a big problem for the Indian markets? How would you put the pieces together?
No, exactly. I think you hit the nail on the head. We personally feel that the IPOs which are happening in India right now are at very, very good valuations when you specifically compare this to some of the listed comps. And this presents a very attractive opportunity for a lot of investors to come in. I think there's a lot of work which all the institutional investors do before they kind of raise their hands to kind of invest. The pricing discipline is very, very high. So effectively, what you're getting as a product in an IPO from an investment standpoint is a very attractive proposition. So I won't be even a bit surprised if FIs start entering the Indian markets back again through the IPO route significantly, and kind of that kind of turning back into a flow in a big time into secondary markets later. And I see this trend continuing a lot. I mean, the bigger the issues, they will have to be. They can't afford that. Some of these IPOs come, the large IPOs come, the big nice business models of India. They come for an IPO, and FIs are not participating. It'll be. They cannot not have this in their portfolio. So they will be participating, is what we expect.
Well, appreciate you all joining in, gentlemen. Thanks a lot for your insights. Wishing you all a good day ahead, and we catch up soon, since the IPO market could get pretty hot in the coming months. Time to slip into a short break. On the other side, we have HSBC's Yogesh Agarwal, who will be joining in to discuss the trends in the auto and the IT sectors as well. Stay tuned.
Welcome back. Now back above the 24,000 mark. The recovery has been swift. We had a gap up opening, but the gains were about 0.2, 0.3%. And now we're building on it. 165 points up, trying to recoup part of yesterday's 500 point plus loss that we had, correction that we had in yesterday's trade. Look at the advance decline ratio. We've got nearly 2,500 stocks advancing for 380 stocks. And on the gainers list, on the Nifty board, you've got Eternal, Bharti Airtel, Sun Pharma, Max Healthcare, many consumption names, whether it's Nestle, Tata Consumer, these are all stocks with gains in excess of 1.5%. And banks too are participating in the up move, with the Nifty Bank itself up nearly 500 points. But it's time now to talk about sectors, IT and auto. Yogesh Agarwal, he's the head of research at HSBC India, and he closely looks at the IT and the automotive sector. Yogesh, thank you very much for joining in. Let's begin with the IT sector then. What is your view on the valuations and the stock price currently of the Indian IT? Are they below fair value, below intrinsic value, or do you think they're adequately priced? And by the end of this quarter, do you think there will be consensus upgrades, downgrades, or status quo?
Hi, Rima. Look, I think the valuations are pretty much at the bottom. We still don't believe that the sector will continue to decline going forward, which is one of the worries and which is what is showing in the valuations today. But we believe that this year, FY27, is likely to be the worst year in terms of the negative AI impact. And things will start to improve in FY28 and maybe go back to normal in FY29. And therefore, when you factor that in the long-term valuations, the 12-13 times forward PE, which the stocks are trading today, is probably the bottom. So we are not looking at any further downside from here. Whether things will recover quickly may not be the case as well, because this year is going to be a soft year, as I said, because this is the worst year in terms of deflation. And therefore, there is no rush for investors to start to buy into the IT stocks. So I think we are looking at maybe another 1 year of prolonged status quo. But are we looking at a significant downside? Maybe not. And in terms of earnings, this quarter, most likely we will see a slight bit of downward revision in the consensus estimates, because this quarter is likely to be slightly softer than what people thought maybe 2 to 3 months back.
So even if we do see, you expect earnings downgrades, but you don't expect a stock price correction from here on. The downside in stocks is limited, even though we'll get some downgrades in earnings.
Yeah, earnings downgrade, we are looking at 2-3% max, right? Anyway, so yeah.
Okay, so your thesis is that FY27 will be the worst impacted, FY28 will be impacted, but not to the same extent as FY27, and FY29 things recover. What are the growth numbers that we're penciling for all these 3 years?
Yeah, this year is probably now going to end up flattish to maybe 1-2% here and there. I think we could assume a flattish year. It obviously varies across companies a little bit, but at the sector level, we'll probably end up 0 to 2% somewhere there. Next year, probably low single digit as well. And then from FY29, go back to mid-single digit. So mid-single digit is where we were before the AI negative impact started. So we'll probably go back to where we were.
Okay, got that. And in terms of just one quick question on IT before we move on to auto, what can we ask the managements of the IT companies, or what can they say to gauge the entire AI narrative? I mean, what should be the pointed questions as an anchor that we should ask the managements right now to understand the state? And what can they say potentially to your mind?
I think firstly, stop asking how is your AI, because everyone says my AI is the best. So I think the key question here is the numbers, right? Ultimately, numbers have to talk. So this is going to be another soft quarter. So the companies have to, I think if any framework has to be put, the companies have to talk about the percentage of their business which has already gone through the knife in terms of deflation. So our view is last year was 15-20% of the industry which already got the impact, and this year could be another 40 to 50%. So at the company level, if they could start telling what is the percentage of their revenues which have already gone through the knife in terms of the AI deflation, that I think is a very value-added data to share. So I think that's the thing you should grill them on.
Okay, hi Yogesh. Let's turn our attention into the auto pack. How were the demand trends in Q1? Was it up to your expectation? Obviously, we had a lot of pain from the global markets, but how about the trends on the whole? What are you estimating for the remainder of this year? And which segment in autos are you most bullish on?
Yeah. Hi, Nigel. So the demand has been quite positive and very surprising as well because
okay. All right. I think we seem to have lost that feed. Let's get... Yeah, Yogesh, you're making that point. Please go ahead. We lost you for a bit.
Okay, sorry. So I was saying demand has positively surprised all of us in the last few months. And actually, if you step back, it's quite surprising because last year was supposed to be a flattish to negative year. And obviously, after the GST cut in October, things picked up very significantly. And just imagine the price cut for the vehicles were 5 to 10%, and we've already seen 3 to 5% price hike, right? But despite that, the demand has sustained very, very strong. So now the only worry is the second half base effect will start to kick in from October. But so far, so good. And actually, if you take a big picture view, India is actually not a penetration story, right? India, if you look at passenger vehicles, we have around 4 crore vehicles on the street. And if you assume the number of households who can afford a four-wheelers, they will not be more than 4 crore. So we are already there in terms of addressable market penetration. So the whole thesis is that more and more people will be able to afford, and the GST cut led to that. But the price hikes, the recent price hikes, and the petrol hike as well has not impacted demand at all. So it's been a very, very positive traction in the last few months.
So the best company to play the EV theme would be Ather, M&M. One stock if I had to buy, which one would you recommend?
Sorry, talk about stocks, but yes, I must say that EVs as a space obviously is a real penetration story. But think about it. Okay, the most pessimistic forecasts for EVs in the past few years have turned out to be optimistic as well. So EV penetration has not been to the expectations, but the recent war worries and the fuel hike has led to a sudden surge in electric penetration. So four-wheelers have gone up to 7-8%, two-wheelers is 10%. So in general, we are seeing a EV penetration pickup, but we still believe, I mean, if you take a 3, 4, 5-year view, at some point Indian government will have to raise taxes on EVs because it's a significant impact on the tax collections. And therefore, I think maybe 4 years out, the EV penetration will be mid-teens for cars and maybe 20-25% for two-wheelers.
Okay, thank you very much for that. Yogesh basically saying buy it in the next 4 years if you have to buy EV, because after that, the taxation, the SOPs, whatever incentives are coming through, perhaps will go as penetration.
Reema, you don't require a reason to buy all of this. Yeah, Reema is driving a
Okay, let's move on now. Let's move on now. And Yogesh, thank you very much for joining in. Always great to hear your views on the auto and the IT sector. Okay, move on now to another sector, that's capital markets. Devyani is now joining in. This is our special QSQT, that's quarter se quarter tak. We'll quickly prep you up how Q1 FY27 is going to look like for the capital market players. Devyani.
Well, a good quarter coming in for the capital market space. Now, Nifty gained 6.3% on a quarter-on-quarter perspective, while Nifty Capital Markets Index, that rallied 23% in Q1. Now, strong markets and mark-to-market gains are expected to support earnings this time around, but keep in mind the volatility that was seen in Q4 has set a high base, and as a result of which, quarter-on-quarter earnings might look softer. Now, coming to AMCs, the total expense ratio rationalization remains the key monitorable here. From a market share perspective, Nippon AMC is expected to be the biggest market share gainer, while ABSL AMC is expected to see the highest decline in market share on a quarter-on-quarter perspective. Now, the focus will be on whether the AMCs have successfully been able to pass on the yield compression to the rest of the value chain or not. Coming to brokers, lower trading activity versus Q4 could weigh on revenues, with PAT likely to soften on a quarter-on-quarter perspective, despite the growth that was seen in the funding books of these companies. Coming to exchanges, options remain the key earnings drivers, but both BSE and MCX have seen volumes come off March highs, which could result in muted quarter-on-quarter performance for both of these companies. Wealth managers are expected to be the most resilient this time around, with RTAs expected to see continued growth in non-mutual fund-based revenue. But the key monitorable this time around is going to be exactly who bears the brunt of the yield compression this time around. So that's the key monitorable here.
Okay, all right. Let's welcome Supratim Datta, the Vice President of Jefferies India, who joins us on the show. Hi, Supratim. Good to have you on the show. Thanks a lot for joining in. Tell us your brief expectations first with regard to the past quarter.
Yeah, thanks a lot for having me. So, see, what we think is that the stock businesses are going to do better than the flow businesses. So, the AMCs, we think, is going to benefit, one, from the other income rising, and two, they'll be better placed to pass on the changes in the base expense ratio. So, from that perspective, we are more positive there from a quarter-on-quarter perspective. And then coming to the flow businesses, I think on the exchanges side, you will see the ADTO going down, considering the fact that volatility has cooled off. So that will weigh on the overall growth of this segment. Coming to brokers, while here also the option trading being lower will have an adverse impact, we think that the strong growth in the margin trading book, along with greater adoption of commodity options, could be drivers that could offset some of this decline. And the other point to keep in mind is during the fourth quarter, there was some delinquencies related to the margin trading book that is unlikely to recur this quarter. So that we think that brokers might be better placed as compared to exchanges going into this quarter. Coming to depositories, this is a space that we have been a bit more bearish on. We think that the lower IPO revenues this quarter, price deflation in KRA, are key risks. The key monitorable here would be how the annual issuer revenue print plays out. We see risks here, considering that the RTA data, if you look at the FY26 RTA data, it indicates that the folio growth is going to be a meager 1-2%.
Okay.
So this is a space that we are avoiding.
Okay.
Yeah.
All right. I wanted to ask you that we just had a discussion on the IPO market, and we have two big IPOs that are lined up. From the space that you look at, SBI funds, their IPO, I think is the price band is out to be launched next week, and then all eyes on NSE. What would you make of the valuations, and how does it stack up with the listed players?
Yeah, I can't make stock-specific comments, but what we have seen globally, to give you some perspective on exchanges, firstly, typically global exchanges, the mature ones like, CME Group, CBOE, or closer to home, if you see the Hong Kong Stock Exchange or Singapore Stock Exchange, they trade anywhere between 2.5 to 3 times PEG. So for 12-13% growth, they would be trading at somewhere around 25-30 times. So and given India, the penetration is still lower. If you see the number of people trading in equities would not be more than 4-5 crores. So given the penetration opportunity, the product opportunity that we have, Indian exchanges could get a premium, or ideally should get a premium to the global peers.
I see. So you're saying, Supratim, hi, good morning, Prashant here. You're saying global mature exchanges with much higher penetration levels are traded about 25 to 30 times.
Correct.
Earnings. Yeah. This is trailing earnings, forward earnings?
Forward, 1 year forward earnings,
forward
if you look
earnings.
at. Yeah.
And in India, since penetration is low and the room for growth is higher, perhaps they should and could deserve a premium. Got it. I think you put out a note on NSE as well recently, Supratim. Sorry, you want to add?
I can't go into stock-specific things, but our view has been that, if you look at the Indian exchanges versus when we compare with global peers, few things that stand out is obviously the reliance that we have on equity options as a key revenue driver. If you see, give or take, for equity exchanges, that would account for 60-65% of revenues. Globally, barring a CME Group, the dependence on options as a product is a lot lower. And the other thing that we find globally is that the revenue from data and technology is much higher. That's again, an annuity revenue, which in India, is fairly low. So those are, differences. However, what stands out for India versus global exchanges is the margins that we operate at. We are significantly more profitable as compared to the global peers, and largely that, the delta in margin lies in the fact that our employee costs are somewhere around 600 to maybe 1,000 basis points lower than global peers, if not more.
That's an interesting point. You're saying that option segment dependence globally is low, except maybe a CME, and data-led revenues are much higher.
Yeah.
Globally. Yeah.
Correct.
Maybe we will also move towards that. I mean, I think the gold mine is the data, right? And I think at some level that'll also start to happen here.
Yeah. Only thing is, the caveat being that in India, a lot of the data is free, and in the US or in other markets, you don't get as much data as we get here, which is a pretty good thing.
Got it. Fair enough. I just want to come back to the here and now. The RBI moves with regards to bank guarantees, but also there was also these overdraft facilities for intraday trading, which kind of which went away, right? I think that had an outsized impact on volumes, especially on expiry days. What's your sense? I mean, what's going to be the durable impact of some of these changes which have happened?
Yeah. So if you see, we had put out a report, once the RBI lending norms had come into, the public domain. What we had highlighted at that point was, the impact on turnover could be somewhere around 10-12%, largely related to, domestic prop and domestic prop trading shrinking, because our view is that this regulation increases the requirement of cash in margin from somewhere around 50% now to 62.5%, and that should result in the cost of doing business on the trading side going up. However, see, we are not in the camp that believes that the recent slowdown in ADTO that you have seen in July can be attributed entirely to the bank guarantee issue, because bank guarantees, what we understand is the norm kicks in once the bank guarantee rolls over, and unlikely that a large chunk of bank guarantees would have rolled over on 1st of July. So it's going to be more of a gradual impact that you will see over the year as compared to a knee-jerk reaction happening in 1 or 2 days. So that's my view. Yeah.
Thing may all still be running, because once it's rolled over, it only kind of expires once. Yeah. But there's the other thing as well, right? Which is this funding, intraday funding, the OD facility, which has now been taken away. Maybe that is having an impact.
Correct.
While all the focus has been on bank guarantees, actually this has been this has perhaps caused it. Yeah. No, but we have seen, right, in expiries so far in July, we've seen numbers drop.
Yes. Correct. We have seen, both equities and commodities, we have seen, the expiries as well as, the overall option premiums go down. I think that trend, while we are looking at the July data, because, it's been sharper, two things to keep in mind is, the expiry timings also differ. And hence, we have to look at it on an entire month basis. That's one. And two, see, some of this is also due to the implied volatility, right? If the implied volatility is lower, the ROEs that a trader can make also goes down. And if the ROE, if you're not making a decent ROE, your cost of doing business has gone up, then less likely, you are going to keep those positions or, continue with those positions.
Supratim, lovely conversation. Thank you very much. Hope you come back and we can, there's enough to talk and we'll have more of Supratim and the debate discussion around, of course, exchanges with all these listings in the capital market space upon us. We'll take a break. We're back. Markets in focus with some F&O sort of updates and commodities in focus as well.
Welcome back. Well, let's take a quick check on the Sensex options data then, because remember, today will be the weekly expiry that will play out. And, initially it's quite interesting because some of those call buyers yesterday, late in the trading session when the markets pulled back considerably, they're actually making some good money today. So just to pull up a few, the 77,000 call, the premium out there yesterday by the time we wound up was around 110 rupees. This morning, you have the premium that's nearly doubled. It's at around 200, 210 rupees or thereabouts. So some out of the money call buying is what we saw yesterday. However, today the sense I'm getting is at around 200, 250 rupees, the writers as well are at play. As is the case with around the 7,400 call. Now there's a bit of a punt that was taken yesterday. For 50 rupees, the maximum you lose is 50 rupees. Currently, there's a mix of activity that's taking place out there because there is signs of writing with the premium at around that 55 to around 60 rupees or thereabouts. So just going by the call writing that we're seeing, at higher levels, there's going to be some kind of resistance that will come in there. The 20 DMA is going to be important. That comes in at 76,677. That's the reference point on the low side. And that's the level that, in fact, the bulls will not want to see in today's trading session. That's a firm support, actually, just for today's trade, 76,700 or thereabouts. On the upside, though, going by the options data that we just spoke about, 77,000 call, 77,400 call. Both those two put it together, plug in there the premiums as well. The range that you're looking at is up for you on the screen. The bears will want to defend this range for today's trading session. Volatility picks up in the final hour of trade because it's the weekly expiry. But that's the big resistance mark just for today's session. Well, I'll tell you what, we'll slip into a short break. But on the other side, Lada's waiting by. She's going to be discussing with Soumyakanti Ghosh of SBI and veteran banker Raj Kiran Rai whether priority sector rules in banks need to be tweaked. Stay tuned for that conversation.
Well, the SBI economist Soumyakanti Ghosh has brought out a report on banks' priority sector lending, and he has asked that infrastructure and climate financing be included in the priority list. This is an old demand. He has also asked for higher limits for affordable housing loans, solar rooftops, basically renewable, schools, hospitals, funding, etc. Separately, the Niti Aayog had also a few years ago requested that loans to EVs, electric vehicles, be included under priority sector, especially loans for EVs owned by drivers themselves, driver-owned commercial vehicles. To debate these, I have asked the author of the report himself, Soumyakanti Ghosh, and veteran banker Raj Kiran Rai, is former MD of Union Bank and now MD of NABFID. Gentlemen, thank you very much indeed for your time. Soumya, let me start with you. First, take us through your infrastructure demands. These are old demands, but exactly what are you asking for?
Yes, Lata, thank you for having me on the show. I think very quickly, the demand for infrastructure sector has been old enough. But why this demand has been made? Because there is just a reason for that. Because Today, what is happening is that in the total, if you just try to make it simple, the way priority sector is calculated is as part of the adjusted net bank credit. Now, if you look into the adjusted net bank credit, there are two ways, either organic, inorganic. Inorganic is basically in the priority sector lending certificates, which is now taking up 20% of the overall requirements. So why we are asking for this infrastructure sector? So there are two options. Either the infrastructure sector could be given a priority sector status, or the RBI currently what it does is that when the banks invest in the infra bonds, that is not taken as a part of this process. So what we are asking is that in the same vein, if either you take the infrastructure sector, give a priority status, or keep it out of the calculation of the ANBC requirement. Why you are asking it for the ANBC requirement? Because if it is kept in the ANBC requirement, suppose infrastructure sector is taken, then the ratios and the weights of the other sectors for the weaker sectors may get a little lower. So the best way is that either a priority sector status or keep it out of the weight of the ANBC sector. Or the third option is that whenever the banks are investing in infrastructure out of their own funds, let it be included in the overall priority sector.
Okay. Now, I'll tell you the problem with this, and let me get Mr. Rai on the matter. Who are the guys who are investing in infrastructure at this point in time? You have Adani Group, you have Reliance Group, which is doing batteries and solar manufacturing. You have the Tatas in Tata Power and data centers and semiconductors. You have Jindals, who are in ports and power. These are giants who will take all the money. Isn't a priority sector meant to go to people who will be otherwise ignored, like small farmers? Mr. Rai, do you think the Reserve Bank can ever buy this argument?
Yeah, we may have to present it differently. See, we should never make a case that to achieve our private sector targets, we have to tinker with these sectors or classifications and all that. But there is a good ground, actually, what Mr. Ghosh has put out, because see, initially, we should understand the basic presumption under which this priority sector lending started. It is for the socio-economic development, neglected sectors, neglected areas of the country where the credit flow should happen. And it has worked for so many decades, and it has done wonders for those sectors, whether it's agriculture, MSME, and others. So in infra, actually, there are certain sectors which need that focus. You mentioned about the large players infra. I agree with you, because if you put the whole infra under one bucket, actually, there is a lot of distortion. But there are areas in infra which need the focus where the credit flow should happen. Like social infra, when you say, is already a part of this priority sector, but the limits are very small. Whether it's renewable energy, whether affordable housing, whether it's healthcare, the education, basically. So actually there is a real good case. Because one more thing, the urban local bodies, which are responsible for this urban development, we are seeing actually, they are not capable of handling or raising funds to invest in urban infra development. Wherever the banks have entered, actually, because banks have that footprints in those areas, the financial discipline on urban local bodies also will improve. So there is a case for banks to get into urban local body financing to improve the urban infra, and where the limits can be even up to 200, 300 crores. Instead of considering very large infra under priority, so banks can create a very good area to invest and develop, and which will also help. I'm not in favor of tinkering with the classifications to achieve the targets, but then the focus should be to put the money into places where it needs. And urban infra is definitely affordable housing and all that area. Yes.
I take your point, Mr. Rai. As a banker, you would know that if an urban local body went with a very good project, like, say, Atal Setu or, metros, the banks would anyway finance it because they come normally with some foreign financing also.
Yeah.
Do they require enticement as priority? My fear is that those who are otherwise unable to get may get, excluded if something as large as an urban infra project comes in. Is that fear of the Reserve Bank, which I have heard in the past, a legitimate fear?
There is a case, Lata. See, if you look at the infra book of the banking, it is growing at very low single digits. Actually, the total infra book of the system is about 35 lakh crores. Out of that, hardly 13.5 or 14 lakh crores is in the scheduled commercial banks as of now. The rest, close to 20 lakh crores, is in NBFCs and AFIs like us. So the banks are actually literally not growing on infra book. There is a case that, because this is a very critical investment for the 30 trillion economy, the infra book has to double actually. So banks actually have to be pushed to do infra funding because they have a big ALM mismatch. That's why a relief on infra bonds, when the banks raise infra bonds, that relief is already given. So something can be extended to banks to push them because there is a big asset liability mismatch. So that is a good case for banks to increase in infrastructure lending, and some kind of tweaking in the private sector will definitely help banks to manage that ALM and also entice them to do more on infra.
Okay. That's very strongly made point, Mr. Rai, and maybe I should have an RBI governor or deputy governor to get their point of view. But I have heard very vocal points from previous governors and deputy governors that their fear is that the ignored segments may not get if infra is included, since this is a long-standing demand. But your point is extremely well made. Soumya, the other one, what are the other big asks? Isn't it climate financing?
Yeah, Lata, just one clarification to the entire discussion. I think that's why, and this is exactly addresses the concerns which you made, that if infra loans is added in the private sector, it may distort the lending. That is exactly the reason why you are asking that one of the other options is that take the infra loan out of the NBC requirement. If you include the infra loan, it is the ratios of the other sectors could actually decline. The point which you forcefully made, and that is correct. So the other option is that if you take out the loan from the NBC requirement, then it will be even more easier for the banks actually to meet the private sector lending commitment. So that's the other way of looking into the things. Okay. Now coming to the other point, I think the other points are also
climate financing and raising the limits.
Housing loan limits needs to be increased. I think if you look into the overall affordable housing loan limits today, I think 50 lakhs is the limit, which of course is something which needs to be looked into. The education loan limit of 25 lakhs, the renewable energy is at 35 crores, and on individual solar tops it's at 10 lakhs. I think these numbers need to be significantly advanced. And the other important point is that the agricultural sector, if you look into it, apart from the farmers, there is also allied activities, and for that the government has created a special agricultural infra fund. So to make that fund more attractive, maybe that limit could also be raised. And the points with Mr. Rai also mentioned, the school and healthcare, which is the social infrastructure. And of course, ESG financing could be carved out as a separate niche area for the banks to concentrate on this green funding.
There again, the Reserve Bank's point in the past, actually, to be fair to the Reserve Bank, they changed these numbers as recently as April 2025.
Yes.
So it is not as if this is, some 2011 or 2015 numbers and it has not been adjusted to inflation. It is only a one-year-old number. And therefore, to demand that, now inflation has made this number a little archaic doesn't work. Their worry at that time, in 25, when we had this discussion with them, their point was, if you give 200, as you say, 200 crores or 500 crores as a limit for agri-infrastructure, that's get taken away by some corporate entity. It doesn't go to a small farmer cooperative. The idea of inclusion gets excluded if you do that. So that's their argument.
Yeah, but I think, I take cognizance of that argument. But if you actually look into the numbers, all banks are actually lending to the farmers. And if you look at the small and marginal farmers, the KYC norms and other things, I think 7 crore small and marginal farmers. So there is an agricultural sector credit growth actually has been expanding at quite a decent rate. So my simple point is, yes, the central bank, the RBI Reserve Bank has revised these limits last year only. But I think some of the sectors, the limits may be looked into, or may be looked into a little bit different paradigm, given that the changing needs of the lending infrastructure of the banks in the current scenario.
Fair point. Mr. Rai, unfortunately, it's a short segment and I'm out of time. But you know the space best. As a career banker for probably 40 years and now in charge of infrastructure, what would be your ask?
Yeah, I like some of the points Mr. Ghosh has made out are really to be considered, particularly on the social infra side. And his point on agri-infra, See, the point, I will not take that point that big corporates will come and invest. It is good if they invest because the beneficiary is the farmer. See, we are producing enough agriculture products actually. The storage, the transport, this is the issue. Even if corporates go and invest in warehousing or cold storage, it should be welcome. And keeping them under priority and encouraging banks to lend to that is a welcome thing. Like, now we need to really change the way we are looking because the banks are well tuned to do agriculture, MSME and all that. Getting some sectors like social infra or agri infra into priority sector lending is a good ask at this point of time. Because now we need to move up the value chain. Actually, farmers need storage now, warehousing. Yeah, so it will be a good case. Even if corporates come and invest, it will be very welcome.
Okay. Fair point, sir. Unfortunately, out of time, we should have a longer debate on this. Well, actually, nationalization of banks and priority sector both came around the same time in 1970. And now it is 50 years or even more, 55 years after that. Maybe a general debate on both these issues, nationalization and priority sector, whether it should be actually directed lending, is a good debate to have. Thank you very much for starting and whetting our appetite, Mr. Rai and Xiaobyu. That's it on this edition of Bazaar, and it's the economy after break. Chartbusters.
Dr. Reddy's flags issues with APIs for the commercial supply of semaglutide. The stock slips but has come off from lows.
The government exempts goods imported to manufactured displays from customs duty. Stocks of Dixon Tech, Sirma shares, both of them rally to around 4.5%.
IT bellwether TCS will kick off the earnings season after market hours today. A muted first quarter is expected from the company with a dollar revenue and margin expected to be lower. The stock trades with cuts of about 2%.
Phoenix Mills reports strong growth in its malls business with consumption rising more than 30% year on year. The stock gains close to around 2% as JP Morgan also issues an outperform call on the stock.
Eternal is the top gainer on the Nifty 50 today. The stock has an FII ownership headroom of about 25%, and analysts expect up to $600 million of inflows, with the MSCI set to increase the stock weightage in its August review. The stock has slightly come off from the highs and has surged over 20% in the last 1 month.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and with me is Vinny. Hey, Vinny, good to have you on the show. The folks demanded that there's too much of bromance that's taking place, so we have brought in a bit of a glam factor with brains. Vinny, welcome to the show.
Thanks so much for that, Nigel. But
all the glam factor also comes in from you and Mangalam as well. But today there's the glam factor coming in for the markets as well. Despite, the geopolitical tensions, a lot of commentary that comes in here. Today we're still managing to hold on to some bit of a gain. We're holding on to the 24,000 level, 0.6% of gain for the Nifty 50 is what we're watching out for. Also in terms of sectors, realty, pharma, that's doing well. So that's something that is managing to hold on to gains. IT on the flip side, Nigel is not managing to hold on to gains. We'll have TCS that will come out with its numbers today as well.
Okay, all right. Let's get then to an IPO that's opening up. We have Mr. Dinesh Kumar, the managing director. We have Mr. Dinesh Kumar of Rishabh Instruments, who joins us on the show. And, we're going to be running through the discussion points as well. The demand trends across various segments, the data center opportunity, as well as the update on the medium voltage transformer segment. Well, good to have you on the show, and thanks a lot for joining in. Yesterday we were looking at the screen and there was a weakness, but on your counter, Dinesh, there was a lot of excitement. Could you tell us how the demand trends are on ground and what kind of growth guidance can you give us for this year?
Yeah, Nigel, good morning and thanks for having me on the show. And it's been a while that I've been on your show now. And we're happy with what is coming out in the stock market, but the fundamentals have remained the same that we have been talking. And in spite of whatever global situation that we have had, so last 4 quarters, we have delivered what we committed all along. Especially our electronics instrumentation sector has been doing extremely good all across our business continents, India and USA, Europe and UK, all the geographies have been doing good, and this is fueled basically by upsurge in energy optimization and unconventional energy sources that have come up.
Let's get some numbers going then. In your EEI segment, you were guiding for around 20-25% growth, margins in the vicinity of around 20 to 22%. Could you help us out? What's the current order book looking like and any tweaking to this guidance?
See, normally we in electronics business, so we have kind of a forecast. We don't have a thick order book. It's always, we have order book of typically 1 to 2 months, not more than that, and it keeps on coming. So we see a big surge in, low voltage and medium voltage coming because of, data centers, AI data centers that are coming up in USA, India, and Ireland, and parts of Middle East also. That's something which has been fueling the growth. And obviously, as the cost of energy is going up, and people want to have more optimization of the resources, and that also triggers in some capex everywhere. In spite of some of the international markets have increased their spendings on military side of it, but still energy sector is continue to grow because of upgradation of distribution networks, and most of the countries actually in Europe, as well as in countries like India, Latin America and Africa. There's a lot of project spending which is happening. So our business is driven by two parts. One is coming out of new projects, spendings in developing countries, and in the developed countries, more on upgradation and energy optimization initiatives that have been going on.
Okay. Hi, Dinesh. Good morning. This is Vinny joining in the conversation. You're talking about the transformer side, medium voltage, low voltage. You have that in your plans coming in, and we've heard this in your con calls as well. You highlighted the data center opportunity. Could you help us understand how much of your current order book is coming in from here, whether US or other markets on the data center point of view, and the medium voltage point of view for the transformers? How is the R&D moving there? I believe you all are going to commercialize that by the end of this year?
Yeah, so for as far as R&D is concerned, we have had this whole pipeline of products for the next 5 years, which we finalized last year. So this is like 5-year product development plan which we have, which extends from low voltage products to medium voltage products, and we keep on adding about 12 products every year from our 7 R&D centers spread over all the continents. And these are all R&D efforts which are happening with joint project. So somebody in China is making hardware, we are making software, and somebody in Poland is doing some other product line. So it's all coming through there. And we also are expanding our capacity in here in India. So two multi-storied buildings in Nashik, which are the buildings are all ready now, and slowly we are moving in there. And this is an expansion which is targeted at more than doubling our sales in the next 3 to 4 years time. So that's coming very well. So we see that because we have got so much of product group, about 145 product groups we have spread over so many continents and so many industries. So we are kind of immune to something going wrong in any particular industry, because energy is consumed everywhere in almost every industry. It is there. So from that perspective, we are kind of you can say not too much dependent on any particular industry.
Absolutely, you're not too dependent on any particular industry, but just for our understanding purpose, if you could help us, you said doubling your revenues in the next 3 to 4 years. How does this opportunity for the transformer side work? Specifically, why? Because transformers are facing a shortage globally as well. So then what is the opportunity for you here? How is the inquiry and that order book, especially for low and medium voltage, how is that moving now? Or are you seeing more inquiry?
Just to give kind of quantify that, we produce this low voltage transformers about 6,000 a day. That capacity we are enhancing to 10,000 a day. Just an example. So we have a order pipeline or a forecast to support that kind of a growth, and that's coming thick and fast from USA particularly, and parts of Europe and India. So as I said, it's a business where we sign some contract, but not a very long-term contract when it comes to electrical instrumentation business. So we see that growth pipeline, and we keep building the capacity, and we keep on delivering. So the booking to billing cycle is relatively smaller, about a month or 2 months at the top. So that's where the cycle comes, and we have got a lot of indicators to do that. And also we are expanding our capacity to do more of a medium voltage transformers also. So you're right that there's a shortage of transformers coming out of demand for energy. All these AI data centers, the base is energy, and then you have computing power and apps, and everything comes like it's like a pyramid, as has been spoken about. So we are very much there as a base where you need to have energy available, and also quality of energy and efficiency of the energy.
Got it, Dinesh. Quickly, two numbers. 750 crores becomes 1,500 crores in the next 3 years. Going by what you're telling us, margins improve to what levels? In the last few years, they've improved considerably. Last year it was 16%, the targeted margin.
Yeah. So we have got two. If you look at our business, it used to be 40% aluminum high pressure die casting, which went through a lot of stress in Europe. Apart from that, rest of the business, about 60% was electronics instrumentation. So that electronic instrumentation, we have grown to about 75%. This aluminum die casting is about 25%. So this electronics instrumentation business is growing at about 20%, year on year. And EBITDA levels in this business, our guidelines are about 20 to 22%. In last 2 to 3 years, we have had about 25%, EBITDA on these numbers, and this is going to go on. So as far as aluminum die casting business is concerned, so we scaled it down. We got rid of all the non-profitable businesses. Now we are filling in that capacity, and we are not focused on growing that business to get it profitable. So a year ago, last year, it was -7% on the EBITDA. We got it to about +2.5%. So there was a big turnaround in that. So we want to consistently. This is also another year where we are building it. So our guidelines for that part of the business is not, just to have a break-even this year. And there we have got a lot of traction going on to add more businesses, and this will grow in the next couple of years. So our focus is more on EI sector, electrical and electronics instrumentation business now.
Okay. Dinesh, thank you so much for joining us this morning, giving us an understanding in terms of the outlook of the business going forward. Thanks so much for that. But on that note, quick check in terms of the market, where that is headed as well. Seems like we've seen a bit of a pickup in the last few minutes. Now, 24,120 is what the market and Nifty has moved up to. When we started the show, it was just around the 24,000, just slightly above the 24,000 mark. So let's watch out for that. As of now, we've seen a sharp spike that has come in the markets. And in terms of the movers that are supporting the up move right now, the names like ICICI Bank, Reliance, Sun Pharma, SBI are among the top supporters for the market and the top movers for the market for Nifty 50. So let's watch out for that. But on that note, we're going to step into a very short break. After the break, we'll come back and we'll have the management of Laser Power and Infra. The IPO is hitting the streets today. It's a 742 crore IPO. We'll be discussing all of that with the CMD of the company, Deepak Goyal. Stay tuned there.
A bit of a spike in the market as we speak. The Nifty currently holding at the high point of the day. We suddenly spiked to 24,100 and then we cooled off a little bit. The Nifty Bank, the leader, with around 500 points gain in today's trading session. The good news, though, is the breadth of the market is holding rock solid. But as I said earlier, let's turn our attention to the IPO market. Power cables and distribution equipment manufacturer Laser Power and Infra, their 740 crore rupee IPO has opened for subscription. It's split up. 200 crores is the offer for sale, along with around 540 crores, which is the fresh issue. To understand what's going on with the company, the utilization of these funds as well, we have Deepak Goyal, the chairman and managing director of the company, who joins in to help us with that. Hi, Deepak. Good morning. Welcome to the show and welcome to the capital markets. From here on, we'll be interacting far more. Let's get a couple of details with regard to your business. You're raising an OFS as well as a fresh issue. So the money that comes into the company is largely going to be used to repay debt. And I think the debt was closer to around 500 crores. So will you be debt-free post this? And if yes, would that equate to close to around 50, 55 crores of interest saving? Please go ahead. Deepak, we would like to hear you. So, unmute yourself.
All right, good morning. Good morning, and thanks for welcoming me on the show. I hope my voice is clear now.
Absolutely.
Yeah. So about the debt part I was talking about, that my company has a debt of around 800 crores, out of which around 250 crores is tied up for various fund-based limits that we have. So the net debt would be at around 600 crores, and post-IPO, almost 500 crores of that debt would be repaid, which would bring about almost 40 to 50 crores of interest savings for the company. So going forward, the proceeds from the IPO is mostly going to be used for that purpose.
Okay, point taken there. So you will be having some interest saving there as well for from the debt that you will repay. Hi, Deepak. Good morning. This is Vinny joining in the conversation. I want to start understanding the business a bit more as well, right? When you talk about it, you have the manufacturing side and the EPC side of the business. Now, manufacturing is most portion of the revenue, right? What is the split in terms for the manufacturing side, specifically your different segments there for cables, conductors, if you could help us with that in terms of revenue contribution?
I'll let you know a little bit first about the business, where we operate and what is the space where we are generating our revenue from. If you look at the power T&D sector, what happens is from the point of generation right up to the point of consumption, there has to be a very strong infrastructure of power transmission and distribution. As you already know, our country is striving to get our energy security at a better level. Today, we are producing around 500 gigawatt of power, and we have planned to increase that power to around 900 gigawatt by the year 2032. So when we are planning that, the biggest challenge shall be coming from the infrastructure that we have in the T&D sector. Now, in the T&D sector, the space where we exist is in the transmission side. We have all the products that are required for the infrastructure improvement of the transmission corridors. Now, just to let you know a bit, if you know, transmission lines are having big challenges of right-of-way issues at this moment. So what happens is in the existing towers, if you have an option of increasing the power by 2x or 3x, that is something where where Indian transmission line would really like to have a lot of investments. So we have recently tied up with a company in US where we are bringing in best technology for improvement of delivery from point A to point B just by replacing the conductor. That means the towers will remain the same.
Only change in conductors.
Yeah. So that is one part of it. The second is many cities are now going underground. So we are making a lot of underground cables, and we see a lot of opportunity there as well. And apart from that, we are also doing EPC business of erection. So in the T&D space, we exist at every level.
So then what is the breakup, Deepak, for power and control cables you spoke about? You spoke about conductors, you spoke about some other specialty products that come in as well. Specifically in T&D, then how is your revenue breaking up between all of this, given the opportunity that you're talking about and the supply side issues?
Yeah. Our revenue breakup is around 70% from the product side. And in the product side itself, the revenue from conductors would be at around 7 to 8%, and the rest would be from cable part. Having said that, from the conductor part, we are going to be increasing our revenue from 7 to maybe 10 and 11%, 10 or 11% through the new technology that we are bringing. Although even in the cable sector, we are planning to increase our capacity further. And we are making 11 kV underground cables as well as 33 kV and right up to 66 kV.
Okay. All right. Deepak, tell us a little bit more. I think cables is the largest part of your business, as you just broke it up for us. Who would be your competitor? I mean, how much of your business would be B2B, B2C, if you could split that up for us?
So our business is almost 50-50% split between B2B and B2B. Business is mostly B2B between government and private. So government business would be around 50 and private would be around 50. And as far as the cable part is concerned, our peers would be companies like Polycab and KEI and APA. So those are the peers who are competing with us. Having said that, we have a lot of strength in the eastern part of India because eastern part of India is a raw material hub. So all the aluminium, steel and polymers are being produced here, and from here it is moving to the other parts of the country. Whereas we have that distinct advantage being in eastern part of India.
Got it. Okay. Very quickly, Deepak, we'll push you more once you list. But you've done around 2,500 crores in the previous year. Last year was a bit of a degrowth. But, without incurring any further capex and with the money that you're getting from this IPO, you'll be repaying some debt. So, with the current investments and maybe minimal capex, what can you scale the business to in terms of revenues?
See, we have a capacity to scale it up to 4,000 crores. Because of the headroom of unutilized capacity that we have. We usually utilize our capacity to the extent of 65%, and we expect this capacity to increase, or we have enough headroom to increase this capacity to 400 crores. Having said that, we also have enough greenfield expansion space available with us. we will not have to do too much of capex to generate revenue. Our capital efficiency has been quite high as compared to our peers. We have been operating at around 8 to 10x. So if I have to invest maybe 100 crores for me to generate a revenue of 600, 700 crores from that 100 crores of investment would not be very difficult. Having said that, money from the IPO is coming in from investors like Nippon, Kotak Mahindra,
marquee investors there, Deepak, coming in.
Yeah, marquee investors. Marquee investors are there. Even life insurance companies like Edelweiss and Kotak Life are there, and even
We've got that list. We have got that list.
Deepak,
Yeah.
just a quick one. So you said 4,000 crores potential revenue, right? By when? 1 year, 2 year? When is that target for?
See, we have not really given those kind of projections, but we expect that to happen within next 3 years timeline. It can happen because we have been growing at almost 28% annually since last 10 years. So we expect that to happen through that if the ratio continues.
Got it. Okay, all right, Deepak. We'll push you a little bit more for that trajectory from that 2,500 crores to around 4,000 crores. Relatively, the IPO seems to be pretty okay priced, in comparison to some of the peers that you mentioned. That's why I wanted clarity on that front. But we'll push you a little bit more for numbers once you list. All the best and welcome to the capital markets.
Thank you. Thanks a lot.
Well, time to slip into a short break, take a breather on the show, but more news and updates coming up on the other side.
Welcome back to Chartbusters on CNBC TV 18. The Nifty is again come back down to 24,000 levels around that mark. So where we saw the 24,100, now it's again come back from those highs. But let's talk about Dr. Reddy's, right? That's the one we'll put the spotlight on. Why? Because the company has made an announcement and a statement stating that certain batches of semaglutide were found to be some specifications had some issues on that term with the supply side in the API product of this. So that is why there's some bit of a supply issue, delay in supply of semaglutide. So that is a bit of a concern that comes in for Dr. Reddy's. The stock at one point of time was down more than this as well. As of now, it's down 4% in the trading session. And obviously, the company said that they are investigating the root cause and taking the appropriate measures to ensure the product quality as well. So some supply issues coming in on the semaglutide front. API issues seems like that's a concern. Nigel, that's what we'll keep an eye out on the pharma front today as of now.
Well, that's right. We'll keep an eye out on that particular one. But I think Vivek is joining in to help us out with the reason why Eternal is spiking up. Vivek, some room being created out there. Possible inflows, if they go the distance. Please go ahead.
Well, that's right. As you highlighted, even in the morning chat, Eternal is in focus. Now, this is on the back of the fact that the company last evening has gone ahead and uploaded the latest shareholding, and this is at the end of Q1 FY27. So now, what this indicates is that the foreign headroom availability has gone above 25%, and quant analysts say that the probability of MSCI going ahead and increasing the weightage of Eternal, which is already present in the MSCI indices, has now gone up. In fact, analysts estimate that there could be inflows of anywhere between $520 to $600 million, close to 7 days of buying as far as Eternal is concerned, if this particular weight increase is sanctioned by the MSCI. Now, just for some perspective, remember last year, Eternal, once it became an IOCC or an Indian-owned company, saw its foreign limit drop down to 49.5% from 100%, on account of which MSCI also decreased the available weightage of MSCI by 50%, thereby leading to significant outflow. Now, this means that there would be passive inflows once again likely to the tune of 520 to 600, and this is expected to be done in the August review when MSCI goes ahead and reviews all of the index probable inclusions and exclusions.
Appreciate it, Vivek. Thanks a lot for joining in and giving us a quick update. For the time being, we'll wrap up on this edition of Chartbusters. That's it from Vinny, myself, and the team that put this together. But the team of Trading Hour is waiting for you on the other side. Stay tuned.
Hello and welcome. You're watching Trading Hour. I'm Ritu Singh. With me is my colleague Hormaz Patakia. The market's looking to make a recovery from that sharp sell-off yesterday. The Nifty above that 24,000 mark, although it has come off in the last hour or so in trade today, but looking well. The IT pack is one that's under pressure, but overall, the breadth of the market looks very good. Hormaz, if you look at it, almost more than 4 stocks that are advancing for every 1 stock that is on the decline is something that the markets will take comfort in today.
Morning, Ritu, and welcome back to you as well. And the market's looking to find some degree of stability after what happened in the last 90 minutes of yesterday's trading session. It's been a little choppy over the last few minutes for the index, and now below the mark of 24,000. We had now gone up to and even reached levels of 24,100, 150. But again, there is some supply that is emerging from higher levels. Of course, you have to take into account for the fact that today is the Sensex expiry as well for the weekly contract. So it will bring with it its fair share of volatility. And there are a lot of other domestic and global factors to track as well, Ritu.
That's right. In fact, the markets had crossed that 100-day moving average, but now below the 24,000 mark, and we'll have to see how some recovery is made there. The market breadth is still looking good. The bank Nifty staying above that 57,000 mark. I mean, that's another level that markets will be keenly eyeing. 57,122 odd level. That's where the bank Nifty is at. Apart from that, if you look at what's doing well today, media, realty, pharma, all of that up and about. FMCG pack is doing well, and apart from IT, on the flip side, metals metals and autos are seeing some pressure. But as always, let's put the spotlight on the individual movers and shapers in the market. And Hormaz has walked over to the wall to give us that list.
You know, the bulls would be looking to first cross that 24,000 mark and sustain above it on the upside. That is their target for today's weekly expiry. We did so in the first hour of trade, but now we are hovering around those levels still. So 130 points higher after yesterday's 500 plus point sell-off that you witnessed on the Nifty, and it was almost back to square one for the index after yesterday's sell-off from all the gains of the July series wiped out in just a matter of 90 minutes. But for the Nifty Bank, though, it's trying to recover as well. It's now above the mark of 57,000. It closed below that in yesterday's trade, but that is one level that you need to watch out for on the Nifty Bank as well. The IT index, of course, ahead of TCS's results, had opened sharply lower, but still holding on to losses of around 0.8%. There is some recovery that has come in from lower levels. Of course, that does not take away from the fact that there is plenty of stock-specific driven activity in the broader markets. The custom duty exemption on the display screen components has led to a sharp boost for Dixon, Amber, Sirma SGS at one point was also up 4%. In fact, Sirma has also had a bullish initiation from HSBC earlier in the day. So that stock is doing well for itself. Dixon now above 13,500. It closed above 13,000 last week for the first time this year, and it's extending those gains. What is also delivering gains today are the quick commerce players, both Eternal and Swiggy. Eternal up another 3%. Swiggy, a big underperformer, but has done well this week, 7% higher in today's session as well, but still sharply lower from its issue price is Swiggy. The rebound in real estate continues as well. The index, yet again, the top sectoral gainer. Every single component of the index is trading with gains. Aditya Birla Real Estate, Lodha, Anantraj, all of them seeing gains of up to 3%. Brigade 2 doing well for itself in today's session. You look at the newsmakers today. Dr. Reddy's, the semaglutide concerns resurfacing. The stock had recovered from the lows but has seen some very sharp selling over the last half an hour. 5% lower now on the stock. Phoenix Mills, after its business update. JP Morgan too remains overweight on the stock, and PC Jewelers, it announced that it has now become a debt-free company, paid off all its debt, 13% higher on this one as well. Staying with the jewelry names, Kalyan Jewelers is extending its gains now 15% higher today. Of course, we'll talk more about that in just a bit. And Unichem Laboratories, which ended at a 20% upper circuit in yesterday's trade, in a weak market, is up another 11% in today's session. And lastly, the stock to watch out for after market close today is going to be TCS. That opened lower, is recovering from the lows, still down around 1%. That is the only big trigger after market hours that you need to watch out for, Ritu.
That's right, and we'll be keeping a close eye on the TCS numbers that come in after market hours. But, you know, Infosys, that's another name that's not doing so well. Tech Mahindra, all of them. The IT pack overall being dragged down. But let's get some market opinion. We had CLSA's Vikash Kumar Jain. He spoke about the themes that he likes in the current markets. Take a look at what he had to say.
Some of these stocks have corrected to price in much lower than current market prices. There could be some upstream oil stocks. There could also be some non-ferrous commodity stocks, non-ferrous metals. And I believe that these are potential hedges that one should definitely not let go of in their portfolio. In the current environment, which very well, I don't know. I mean, if you overlay the fact that we have a US, we have elections for the Senate in November, and also overlay the fact that maybe response from Iran has been delayed because of the ongoing mourning. This thing can actually continue for far longer than what any of us or what markets are hoping for. If you remember, the period around March, April is the point where some of these stocks, power utility stocks, were doing pretty well. And then they have corrected quite a lot. So I would say they represent some kind of safety in the portfolio. And since we are getting into a bit uncertain times, they typically tend to do all right. We like defense as a space. I will not get into stock specific, as we know that we have restrictions on that. But yes, we do cover defense names and we like that space.
All right, so those are some market voices coming in, but let's get back to the IT pack that we've been tracking for you, because earnings season is starting with the IT bellwether TCS, which is expected to report numbers later today. So what should you expect? What should you be prepared for? Reema Tundalkar joins us now to give us the key expectations. Reema, how would it look for TCS today?
Well, it's going to look pretty muted. Flat revenue growth in constant currency terms for the company in Q1. TCS is the IT bellwether and always the first to kick off the earnings season. So what they do, what they say is paramount to the entire sector. So constant currency revenue growth, as I said, would be flattish. The range we were working with was minus 0.1% at the lower end, going up to a plus 0.4%. In rupee terms, especially on a year-on-year basis, the numbers will look up on account of a very sharp currency depreciation. So you know what's happened in the current quarter? The INR, that's the rupee, has fallen against the dollar by nearly 2.5%, and year-on-year it's fallen by nearly 10%, which is why year-on-year numbers will look good. Now coming to the margin performance. Now in Q1, from 1st of April, the company doles out their wage increases to the entire employee base. So which is why Q1 margins are always depressed. Typically, they come down by 150 to 200 basis points. But this time, because of the foreign currency tailwind, it'll partly offset that impact, and the overall margin decline should be about 120 basis points down to 24.1%. Profits, according to our poll, should be down about 2%. There could be a one-time legal expense of about $70 million, and that could come in below the line. Now, this quarter is typically a seasonally strong quarter for the entire IT industry, but this time, because of AI deflation, companies are losing work on account of AI productivity benefits are getting passed on. And not to forget, there was a Middle East conflict as well. So there was some deferral in the deals, and they were not getting converted into revenues. Accenture had flagged off a $100 million impact in Q1, just purely on account of the Middle East war. So all that is hurting sentiment. I think consensus expectations and the way the stocks have reacted, TCS itself is down 35% from the start of the year. Valuations are closer to trough levels at 13, 14 times forward multiple. Consensus expectation is that FY27 is going to be another washout year, fourth consecutive year of anemic growth. FY28 may not be as bad as FY27, but don't expect any growth. Maybe FY29 onwards, things will start improving. I think some key numbers to watch from TCS, they had quantified their AI book at 2.3 billion, AI revenues at $2.3 billion in the last quarter. At what rate is that growing at? And secondly, at what point will at least the industry start coming back to mid-single digit kind of a revenue growth from low single digits? So commentary is going to be very key in terms of numbers. Expectations are very muted.
Reema, thank you for that update there, setting us up for the big result of the day, that is from TCS. Of course, the stock back above the mark of 2,000. It had not closed below that until September of 2020, but now has managed to reclaim those levels. Still seeing some selling pressure in today's session ahead of its results. What is not seeing selling pressure whatsoever is Kalyan Jewellers, and it's now up 15%. The top gainer undoubtedly on the Nifty 500, continuing to do well in today's session, extending its gains at the highest point of the day. There's a small block deal as well that took place on the stock. But you take a look at the moves over the last 2 days. The stock was up 5.5% on Wednesday. In a weak market, the stock is up another 11.5%, another 15% now in today's session, and the stock has now gained almost 20% over the last two trading days. Of course, today's gain is the biggest single-day gain in the last 5 months. Volumes have already crossed 75% of yesterday's volumes as well. So over 4 crore shares have been traded now for Kalyan Jewellers. In fact, now close to 6 crore shares have been traded, and in fact 6 crore shares were traded in yesterday's session as well for Kalyan Jewellers. Around about 30% of those are marked for delivery so far. It's the most traded stock by a distance on the Nifty 500 today, so far at least in the first couple of hours, and the stock has crossed a very important level, that is the 100-day moving average for the first time after the month of April. Now, why is this 100 DMA very significant? If you could get us the 50 and 100 DMA lines on a year-to-date basis, it has struggled to sustain above that 100 DMA mark. After it slipped below that level on the 100 DMA last year, it was in August August of 2025. It stayed below that level until January of this year, and it was only on the 5th of January this year that it managed to cross the 100-day moving average. But again, it could not sustain above that. It went below that mark on the 13th of January. It stayed below that till the month of April, and then again after crossing it in the month of April as well on the 8th, it fell below that on the 17th of April, and it is only after April the 17th that it has finally managed to get on to that level in today's session after this 15% up move. The next level to watch on the upside is the 200-day moving average now, which is at 432. So it's very close to that level as well. So keep an eye out on Kalyan Jewelers extending its gains with another very strong up move. Take a short break. Back with more on the bond markets with Manisha Gupta. Welcome back. The markets are still around about that 24,000 mark for the index, 130 points higher. But if you focus beyond the markets, a new chapter is unveiling for India's credit card story. TransUnion CIBIL data shows that lenders are now fighting for a bigger slice of the same borrower's wallet compared to chasing new customers. Now, to decode more on this changing credit card story, Ritu will set us up first with her macro signal of the day. Ritu.
Thanks, Hormaz. For years, we spoke about the consumer credit story being driven by adding these new first-time borrowers in the market, but that seems to be changing. At least if you look at the latest report that's come out from TransUnion CIBIL, it shows that lenders are increasingly competing for a bigger share of the same customer's wallet rather than just going on adding new customers. Now, in the last decade of the data that they've put together, the credit cards, of course, they've grown more than fivefold. Card holders have quadrupled, and the outstanding credit card balances we have in our wallet per average, that has expanded by more than 8 times. But now here's where the picture is changing slightly. Credit cards remain an important source of consumer credit, no doubt, and the average outstanding balance per cardholder has also more than doubled in the past decade to almost 65,000 rupees. But credit cards are increasingly accounting for a smaller and smaller share of the overall consumption lending market, falling from 56% in 2016 to just 38% as of 2026. Now, at the same time, consumers are also building more complex credit portfolios. So the share of cardholders who will also have another consumption loan has doubled in the last decade from 16% to 32%. And the share of consumers that are holding 3 or more credit cards has also risen from 12% to 22%. So put together, the message is that today's borrowers are spreading their spending across multiple products, not just credit cards, and multiple lenders, and that makes the competition for the consumer's wallet that much more intense. Now, this also matters for future patterns. For instance, the report points out that young borrowers, they're entering this formal credit system much earlier than you and I did, Hormaz, and with far more borrowing products already in hand than previous generations. Among the Gen Z consumers who are getting their first credit card, nearly 1 in 3 hold at least 2 other credit products already, and nearly 1 in 4 already have a small ticket personal loan, while almost 1 in 5 has a consumer durable finance loan as well. So the takeaway is this: the consumer credit boom is becoming more competitive, more complex, as borrowers juggle multiple cards and multiple lenders. And so banks must also compete not just to lend first, but to remain the preferred lender of choice. So that's the setup for this chat today. Let's bring in Bhavesh Jain, the MD and CEO of TransUnion Civil, for more takeaways from this very interesting report. Bhavesh, thanks very much for joining us now. You know, this displacement that is happening, credit cards no longer being that entry product for consumer credit anymore. Start by telling us what's caused that sort of disruption, how much of it is because of, the rise of these fintech loans and the disruption from UPI, and what is the implication for lenders in the market?
Thanks, Ritu, for having me on the show. There's been a significant shift where today the entry product in the credit market for youngsters and millennials is actually the consumer finance loan, largely the mobile finance loan. That brings in the bulk of new to credit. Now, credit card as a percentage of new to credit sourcing has become insignificant. It's hardly 3% right now. So it's the consumers coming through mobile finance, through personal loan, and then probably the consumer or the Gen Z is going for the credit card product. And then after taking the credit card, this next product again taken is largely the credit cards. So the lenders are tapping into customers who have existing credit cards. So in fact, almost 70% of the credit card sourcing is given to people who already have existing credit card. Now that's a question you had asked, saying that why is that shift? The shift is multifold. One, today the consumer has multiple choices of getting financing, either through consumer durable or personal loan or BNPL, multiple options available. Same time, if a consumer is using credit card as a payment tool, the consumer today has multiple choices, largely in form of UPI. And second big point to highlight is in terms of accessibility. So today, there are almost upwards of 600 million UPI terminals, and there are just 11 million credit card POS terminals. So choices available to the consumer across payment and credit card. Second, and lending products. Second is in terms of the accessibility. So these two are the key factors leading to the shift.
Bhavesh, very quickly, these consumers that you're finding are increasingly, instead of a credit card starting with personal loans or BNPL or whatever it is, are they eventually then shifting to credit cards, or is that a product that many first-time users are bypassing altogether?
So it's not the first product anymore. It's not the most preferred product anymore. So today it's the personal loans, consumer durable loans, and the gold loan, which are the most preferred credit products by the consumer. It's only 5.2 crore of the consumers who have actually been holding credit card, and that number has been static for some time. In fact, last year, same time was just 5.2 crore consumers holding credit cards. That number remains the same as of now as well. So the market hasn't expanded. It's the same set of customers who are taking 2 or 3 cards in their wallet.
Bhavesh, does that mean that the credit card industry in itself is a shrinking one? Because the only possible incentive, I confess my ignorance here on this, that I may not be a very active credit card user. Is the only interest that comes to me for getting a credit card is, okay, it might give me a lounge access at the airport sooner or later. But for the Gen Z audience, what is the trend that you're observing for them in case they do opt for a credit card? And since you mentioned yourself that there are plenty of other options now, right, other than a credit card, there is gold loans, there is UPI, and there is so much as you are almost spoiled for choice.
So Gen Zs are not going as the first product of choice. The first product of choice continues to be PL and consumer finance loan. This is probably the third or fourth product which the consumer is getting attracted to take. Second is, yes, the end purposes could be lounge access, could be some rewards, cashbacks, some tie-ups with an e-commerce website. So those are there. And what's happened is today the credit card average balances, which is 60,000 rupees, is exactly same as the personal loan ticket size of around 68,000 rupees. So no more is credit card is top of the choice for the consumer. It's just another credit product or a payment product. So today it's only the certain set, in fact, just 1/3 of the consumers who are heavy on credit card usage, that they are going for the second, third, or the fourth credit card, and they're using for different use cases or different rewards and cashbacks and access across different parts of the country.
Bhavesh, very quickly, the fact that Gen Z are entering the market with more cards on average, more financial products than some of us have, and I'm with Hormaz there. I'm not a heavy credit card user, but what is the implication there? Is it simply the idea that financial inclusion has improved, or is there more stress in the system, and what are delinquency levels, particularly among Gen Z, pointing to?
So, Ritu, there is no stress right now. What we see on the retail credit portfolio, at an overall level, the credit card delinquencies have come down significantly across personal loan. And in fact, even for credit card, the delinquency from last year same time has come down. It's just 1.7%. Even the early delinquency is on similar levels. So there is no portfolio stress on the retail side. Second is that when we look at it today, credit card holders as a percentage of credit active population is just 25%. So out of 25 crore consumers, it's just 5 crore card holders. So there is a huge headroom for the market to tap into the Gen Zs and the consumers at large to give them credit card. And at the same time, when we look at the overall population, there is again a huge headroom. So we have to continue to spoil the consumers with multiple choices, credit card being one.
Yeah. Bhavesh, quickly, since we've run out of time, if the idea is not really just about adding more and more customers, but getting them to spend more, and put all these trends together, who are the biggest winners and losers? Is it, the large players in the market, the HDFCs, ICICIs, SBI cards, or can the newer ones also gain meaningful share?
So there's an opportunity for everyone, because today the credit card sourcing is happening equally across the urban locations and the rural locations. So the market is open, the market is pretty good and attractive for anybody to come and tap the customer base.
All right, Bhavesh, from one non-heavy credit card user and another one as well. Thank you so much for sparing time and joining us today on the show with this very interesting insights on the cards industry as well. Take a short break, back with more on the markets on the other side. Welcome back. Some buying interest emerging at lower levels yet again for the index. So you're back above the 24,050 mark, 170 points higher, in fact 180 points higher now on the index. So the dip that has taken place intraday is looking to get bought into, but there is a pocket that is doing very well today. Is the EMS company, Sirma, Dixon, Keynes. We highlighted that at the start of the show as well, and that's after the government extended the custom duty exemption on key display assembly components till March of 2029. Upasana is here with more details on that. Upasana.
Well, certainly the EMS sector certainly remains in focus today as government extends the basic custom duty exemption on key display assembly components till March 2029. Now, this is on the 5 imported components used in the manufacturing display assemblies for automotive, medical and industrial applications until 31st March 2029. Mind you, this is mainly an extension of the nil BCD benefit rather than a fresh duty extension. Now, the amendment ensures that these components continue to enjoy duty-free imports through March 29, providing a long-term policy visibility for manufacturers. Now, the exemption covers 5 critical components, that is cell, FPCA, that is flexible printed circuit assembly, BLU, that is backlight unit, frame, and even ACF, reducing the import cost for domestic display assembly manufacturers. Now, Equities says that this will certainly benefit, and it applies only for display assemblies used in automotive, medical and industrial electronics, and overall this move is positive for the EMS players as it lowers the landed cost of critical display inputs, supports domestic value addition, and even improves the competitiveness of manufacturers supplying display assemblies for industrial and other key segments that highlighted earlier. Now, the key beneficiaries of this would be Syrma SGS, Dixon and Keynes, and we can certainly see the surge in these stocks on the back of this.
All right. Thanks very much, Upasana, for bringing us that. Let's shift focus to Eternal. Now, that stock is among the top Nifty 50 gainers in trade today. Foreign shareholding in Eternal, the foreign headroom has increased to more than 25%. And in addition to that, all eyes are also now going to be on the MSCI August review. Let's bring in Vivek to understand the kind of inflows that are expected in this particular stock. Vivek, over to you.
Well, that's right. So the latest update as far as Eternal is concerned is strictly technical or quant, if you may call it that. So the shareholding pattern has come about, last evening, and the foreign headroom availability has now gone about 25%. So what does that indicate as far as passive funds are concerned? MSCI is now likely to go ahead and increase the weightage of Eternal on account of the higher foreign headroom available, and analysts estimate that this likely increased weightage could lead to inflows of a little close to $600 million as far as Eternal is concerned. This particular development is likely to happen in the MSCI August review that will transpire. Now, just for some context, remember Eternal last year, after the company went ahead and classified itself as an Indian-owned company, saw its foreign ownership limit drop to 49.5% from 100%, on account of which MSCI had reduced the weightage on the stock, and you had seen significant outflows then. This particular event is a positive given the fact that it would lead to inflows, and analysts estimate it could lead to close to 6 to 7 days of buying as far as Eternal's daily average turnover is concerned.
Vivek, thank you for that update there, and Eternal doing well for itself, continuing its recovery from the 52-week lows. Take a short break. Market Technicals with Ajit Mishra on the other side, and some trading ideas as well.
Welcome back. A tad bit of a recovery in the markets from, a few minutes ago. The Nifty at 24,066 is where we're at, trading with gains of about 184 points. And the Sensex also seeing gains of about 580 odd points as we speak. The Nifty now above that 100-day moving average once again. Let's bring in Ajit Mishra from Religare Broking, who joins us now for a quick technical check of the market. Ajit, we're barely holding on to that 24,000 mark today. Hopefully go up from there. What are the key near-term levels you'll be watching out for? And in this market, your top stock picks.
Good morning, Ritu. So, Ritu, yes, we are seeing that market is making an attempt of a rebound, especially after the sharp decline that the market experienced yesterday. We've slipped below the key averages. In fact, the short-term average also got breached. Today, we have reclaimed 20 EMA. We are inching closer to the 100 EMA mark, which is close to around 24,150 zone. So in case if we manage to hold this area, then probably we are set for a consolidation. Means after this 700, 800 point kind of a correction, possibly we may continue to hover in this range of 23,800, 23,650 on the downside, with 24,150 to 400 being on the higher side. This range is likely to play out in the index. And of course, since we have the earnings season also scheduled, so stock-specific opportunities will continue to be the focus area in the current market scenario. Basis that, Bharti Airtel, it's been almost like a month-long consolidation around the major averages. We've seen a decisive breakout in today's session, so we anticipate this recovery to further strengthen. And 2060 is what we are eyeing as an immediate target. So with stop at 1900, one can accumulate Bharti at current levels. Then we have Marico within the FMCG basket, which is outperforming after a marginal consolidation around its record high area. It looks set for the next leg of the up move. So here 905 is what we are eyeing as a target zone, with 830 as a stop loss.
Ajit, very quickly, a view on Dr. Reddy's as well. The stock is seeing a very choppy move. It recovered from the initial lows of 2.5%, then fell to almost 6.5% lower. Now again holding on to losses of around 5%. Has there been a breakdown on the charts for Dr. Reddy's?
So it's more of consolidation, which has been continuing for almost 2 years now. 1,400, 1,200, that's the broader range. So we have retested the upper band, and now we are again seeing profit taking. So I believe the chart structure indicates this consolidation is likely to continue. So relatively, Lupin and Sun Pharma, they are the better candidates within the pharma baskets.
Ajit, thank you for sparing time and joining us with your views on the index and on specific stocks as well. Since we are on the subject of Dr. Reddy's, let's bring you Vinny, who will tell you why the stock is doing the way it is. Vinny.
Hi, good morning. So yes, for Dr. Reddy's, they flagged some quality issues in the semaglutide batch, in one of its semaglutide batch. So this will lead to a commercial supply. That is a possibility of a delay that could come in on that front. Now, obviously, what happened here, they said that the certain semaglutide batches were found to be out of specification and out of what the requirement was. So this issue was mainly linked to API used in the product. So API was the issue that came in. They said, and the company's response that came in on the exchanges, that the root cause of the investigation is still underway. They will take corrective measures, and they will ensure the product quality comes back to the level that it is required at. But obviously, we'll see some bit of an impact coming in on commercial supplies that will be delayed until this issue is resolved. And obviously, do not forget, OneSource Specialty is the CDMO partner also of Dr. Reddy's. So maybe some bit of an impact could be seen on this one as well. But as of now, Dr. Reddy's, because of this, is seeing the fall.
All right, Vinny, thank you for that update there on Dr. Reddy. Still 5% lower, the top loser on the index. And that's where things stand for Dr. Reddy's. But Kalyan Jewellers is now up 17%. And with that move, the stock has now crossed its 200-day moving average as well, which was at 432. It's been a while since it broke below that 200-day moving average, which was around in August of last year. And it has now managed to reclaim those levels of around 432 as well. So 16.5% higher for Kalyan Jewellers, the top gainer on the Nifty 500 and the most traded stock on the index as well by a distance. Shifting focus now to a CNBC TV 18 exclusive. We understand from sources that Borosil Renewables is exploring the prospects of a strategic investment wherein promoters may offload stake if all works out. Let's bring in Rachna for all of those details on this. Rachna.
That's right. A big deal is brewing in India's glass industry. Borosil Renewables, which is India's first and largest solar glass maker, is in exploratory talks with a strategic partner for a promoter stake sale. Now, if the promoters are offloading fully or partially is what we'll know with time. But for now, the talks are on. There's a strategic player in the fray who's looking to get in on Borosil Renewables with the promoter stake. Now, the promoter family, which is the Kheruka family, owns close to 59%, about 58.77% in the company. Now, what is important here is to understand the valuation. Right now, the market cap of the company is around 8,000 crores. But what we understand is that the promoter stake could be at a substantial discount of what the current market price is. So that is one thing to watch out for. Apart from that, the timing is also very interesting. Right now, there's an anti-dumping duty going on, which expires in December of 2029. We're in the middle of it. And once the duty expires, there's no certainty whether it will be renewed or not. So this is a very good time for the promoters to explore these stocks. And that is exactly what they're doing, is what we're learning from our sources.
Thank you.
Rachna, thanks very much for bringing us that update. Borosil Renewables, that stock is up and about today in trade today, perhaps on the back of the expectations we're bringing you there on some promoter stake sale up 9.6% as we speak. But let's get in Sudarshan now to get us the latest trends from the F&O space and what's brewing there. Sudarshan.
So market is managing to hold on to its opening gains, and now Nifty is approaching the level of 24,100. If you take a look at the options data, it's like bullfight going on between the put writers and call writers in the range of 24,000 to 24,100. But if you look beyond the data, now there would be hope that there is no any fresh statement from Donald Trump regarding US and Iran tensions. And if it comes, if there is any fresh statement, it should be positive, and that's what bulls would be hoping for. So talking about the two major indicators, Nifty put call ratio, because of major put writing, now put call ratio has increased to 0.95 from the earlier level of 0.80. And also we are seeing a downside move in volatility index. Now it's back below the level of 14. Currently it's down almost 9%. Now come to the options data. Take a look at on the put side 24,050 and 24,100, and similar options strike rates even on the call side 24,050 and 24,100. If you take a look at the volume, or basically increase in the open interest on the put side, the increase is almost 2 times what we are seeing on the call side. So that indicates the major or aggressive put writing we are seeing in the range of 24,050 to 24,100. That's the reason. Immediate support for Nifty would be 23,950. That should 20 DMA, and resistance will be 24,150. If we cross 24,150 comfortably, then the door opens for even 24,300. As far as Nifty Bank is concerned, support will be 56,740 and resistance will be 57,500. In the last few minutes, we have seen a big up move in Nifty Bank. Let's see if it manages to cross 57,500. Now coming to the stocks, one stock that has been moving higher, not only higher, aggressively moving higher for the last 2 days is Kalyan Jewellers. Today also the stock is seeing short covering, currently up almost 16%. Another stock, because of the news to semaglutide, has seen fresh shorts, and that's Dr. Reddy's. It's our top Nifty loser. Solar industry amongst all the defense names is the weakest one, and also today Kotak Institutional Equities has initiated coverage with a sell call and target price around 10,300 after their stock is seeing fresh short additions.
7 crore shares have been traded on Kalyan Jewellers in today's sessions. Fresh short covering seen there as well, and shorts seen on solar industries. A bearish note coming in from Kotak. Sudarshan, thank you for that update there from the F&O desk. Take a short break, continuing our conversation on the markets with Christy Mathai of Quantum AMC on the other side. Welcome back. Continuing our conversation on the markets then with Christy Mathai of Quantum AMC, who's joining in. Christy, good morning. Thank you for taking out time. We are on the cusp of yet another earnings season, starting today with TCS. What are your expectations this time around from India Inc.? Is the low base going to be of any solace for the companies, or the West Asia war was too big to ignore?
Right. Thanks for having me. So when we look at least the recent numbers, looks like because bulk of the input cost impact is going to come maybe in 2Q, not in 1Q, because a lot of sectors, so many companies are sitting with sort of low cost inventories, which sort of help them in terms of protecting margins and revenue growth. So this particular quarter, things may look up, but bulk of the impact may come later. And then from second half is when we sort of expect a recovery, hoping that things do not turn sour on the West Asia. So that's one of the assumptions. But despite that, if you were to look at the earnings trend, over a slightly longer term, we are looking at, resilience in earnings, things sort of coming back, because some of these external shock have to be normalized. It may not continue for a very long time. So given that India is really well placed for a cyclical sort of recovery after sort of two bad years, FY25 and FY26, in terms of earnings for quite a few sectors. So that's how we are sort of looking at the market earnings at the juncture.
Christy, the two sectors most heavily hit by foreign investor outflows. I mean, IT is one you've spoken about. What about financials? I mean, of course, the earnings start mostly next week. We have some names today. But what's the expectation overall? Some turnaround, especially in the private space. Is that looking better to you?
Yeah, so we are sort of quite positive, especially on the banks, the private sector banks. So if you were to look at all the efforts by RBI sort of in terms of driving up growth, etc., sort of is coming through from the start of the year. And, that's why you see system credit growth at 17-18%. Some of it could normalize, because if you were to really dissect where it is coming from, some of it is through corporate, which is largely a bond substitution from NBFCs, coming to banks as opposed to NCDs and so on and so forth. So that is one part of it, but it is still a very healthy growth. And a lot of the past growth did not really lead to the, a profitable growth, in the sense like, the margins have sort of come off. Now that might change as you look at this year, because, there is no major rate cut impact going into the banking space. Also, the PSU pressure on the yields are slightly going to come off. So we are sort of positively positioned within the banking space. And also we have allocated some bit to the asset side of the Indian consumer, which is largely on the insurance space, which especially on life, that is one space where we are sort of positive, given the correction it has witnessed over the past 2-3 years.
What about pharma, Christy? The entire gamut has done fairly well over the last month or so. There are multiple stocks that are at 52-week highs, and all are different businesses, be it generic players, exporters, even the CDMO players like Laurus. All of them have done very well, and most of them are at 52-week highs too. How are you positioned in the sector? Where does your preference lie?
Right. So we are at the moment sticking to the large sort of players who are very well diversified, both in US markets and India. So again, it is a very bottom up within this whole pharma pack. For example, we sort of moved out of a particular position because it has rallied. But, in the same space, we are able to find an opportunity which is sort of catering to slightly different products and different markets. So it is very bottom up. So at present, we have around 2 stocks within this whole sector, and one is very large India focused, and there is also a US opportunity. So there is a large molecule which is seeing a price erosion, as we all know from the past 2 quarters, and some of these companies have used the surplus over the years to invest into companies which is sort of slightly better margin profile, better businesses. And moving forward, when you normalize for the earnings, this is going to help some of these companies. So we are sort of positively biased from these particular stocks, but not everything is cheap. So one has to be careful in the whole pack.
Christy, very briefly, defense, chemicals, these are typically the names that come up in the backdrop of what's happening in geopolitical tensions. Any value emerging there? Do you see any opportunity?
See, from chemicals perspective, it is very difficult to justify the valuation. We understand, over the past, 2-3 years, things have really corrected and things like that. But the pricing element, the ability for the companies to take a price hike or, the pricing power, it is at all not there because of the large China exports. So we struggle to value them. Should we look at it as from a commodity angle or should, we be paying up? So there are maybe 2-3 companies which really fits the bill in terms of pricing, but they are priced very expensively. So we have largely avoided. So defense again is to our minds is an opportunity. If it's a structural opportunity, if you were to think about it, there are indigenization themes. There are some of the export emerging. But again, the government allocation has continued to be very stable to this sector. So that is a positive. But it is very difficult to justify in valuations, especially for us as a value manager. So we have largely sort of avoided these themes.
Christy Mathai, pleasure having you today. Thank you for sparing time and joining us on the show. Looking forward to the next conversation. Take a short break. Back with more on the other side.
Welcome back. Let's shift focus to the primary market action where India's largest asset management company readies for a Dalal Street debut. SBI Funds Management, that's the company we're speaking about, their 11,692 crore rupee IPO is all set to open for subscription come the 14th of July. My colleague Devyani joins it with an analysis of what to expect there.
Well, the 11,692 crore IPO opens on the 14th of July and goes through till the 16th of July. Now, it's a pure offer for sale with 20.37 crore shares to be sold by promoters SBI as well as Amundi. Now, the price band is set at 545 rupees per share to 574 rupees per share, implying a market cap of 1.17 lakh crores at the upper price band. With a price to earnings of 38 times its FY26 PAT. Now, coming to what SBI Funds Management exactly is, it's the largest asset management company in the country with 12.5 lakh crores in mutual fund assets with market share of 15.3%, which is the highest among peers. Now, SBI Funds Management is a partnership between India's largest lender, that's SBI, and one of Europe's leading asset managers, that's Amundi. Now, it is the fastest growing top AMC in the B30 cities with over 19.2% AUM coming in from these areas. Now, it is also the one of the largest PMS AUMs with 16.88 lakh crores, out of which over 90% comes from Provident Fund and EPFO mandates. So that's an important thing to remember because these are very, very low margin businesses for the company. Now, coming to the numbers, revenue for FY26 came in at 4,389 crores, implying a compounded annual growth rate of 26% from FY23 till FY26, while PAT came in at 3,067 crores, implying a CAGR of 31% since FY23. Now, where does it stack though compared to its peers ICICI AMC and HDFC AMC? Now, it has lower yields compared to peers with 35 basis points of revenue yield as well as 25 basis points of PAT yield, but that's primarily as a result of the asset mix. Now, it's very passives heavy, which with 32% of its AUM coming from passives alone, and keep in mind these are lower yielding funds. So as a result of that, the profitability for SBI is lower than its peers ICICI AMC as well as HDFC AMC, in spite of having higher AUM than both. Now that said, from a valuation perspective, ICICI AMC sits at 48 times its FY26 price to earnings, while HDFC AMC sits at 40 times its FY26 price to earnings. So it's lower than both, and we'll be watching out for how the street reacts to these numbers going forward.
Devyani, thank you for that update there. The biggest IPO of the year so far on set for Dalal Street debut. Now, the US has launched a major trade investigation and India is on the list. Washington is probing 16 countries, including India, over excess factory capacity in sectors like petrochemicals and textiles. A second probe covers forced labor across 60 countries, again, including India. Let's hear more from Abhimanyu on this.
India is all set to oppose the proposed 12.5% tariffs which the USTR intends to levy under the Section 301 probe which is underway on forced labor against several countries including India. Now submissions have already been made not just by the government but also by several industry bodies and a hearing is likely on the 9th of July as per Indian time. It remains to be seen what happens in the hearing, what transpires, based on which any further decision would be taken. For now, the tariffs which have been levied by the US government are set to lapse on the 24th of July. However, there are two other proposals which indicate that tariffs may be levied on issues like forced labor as well as excess capacity. Now, India has already communicated its opposition to both these proposals by the USTR to levy tariffs under Section 301. Now, India's submission has indicated that the USTR's determination does not meet the legal standard under the Section 301 and the USTR's determination lacks product and country specific analysis as well as sufficient causal link. It also has indicated that the probe does not satisfy the legal requirements for the initiation and there is no evidence which has been provided to suggest that India's exports to the US confer any artificial advantage or burden or restrict US commerce in any way. Now these submissions earlier too had been given by the Indian government and it has been reiterated not just by the government but also by several industry bodies. All eyes, of course, would be on what comes out of the hearing, based on which any further action would be initiated by the US government or by the USTR, even as the tariffs which are currently in place are set to lapse on the 24th of July.
Abhimanyu, thank you for that update. Take your leave on this edition of Trading Hour from Ritu and me. Thank you so much for watching. We leave you with the Nifty 170 points higher. Halftime report on the other side.
Stocks see a broad-based rally with the mid-caps leading the charge and advances far outnumbering the declines. Hope of US-Iran thaw aids sentiment, realty and healthcare are the big gainers, while IT is the key drag.
Government extends the import duty exemption on key display components till March 2029 in a big boost for EMS companies like Dixon Technologies, Syrma SGS and Keynes Technologies. The stocks of EMS players perk up.
Dr. Reddy halts supply of weight loss drug semaglutide on discovering an issue with the bulk drug used in its production. The company indicates commercial supplies will resume only once the issue is resolved. The stock skids.
India's largest asset manager, SBI Fund Management, has set an upper price of 574 rupees per share for its IPO, indicating an issue size of nearly 11,700 crore. Parent SBI and partner Amundi will together sell 10% stake in the IPO.
Tata Consultancy Services will kick off the big IT earnings season with Q1 numbers today. Growth is expected to be muted and margins are likely to see a compression on wage hike impact, though rupee depreciation can limit the impact.
Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vinny Motiwala. Well, a good day for the bulls so far. We are seeing gains across the board, be it Nifty, be it the broader markets. Banks are participating as well, but a bigger outperformance coming in from the mid-cap index, with the advances far outpacing declines as we speak. It was yesterday around 2 p.m. that we saw that sharp fall in markets. The West Asia tensions impacting the markets again, but some reversal is seen today, and the gap between advances and declines is a big one. Vedanta Oil and Gas, it is in focus because the Delhi High Court has rejected government's objections on $99 million award enforcement in favor of Vedanta and Rava. Rava is a big field for Vedanta Oil and Gas, and this is where they will be receiving this award. So $99 million, that's basically money coming into Vedanta's book. So that's why that stock is higher in trade, 5.5% higher on that one. Other than that, most of the sectors are in the green today. We do have Nifty IT, which will be in focus on the back of TCS's numbers. We'll discuss that in greater detail, but really making a comeback yet again, the top gainer.
Absolutely, Sonal. Good afternoon. Realty making that comeback. Do not forget, Pharma is also on the top of the charts in terms of sector movers. We have Nifty Pharma managing to hold on to gains of around 1.5%. We have Media, which is holding on to gains as well. And obviously, IT is the one which is muted. A lot of individual movers today on the broader end of the market. CE Infosystems, that's MapMyIndia. We have Swiggy, that's buzzing. Kalyan Jewellers continuing to see that up move after the Q1 update on that day. We saw a fall, and after that, seems like it's making a bit of a comeback there. But what's on the show for you all today? We will connect with the management of Yash High Voltage ahead of its meeting EGM on 15th of July, where the company will seek shareholders' approval to raise funds through preferential issue and warrants. We have the names coming in, so that is key to watch out for. Vivek will take us through the whole host of stocks which are moving around in the trading session, so stay tuned for that. And on to some other buzzing stocks in trade, we have Dr. Reddy's, that's in focus, Phoenix Mills as well as Eternal. In our movers and shakers segment today, we'll be discussing all of this. Rima will also be putting the spotlight on what you need to know ahead of TCS's Q1 FY27 earnings later today. We'll also take a closer look at Q1 earning expectations for capital market players. Stay tuned for that. First up, we have Vivek, who's here on that note to take us through the stocks that are moving around in the trading session. Good morning. Good afternoon, Vivek.
Well, good afternoon. What a difference 24 hours has made, especially in terms of the market movement. Yesterday around 1:30, we saw the sharp fall, and today significantly higher as far as markets are concerned. Advance decline ratio very much in favor of the advances as the broader markets are outperforming. In terms of individual names, individual sectors, have a look at the capital market players. BSE, MCX as well as CDSL, all of these stocks are doing very well on account of the fact that options trading activity has regained traction, especially in the last couple of trading sessions on account of the volatility. Kalyan Jewellers is the other stock on the radar, a significant buying seen over here. stock up 16%, and this is despite the company in its Q1 actually underperforming a larger peer like Titan. Swiggy, now this particular name, continues to outperform. In fact, most of the quick commerce companies today doing very well. MapMy India, this particular name stands out in the broader end of the markets, up on very, very strong volumes. MapMy India and Dixon, along with other EMS names today, one of the top gainers, up 5% for Dixon today. On the other hand, quite a few drags as well. Page Industries giving up its recent outperformance amongst the top NSE 500 laggards today. Mazagon Solar Industries, select defense shipbuilder names seeing a bit of profit booking, a little bit of pressure there. Wire and cable stocks, KEI as well as Polycab under a bit of pressure. KEI giving some muted commentary in recent analyst meets, and TCS, continues to remain muted ahead of the results.
Okay, that is about all the buzzing stocks that we are tracking. But there are some individual names which are reacting to news updates. So this is time for our movers and shakers segment. We'll track a whole host of stocks buzzing in trade. First up, let's talk about Dr. Reddy's, a big fall that we saw since the time that news came. Winnie, let's start with that and what it means for the stock.
So yes, Dr. Reddy's, what's the announcement that came in on the exchanges? What the company highlighted that yes, there is some bit of a supply issue that one could face on the semaglutide front. They flagged off quality issue in semaglutide batches. So there is a commercial supply delay that is there that could be temporary, but that is what one could see facing. Now, obviously, certain semaglutide batches, they found out that there was an issue linked to the API used in this product. So because of the API issues, right now the commercial supply will not happen for the semaglutide front. Root cause, they're still trying to find out about it, but they're saying that they'll take the corrective measures. Until then, there will be no supply for this front as well. They'll ensure the product quality comes back to the level and specification that are required. So obviously, there's a bit of an impact that we will see coming in for Dr. Reddy's on that front, and that is why the stock is down 5%. But do not forget, we have OneSource Specialty as well, which is partnered with Dr. Reddy's as a CDMO player, right? So that is also a company that you should watch out for with Dr. Reddy's on the back of this news flow.
Okay, all right. So that's about Dr. Reddy's. A sharp fall in stock price, 5.5% lower. With that, let's move on and talk about Eternal. The foreign shareholding in Eternal foreign headroom has increased to over 25%. Of course, we'll be watching out for the MSCI August review as well. Let's get in Vivek again to understand the kind of inflows that are expected. Vivek.
Well, Eternal at one point of time was the Nifty's highest gainer. So why is it in focus today? Well, the shareholding pattern came last evening, and what it indicates is that there is now foreign headroom availability of a little over 25%, which implies, and as per quant analysts, they estimate that in the upcoming August review, Eternal could see its weightage in the MSCI indices, where it is already present, both the standard index. You could actually see a weight increase come about. What is the likely inflow that could come about? Analysts estimate anywhere between $520 to $600 million of inflow on account of the likely weight increase in the MSCI indices. Now, for some context, remember, similar to Swiggy recently, Eternal too last year went ahead and declared itself as an IOCC or an Indian-owned company, on account of which it reduced the available foreign ownership limit from 100% to 49.5% limit, on account of which MSCI went ahead and reduced the weightage by 50%, which led to a significant outflow as far as Eternal is concerned from the MSCI indices. This particular move will help Eternal recoup some of the FPI flows that it had lost on account of the IOCC limit. So again, we'll keep an eye out in the August review and expect a weight increase for Eternal.
Okay, all right. Thank you so much, Vivek. So that's about Eternal. It's up 2% in trade. Phoenix Mills is the other one that I'm tracking today. That stock is higher on the back of its Q1 update. We've been talking about how a lot of these consumption companies have done well in the quarter gone by. The consumption has increased across the board, and that, of course, is positive for Phoenix Mills as well. Their overall consumption for malls has gone up by 32%. And if we talk about their commentary, they say performance was supported by healthy consumption trends across the portfolio, and most of their assets have seen double-digit growth as well. As far as the commercial segment is concerned, that's where the occupancy has increased. It has come at 72% versus 70% on a quarter-on-quarter basis. In their hospitality segment as well, they've done well. The RevPAR has increased for the Mumbai hotel, which is St. Regis, by 15%, and Courtyard by Marriott Agra has seen a growth of around 23% on a YOY basis. JP Morgan is bullish. They have an overweight call with a target price of 2,000 rupees a share. They say the Q1 consumption was ahead of estimates according to them. Most malls have delivered double-digit consumption growth. Low gold prices may weigh on jewelry consumption from here on. And limited profit sharing from jewelry tenants caps the downside risk there because it will not impact their profitability so much. But overall, it has been a good quarterly update, and that is what the street seems to like.
Absolutely, that is what the street seems to like for Phoenix Mills over there. 4% gains for the company. But on that note, we're going to sip into a very short break. After the break, we're going to be connecting with the management of Yash High Voltage. This is on the pref issue. They'll be having an EGM on 15th of July as well to raise those funds. Stay tuned for that conversation. Welcome back to Halftime Report on CNBC TV 18. Nifty at 24,050, 60 levels as of now. 0.7% of gain is what the Nifty is holding on to. But let's focus and bring on board the first management for today. We have the management of Yash High Voltage who's joining us. Now, there's a preferential issue as well as warrant issue that the company has done. They're looking to raise money through this. There's going to be an EGM that's going to be held on 15th of July. We have a lot of investors that are coming in through this as well. To discuss more on this, what is the outlook of the company as well, let's bring on board Keyur Shah, CMD at Yash High Voltage, joining us to focus on this. We'll talk about the preferential issue proceeds. That's one of the key points. What is the demand looking like, order book looking like for FY27? How is all of that shaping up, along with supply chain challenges which were there previously? Is that still there for the company? Has there been an improvement? We'll discuss all of this. Keyur, good afternoon. Thank you so much for joining us on the show. So you're looking to raise around 150 crores. There's going to be a pref issue as well as there's going to be an issue of warrants as well. You've given some marquee investor names, ValueQuest, White Oak, Motilal and Malabar India Fund is going to be the warrants one. So could you help us understand the reason behind going for this mix with pref versus warrants? And obviously warrants will have that 18-month conversion window as well, right? So why not go for a QIP? What was the reason behind this?
Good afternoon, madam. Thank you very much. And yes, we are now ready for the EGM happening on 15th of July. And this purpose for this fundraise is primarily complete capex. We had planned our investments for 245 kV class, but looking at the market demand and the way things are picking up, we have decided to go up till 550 kV. And the company is now in an expansion mode. We are also doing a brownfield expansion in our existing factory. And since today the delivery of the equipments are a bit longer, we don't want all the money lying in our account. So it's okay for us to have the staggered investment. And we would like to take the money as and when we need. So that's the reason a portion of this, we are doing it by warrants.
Keyur, I want to understand in terms for the split as well. You said obviously you're focusing more on the 550 kV as well. So one, in terms for 550 kV, are there better margins that you will get as well? And obviously brownfield expansion, anything specific you could come in terms of details on that front? How much will be the split between both of these expansions?
Thank you. In India, typically we have 420 kV and globally there is 550 kV in a couple of countries. We as Yash High Voltage are preparing ourselves for a global supplier, right? Preparing Yash as a global supplier. So we are keeping that range in our sight that we should have 550 kV range also. And we see a huge margin expansion once we go up in the ladder with higher voltage classes. It is not only about margin, it also helps us giving a complete range. Typically in a transformer, if a low voltage bushing is of suppose 220 kV or 132 kV, and if I'm not offering 420 kV, then my customer has to go to two different vendors. So by having 420 kV in our basket, we will also be expanding our sales for our lower voltage class bushings also. Sometimes some customers have a preference that we would want to buy only from one bushing supplier, both the ratings. So the reason of 420 kV is also not only increase margin, but also increase revenue.
So how
And
much?
for the brownfield, we have been typically making oil impregnated bushings for 20 plus years now. And there is a huge demand for the oil impregnated also globally. So the purpose of expanding in the OIPs also is that also is going to continue for many more years. And we would like to be ready for that also for catering to the increasing demand. As such, today our lead times have gone to 10 or 12 months plus. So we want to be ready for the increased order inflow, and for next 3, 4, 5 years, there is a continuous visibility. So we want to make sure that the infrastructure should be sufficient to cater to these loads.
So 150 crore rupees, if you can split it up for us, how much will go in the RIP upgrade? How much will be in OIP brownfield expansion? And you spoke about it's not only margin accretive, it will be revenue accretive as well. What's the asset turn on a capex like this?
So around 4, not more than 4.
What
and in
times?
today's, max 5, most probably 4. And around 20%, 15 to 20% will go for the brownfield expansion, balance all will go for the greenfield facility.
Okay, so that means you will be able to do around 600 crores of revenue from this particular capex that you are announcing.
The preparedness for revenue from this capex in all should be close to 900 CR. We might need some incremental investment going forward, but that we can manage from our internal accruals. Hopefully, between 800 to 1,000 crore revenue should be possible, because it's the 150 is the additional raise. Initially, also we had raised through an IPO. So all put together, we will be investing 200 or CR. So with that, we can say that the investment should be sufficient to make the company capable for delivering close to 800 to 1,000 crore of revenue, putting both the facilities together.
Absolutely, point taken there. This is the possibility in terms of revenue. But when do you start seeing the synergies coming in? When will this be commercialized as well? You're upgrading it to 550 kV right now. So when does that start reaping the benefits? Will it be in FY27 or will we start seeing these benefits in FY28 for the company? And how much would that be per year?
So the revenue contribution has already started from the new factory, right? Because the assembly hall and the test hall is already ready. So in our existing facility, whatever we were not able to match up in terms of delivery, in our meeting our monthly goal or a quarterly goal, now at least there is some contribution which has started from the new factory. And in another 2 months, we plan to be also ready with our localized core for which we have put up this greenfield facility. After that, maybe around 2, 3, 4 months will go in the plant approval and the pre-qualification process. Next year, for sure, we see reasonable revenue addition from the facility, and the margin expansion we expect from FY 28-29.
What would that number be? Could you help us with that, Keyur? I mean, what's the possible synergy? Maybe we could see this year as well, in the next full year, maybe if you count it, as well as in terms of margins that you're seeing the benefit. So how many basis point improvement can we expect because of this on the margins? Maybe in FY 28 that you will see the full year.
Yeah, so particularly this ongoing year and the next year, we would still maintain the growth rate as what we have been delivering, around 40 plus percentage. We still assume it will be a safe bet for us to deliver in this year and the next year. Maintaining the margin almost plus minus as what it is today, around 25% plus minus EBITDA, what we are doing today. There might be marginal plus, marginal minus, because there will be a lot of depreciation. There is a lot of investment, a lot of new people we are joining in the company.
But
So
depreciation won't be
net,
seen in margins, right? Your EBITDA margin shouldn't be impacted by depreciation.
yeah, I agree. But there will be also a couple of expenses which are increasing, because the revenue from the new facility is going to take some time in terms of higher value. But the expenses, the routine expenses increase, the security increase, the housekeeping increase, the employees
Okay,
increase,
got
the
it.
people increase. So the manpower cost, your
Margins will
running
be
cost, that
at
all
similar.
increases.
Okay.
Still, we would make sure that we are able to maintain the profitability, or maybe marginally plus or minus.
Okay.
But from 2029, we expect reasonable increase. And the purpose for that is we would be able to localize the product. At the moment, we are having a couple of components which are imported, which we are localizing with this facility. So with that, we believe that the margin at the gross level also will improve. And once we start exporting the RIP bushings from this facility, we also see a margin expansion on the revenue side.
So, KU, that is about the
Together,
PNL. Yes, we get that point, and you speak about how you will be able to do it in India versus the imports that you're looking at. Your working capital days, they have increased from 45 to 69 in FY26. Your cash conversion cycle has increased from 112 to 182. Your return on capital employed has reduced from what you saw in 2024 from 45% to 29% right now. Can you explain what has led to all of this? Is it more capex? Is it slower cycle or lower inventory conversion? And that is something which will improve going forward?
Yeah, definitely there should be an increase. See, please understand, today we are having reasonable dependency on imports. And in today's market, we have to accept what our supplier will want to deliver us. Right? Sometimes we give a schedule, but if the supplier is ready with material as per his schedule, we have no other option than to put it up in our inventory. And sometimes it also happens that couple of components are ready, couple of components are not ready, because our suppliers are also gearing up. Nobody had anticipated such tsunami in our sector. Right. So, and our products are such that we cannot overnight add any vendors. We need to give time to our existing vendors and couple of new vendors, but also to meet up our quality expectation. So sometimes we have to agree to their terms, and we put up the inventory, and it helps us also. Honestly, if you ask me, by having an additional inventory, we are also able to deliver much faster, right, to meet up our customers' expectation also. So in all, yes, we agree that the working capital cycle has been a bit changed. But going forward, once we localize more and more, we should be able to bring that up back to the levels.
Kayur, just a quick point. In terms for exports, you said exports will grow. As of FY26, your exports were around 7% overall. How do you see that increasing? And also in terms of order book, a very sharp jump up in terms of order book that came in for FY26, 400 crores at what it stood at. Today, how are you seeing order inquiries coming in, specifically given that you're seeing that's the need of the hour? Bushings is what is required from the T&D side as well. All this is the need. So where are you seeing orders increasing more now? And where do you see it in FY27?
So most important thing in our product is, madam, that there is a huge entry barrier. Generally, people take a time in approving a new vendor and finding it trustworthy to buy the bushings regularly. So as Yash, we are today fortunate that now we are stabilized in the global markets also. And the customers across the world have now started considering Yash as their preferred vendor. And we are seeing increased order inflow each and every day, each and every week. There is an increase in order inflow from the export side. If you see our numbers on the revenue side, it was 7%, but on the quantity wise, it was 15%. RIP bushings, we were not exporting. With our localized product, we would be able to export it also globally. That would be increasing our revenue share from exports, preferably over a period of next 3 to 4 years, to close to 20%. And we believe that that would be the right thing today to do more and more import substitution and also to become more and more export competitive. As Yash, we believe in both the understanding that we have to be more and more independent, Atmanirbhar, and to also make sure that we have very, very less import dependency, but also our products should be going up globally and to be able to deliver to the global
Take
markets.
that point, Keyur. Take that point, Keyur. Thank you so much for joining us today and explaining to us the new capex plan that you have in place and what it would look like for the P&L and the balance sheet going forward. That's the word coming in from Yash High Voltage. The stock is at the day's high, up 4.5% in trade. Slip into a short break. On the other side, we'll get you more updates from the markets. Rima will also join us to tell us what we are expecting from TCS's Q1 numbers, which are due later today. Welcome back. You're still tuned into Halftime Report. Well, earnings season begins now. The IT bellwether TCS is expected to report numbers later today. Rima is joining us now to tell us what are the key expectations. The stock has recovered from the lows of the day and is at the day's high. Rima, take it away.
Well, it's going to look pretty muted. Flat revenue growth in constant currency terms for the company in Q1. TCS is the IT bellwether and always the first to kick off the earnings season. So what they do, what they say is paramount to the entire sector. So constant currency revenue growth, as I said, would be flattish. The range we were working with was minus 0.1% at the lower end, going up to a plus 0.4%. In rupee terms, especially on a year-on-year basis, the numbers will look up on account of a very sharp currency depreciation. So you know what's happened in the current quarter? The INR, that's the rupee, has fallen against the dollar by nearly 2.5%, and year-on-year it's fallen by nearly 10%, which is why year-on-year numbers will look good. Now coming to the margin performance. Now in Q1, from 1st of April, the company doles out their wage increases to the entire employee base. So which is why Q1 margins are always depressed. Typically, they come down by 150 to 200 basis points. But this time, because of the foreign currency tailwind, it'll partly offset that impact, and the overall margin decline should be about 120 basis points down to 24.1%. Profits, according to our poll, should be down about 2%. There could be a one-time legal expense of about $70 million, and that could come in below the line. Now, this quarter is typically a seasonally strong quarter for the entire IT industry, but this time, because of AI deflation, companies are losing work on account of AI productivity benefits are getting passed on. And not to forget, there was a Middle East conflict as well. So there was some deferral in the deals, and they were not getting converted into revenues. Accenture had flagged off a $100 million impact in Q1, just purely worry on account of the Middle East war. So all that is hurting sentiment. I think consensus expectations and the way the stocks have reacted, TCS itself is down 35% from the start of the year. Valuations are closer to trough levels at 13-14 times forward multiple. Consensus expectation is that FY27 is going to be another washout year, fourth consecutive year of anemic growth. FY28 may not be as bad as FY27, but don't expect any growth. Maybe FY29 onwards, things will start improving. I think some key numbers to watch from TCS, they had quantified their AI book at 2.3 billion, AI revenues at $2.3 billion in the last quarter. At what rate is that growing at? And secondly, what is, at what point will at least the industry start coming back to mid-single digit kind of a revenue growth from low single digits? So commentary is going to be very key in terms of numbers. Expectations are very muted.
Thanks so much for that, Reema. But on that note, CLSA India's senior research analyst Sumit Jain believes that Q1 FY27 earnings will be weak for IT service companies and any further guidance cut will fuel deflationary concerns. Listen in.
In the near term, we do believe that the deflation argument or the narrative will be stronger than the volume opportunity. We are still not getting any valid data points which flag that IT service budgets are shrinking with the Fortune 500 or G2000 enterprises. Yes, the deflation to the base business of IT companies will hit for the next 2 to 3 years as and when the large deals come up for renewal. But mind you, in every deal, the scope of volumes are also increasing. So I failed to mention, but TCS and Tech Mahindra continue to maintain the stance that the volume opportunity is higher than deflation in the AI world. I think this quarter is going to be weak. Accenture laid out the lay of the land by cutting down their guidance by 50 bips. And in this currently negative narrative for IT services sector globally, any guidance cut will further fuel the narrative of deflation being very strong. Tech Mahindra stands out clearly in the large cap IT space where they have two large telecom deals which will ramp up, one in this quarter and one in next quarter, and that's why we see Tech Mahindra's growth to be relatively higher than rest of the large cap names. Whenever a technology disruption happens, the mid-tier operators are always a bigger beneficiary because they can disrupt their business model much more easily and shift towards the new age solutions, and that's what we are seeing with both Coforge and Persistent.
That's about the IT pack, but let's shift focus and talk about capital markets. And in our special segment, Quarter Se Quarter Tak, where we bring you earning expectations for each sector. Today, Devyani is going to be putting the spotlight on expectations from the capital market in Q1 FY27. Devyani, over to you.
Well, a good quarter coming in for the capital market space. Now, Nifty gained 6.3% on a quarter-on-quarter perspective, while Nifty Capital Markets Index, that rallied 23% in quarter one. Now, strong markets and mark-to-market gains are expected to support earnings this time around, but keep in mind the volatility that was seen in quarter four has set a high base, and as a result of which quarter-on-quarter earnings might look softer. Now, coming to AMCs, the total expense ratio rationalization remains the key monitorable here. From a market share perspective, Nippon AMC is expected to be the biggest market share gainer, while ABSL AMC is expected to see the highest decline in market share on a quarter-on-quarter perspective. Now, the focus will be on whether the AMCs have successfully been able to pass on the yield compression to the rest of the value chain or not. Coming to brokers, lower trading activity versus quarter four could weigh on revenues, with PAT likely to soften on a quarter-on-quarter perspective, despite the growth that was seen in the funding books of these companies. Coming to exchanges, options remain the key earnings drivers, but both BSE and MCX have seen volumes come off March highs, which could result in muted quarter-on-quarter performance for both of these companies. Wealth managers are expected to be the most resilient this time around, with RTAs expected to see continued growth in non-mutual fund-based revenue. But the key monitorable this time around is going to be exactly who bears the brunt of the yield compression this time around. So that's the key monitorable here.
Okay, Devyani, thank you so much for that. Those are the expectations from the capital market side. But on that note, we're going to slip into a very short break. After the break, we'll come back, get you more on stock-specific action, get you more on the markets, and a whole host of EMS stocks. Why are they buzzing? All of that in the next segment. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. And now you have some of these stocks that are moving around from the broader end of the market. CE Infosystems picked up a bit more pace in the last 30 odd minutes. You have Amara Raja Batteries, that's also picked up pace. Hunasa Consumers too. So watch out for some of these names in the trading session today. Nifty as of now, yes, at those 24,050 levels. Not much of a move from that level as of now. So watch out for that. But the other names that are buzzing around today, Syrma SGS, Dixon Technologies, Keynes Technologies, all these are in focus. And this is coming after the government has extended the custom duty exemption on key display assembly components, and this is till March 2029. Now, what does this mean for these companies? Let's go across to Upasna, who's here to help us understand that. Upasna, over to you.
Well, certainly, EMS stocks continue to remain in focus today as government extends basic custom duty exemption on key display assembly components till March 2029. Now, mind you, this is mainly an extension of the existing nil BCD benefit rather than a fresh duty reduction. Now, this is on 5 key imported components used in manufacturing display assemblies for automotive, medical and industrial application. Now, the exemption covers 5 critical display, which includes cell, FPCA, that is flexible printed circuit assembly, BLU, that is backlight unit, frame and ACF, which will certainly reduce the import cost for the domestic display assembly manufacturers. Now, Equirus believes that this will benefit only the display assemblies that is used in sectors like automotive, medical and industrial electronics as highlighted earlier, and it is certainly positive for the Indian EMS players as there are 3 benefits. Firstly, it will lower the landed cost of critical display inputs. Secondly, it supports the domestic value addition and even improves the competitiveness of manufacturers supplying in these industries. The key beneficiaries of this would be Syrma SGS, Dixon and Keynes Technology. Now, mind you, today HSBC has also given a buy call on Syrma SGS. Certainly, stock remains in focus throughout the day with a target price of 1750 per share. It says that the company's export mix, vertical integration and high value product supports the overall margins for the company. The strong acquisition and JV tracks record strengthens its position in terms of the EMS competitive intensive environment. Even the delays in the new plant commissioning is one of the key risks highlighted by the brokerage. So all in all, certainly EMS is the sector to watch out for today.
Okay, all right, take that point, Upasna. Thank you so much for joining us. So that's the EMS space. Jewelry stocks are also buzzing in trade. There's TBZ, we do have PC Jewelers and Kalyan Jewelers. Big run up there. It's around 16% higher. Let's take a deep dive into the technicals of that stock. Bring in Hormus for a quick stock check. Hormus.
Well, you know, Kalyan Jewelers has had a very good last couple of sessions, although it's still a big underperformer, yes. But across the Wednesday and today, the stock is up almost 20%. It was up 5.5% in yesterday's session, despite the very steep sell-off that we saw in the market. And in today's session too, we are adding on to that, gaining almost 16% and on very, very strong volumes as well. Now, what has happened here is that the stock has crossed key levels on the upside. The fact that it is now trading above the 100 DMA in today's trading session. And why the 100 DMA is very significant, because it has not managed to sustain above those levels for a very prolonged period of time. Now, last year when the stock fell below its 100 DMA in August, it only took until January of this year to go past that 100-day moving average mark, and it was only on the 5th of January that we crossed that level, and then we came below those levels in just a matter of a few trading sessions from the 13th of January, and again it took us another 3 months for Kalyan Jewelers to reclaim that 100-day moving average mark in the month of April. And even then in the month of April, we've crossed that level on the 8th of April, and then we slipped below those levels on the 17th, and then only after the 17th of April, it is for the first time in today's session that we have managed to cross the 100-day moving average as well. But as a result of this up move, the stock has also crossed its 200-day moving average on the upside, which was at 432. Currently at 434 is the Kalyan Jewelers. So crossing important technical levels, it is important to see whether it sustains or not. The good part is the gains are coming on very, very strong volumes. More than 8 crore shares have been traded on Kalyan Jewelers so far. It remains to be seen whether this move sustains or not. Still down 40% from its 52-week highs.
Okay, big fall from the highs, but the momentum is building up as the data suggests, presented by Hormus. But it's time for a break now. Rajesh Palvia of Axis Securities will join us on the other side for a technical check on the market. Stay tuned for that. Welcome back. A lot of action in the broader markets is what we are seeing. We do have Vedanta Oil and Gas, which has won that arbitration award. The Bombay High Court has ruled in favor of Vedanta Oil and Gas, so they'll be getting around $99 million versus the government. NAC Packaging, that's the new listing that listed yesterday, so we do have another 7.5% gain on that one. Swiggy continues its up move, by the way. Eternal is doing well in the Nifty pack. Swiggy in the broader market is also up around 5.5%. Quality Walls is the other one, up around 4% in trade as we speak. So good time to get a technical check on the markets. Rajesh Palvia, VP Technical and Derivative Research at Axis Securities, is joining us now. Rajesh, good afternoon. Thank you for joining us. We saw a sharp fall yesterday. There's an uptick today, but will that sustain is the big question. What are the charts suggesting?
Yeah, after a sharp sell-off in the previous trading session, there is a pullback action took place, but still Nifty is struggling to cross the major call concentration area of 24,100, which is very important for this pullback. If at all Nifty manages to cross 24,100, then yes, we may see some short covering action to play out, and Nifty can move further higher towards 24,250 or 300 zone also. But broader market has recovered quite well in today's session, and most of the mid cap, small cap space is doing good. And the sector where we have seen, panic selling in the previous trading session is also, trying to get some support buying action in this pullback action. And surprisingly, today we have seen, PSU banking basket is also contributing, as most of the PSU banking basket were under, selling pressure since last couple of days. So I think market is closely monitoring all this geopolitical event which is going on, and market is waiting for if something comes on a positive side. I think our market is poised to give breakout on the higher side, as broader market is showing sign of confidence in last couple of weeks. So one can remain stock specific in this kind of volatility. For Nifty, breakout about 24,150 may give further more room to upside. So one can wait for that breakout to buy aggressively in the market on the large cap as well as on the Nifty front. Bank Nifty is again showing sign of recovery, but 57,500 600 zone is the major supply zone based on the call concentration. So I think that level needs to cross to get more buying interest in the banking stocks. So till the time Bank Nifty not crosses those level, we may see some consolidation range of 56,800 to 57,500 would be the range for Bank Nifty. On the stocks front, we are focusing some of the stocks where a continuity of uptrend is there. So Lupin from the pharma space is looking quite interesting. After a long consolidation, now stock is managed to give breakout on the near-term, short-term chart. And looking at the formation on the weekly chart, we believe that this stock has potential to extend gain on a positional basis also. So one can buy and accumulate Lupin for upside target of 2650 to 2700. On the downside, 2440 needs to keep as a stop loss. Another stock where we are seeing strength on the near-term chart, that is Paytm. After a consolidation, now stock managed to give breakout on the daily weekly chart. The stock is comfortably holding about to 20-day, 50-day moving average. Derivative data is indicating a long built up. So Paytm is another stock where we are focusing and projecting target of 1300 to 1320. On the downside, 1220 needs to keep as a stop loss to buy Paytm.
Yeah, Rajesh, thank you so much as always for joining us and giving us the levels for the markets as well as individual stock names. Thanks so much for that. On that note, let's move on and now go across to Sudarshan, who's here to tell us what's happening in the world of F&O this afternoon. Sudarshan, good afternoon.
Good afternoon, Vinny. So we are seeing aggressive call writing as well as the put writing. So if you talk about the put writing, it's happening between the range of 23,800 to 24,050. And if you talk about the call writing, it's happening just in the narrow range of 24,050 to 24,100. Now, one positive part, and that's indicating in your PCR, because of major or aggressive put writing, your put call ratio has improved or moved higher to 0.97 to 0.98 from the previous level of 0.80. Now, if you take a look at the volumes on the put writing front, it's almost 2x or 3x to what exactly we are seeing in the call writing front. So as I told you, in the put writing, 24,000, 24,050 and 23,800, and on the call side, 24,100 and 24,050 are the most active ones. On the put writing, we are seeing a sharp increase in the open interest with a sharp fall in the premium. On the call side, premium has seen an increase. Now talk about the stocks. Three stocks I have seen unusual move in the last 1 or 2 hours. First one is KFin. Just take a look. In the last 1 hour, the stock has seen a sharp up move, currently up more than 4%. And the positive part is it has started seeing fresh addition on the long side. Lodha. Now, yesterday, the stock closed with a minor gain of around 1,100 on the cash side, but in the futures, it was down almost 2 to 3%. There was a discount of almost 40 to 50 rupees. Now, the discount has come down. Now, the discount has narrowed to just 10 rupees. Last one is Kalyan Jewelers. Just till an hour ago, it was seeing short covering. Now, the stock has started seeing fresh addition. So, on the long side, now it tells you that there can be a further up move as far as Kalyan is concerned. Lastly, talk about the levels for Nifty. Support, I'll see around 23,950 and on resistance 24,200. But for that to happen, Nifty has to cross comfortably the level of 24,100.
Take that point. Thank you so much, Sudarshan, for joining us. So that's about the F&O setup. But with that, we'll slip into a short break. When we come back, Vishal Manchanda of Systematics Group will join us. We'll talk about Dr. Reddy's as they have flagged a quality issue with certain semaglutide batches and the entire space overall. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV. 24,030 is what the Nifty is trading at right now. But Dr. Reddy's, that's a stock that's under pressure today. And this is coming in after they've spoken about some supply issues coming in for the semaglutide front and a commercial supply problem that could delay the deliveries temporarily for the company. Let's discuss more of this. And we have Vishal Manchanda, pharma analyst at Systematics Group, joining us right now to help us understand more in terms of details. Vishal, good afternoon. Thank you so much for joining us. You know, Dr. Reddy has now flagged off this quality issue that has come in for semaglutide batches. Could you help us understand the impact in terms of revenue? GLP-1 was that big opportunity everyone was betting on. How much could this delay in terms of the revenue for the company? Any understanding there?
Yeah, hi, good afternoon. So I think this is a complex product. Semaglutide is a peptide, and probably I think one can expect such scale-up issues happening in such categories like peptides. So I think the impact would largely depend on how long the supply disruptions last. So if they are able to quickly resolve, probably we'll not see any significant impact on numbers. So probably if they kind of get this done in the next 1 month, I think that should kind of not meaningfully impact expectations that people have for FY27 or FY28. But if they take longer to kind of sort this out, then certainly it has an impact on the company.
So if it is sorted out in a month, it will not be such a big impact, but anything more than that will see an impact. How big of an opportunity is it for Dr. Lal, Vishal? What is the estimate that you've penciled in along with Dr. Lal, since you're saying that it is a complicated and complex product? Do you think it is something other players could face as well? Because it's a big market now, a lot of players here. What does it also mean for OneSource? Because that's the CDMO player in this case for Dr. Reddy's.
Yeah, so I think OneSource is also a supplier. Shaily Engineering is also a supplier to Dr. Reddy's. So Shaily will supply the pen. OneSource does the sterile fill and finish. So I think, again, if Dr. Reddy's doesn't produce the API, probably we'll also see an impact. But then there are take-or-pay arrangements that these companies have with their customers. So to that extent, I think these players, OneSource or Shaily, would be protected because of the take-or-pay arrangements that they have. Otherwise, I think my forecast for FY27 for semaglutide for Dr. Reddy's is about $100 million. I think if they resolve it quickly, I may not need to change my forecast. But if this takes longer, then certainly numbers will need to be taken downwards, because this is a ramp-up phase. We'll see more players entering in. So if more players enter in and Dr. Reddy is not able to kind of get the issues sorted, they might lose market share probably permanently in the class.
Absolutely, with many players and that competition coming in here, then possibility if this goes on for longer, then they will lose market share. But as of now, if they manage to solve it in a month's time, then not much of an issue. But Vishal, just yesterday we had that news flow also coming in for Orchid Pharma, right? The tie-up with the Russian company, Russian hospital side opportunity that comes in for them. Could you help us understand what it means for Orchid Pharma as well? We saw the stock run up in trade, but in terms of revenue, how much is the potential for this?
I think the best part of the deal that Orchid did in Russia is the partner. The partner is a very large player in Russia. They are one of the leaders in hospital antibiotics. So I would presume, so having got that partner, I mean, so that partner should do kind of full justice to the molecule. They should kind of ramp it up to whatever scale it can achieve. But based on the estimates that Orchid shared in terms of the market opportunity, it could be like about, say, around $25-30 million in annual sales at peak in Russia. And my sense is Orchid should have a should have a strong economic interest in that.
Okay. Vishal, coming back to the weight loss drugs, there have been a lot of data which is suggesting that buyers are preferring the innovator drug instead of the generic drugs. Are you seeing that in the market? What is the data suggesting? And if that is the case, what would that mean for these listed companies which are looking at big sales from semaglutide, the generic version that is?
You mean the Indian markets?
Yes, the Indian market. Yes, yes.
So I think we will see a fair share that generics would get, and I think by volume we'll still see the generics dominating the market. I would at least expect the generics to get to 70-75% market share, unless the innovator resorts to steep discounting at levels where generics are.
So what is the current gap between the two in terms of pricing right now?
I think at the lowest end, if you look at generics, at the lowest end of the range, probably generics would be 1/3 of the innovator price.
So there's no change in pricing even on the innovator front for now?
Yes, nothing that we have seen as an announcement coming in from the innovator on pricing front. There could be a situation where innovators are offering maybe like a patient assistance program, or could be like kind of freebies to kind of like a month supply free on another month supply. We don't know about those schemes, but at least on the MRP level, they seem to be like at a significant premium to the lower price generics.
Okay. Point taken there, Vishal. Thank you so much for joining us this afternoon, explaining us about the impact that comes in for Dr. Reddy's, what it means for other companies with the API manufacturers, CDMO players as well as for Orchid Pharma. Thanks so much for joining in. But on that note, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, a Business Lunch.
Stocks see a broad-based rally with mid-caps leading the charge and advances for far outnumbering declines. Hope of a US-Iran thaw aids sentiment. Realty and healthcare are the big gainers, while IT is the key drag. Government extends the import duty exemption on key display components till March 2029 in a big boost for EMS companies like Dixon Technologies, Surma SGS and Keynes Technologies. The stocks of EMS players perk up. Dr. Reddy's halts supply of weight loss drug semaglutide on discovering an issue with the bulk drug used in its production. The company indicates commercial supplies will resume only once the issue is resolved. The stock skids. India's largest asset manager, SBI Fund Management, has set an upper price of 574 rupees per share for its IPO, indicating an issue size of nearly 11,700 crore rupees. Parent SBI and partner Amundi will together sell 10% stake in the IPO. Tata Consultancy Services will kick off the big IT earnings season with Q1 numbers today. Growth is expected to be muted and margins will likely compress on wage hike impact, though rupee depreciation can limit that impact. Hello and welcome to Business Lunch live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan. Good afternoon, guys. After yesterday's brutal sell-off that we saw happen around 2 p.m., the markets are back in the green, but those gains are slightly capped on account of, flare-up of tensions in West Asia. The Nifty at 24,040 right now, about 0.6% in the green. We've got the Sensex also higher by about 500 points. The mid-cap index is leading that charge, 1.5% in the green, and it's doing well. The Nifty Bank also outperforming the blue chips. That index as well is 1% in the green. And if you bring up that advanced decline ratio, we've got 575 stocks only declining for every 2,487 stocks that are advancing. So a big gap in that advanced decline ratio, as you can see on your screens. If you take a look at the sectors, the Nifty Realty's rebound continues. Phoenix Mills is up over 4%. DLF and Godrej at this point, Phoenix Mills is up over 4%, Godrej nearly 3% higher, and DLF as well over 3% in the green. We've got those PSU banks also contributing to the up move. Canara Bank, PNB, Bank of Baroda, all of them between 1% and 3% higher. The only index in the red is the IT pack. TCS is down at this point 0.1%, but it was down 2% ahead of its results. So we're seeing some recovery there in the IT pack as well. Infosys nearly 1% lower, but Tech Mahindra, which was in the red, has seen a recovery and is now 0.2% in the green. So that's how the markets are shaping up this afternoon. But to the top story today, tensions in West Asia continue to escalate. Iran's military says it carried out drone strikes targeting U.S. bases in the Gulf. The Iranian military said it used a large number of various types of drones in the attacks. CNBC's Emma Graham gets us the latest updates.
Just in the last few hours, U.S. Central Command announcing that a second round of strikes this week have concluded. They hit several sites in southern Iran, very similar to the sites they hit earlier this week in response to Iran's taking of ships in the Strait of Hormuz. Now, this is really significant because these strikes have resulted in strikes across the Gulf again this morning. Iran retaliating in Qatar, Bahrain, and Kuwait, all sites of U.S. bases. And all of this follows as we saw President Trump at the NATO summit in Ankara. Steve, getting a question to him about that just afterwards, saying that this MOU, this memorandum of understanding with Iran is now officially dead. Iranian state media as well, Tasnim, saying yesterday as well that this was dead. Now, this was supposed to be a 6-week deal with Iran and the United States in which they were supposed to come to an agreement, really, on how to end Iran's nuclear program and kind of look forward into the relations between the two countries. This was supposed to come to an end mid-August, but now there's no telling what will happen next. It seems that negotiators are free to continue discussions, President Trump said yesterday, but we've seen the Pakistani delegation who are involved in mediation efforts, as well as the Qataris, urging calm and urging, a response from Iran that is as calmer and a return to the negotiating table. But it remains to be seen if this will happen. And it all comes after a week of really renewed tensions here in the Middle East. As I said, the Iranians taking interest in the Strait, still controlling that crucial waterway and disrupting shipping there. The United States responding to those strikes earlier this week. The first round of strikes hitting Bandar Abbas, that key port city in Iran. The Iranians then striking back yesterday morning in Kuwait and Bahrain. Now we're seeing that second system of strikes throughout the region here. So really an uptick in tensions this morning here in the Gulf.
An uptick in tensions in the Gulf. Emma there with the latest on what's happening in West Asia. Meanwhile, U.S. President Donald Trump says that Iran has a little left in terms of military capacity and suggested Tehran is now eager to negotiate. He also issued a stark warning on retaliation, saying Washington strikes have been running at a ratio of 20-1 and that any further Iranian attack would be met with an even heavier response. Let's listen in to his comments.
And I say we hit up 20-1. Every time they hit us, we're going to hit them 20. And we did it last night. It did a little something today, but it was really retribution for last night. They hit actually 3 boats, not 2. And when they hit, we hit back much harder. We have many ways we can win, but we've already won militarily. They have very little left, and they want to make a deal so badly. They called a little while ago, they want to make a deal so badly. I just don't know if they're worthy of making a deal. I don't know that they're going to honor the deal. That's the problem.
And shifting the focus back to all the action on Dalal Street, a number of stocks are buzzing on the back of news flow. Ria is here to get us all of those details. Ria?
Well, yes, let's start off with Dr. Reddy's Labs first. The stock is down over 5% today after the company has said that certain semaglutide batches have failed their specifications due to an issue in the API, which is the active pharmaceutical ingredient. And now commercial supplies have been delayed pending this API issue investigation. Moving on to Eternal, which has been in focus as the MSCI is likely to increase the weight of Eternal in the standard index in the August index review. Borosil Renewables has also been in focus today as sources have indicated that the company is in preliminary and exploratory talks for a strategic investment, and that promoters may divest part or full stake in the company if talks proceed and fructify. Also taking a look at some of the stocks which are in focus on the back of business updates. IRB Infra, the June gross collection has gone up by nearly 28% on a year-on-year basis to 808 crore rupees. Phoenix Mills is also in focus on the back of its Q1 update. The Q1 consumption has seen a growth of nearly 32% for the company to nearly 4,727 crores. And lastly, EMS companies are also in focus today as the government has extended the BCD exemption on the key display assembly components until March of 2029.
All right, Ria, many thanks for bringing us those details. Now, electronics manufacturing stocks are surging as the government exempts the import of goods required to make displays from custom duty. Hear out what MeitY Secretary had to tell us on the decision earlier today.
I think that we have been based on industry representations we have taken up with the Ministry of Finance. We are very, very happy that these notifications have been issued. This will really stimulate the electronics industry, especially the electronic component industry in the country. This is an important requirement. This is an important change, and it would help us further deepen the value chain here and the ecosystem here.
Market regulator SEBI has issued its first round of observations on the National Stock Exchange's IPO filing. Yash Jain is here with all of those details. Yash, take us through what you're learning.
Well, the first milestone really in that sense after the National Stock Exchange filed its IPO DRHP with market regulator SEBI, what sources have given us is that market regulator SEBI has issued its first set of observations as far as NSE's DRHP, IPO DRHP is concerned. Now, what we've been given to understand in terms of the nature of observations is that almost all the observations issued by market regulator SEBI are procedural in nature, and a reply to all those observations is expected to be submitted by the National Stock Exchange very, very soon. Not a specific rule, but generally there are about a couple of sets of observations which market regulator SEBI issues in any IPO, DRHP or draft prospectus. The first one has been issued for NSE. The second one, of course, once the reply is filed, if there are further observations, market regulator would do that. What we've been given to understand from our SEBI is that the expectation is that in the month of August is when NSE expects to receive the final set of observations, which would also be market regulator SEBI's approval on the DRHP filed by NSE, and in true sense a final go-ahead as far as the launch of the IPO is concerned. As far as the timeline is concerned, we've reported this before, but NSE is targeting the month of September for the launch of its IPO. As far as the valuation is concerned, the exchange is targeting valuation of about 5 to 5.3 lakh crore rupees, a fundraise of about 30 to 32,000 crore rupees.
All right, Yash, thank you so much for those details. Now, earnings season begins with IT bellwether TCS expected to report numbers later today. Rima joins us now to give us the key expectations. Rima?
Well, it's going to look pretty muted. Flat revenue growth in constant currency terms for the company in Q1. TCS is the IT bellwether and always the first to kick off the earnings season. So what they do, what they say is paramount to the entire sector. So constant currency revenue growth, as I said, would be flattish. The range we were working with was minus 0.1% at the lower end, going up to a plus 0.4%. In rupee terms, especially on a year-on-year basis, the numbers will look up on account of a very sharp currency depreciation. So you know what's happened in the current quarter? the INR, that's the rupee, has fallen against the dollar by nearly 2.5%, and year-on-year it's fallen by nearly 10%, which is why year-on-year numbers will look good. Now coming to the margin performance. Now in Q1, from 1st of April, the company doles out their wage increases to the entire employee base. So which is why Q1 margins are always depressed. Typically, they come down by 150 to 200 basis points. But this time, because of the foreign currency tailwind, it'll partly offset that impact, and the overall margin decline should be about 120 basis points down to 24.1%. Profits, according to our poll, should be down about 2%. There could be a one-time legal expense of about $70 million, and that could come in below the line. Now, this quarter is typically a seasonally strong quarter for the entire IT industry, but this time, because of AI deflation, companies are losing work on account of AI. Productivity benefits are getting passed on, and not to forget, there was a Middle East conflict as well, so there was some deferral in the deals, and they were not getting converted into revenues. Accenture had flagged off a $100 million impact in Q1, just purely on account of the Middle East war. So all that is hurting sentiment. I think consensus expectations and the way the stocks have reacted, TCS itself is down 35% from the start of the year. Valuations are closer to trough levels at 13-14 times forward multiple. Consensus expectation is that FY27 is going to be another washout year, fourth consecutive year of anemic growth. FY28 may not be as bad as FY27, but don't expect any growth. Maybe FY29 onwards, things will start improving. I think some key numbers to watch from TCS, they had quantified their AI book at $2.3 billion, AI revenues at $2.3 billion in the last quarter. At what rate is that growing at? And secondly, what is, at what point will at least the industry start coming back to mid-single digit kind of a revenue growth from low single digits? So commentary is going to be very key in terms of numbers. Expectations are very muted.
So muted quarter there expected from TCS, and commentary will be key to watch. That stock was down 2% in early trade, but has seen a recovery. So we'll have to wait and watch what happens with those numbers post-market hours. Thank you so much for those details, Rima. On that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. The International Monetary Fund releases its July 2026 World Economic Outlook update. The IMF has trimmed its global growth forecast and has raised its inflation projections. Ritu Singh is here with more from that report. Ritu?
Well, let me start with India, which remains a bright spot in an increasingly divided global economy. The IMF says India will continue to be among the world's fastest growing major economies, even as it cut the overall global growth forecast. So the IMF now expects India's economy to grow 6.4% in FY27, which is 10 basis points lower than the April estimate, before the economy accelerates to 6.7% in FY28, which is a 20 basis point upgrade. Now, on a calendar year basis, India is projected to grow 7% this year and 6.4% next year, with growth supported by resilient private consumption and strong services activity. But the global picture is becoming more challenging. IMF has lowered the global growth forecast for this year to 3%, while raising the next year estimate to 3.4%. But even then, it says growth in the next 2 years remains below the 3.5% average that we saw in the preceding 2 years. The fund also says that the world economy has weathered this West Asia conflict better than initially feared, but the projections are also assuming that the Strait of Hormuz begins reopening sometime mid-July. Now, the report highlights there's also this growing divergence in the global economy where countries that are plugged into the AI-driven tech cycle are outperforming the others, with the top 4 exporters of AI hardware, for instance, Taiwan, Korea, Thailand, and Malaysia, posting an average upside growth surprise to the tune of 440 basis points. Now, at the same time, world trade growth is expected to slow down to 3.5% this year before it recovers a little bit to about 4.3% next year. Among major economies, advanced economies are expected to grow by 1.7%, while emerging market economies grow a little faster. Now, IMF has also turned cautious on inflation, raising the global inflation forecast to 4.7% for this year before it cools down to 3.9% next year. So it expects energy prices to remain above the pre-war levels, with oil averaging about $89 a barrel this year, with crude oil, natural gas, fertilizer, food prices all expected to remain elevated. Overall, the risks are balanced compared to April, but they are still tilted very much to the downside, and IMF is urging policymakers to prioritize price stability, rebuild fiscal buffers, and invest in skills, energy, as well as digital infrastructure to be able to fully capture the benefits of artificial intelligence.
All right, Ritu, many thanks for those details. Now, the US has launched a major trade investigation and India is on the list. Washington is probing 16 countries, including India, over excess factory capacity in sectors like petrochemicals and textiles. A second probe covers forced labor across 60 countries. Again, this one also includes India. Let's hear more from Abhimanyu. Abhimanyu, take us through what exactly these allegations are.
Well, these allegations were initially levied by the United States Trade Representative, and there are 2 counts on which allegations have been made, in which the Section 301 probe is being proposed. One is on forced labor and the other is on excess capacity. Now, for now, the hearings are slated to take place on the issue of forced labor, in which both the Indian government as well as several sections of the Indian industry have already filed their opposition to any such initiation of a probe, as well as any levy of a proposed 12.5% tariff. Now, the hearing is slated to take place before the USTR. It remains to be seen how the hearings are going to pan out, even as the 10% tariffs which are currently in place are slated to lapse on the 24th of July, post which only MFN tariffs are slated to apply. However, if there is some adverse verdict from the USTR, that would imply a levy of 12.5% tariffs on several sectors across several countries, in which India is also going to be an affected party. Now, the Indian government has already filed its response. The first response was filed a few months back, and the other one was filed earlier this week before the USTR, in which they have opposed any such probe, any such proposal of levy of a tariff. They have indicated that the probe does not satisfy the legal requirements for the initiation, and there is no evidence to suggest that India's exports to the US confer any artificial advantage or burden or restrict US commerce in any way. Now, the Section 301 probe, which has been initiated on not just excess capacity but also on forced labor, and several countries are expected to take part in it. But all eyes, of course, would be on how this is going to pan out, based on which any further levy of tariffs is going to be decided, even as the current 10% tariffs are slated to lapse on the 24th of July.
All right, Abhimanyu, thank you so much for taking us through those details. But on that note, it is time for us to head into a short break. But more news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Prime Minister Modi arrived in Melbourne last evening on the second leg of his three-nation tour, where he was received by Australian Minister for Housing Claire O'Neill. Today, PM Modi was accorded a guard of honour by Australian PM Anthony Albanese, following which both leaders addressed the India-Australia CEO Forum, with Modi pitching a $100 billion bilateral trade target by 2030. Paul Schroeder, CEO of asset manager Australian also announced a $500 million Australian dollar investment commitment. The two leaders then held the third India-Australia annual summit, signing MOUs across maritime security, civil nuclear energy, emerging technologies and skills, with Australia formally committing to export uranium to India for peaceful purposes. Here's what the Prime Minister had to say.
हमारी रिन्यूएबल एनर्जी पार्टनरशिप, क्लीन एनर्जी और क्लाइमेट एक्शन में हमारे प्रयासों को साकार रूप दे रही है। इसके तहत हम इन्वेस्टमेंट, टेक्नोलॉजी ट्रांसफर और इंडस्ट्री टू इंडस्ट्री कोलैबोरेशन पर विशेष बल दे रहे हैं। न्यूक्लियर एनर्जी के क्षेत्र में आज हमने एक महत्वपूर्ण समझौता किया है। इससे ऑस्ट्रेलिया से भारत को यूरेनियम सप्लाई का मार्ग खुलेगा और हमारे क्लीन एनर्जी के उद्देश्यों को नई ताकत मिलेगी। रक्षा और सुरक्षा में सहयोग बढ़ाने के लिए आज हमने एक महत्वपूर्ण जॉइंट डिक्लेरेशन जारी की है। भारत ऑस्ट्रेलिया डिफेंस इनोवेशन कॉरिडोर से हम डिफेंस स्टार्टअप्स और इंडस्ट्रीज को जोड़ने पर काम करेंगे। हमारे मैरीटाइम सिक्योरिटी कोलैबोरेशन रोडमैप से इंडो पैसिफिक में हमारे साझा प्रयासों को नई ताकत मिलेगी। हम शिप बिल्डिंग, शिप रिपेयर और मेंटेनेंस में भी मिलकर आगे बढ़ेंगे।
And Abhimanyu Sharma is back with us for all the updates from the India-Australia Annual Summit. Abhimanyu?
Well, 18 outcomes so far have emerged from Prime Minister Narendra Modi's official visit to Australia, and the visit is still continuing. It's likely that more meetings would be undertaken by the Prime Minister as part of his official visit. Now, several deliverables have already been announced so far. Both the sides have agreed to deepen their defense and strategic partnership, which will involve several outcomes which are going to be implemented in the next few years. Also, a joint declaration is going to deepen the bilateral defense and security relationship, and a common vision for Indo-Pacific has been spoken of by both the sides, which will imply more maritime cooperation between the respective coast guards of both the countries. Also, Indian states and Australian provinces can possibly look at forging economic partnerships based on their respective competencies. That's something which the Prime Minister had alluded to in his address. He also indicated that he's looking forward to a deepening of the trade relationship too between both the sides. Now, a trade pact already exists, but PM Modi indicated that both the sides can look for an early conclusion of the proposed comprehensive trade pact, which will cover all sectors and will increase overall trade between India and Australia. Both the sides are also looking to collaborate more on critical minerals, not just for extraction, but also for value addition, to add more synergy to the partnership and also to improve competitiveness on both the sides. The competitiveness is also possibly being looked at in terms of better cooperation between educational institutions, between research institutions and innovation-led partnerships, which both the countries are looking forward to. And several partnerships have been announced between Indian and Australian universities, which are going to be effected in the years to come. It remains to be seen which further outcomes are going to emerge from PM Modi's current visit to Australia.
Lots of action there from the India-Australia Annual Summit. Thank you, Abhimanyu, for taking us through those details. Now, Nissan India is all set to enter the mid-size SUV segment with the launch of the Texton. The Texton will be Nissan's first mid-size SUV in India since the Kicks was discontinued in 2023. The Texton rivals several popular SUVs like the Kia Seltos, Tata Sierra, Hyundai Creta and more. Bookings for Nissan Texton will start today and deliveries will begin from the 20th of July. The car is expected to be offered at an ex-showroom price of 10 to 18 lakh rupees. And with that, it is a wrap on this edition of Business Lunch. Mid-Cap Radar comes up next and we'll take you through the market action.
Good afternoon. Welcome to Mid-Cap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Vivek, good afternoon. Well, yesterday during MCR, we were talking about that big market fall because of Trump's comments, and now we are back up again. It's been a good day so far for the bulls. Mid-caps are participating big time, and Bank Nifty has also made an up move. It's up around 1%, and across the board, it is a green-looking screen.
Absolutely right. Good afternoon. Yesterday, we were the harbinger as far as, the sell-off that we saw is concerned, but today a very, very smart recovery. And in fact, it's the broader end of the markets, the mid-cap and the small-cap end of the markets, where advanced decline ratio is extremely strong. In fact, the market breadth, if you see that, that's very much in favor of the advances. A lot of stocks rebounding, especially from the capital goods as well as the banking pack. That's where most of the action is lying, Sonal.
Okay, all right. So that is about the secondary market. It's time to talk about the primary market action as well. India's largest asset management company, SBI Funds Management's 11,692 crore IPO opens for subscription on the 14th of July. Ahead of the issue opening, my colleagues Prashant Nair and Reema Tendulkar sat down with DP Singh, joint CEO, and R.S. Srinivas Jain, who's the Executive President, Chief of Strategy and Digital and Technology Head of Investor Relations, and began by asking them about companies' valuations and forward projections. Listen in.
So many factors around it, but if we go by our past history, the way we have been growing, then definitely yes.
Okay.
But there are always in the market, there are uncertainties. It could be more than this, it could be a little less than this. But the growth rate, the more and more financialization happens in the country, SBI mutual fund is at the forefront. We will get the maximum benefit. The moment today the biggest friction in growth of mutual fund business is the way KYCs are being done. These small players, the way it's a linkage between the remuneration for acquiring a customer and see all efforts to be bring in. So that is not working. The moment that friction is over, which is likely to happen very soon, and see once because all the bank accounts are now KYC compliant. The moment any bank account which is KYC compliant frictionlessly can part money in mutual fund, I think that will be the biggest revolution, and the number which is there today, only 6 crore investors, that will multiply like anything, and that the number could be anywhere. I'm not saying as much as number of bank accounts are there, but at least 20% of the bank accounts will be the mutual fund investors.
As soon as this KYC is that big, I mean, whenever that happens.
That's big, because lower level, middle level, nobody is servicing today.
Yeah. So just to close the loop on that, I'm not wildly inaccurate when I say 5,000 crores in net profits, 24 times earnings, which is actually quite reasonable as compared to some of the other listed peers, which I'm sure is a conscious decision. Srinivas, you want to just point, come in on that KYC and, I mean, that big leap that provides?
What are the two factors today driving the growth of this business, right? One is, of course, education. We talked about the 100 crore bank accounts, 5.5 crore customers in mutual fund industry. So obviously, there is some gap. That means that needs to be driven through either education. With mutual funds IA and such campaigns have really been helpful building that. As that moves, you now need to remove friction also. I think the way eKYCs have now come on board, the friction is kind of come down, but still it exists. Today, if you're a bank customer and you've done every KYC that's there, why do you need to do another KYC when you do a mutual fund? There's new KYC 2.0, which is CKYC 2.0, what they're calling as One Nation, One KYC. If that comes in very quickly, this friction point also goes away.
Do we have any timelines for it?
My understanding is that they are fairly advanced and ready from a technology point of view. We've also been talking to both Protean, CKYC team and all. SEBI chairman actually made a statement saying you should expect that very soon, because he's kind of spearheading this particular debate. So one of the things that we at SBI Group have about 55 crore customer base. And even if you take all those Jan Dhan accounts and others away, we have a 35 crore investors who are KYC'd in the bank. And that's like 55 lakhs today with us from already KYC'd SBI mutual fund customer. The headroom for us to grow, and this friction that's going to go away is going to make it a big...
55 lakh accounts, 35 crore KYC'd.
35 crore is the target audience. and 55 lakh is the audience today.
Where you are right now.
It's 2%, right? So from 2% to, even if I were to go to 10%, DP's number, which we are talking about 20 is a little far. Even if I go to 10%, that's a huge number. That's like 5 times our business that we are today with the bank. That's 2.5 lakh crores is what State Bank of India's AUM is with us. So think about it. That's a huge business.
It's a huge headroom to grow. So let's just understand about SBI Mutual Fund and the scale today. So in that 13 lakh crore of mutual funds, what is the contribution of equity, debt? And then if you could tell us the yield that you make on each of these, and including the ETFs.
I mean, so it's all in the public domain, but I can tell you we are about 6.5 lakh crore worth of active equity out of the 13 lakh crore that we have. Equity is a fairly profitable, very profitable business for every asset manager. For us too, it's upwards of 60 basis point is what we make on that pure equity assets. But then we also have, the scale kind of comes down. We have hybrid products, we have, fixed income products, we have money market products, and then we have ETFs. In ETF also, there are 3 varieties of ETF. The one we manage for the Nifty and Sensex, which are extremely low yield but very high volume business. But we also manage a gold ETF and silver ETF, which are fairly large margin businesses, which are even closer to active equity kind of margin. So it's widely diverse, the pace of business, and it also widely diversified. That means thanks to hybrid business, it's also not very volatile thanks to mark-to-market impacts that we have. We also have a fairly large fixed income pool that we manage. So our business margin moves from 2 basis point to a 65 basis point kind of spread.
Okay. On a blended basis, you would be at 37 basis?
Yeah, in fact, that's an interesting story there. Absolutely. Absolutely. That's a very interesting story. I think one of the things that have happened to us is that passive overhang that we had as 40% plus market share is kind of averaging out, and we are actually building a strong equity book. As you see, our SIP book is now 4,000 plus crores every month. And that's actually improving our active mix. Last 3 years, we've grown almost 32 to 42%. And that's a very steady growth. And I see that growth continuing.
So as your equities, which are actively managed, compound at 20-25% on an annual basis from here on, what would your blended yield look like going ahead, say 2 years or 3 years down the line?
Anyway, way to think about it is that today the best in class is close to about 44 basis point. I think we should come very close to that because clearly, as you see, the active participation going up. But at our scale, that's a difference. The blended yield for a smaller player at 40 basis point and at a 13 lakh crore player is a completely different way to think about it. So we are probably one of those few very large asset manager because of this active mix going up.
And your operating cost, I believe, is also the lowest in the industry.
Yes. We run a very tight book. In fact, our cost-to-income ratio is like 20%, which is probably one of the most attractive, not just in India, globally, for any asset manager.
Well, that was the management of SBI Funds Management and the ongoing IPO. A lot of interest in that particular name. Well, we now slip into a short break. When we return, a deep dive into how India's real estate sector has fared in the first half of 2026. A detailed chat with Knight Frank's Vivek Rathi is coming up on the other side. Stay tuned.
Welcome back. Real estate, Nifty Realty, that is the top gainer today as far as the sectoral moves are concerned. If we talk about the data, housing demand has held steady in the first half of 2026. New home launches have outpaced sales in first half of this year. To discuss more on the trends in the commercial and the residential space, we have with us Vivek Rathi, National Director Research at Knight Frank India, joining us now. Vivek, good afternoon. Thank you so much for joining us. So your data suggests that in the first half of this year, India overall has seen a growth of around 4% in terms of launches and 1% in terms of sales. What is the outlook for the remainder of this calendar year? Do you think the launches are far outpacing the sales growth and that could become an issue at some point in time?
Important question, but before coming to that, I would like to highlight all of these decisions when it comes to housing are long-term in nature. Home buyers take a 10-20 year view and accordingly commit. And what that means is the home buying sentiment continues to remain positive in the backdrop of all of the concerns we have been carefully watching over the last 6 months and also 12 months. Yesterday, with the development on the US-Iran standoff, again, there's been great amount of uncertainty. Having said so, home buying as a area continues to remain in the domestic territory, and driven by the domestic variables. We think 2026 is likely to close at fairly same levels as 2025.
Okay, so you're expecting demand to remain stable despite all of the uncertainties that we've seen as far as the market is concerned. In terms of geography-wise, Mumbai clearly ranks up high in terms of the performance. Have there been any worries, especially as far as Karnataka, Bangalore, or Hyderabad is concerned, given some of the worries regarding the IT sector?
So as of now, what we've seen is there's been demand slowdown in the IT sector when it comes to commercial office space take up as well. But at the same time, there has been a great amount of take up compensation by GCC segment and flex categories, which highlights how the overall demand momentum for commercial spaces continues to feed into the subsequent housing demand that we should build our expectations on. And markets like Bangalore or Hyderabad, Chennai, these are ecosystems in themselves with deep tech talent, and the kind of demand we've seen in segments like GCCs, flex spaces, leads us to believe that the momentum is going to be fairly resilient in the next 6 months as well.
Okay, all right. NCR in particular has seen a decline in sales, has seen a decline in launches as well. What is really happening in that market? Because we do have players like Oberoi Realty seeing, a huge chunk of their projects selling in the first week itself. Then you have sales going down. What is happening in that market?
So, like you said, you highlighted one instance of the high value segment, and this is one of the key reasons why at the overall level the NCR market has seen a decline, because when it comes to the volume for the overall market, participation has to come across categories, right from the low value segment to mid value leading up to the high value segment. What has happened is that been crowding out for the lower value segments and mid value segments in markets like Gurgaon, which is why the overall numbers show a decline. Whereas in the higher value segment, where there is relative inelasticity when it comes to home buyers desire to fulfill their wish, there's been a strong momentum even in the NCR market from on the instances we've seen in the recent projects as well. So one of, whether it is Mumbai or it is Gurgaon, there the key variable to watch in terms of high value segment is going to be the level of launches or unsold inventory. As long as that is in right position, market is fairly poised even in the premium segment. But in the lower segment, it's more of the crunch on supply for a range of reasons.
Vivek, give us a sense as far as the commercial space is concerned. You alluded to the fact that there's been a little bit of weakness as far as fresh space for office is concerned. So which are the segments doing well, which are the segments not doing so well, and how are realization trends panning out over there?
So when it comes to commercial spaces, we've seen shrinkage in the space take up by the third-party IT services sector. Now, primarily, the third-party IT services sector was witnessing pressure in the backdrop of all of the geopolitical concerns in terms of their billing cycles on client accounts, and as a result, and also the AI related disruption that is requiring them to reorient their business. But at the same time, GCCs, which is again on the outsourcing premise, but a greater commitment when it comes to the occupiers, that space has continued to remain very strong even in the latest period. Besides, we've seen uncertainty over the last 6 months yesterday with the development on the peace accord, there's going to be uncertainty even more going forward. So occupiers are looking to build in optionality or flexibility in terms of their long-term plans. So what we will see very likely is long-term plans will continue to remain intact, but given the uncertainty of the next quarter or two, because of whatever is happening on the geopolitical account, occupiers would want to build in flex spaces in their portfolios. And a translation of that is what we've seen in the demand share for flex space, which has further improved in this particular period.
Okay, all right. Thank you so much, Vivek, for joining us with your thoughts on what's happening in the realty space. And while we are talking about realty space, Oberoi Realty is in focus again. This is a PTI story where Punjab and Haryana High Court have restrained Oberoi Realty from fresh allotments in the Gurugram project. Remember, this is the recent project that they had launched on 29th of June, and they had announced this Monday itself that they have done bookings of around 8,000 crore rupees. This was a long-awaited project for the company, and they got that approval on 23rd of June, the RERA approval that is, and they launched it on 29th of June. And now there is a news that Punjab and Haryana High Court have restrained the company from fresh allotments in Gurugram project for brokers or for third parties. We'll try and understand what this really means and where this order has come in from. But there is a stock reaction for sure. The stock is at the day's low, down around 2%. A very important project for Oberoi Realty, and any adverse news is something that is impacting the stock price for now. Slip into a short break. We'll get you more on this markets and stock-specific action on the other side. Welcome back. You're still tuned into Mid-Cap Radar. The market continues to do well, but we do have the mid-caps which are surging in trade. This is our segment Mid-Cap Movers, and Upasana is here to take us through the mid-caps that are moving around in trade. Upasana.
Well, the Nifty mid-cap index is up over 1.5% as we speak right now. So let us focus on the top gainers in today's trading session. Topping the list is Unicam Lab. It's up over 36% in terms of the 1-month move and up more than 12% as we speak right now. Second one is Azad Engineering, is the another one on our radar, certainly a volume buzzer. The stock is near its 52-week high, followed by Borosil Renewables, continued to remain a volume buzzer since morning, up more than 10%. And also remember that the CNBC TV18 exclusive, according to the sources, there was a news break that the company is in preliminary talks for a strategic investment. So hence we are seeing that such a sharp move on that one. DB Corp also in focus, another volume buzzer, volumes up more than 71 times the weekly average, up more than 5% as we speak. And lastly, Brigade Enterprises continues to outshine with a 4% surge. Also, Nifty Realty Index also continues its positive momentum today as well. Now, let us look at some of the stocks in EMS segment. So, since morning, EMS segment continues to remain in focus as government extends basic custom duty exemption on key display assembly components till March 2029. Dixon, Kane, Sirma, certainly one of the key positive beneficiaries of this one. So we can see that surge today, up all of them more than 4%. And on the flip side, let us look at some of the top losers in today's trading session. Topping the list is Page Industries, down nearly about 2%. Polycab also down nearly about 1%. Sterlite Tech has recovered with an uptick of nearly about 2%. And lastly, BLS International is down 2% as well.
Thank you so much, Upasana, for joining us and giving us all of the top movers and shakers as far as the broader end of the markets are concerned. Well, now moving on to our special segment, Mid-Cap Spotlight. The stock that we are tracking today is Capri Global. Ria joins in. Ria, what's triggering the run-up in the stock of late?
Well, yes, Capri Global has been in focus today, up nearly 5% today, and this is after Capital Group's small cap World Fund has increased its stake in the company by nearly 1%. They've bought around 1 crore shares in an open market transaction yesterday. The deal value is nearly 240 crores, which at an average price of 240 rupees per share. And remember, the fund has increased its shareholding in the stock from 1.71% in June to now nearly 2.74%. Now, following this, the stock today has hit an all-time high of nearly 249 rupees on strong trading volumes as well. And in fact, in the last 1 month, the stock is up nearly 23%. In the last 6 months also, we have seen a good performance, around 36% of an increase on the stock. And even in the last 1 year, nearly 50% of an increase on Capri Global. Now, recently, remember, the stock also received a rating upgrade to a AA positive rating from its earlier AA rating. And in fact, in FY26, the business has been performing well. In FY26, they reported very strong AUM growth of nearly 60% compared to the previous year, with the net profit almost doubling compared to the previous year as well. And in fact, gold loans also now account for nearly 46% of the total AUM of the company, which strengthens its secured retail portfolio. So the company has been performing well, and with this new investment, the stock continues to gain high in today's trading session.
Thank you so much, Ria, for joining us and putting the spotlight on Capri Global. But moving on, the next stock on our radar is Amara Raja. It's buzzing in trade on the back of a government relief for lithium cell makers. Sudarshan, who tracks the space closely, joins up with more details.
So it's positive news for all the battery makers, and Amara Raja is one of them, currently high in the trade because the news flow is government has exempt customs duty for the goods used in the manufacturing of lithium ion cell, and all the companies including Exide Energy, Amara Raja and Reliance Energy are setting huge facility. Amara Raja, if you talk about, it's setting up 16 gigawatt lithium ion cell manufacturing unit in Telangana, and on the back of this, stock is sharply higher. And another positive news for battery makers is there is a sharp reduction in lead prices also over the last few months. So tracking both the news flows, all the stocks are high.
Well, thank you so much, Sudarshan, for joining us, giving us the details on Amara Raja. Well, once again, if we could look at the stock price of Oberoi Realty, that particular stock has now moved to the lowest point of the day. Remember, there was quite a lot of excitement in the market, especially as far as the Gurugram project is concerned. But any negative developments out there is something that the street doesn't like. That stock has now moved, from being in the positive, now moving into the negative territory. The other stock that's seen quite a bit of a sell-off is Maruti. Maruti is now down to the lowest point of the day, that particular stock down over 1.5%. And very interestingly, even as Oberoi Realty moves lower, DLF has moved to the day's highest point. Remember, DLF2 is a prominent player in the same geography that Oberoi Realty has actually made a bit of a foray into. But with that, it's all the time we have on this edition of Midcap Radar, Mutual Fund Corner, when we return.
Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Sonal Bhutra as always. Sonal, a very good afternoon. And today we're going to be discussing NFOs. Now, it's interesting because the inflows that we saw coming in for NFOs were at a multi-month low in the month of May. We have more data coming in tomorrow, but at least May, as of now, an indication didn't seem that exciting. What do you think?
So, yes, NFOs are something that saw a big surge a while back, but then this momentum that has tapered off. If you look at the data as well, last year, July, there were 30 NFOs which were issued by the AMC industry, which raised around 30,416 crore rupees. And since then, it has been a one-way downfall from those levels. August, 23 NFOs with 2859 crores. Then, yes, it picked up a little bit in terms of the total amount or the total value of the NFOs. But then Jan 2026, we started on a somber note. It was around 2,000 crore rupees. Then come Feb, it was around 4,979 crore rupees. We came to April at 828 crore rupees. And in May, though the number of NFOs were higher than April at 13, the value there was lowest that we've seen in in a lot of months. So it was just at 471 crore rupees. We thought it's interesting to understand what NFO really means for an investor. In this week itself or in this month itself, we do have some interesting ones which are ongoing or will be upcoming as well. Let's talk about that because a lot of them are passive funds in particular. We do have Axis Nifty 50 Equal Weight Index Fund which launched on 3rd of July. The closure is on 17th of July. We have a Nifty Metal Index or the ETF which is launched by Edelweiss and that is the closure date is 20th July. There's Nifty Cements ETF, which is by Grow, and it ends on 22nd of July. So a lot of sectoral funds or sectoral ETFs are also getting launched now. ICICI is coming out with its balanced hybrid fund, which closes on 14th of July. They also have a multi-asset fund of fund. Interestingly, they do have a multi-asset fund already, and now there's a fund of fund which is coming by as well, which closes on 14th of July. Kotak Nifty Private Bank ETF, again we have a sectoral ETF which is coming in the market. There are two interesting ones now. It's a very aggressive momentum fund which is launched by Mirae Asset. It is BSE Midcap 150 Momentum 30 ETF. We'll discuss that in greater detail. There's Motilal Oswal BSE Midcap 150 Momentum 30 Index Fund. The underlying of both these funds are the same. They are quite aggressive. So this is for high risk taking investors. But again, these are momentum funds, so you need to keep that on your radar. Trust Mutual Fund is coming out with a large and mid-cap fund. The fund launch date is 3rd July and the closure date is on 17th of July. There are some interesting lineups basically that are ongoing, but as we saw in May, the launches were not so big. So what happens now? What's the outlook going, and who should be looking at NFO? Let's just simplify that for our viewers first up. To do that, we do have with us Kaustubh Belapurkar, Director of Fund Research at Morningstar Investment Advisor, joining us now. Kaustubh, good afternoon. Thank you so much for joining us. A lot of viewers do get confused because the 10 rupee NAV, the understanding is maybe it is making a fund cheaper, and that's why you should just look at an NFO versus an existing category already. Does that really make it more cheaper or more attractive than a fund with a higher NAV?
Sure. Hi, Sonal, and thanks for having me in the show. I think, just taking a step back from the numbers that you mentioned about the NFOs, it's a little bit like Mumbai rains, right? We've had heavy number of NFOs come in, and there's been a little bit of a slowdown now in terms of, I would say, volume, in terms of the amount it's collected, but I think the numbers still remain fairly elevated in terms of the overall launches that are happening, right? Coming to a specific question, I think that's a very important distinction to make, right? That categorically there is a lower NAV has absolutely no bearing on the future outlook for a fund. I mean, investors shouldn't base their choice of fund based purely because it's a 10 rupee NAV versus an existing fund that's at a high NAV. So that's, I think, very, very categorically, I think investors should stay away from making any such decision. I mean, it's not steeped in any kind of logic from any sense. I mean, if you had two funds which have exactly the same portfolios, one's a 10 rupee NAV, the other say 1,000 rupee NAV. If they have the same portfolio, if they return 10%, the 10 becomes 11 and the 1,000 becomes 1,100. So exactly the same percentage movement. And if anything, a fund with a high NAV used to be a 10 rupee NAV fund at some point of time, right? So they've actually built that track record over a period of time and delivered that the proof of the pudding of the returns that they've delivered to investors. So do not go by optically lower NAV that has absolutely no bearing on the future performance of the strategy.
Mm-hmm. Do not go by the NAV number. That's not got the indication in terms of the fund performance. And Kaustubh, when it rains, it pours, right? In terms of NAVs also, NFOs also. So that is something that we'll keep an eye out on in the months going forward as well. But specifically, given that there is no track record for this, how should investors evaluate NFOs? NAVs is not a criteria. How should we look at it before investing?
Sure. And I think that's a very important thing to think about, right? That you have all of these new NFOs come about. How should investors be looking at it, if at all, right? So the first thing that every investor needs to do is ask themselves that question: that is this fund suitable for my portfolio? Depending on his or her risk return objectives, what is the investment time horizon? And what is the asset allocation that kind of drives the overall portfolio mix in their portfolio. So that's the first question that every investor needs to ask themselves, because if the fund's not suitable in their portfolio, however attractive it might be, it shouldn't even be evaluated or thought about from the context of your individual portfolio, right? So that's the first step of evaluation. If it does meet that criteria, then the next and more important thing you need to think about is, what is this fund giving me that existing funds with already well-established track records are not providing to me, right? So I think that's something that investors need to think about. Is there a unique edge, or is it giving me a certain exposure that perhaps I need as a part of my portfolio, which existing funds aren't offering, or something which I can potentially think about evaluating. right? That's something that you can look to assess in terms of the investment strategy or the way the portfolio would be potentially constructed in that particular fund, right? And again, I think most funds that you would think about would probably, for investors, not make sense, NFOs, because you don't know how the fund's going to pan out over a period of time, or there are already existing credible, well-established alternatives that are available, from the investment universe. If you think that there is an edge that's there in the investment process or in the way the fund will be managed, you also need to think about the investment team expertise, right? Now, there's no track record, obviously, in terms of the fund, but most likely the investment team that's managing it have a pretty well-established track record, be it in managing funds or perhaps, other schemes like PMSs, or, that's something that investors can assess and see where is the expertise, how they delivered sort of, across market cycles and some of the other strategies that they manage. So I think some of these checks can be done by investors, but like I said, I think most investors can probably, just stay away from NFOs purely because, you already have existing good alternatives that are available to you and already afford you that exposure. You don't really need to go to an untested sort of, product that's just being launched.
Exactly. So, people often confuse NFOs with IPOs, not understanding that you already have that category available. It is not going to give you any listing gains. It is not going to change its performance or their portfolio construction in any way unless it's a new category. So that's exactly my next question. When a fund launches, when an AMC launches a fund, what is the reasoning behind it? Is it just portfolio expansion, or are they trying to really fill a gap in investors' portfolios?
Sure. So let's think about, let's take into context what's been happening over the last many years and, in terms of just the way, fund launches have happened, right? One is obviously now SEBI has a fairly stringent categorization system that's been in place since 2018. In most diversified categories, they've obviously laid out one fund per category, but they also have sectoral thematic funds, passive funds, and there have been introduction of a few new categories that have come about, and we'll talk about some of those that have recently been launched, right? So when you think about the launches that have happened, you have new asset managers that are coming to the fore, and obviously they will be launching diversified funds within fixed income and equity, kind of completing their product bouquet, right? Those are some of the launches we've been seeing in the recent time. We've had a lot of passive strategies that have come about, first on more broad-based market cap-based indices, large cap, mid cap, flexi cap, and so on and so forth. But more recently, we've also seen more sectoral thematic, some of those you alluded to, which are coming up to launch, and also sort of smart beta, could be factor-based indices that are coming about on the passive side, right? So that's another area that's seen a lot of fund launches. Then we had this whole host of what we call sectoral thematic funds. 2024 was a big time, and we were in this extreme bullish phase of the market where you had a lot of these sectors or themes that were getting launched. I think we've seen a little bit of a slowdown on that, but some pockets, sort of still continue that we've seen kind of launches around that. And then, which is I think very interesting in the more recent past, is the new categories that SEBI's introduced. For instance, the life cycle funds. Now, a couple of asset managers have already filed for life cycle funds, and I think this is a space which is quite interesting from our perspective, because this is a category which could be, sort of long-term investing opportunities for investors who are looking for meeting goals like retirement or several other sort of long-term goals. This is a very popular category in markets like the US, called target date funds, and this is something which we're looking out quite actively for, because they can actually fulfill a need for investors in terms of portfolios, which currently may not exist in its purest form as a auto allocation sort of life cycle strategy. So yeah, I think that's broadly the way asset managers have been sort of launching. It is a growing market, so obviously I think the NFO momentum will perhaps continue. But I think investors need to be very judicious about what makes sense in their portfolios and what should probably just be avoided.
Absolutely, point taken there, Kaustuv. But on that note, actually we're going to slip into a very short break, viewers. We'll also come back with more on these points, more on NFO discussions. What should we all be looking at? Stay tuned in on the other side. We'll be back. Welcome back to MF Corner on CNBC TV 18. We still have with us Kaustubh Belapulkar, Director of Fund Research at Morningstar Investment Advisors. And we're discussing NFOs. Now, while we've in detail discussed what should you all be looking at when picking up an NFO, is it exciting to look at it? Kaustubh, the question comes in at a point of time when you already have existing funds, then are investors better off choosing existing funds versus an NFO that is coming up right now, other than life cycle funds, which you mentioned, are the newer categories which the SEBI has come up with? Would it be better to look at an old fund then?
Yeah, really, absolutely. I think, that is, a very simple answer to that, I think in almost all the cases for investors in strategies where, you already have existing well-established funds, you have a track record to go by, you've had a very stable investment team, you've seen the way the fund has been managed in terms of its style, it's how it's done across market cycles. That's the strategy that I would go to, pretty much all the time. And that's what I would do. Only, like I said, where there are very, very strategic differences where you would see, which exposure that you've never gotten before and an existing fund doesn't offer. Those could be some of the cases where you could potentially consider an NFO, or perhaps, and this is, this is my personal opinion, that there's maybe a portfolio manager that you really like, and he or she has managed funds with maybe another asset manager in the past, and you've been invested, you've had a good experience, and perhaps you want to now invest in a fund that they're managing, with a similar style in a new asset manager. So it's an NFO. Maybe you can think about it, but again, like I said, right, always the well-established ones would anyway serve your purpose. NFO is whatever you may like. It's not tried, it's not tested. So you would rather let it build its track record, its credibility, and then you can perhaps evaluate it. But yeah, in most cases, you just be better off investing in existing funds.
So, when you said some of these, you do not have a record of the fund, but you do have a track record of the team. But we do have a lot of AMCs which are coming in the market, and to expand, they have to come out with new products, right? So when you're looking at such newer AMCs, which does not have a track record, maybe yes, the CIO, but other teams they are not so aware of. What are the key risk investors may be overlooking while they invest in any particular NFO, maybe from an existing well-established AMC or the newer ones as well?
Yeah, that's a great question, Sonal, because many times obviously you think about the face of the portfolio manager who's been managing the strategy, but there are a couple of things to think about when you evaluate any strategy, right? Be it a new fund or an existing fund. Now, there's obviously the investment team you want to think about, that not just the portfolio manager, but the support cast is equally important in terms of evaluating that. Are they able to provide the raw material, which is the stock or the bond ideas to the portfolio manager, where they can build a portfolio, for the long term, in a very similar style that they've perhaps done with their early AMs. Now, that's something which may not be easily apparent to investors. That's something, which could potentially be a risk that maybe in the newer asset manager, the team is still, kind of finding its ground. There's still, whereas an established team that has worked together for a long period of time, they actually have a pretty good understanding and cadence of the way the portfolio is to be managed, right? So that is an unknown entity or risk in that sense. Even though perhaps the portfolio manager is good, they need to find their feet sort of in the new system, right? The other is, how is that portfolio actually going to shape up over a period of time, right? One is obviously deploying the funds, but is it going to be run in a similar style, or are there going to be changes in the way it was managed? That is an unknown entity. So we speak about the investment process, the portfolio construction. We don't know how that's going to be in a new fund offering, right? So while obviously the new asset managers who are launching funds, they're very much, they have to do that because that's how they will build a track record. But investor has the choice, right? That they can just maybe observe for a period of time and not jump into that, because it's not like you have to get into the NFO period. You can always invest after a few years down the line when it's built that track record. So I think these are some of the risks that investors need to keep in mind. Another very important risk, especially the new funds that have been coming, right? Because there are narrower thematic sort of sectoral or sort of smart beta strategies, they might optically look great to an investor because perhaps that segment of the market has done really well in the recent times, and you might be sort of keen to invest because of those recent returns. That's actually probably the worst thing to do looking at, because A, the fund may not be suitable for your portfolio or your risk return or your time horizon. And B, as we know, markets always go through cycles. And just because it's done well in the recent time doesn't mean that performance is going to continue till perpetually. And investors might come with mismatch expectations. And that's actually a big risk when it comes to sort of, more narrower thematic strategies. Again, not necessarily just NFOs, with any existing sort of sectoral thematic strategies. So I think these are some of the risks that investors need to keep in mind when they're evaluating an NFO or any other strategy.
Some of the risks that one should watch out for when investing in NFOs or other strategies. Costa, point taken there. Now let's talk about some of the new ones, right, that are on the block. You have the Mirai Asset BSE Midcap 150 Momentum 30 ETF. Have you looked at it? This is a passive ETF category. Mainly, this is going to be a strategy that they start with the BSE Midcap 150 Universe, right? That's the word there. So have you managed to look at it, and what sort of investors maybe could look at this one?
Sure. So when you think about the way this index is constructed, right, and again, I want to just talk a little bit about, sometimes there's a misconception that passive is less riskier. That's not the case, right? This is a very, very specific factor-based sort of index, based on the midcap 150, and then you look at the top 30 stocks by momentum score, which, while it's rules-based, but momentum obviously typically looks at the stocks that have over the last 12 months done exceedingly well, and you expect that trend to continue. That's really what the momentum factor is about. So this can be, a very high risk, high return sort of, potential, but can come with extreme volatility, depending on the way the market sort of plays out. So I would say that investors, again, it's a very, very nuanced product, and probably most investors shouldn't even look at these strategies. Only investors who are, probably very, very keen to take on some additional risk within the mid-cap universe, understand the volatility that can come with this kind of a portfolio, might take some graded exposure. But otherwise, I think most folks, who want that sort of momentum play in their portfolio. But I think most folks would probably want to stay away, from these, who want to build sort of more long-termish sort of portfolios in their for their portfolios.
Take that point. So the Motilal Oswal BSE Midcap 150 Momentum 30 Index Fund, it's not an ETF, it's a fund. You would say the same thing, right? Not everybody should look at it, only somebody with a higher risk appetite.
Absolutely.
Okay. Interesting. Both these similar categories are launched at the same time, and as we've been pointing out, high risk, very high risk for aggressive investors overall. So there is this product which has come into the market for them as well. We do have trust mutual funds, large and mid-cap fund as well. In a market where we already have so many such categories, what would you suggest to the investors?
Yeah. So I think, again, on similar lines, I think obviously trust, as an asset manager, is, fairly new in that perspective. But when you think about, Mihir, who's the CIO, and obviously he's also co-managing several of trust funds. I mean, he's a very, very experienced manager, no doubt about that, across mutual funds and insurance. He's seen several market cycles. But again, I come back to that same point. While we've got, a very experienced manager, we have several other well-established large and mid caps with existing track records. So I would rather let Mihir and team build that credibility and that track record with this particular strategy, like they're doing with several of the other offerings on the flexi cap and the small cap. And once that's established, then investors can consider that. But perhaps for now, just look to existing large and mid caps within that space. And there's several good funds that are already available in that space.
Mm-hmm. Okay, Kaustubh, thanks for joining us today, helping us understand NFOs, which investors should look at it, pros and cons over there, as well as in terms for newer NFOs that are coming in, how should one be looking at them. Thank you so much for joining us and helping us understand all of that. But with that, viewers, we are absolutely out of time on this edition of MF Corner. Thank you so much for tuning in. Last hour of trade is still left, and you have closing bell up next for that.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Start with Kospi, the standout, up around 3%.
And every time they hit us, we're going to hit them 20.
Expect a muted quarter, no growth, flat kind of a top-line revenue.
So US launched further strikes against Iran. Oil markets have started 23,950.
Financials and consumer discretionary remain our big bets.
They could increase the weightage of ethanol in the standard index.
There's some bit of a supply issue, delay in supply of semaglutide.
The market's looking to make a recovery from that sharp sell-off yesterday.
Extends the basic custom duty exemption on key display assembly components.
A solar glass maker is in exploratory talks with a strategic partner for a promoter stake sale.
Well, a good day for the bulls so far. We are seeing gains across the board.
Today, only 6 crore investors. That will multiply like anything.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and just a bit from now, Prashant as well will be joining in. Well, it's been a pretty good day for the markets because the Nifty is holding with solid gains. Intraday, there has been some volatility, but at around 24,050, well, little that you can quibble about this. I think the big highlight really is the spike that we saw in crude oil prices has more or less given up almost all of that spike. So we should pull up the crude price. We started the day at around 79.5 or thereabouts. Overnight, it even breached $80 per barrel mark. But the last I checked, it had come back to around $77 per barrel mark, which is good from a bullish perspective. And that's going to be the big highlight as well from here on. You had the Nifty Bank that's been leading the way. That's up close to 100%. I made this point earlier today as well. If we need to see a bit of a bounce, and the Nifty Bank obviously needs to get back to its winning ways. And if not mistaken, I think we should pull up, the 200 DMA with it. I think it's just breached that mark at around 57,200. So let's try to get that up for you on the screen. Nifty Bank is doing well, but I think the real money is being made in the broader markets because yet again, the breadth of the market is looking spectacular. Yeah, that's the Nifty Bank, the level that I'm talking about. At ballpark around 57,300, 57,400. That's a bit of a resistance mark where the 20 as well as the 200 DMA come in at. And that's almost getting breached as we speak. The breadth of the market is good. You have 5 stocks that are gaining for 1 stock that's declining. And a lot of stocks are doing a thing of their own. Kalyan Jewellers, that's quite an interesting stock. Volumes are very, very large out there. The stock had pulled back a little bit. You had a brokerage upgrade that did come in there. But that stock is moving up considerably as we speak. And even after this sort of rally, it trades at around 20 times. I'm reading an ICICI Securities note who have a buy rating out there. Their target price is 670 rupees. And just going by the volumes, I think by the end of today, we'll have to be, checking the block bull details as well, the large trades, if in case there is a big buy that has turned up there, or maybe the seller that was there, that's got eliminated as well. But that's one of the stocks as well that we'll ask our fundamental, experts about. But it's an action-packed final 60 minutes of trade trades. Let me tell you what's lined up on Closing Bell today. The Nifty is hovering around the 24,050 odd mark, around the high point of the day. The broader market indices, they are outperforming. All sectors in the green. Real estate and consumer durables on the front foot. Defense back, well, some of those stocks are sulking on the back of a bearish note coming in from Kotak institutional equities. But what's their rationale for such caution? Well, we'll get the details on Closing Bell. Pharma major Dr. Reddy's, well, that tumbles as there is some quality issue delays with regard to the commercial launch of semaglutide. Details coming up in just a bit. And there's splendid gains on shares of Borosil Renewables. We understand the company may be in process of executing a strategic investment soon. That's a CNBC TV 18 exclusive. But let's start off with focus on the defense pack first. We have defense stocks, especially Mazagon Dock as well as Solar Industries. Both of them are under pressure after a cautious note comes in from Kotak on both these two stocks, currently at the low point of the day. Ria joins in to tell us about why these stocks are under pressure and what's the rationale that Kotak has. Ria, take it away.
Well, that's right. Kotak Institutional has come out with a note on the entire aerospace and defense space. Now, while they do have a cautious outlook on the entire sector, they have said first that they do believe that India's defense sector is on a multi-year structural cycle. The defense capex CAGR will be nearly 11% over FY26 to FY30, and the defense capex is set to reach nearly 2.8 trillion rupees by FY30. Now, they have also mentioned that India's defense companies are well positioned to benefit from rising geopolitical tensions as well as accelerating modernization programs, and also the expanding export opportunity. We are targeting nearly 50,000 crores in exports by the end of FY29 compared to nearly 38,400 crores in FY26. Now, apart from this, the positive part, they have mentioned that India's defense companies trade at an approximately 50% valuation premium over its global peers, and India trades at nearly a 50 times one-year forward PE, while global peers trade at nearly 28 times. Now, they have said that this premium reflects a faster projected revenue growth rate. For India, the revenue growth CAGR is nearly 26%, while for global peers it is 11%. But during FY21 to FY26, Indian defense manufacturers also saw EBITDA margins expanding by nearly 500 basis points to 25%. However, after adjusting for these lower R&D, adjusting for the lower R&D spending, the EBITDA margin advantage versus the global peers narrows from nearly 800 basis points to 450 basis points as per Kotak Institutional. So on the back of this, they have a cautious note on the entire defense space, and they have initiated a sell rating on Mazgaon Dock with a target price of nearly 1,950, and for Solar Industries as well, they have a target price of 10,300 rupees. And on the back of this, both of these stocks are trading lower today. Mazgaon Dock seeing cuts of nearly 2.5%, and Solar Industries down nearly 4% today.
Got it. Okay. All right, Ria, thanks a lot for that. That, note clearly has spooked the stock, both those two, Mazgaon as well as Solar. But let's get in Deven Choksi, MD at DR Choksi Finserv, who joins us on the show. Hi, Deven. Good afternoon. Good to see you on the show. What do you make of these two? I mean, periodically you've seen some of these stocks. Solar, there have been quite a few that have been bearish in that journey from, I think, the most recent from around 5,000 to around this 18,000, 17, 18,000 odd mark. There's another note now that's come in there. It's getting a reaction today in line with what the brokerage has to state. You think it's a knee-jerk reaction? Would you be looking to get into Solar Industries or in fact Mazgaon Dock as well? Or would you stay cautious?
Yeah, good afternoon, Nigel. So my understanding on the subject says that this kind of defense program that the companies like Solar Industry is executing, starting purely from explosive to creating the warheads, this company has actually transited in a very systematic manner into this value chain. That is the first point. Having taken longer time to establish this product and got it approved from the defense organization is another big challenge which they already crossed it. So today they are in a situation wherein probably with the large number of manufacturing facilities and the product portfolios that they have, they are in a situation to get into the mode where probably the products are getting into the exports market. And that's where the larger amount of growth challenges that we are talking about, including, I think, the one which we have recently signed up with BrahMos with Indonesia. I take is that I think some of these particular businesses are going to be expanding big time. Probably today, Indian defense companies haven't experienced enough about the export-led opportunity that they are now getting exposed to. And that's where probably I believe that the companies with capability like Solar would probably have relatively bigger picture to talk about going forward. Expensive valuation, answer is yes. But given the kind of stronger amount of capability at the same time execution, I think that they've proven, I feel that I think this company probably will remain expensive. And I think the buying at a dip would be a better strategy. Also, strategic investment that they have done in different companies which are basically manufacturing some of the missiles as well as drones, etc. They are actually very strategic in nature. And that's where I feel that the valuation unlocking could also be benefiting this company. So we will certainly look at, I think, the correction in the stock price as a buy opportunity in this kind of businesses.
Yeah, no, absolutely. While the Kotak report is a pretty exhaustive, extensive report, and Kotak, of course, is a well-regarded sell-side broker. I mean, research is top-notch. They cover, of course, I mean, the coverage is some of the larger companies, right? That's the thing. Companies which have already become very large, they can continue to do well. but it's the same large cap looking for newer, smaller ideas which can grow much rapidly because of smaller base. So, I mean, I don't know. Anything comes to mind there in the smaller, more niche areas? Lots of them, 5,000, 10,000, actually even less than 5,000 crore market cap companies. These are suppliers to some of these larger entities in the listed space, Devin. Anything you've done, anything you like?
Honestly, Prashant, I think there are many companies which are probably, I think, supplying to the defense areas of businesses, and some of them would including the companies like DCX particularly, and likes of other those companies, I think, which are basically integrated player into some of the larger ones. However, I think my take is that when the size is growing bigger and the opportunity is available to the OEMs compared to I think, the smaller companies, it would probably make more sense to buy into the larger ones like HAL for that matter, or BEL for that matter, or for that matter BDL. Such kind of companies probably I think would deserve to be there in the portfolio, considering the 3 to 5 years of runway is relatively very strong for these companies and the order books along with. Yes, I think the small companies which are ecosystem players within this particular basket, they definitely will get a leg up, but they would be slightly vulnerable comparatively on the margin front as well, because I think the larger players would probably demand at a competitive price. Otherwise, I think they are not wrong, but at the same time, I think we'll have to be a little bit more prudent in allocating funds to those companies which are growing much bigger in size at this point of time.
Got it. Okay, all right. Let's turn our attention to the pharma pack then. Dr. Reddy's, that's the top loser today. Vinny joins us to dissect the news flow on this particular one. Vinny, take it away.
Hi, so for Dr. Reddy's, actually they've flagged a quality issue in the semaglutide batches. So what does this indicate? Now some commercial supplies of semaglutide could become a delay temporarily for the company. They furthermore said that there was some issue that was that came out on some specific issues for quality. Some specifications were not matched, and this was an issue linked to the API supplies that came in, an API that was used in the product. So that becomes an issue, and that is why the commercial supplies now could be delayed temporarily for the company. The company furthermore said that they are still trying to find out the root cause and will go in detail to find out that root cause and investigate that. Obviously, they will take corrective measures, and then only they will start the commercial supplies once the product is up to the quality. But semaglutide was a big opportunity, weight loss drug, GLP-1 opportunity that everyone has spoken about. So because of that, we're seeing the pressure coming in on the stock today. Apart from that, obviously the suppliers to Dr. Reddy's also are something that one should watch out for, whether it's OneSource Specialty or even Shelley Engineering are some of the suppliers that come in, right, or CDMO partners that come in here for the company. So let's watch out for that as well. But as of now, temporarily, this is a blip that comes in here. If it's resolved soon, then there may not be much of an impact that comes in for Dr. Reddy's. But if it goes on for longer, then it's an issue.
Got it. Okay, all right. Thanks a lot, Vinny, for that. Devin, what do you make of this? This news flow has knocked the stock back, but would you be interested at these levels a little lower?
Downside risk in this particular stock has probably, I think, got further minimized. As such, I think the company is trading, I think, at a valuation which is historically a low valuation, as I see it. And given the kind of opportunity basket in which I think the company is operating, particularly next 2 to 3 years from now, wherein I think some of the larger biologics and biosimilar drugs, I think, which are going off the portfolio and probably, I think, creating a larger amount of presence, along with the complex generics like semaglutide, I think all those products are basically showing up a very large opportunity for a company like Dr. Reddy. And current valuations are possibly corrected because of, I think, this news. To me, I think it becomes a buy opportunity, because in this market, when you start buying, when the things get matured, you buy really very expensive. Whereas I think today the opportunity probably is better because I think the downside risk is protected. As such, I think the regulatory findings that they are basically disclosing very clearly that the semaglutide product in the patient is not getting impacted at the same time, but they want to clear the manufacturing process, the chemistry part of it, as I understand. So I would think that I think they will overcome that part of it, and this correction in the price should be an opportunity to buy into the portfolio.
Thanks very much, Devin, for that. Good speaking with you. Always a pleasure having you here on the channel. Well, let's bring in Rohit Srivastava, who's with us. to talk a little bit of markets. He's founder and strategist, IndiaCharts.com and Strike Money. Rohit, good to have you with us here. Thanks for joining in. Yesterday, I guess, caused a fair bit of confusion. What was happening, what was going on out of the blue. But today the market is telling you, price action is telling you that the market wants to move ahead, saying, well, this is a blip. This is not a breakdown.
So it might be just that, but after yesterday's move, I'm not sure whether we are done with the blip or not. So I'm keeping open to some more downside, maybe 23, 300, 400 as our worst case scenario. And with that in mind, then we can, move forward, because I don't think the markets are going to reverse the upward trend that they've been building on. But I'm also not sure whether the knee-jerk reaction that we saw is complete. So keeping that bit of room for downside, and then looking at how to really build positions going ahead. So very, very short-term trading, we are just backing off and sitting quiet today and let the market tell itself. But medium to longer term, nothing has changed. We have not changed any of our views or positions or ideas.
Yeah. So what is the just give us markers for the Nifty Bank and targets and stops, etc.
So like I said, in Nifty, I'll put it at say 23,376. That's 78% of the move we saw from the June bottom. For Bank Nifty, it's a little tighter. I think it's around 56,200. So that's not a lot. Or maybe the 40-day average around 57,550. Sorry, that's 56,570. Okay, so those are a couple of levels. So that's around 500, 800 point kind of downside on Bank Nifty, much less than what we see on Nifty. And mid and small caps so far have held their averages. So those indices may not really see much more than that, is what I would think right now. But even if it does, small cap index, I think worst case, if I put it around 18,466, that's the level I'm looking at.
Got it. Sorry, Nifty support at 23,376, correct?
Yeah, that's right.
And Bank Nifty 50, you said 50, I heard 53,200.
No, 56,200.
That's a...
53 is too steep.
56,200.
Yeah.
Okay. Got it. And you think this move that we are in, I mean, this takes us higher? At where, you think?
So eventually you're going to break past this 24,600 high. We've made two tops close to this and go back to all-time highs is the eventuality. So that I think is coming. It's a matter of time, whether it's 1 month, 2 months, we will, eventually go there. The bottoming out process is visible in individual stocks. It's happening one at a time, one sector at a time, one stock at a time, and eventually moving higher. So that is visible when we see individual stocks. So that gives us confidence that, medium term, you will make it. Shorter term, you just need to, wear through the volatility, which is not ending.
Hi, Rohit. Good to see you. One variable is going to be the crude oil prices, right? What's your take? We saw a bit of an escalation that took place yesterday. The crude oil prices spiked up, but it still, went to 81 and then it reversed. That's going to be a key variable. How do you see that panning out?
Yeah, so on WTI, around 81 is what I see. I think on Brent, you'd probably see a little higher. So 81 around WTI, it hit a high of 75, 76 yesterday, is the best case scenario I'm seeing on the upside. I don't think we'll really go beyond that. Then oil prices may just consolidate much longer at lower levels before they slowly build higher. And that's more based on the commodity cycle rather than anything to do with the war. So the only thing we look for is we don't get volatile moves in oil. So as long as that doesn't happen, we should be okay.
Yeah, got it. So stronger sectors, where to look for ideas?
So we've seen an interesting breakout in real estate on the back of, I guess, the falling bond yields that we've, triggered with the government measures. So the real estate index, which is the Nifty Realty Index, broke past a 2-year downtrend line at around 870. So 870 being the key support now, we should be looking at it advancing towards 1200, which almost puts it close to the 24 highs. So I think that's one sector that is, beginning to move.
Okay. Real estate, 870 support, 1200 perhaps back to 2024 highs. What else? Where else?
So I think interest rate sensitives as a whole. So let's put banking and auto as the next two. Financials have already been outperforming the market over the near term, and I think somewhere within that, PSU banks are beginning to lag. So very clearly, out of PSU banks into private banks, and I like the smaller ones rather than the bigger ones. So the smaller private banks and NBFCs is where I think the high growth moves will happen. So that's the financial space. And the last one is autos, which is still, moving up very slowly. But I think you will see that momentum pick up across the auto segment as well. So these are three that we can, immediately point to.
Fair enough. So PSU banks, smaller PSU banks, NBFCs, autos, and of course you mentioned real estate. Rohit, stay with us. There's a story coming through. Sudarshan is picking up some exclusive details and information as far as Biocon goes. So take it away.
So we understand through sources that Whitelist owned Mylan, which is one of the stakeholders in Biocon Limited, currently is looking to sell part of its holdings. So as of March, its holding stands at 5.64% stake. And now part of that stake can be sold via block deals, and that block deal can happen very soon. Now, earlier, Mylan used to hold stake in Biocon Biologics, and now in January 2026, basically this year, Biocon had announced the deal to acquire Mylan's stake in Biocon Biologics via share swap and cash. So after share swap was done, Mylan was allotted more than 6% stake in Biocon Limited via preferential allotment. Now, after that, they might have sold a bit of stake, but currently its holding stands at 5.64% stake, and now part of that can be sold via block deals, and we are expecting it can happen anytime, like very soon, like in the next 7 to 8 days.
I see. Do we know? So there's going to be, is there going to be a block, or how is it going to get done?
So it can be done via block deals. Their trading window is closed. In the trading window, when it's closed, only promoters cannot sell the stake, but Mylan is part of the public shareholders. That's the reason we are saying block deals can happen very soon.
Okay. So any idea who's interested on the other side?
No idea.
Okay, all right. Thanks very much, for that. So that's Biocon and the story coming through at this point. 396 stocks, I think it has moved a tick or two lower on that news that there's a public shareholder, minority shareholder, which is looking to sell their stake. Just on that, Rohit, pharma as a space, any thoughts?
It's a good place to be, because we have seen the pharma index also break out in the last quarter itself, and it started to meaningfully trend higher. So it was looking like a good place to participate in this move. The breakout sort of happened around 23,590. Now the index is itself at 25,600. So it's made pretty good ground from there. I don't think it's over. If you take a 1 to 2 year perspective, looking at the pharma index trending towards 36,000 should not be difficult. So interesting place. Need to just pick the right stocks within it, and that should be good going.
Got it. IT will start reporting numbers today, Rohit. Do you have any strong views here?
So I have been bearish on the IT sector for almost ever. And I'm avoiding them. I'm avoiding trying to pick a bottom, though they can bounce back when markets are moving up. But my sense is that we may not be done with the worst as far as the IT segment is concerned. And especially when I specifically look at some of the large caps. Now there may be a divergence between some of the smaller names. When we look at maybe Tech Mahindra will look different from an Infosys. But when we look at the big ones like Infosys, that's where then I don't see a clear trend reversal yet. And which is why I'm not sure whether we are done with the worst case scenario as far as IT is concerned. So pretty much just staying away, not trying to trade it either way, and looking elsewhere.
Got it. Fair enough. Thanks very much, Rohit, for joining us. Quick conversation today, and appreciate it here on CNBC TV 18. So we've got the big numbers in the Nifty Bank, and of course some of the stronger areas where perhaps you should look for ideas. Real estate is top of mind for Rohit. Well, another exclusive story coming through, and Borosil Renewables is exploring prospects for a strategic investor coming in. A promoter may offload stake. Stock is up 10%. Rachna gets details. Rachna, take it away.
That's right. We've gathered from our sources that Borosil Renewables, which is India's first and largest solar glass manufacturer, is in preliminary and exploratory talks for a strategic investment. Now, sources tell us the promoters, the Kheruka family, which holds approximately 59%, may divest part or all of their stake if these talks proceed and fructify. There's no certainty if the deal will result to an end result, but for now, when we reached out to Mr. Pradeep Kheruka, he declined to comment. What we also understand is that, of course, Borosil is a strategic asset in India's solar manufacturing chain. The specialized glass it makes goes into every solar panel, and the company has been expanding capacity to meet growing domestic demand. But one factor that's shaping the valuation conversation here, according to our sources, is the anti-dumping duty on solar glass imports from China and Vietnam, which has been in place since December 2024. The duty has supported domestic prices and is due to expire in December 2029, with renewal subject to government review. Now, sources indicate that the deal could value the company below its current market valuation, with the duty timeline among the considerations weighing on pricing. That's all we're picking up from our sources for now, but we'll keep an eye out for more.
All right. Thank you very much, Rachna, for that. So that is Borosil Renewables, perhaps in the fray with the interest in that space. Of course, there's lots of other listed players in the space, bigger. So we'll see what finally comes through. Pramod Gobi of Marcellus Investment Managers at the other side. More market conversation coming up. Welcome back. Pramod Gobi is with us, co-founder, Marcellus Investment Managers. Pramod, good to have you with us here. Thanks very much for joining us. Do you have any IT names in the portfolio?
Sorry, say that again, please.
Do you have any IT services names in the portfolio, Pramod?
No, none as of now.
Okay. No intention to as well, not giving it a closer look?
We are, of course. I mean, you never say never because I think valuations have become really attractive. But the big question mark in terms of the real disruption from AI is still unknown. Part of it, what we've maintained is the deflationary effect in the near term, which is clearly playing out. But what we're trying to see is if there is a new stream of work coming their way, because at the end of the day, enterprises, I don't think can do this job on their own. You can't simply let, you can't install Claude and expect you to run the ERP and CRM systems. There should be new work coming their way, but I think it's very early days. Not many people fully understand how effective AI is in terms of improving productivity and so on. As we've seen, some of the large tech companies globally themselves have said they've maxed out on tokens. So the economics of using AI also is not clear. But yeah, as of now, we're watching it, but we haven't really bitten any of it.
Got it. Hi, Pramod. Good to see you in. But how are you all feeling about the Indian markets? A lot of moving parts, both on the globe as well as domestically. We've seen some rainfall, maybe a little bit too much just in the near term. But that's as well a risk, that's there for the Indian markets. But otherwise, people are reasonably optimistic that the second half of the year, earnings will pick up and crude oil prices will be well behaved. Are you all in that camp?
Well, hopefully, you never know with crude oil. Until 2 days ago, we thought as much, but yeah, things could change. But I think the bigger change that we're seeing in the market is more changing on the regime front, moving away from a sustained rally in value stocks towards quality. Quality seems to have bottomed out. I think market as a whole has sort of become less expensive than what it was 2 years ago. We've seen a bit of time correction, not so much in terms of price correction. We saw almost 8 quarters of single-digit earnings growth. That also seems to have bottomed out. We'll have to wait and see how much of the Q4 earnings boost is driven by inventory gains. We'll see that in a few days in this results. But I reckon, yes, valuations aren't that expensive, but earnings growth is also bottoming out. But unlike the last 4-5 years where earnings was more broad-based and the market rally was broad-based, this could become a lot more narrower. We saw quality outperform for almost a decade, the previous decade, and then quality became too expensive right after COVID. We saw massive underperformance for 5 years. Now we reckon quality is not that much at a premium to the overall market. And at a time like this where government is also cutting down on capex, private sector capex has been elusive, and domestic consumption, there's a shadow of job losses coming from automation and AI. In times like this, we expect quality stocks to hold on their own as they tend to be more resilient, be able to defend more market share, and most importantly, they're not as expensive as they used to be.
Oh, yeah, absolutely right. This entire, sort of, it's basically manufacturing and industrials, right? Which is leading the charge. That's multiples though are 50, 60, 40, 50, 60 times. But I mean, that's where growth, that's where the growth is, and valuations we can keep debating. But any drawdown is very short-lived here in this entire space, Pramod.
No, hopefully this is the final. Finally, the renaissance of Indian manufacturing. Clearly, we have lagged the rest of the emerging market back. Few things are working in our favor. Firstly, the currency depreciation. Yes, there is a silver lining. It has made our manufacturing exports a lot more competitive. Alongside that, at least the European FTA is in place. A few other FTAs are expected, and the big one, we'll wait for it with America, but it is clearly increasing competitiveness for Indian manufacturing, whether it's import substitution or taking market share in Europe. I think demand visibility is significantly improved, and therefore, I think there are pockets within the broader manufacturing space which are looking very attractive in terms of growth. Yes, we wish valuations were a lot cheaper, but then if this trend or the renaissance in Indian manufacturing is structural in nature, I think it might be worth paying those premium multiples as well. But there are pockets where even valuations are realistic, if not compellingly attractive. But yes, that's a sector that we are also focusing on.
All right. Pramod, give us some themes, right? The Indian currency was weakening and people were not too happy about it. But there are, that movement in terms of the Indian currency depreciating and the Chinese currency actually appreciating. That created a bit of an advantage for us in the export market. So what is that space where you see that there will be a good amount of gains? Is it the chemical space? Would it be, a couple of other themes that you all would be looking at? If you could help us out. Textiles,
Yeah, textiles was the first one I was going to say. Clearly, we've had a long history in terms of production, but we've lacked the other emerging markets. Even in the early days of the China plus one story, we lost out to Bangladesh, Vietnam, even to Sri Lanka and Ethiopia in some sense. But I think we're finally getting to see some demand visibility coming through. And given the size of the markets that, for example, even leaving aside US, will wait for the FTA there. But Europe itself is a large market, and given the size of our textile industry, even if we take small share, we'll see a significant growth runway. The other sectors are right up our alley where we have some sort of technical know-how. You mentioned chemicals, absolutely. It's one of the sectors where we've built some IP. We can benefit from this currency depreciation and also coupled with technological competitiveness. The third area is engineering goods, including auto ancillaries. I think we have an edge in certain sectors. The FTA should equalize the tariff burden. At the same time, the currency depreciation should make cost competitiveness that much more. So I think between textiles, chemicals, engineering goods should be some of the big winners in manufacturing exports.
Got it. Okay. All right. Got that, Pramod. Thanks a lot for joining in, giving us your take on the markets. We look forward to chatting up with you in the coming weeks as well. Well, let's focus on the F&O market then. The Nifty actually, though we're holding up in the green, we're not able to hold on to that green. There is consistent selling pressure actually that's coming about. At around the 24,120 odd, we made the high of the day. And from there, we've slipped a little bit. The Nifty Bank, that's at a very crucial juncture. And it's not been able to get past that 220 DMA. That, chart should come up for you on the screen. Yes, it's right at that level. You would like the Nifty Bank actually to move towards that 57,500 odd mark. If that's the case, then some of these positions will get cleaned out. So just keep an eye on that. Nifty Bank at a crucial juncture. The PCR, at the start of today, it was at around 0.8. It went down to around 0.77 and currently it's around 1. Because the put writers have come back into play. So the 24,000 put, the premium out there has come down by half, close to around 120 rupees. Start of the day was 250 rupees, as is the case with 24,050. The premium out there is down to around 140 bucks. At the start of the trading session, it's around 280 rupees. So what that's telling you is the bulls still believe that yesterday's low will hold out. And that's why there is writing at those levels. However, at higher levels, you're expecting some kind of resistance. I say this because at around the 24,100 call, you've got the direction right. The Nifty is up, right? Close to around 100 points. But you're not making too much money out there. The premium still holding at around the 100 odd mark. It started the day at roughly around 95 rupees. So there is a mix of activity that you're seeing at that level. So just punching in these options data and looking at the technical levels as well, yesterday's low becomes the important support, 23,800. As the options data is telling us as well, the 24,200 is going to be a bit of a resistance mark. Now, individual stocks, there are quite interesting moves that we're seeing. And some of those underperformers actually are bouncing back. Kalyan Jewellers, in 2 sessions, the stock is up more than 25%. Disclosures are going to be important today because the volumes are very, very high. Let's see whether or not there is some buzz that there could be names that crop up. So let's see whether or not that happens. So that's one stock to track, fresh buying being seen out there. Lodha, another stock that's corrected big time from the top. That one as well is seeing a bit of a pop, and the open interest is up by close to around 10%. So you have some delivery-based buying that's backed by some fresh long build-up as well. And 2 stocks that actually were seeing some short build-up, those shorts are gradually getting squeezed out. Premier Energies, on there's a bit of a short covering bounce that's taking place, and Amber as well is seeing a bit of a short squeeze in today's trading session. So that one as well should come up for you on the screen. So in the near term, it seems we're in this 400-point band. Global developments will be tracked, and we'll have to see which side will be broken on the up or on the downside. Well, time to slip into a short break. As always, we'll get you a quick check on dealing room chatter. Nimesh is with us. He'll tell us what's going on. We'll also fill in with some stock calls on the other side. Welcome back. Markets have slipped a little bit. It could be having an element of the Sensex weekly expiry as well in today's trading session. So that's why we're seeing some kind of volatility. And a few stocks actually that are slipping. The tech pack actually has moved to the low point of the day. You know, you have stocks like Infosys that have moved down. TCS results will be out in the next 60 minutes or so. But the tech pack has slipped a little bit. It's moved into the red. It was holding in the green. Infosys is down. HCL Tech as well is still up close to 0.5%. But that's trimmed off a little bit of the gains as well. So a bit of a slide is what we're seeing on some of these names. But it's that time of the show when Nimesh joins us to tell us what is he picking up on D Street Chatter. Hey, Nimesh.
Hi, Nigel. Volatile day of trade. We saw a big sell-off yesterday, 500 points down on the Nifty. We've tried to recover a bit in today's market, but as you rightly pointed out, a bit of volatility because of the Sensex expiry. But broadly, the feedback is that maybe at higher levels around 24,300, 400, you're going to see the resistance as well. So every time we go towards those levels, then we see a bit of a sell-off there. So that's acting as a very strong resistance. Flow, again, a mixed day of trade. Luckily, even yesterday, despite such a large fall, the institutional data was on the positive side. Looks like that's the case today as well. Within that, my sense is they're buying into some real estate names, and there's a bit of buying in small private bank names. So that's the feedback as far as flows are concerned. Even the broader markets have seen a bit of a recovery today. The mid-cap, small-cap indices are up 2%. But again, in the hindsight of the sharp sell-off that we saw yesterday, it's a minor pullback. So in the range for the last few days and weeks, looks like that trend is going to continue. But the good part is that there is buying from larger institutions into select pockets like real estate, banking, and to some extent, the metal names as well. So I left out metal, but again, there is a bit of buying as well in metal names today.
Okay, all right, Nimesh. What about individual stocks? A lot of action in the broader markets.
Oh, absolutely, and there is a clear trend of a bit of outperformance in select stocks in the broader market. The first name is Welspun Corp. That's been buzzing off late. In fact, a few weeks back, it was part of my charter list. And this outperformance in the last couple of months is backed by institutional buying. Earlier, the sense was some domestic mutual funds were buyers. Now I understand one of the leading long-only fund has an active buyer in Welspun Corp. So you need to track the institutional data and the percentage of holdings in Welspun Corp as and when the new scheduling comes. Looks like that's going to go up. So that's the first name. The second stock is CE Infosystem, which is MapMyIndia. A big move on that name in the last few days. And it's a bit of surprising as well that we've seen such a large move on large volumes. Now there is a sense that maybe you're going to see a corporate development in CE Infosystem very soon. So that's something to track there. Third, couple of names where there is buying today from large institutions. Sansera, which stands out in terms of delivery-based buying, and so is Hyundai India. After a long time, some sense of buying interest back in Hyundai at current levels. And the last is Oracle India. The IT pack is down, but largely within the IT names, Oracle has actually outperformed in the last couple of months and largely backed by institutional buying. Now I understand there are some block bids as well from larger domestic mutual funds to look to buy into Oracle India.
Got it. So that is the chatter in terms of individual names. Nimesh, I think you put out Choice International as one of the stocks, right? This is a couple of days back, and there is some news there.
So it's an official announcement, Prashant, that has come on the exchanges. So Choice Broking has raised 900 crores in one of the subsidiary from a Korean company. So I had highlighted that maybe you're going to see a fundraising from a global international player, and that's announced now. So a Korean company is looking to invest close to 900 crores into the subsidiary of Choice, the listed entity, which is Choice Broking. So that's the official announcement. Maybe that's the reason why you're seeing a 7-8% uptick in that stock as well.
Do we know for what? I mean, it's a pretty large infusion, right? For a
pretty large infusion, and also the fact that I was just looking at and comparing to the other broking firms. Choice is now having a market cap of more than 18,000 crores, and you compare with the likes of Angel and Motilal, they are like, and valuation wise, you will see Choice a bit expensive purely on the valuations. But the fact that an international player has come out and is investing 900 crores, into that business, looks like they have some big plans on the broking side. So maybe that explains the move and the fundraising as well.
Yeah. NH Investment is a South Korean full-service investment bank.
Yes.
So wealth management, investment banking, asset management, global trading. So seems like there are bigger plans afoot in that sense. On the other one, Nimesh, that is CE Info, MapMyIndia. I mean, anything else? There's a corporate development, but in what direction?
Too premature, Prashant. Too premature to say that what really should happen. See, again, looks like because they're in a silent period, there can't be any block sale or anything of that sort. But my sense is that maybe some strategic investor may come in at some point in time into C info. So that's the buzz. Maybe we'll have to dig something further. But as of now, what my sense is that maybe you're going to see some corporate development. But I guess it's a little premature because now every promoter is in the silent period, so they can't do any transaction at least till the Q1 earnings.
Yeah. And look at the other one, right? I mean, we've discussed quite a bit, which is Welspun Corp.
Yeah.
Oh boy, what a run it's had over a period of time. And by the way, this buying at FII desk, but I'm just looking at the FII holding. There's not very much. I mean, actually, there's Fidelity. I can see Fidelity, which owns about 1.9%. That's it. Actually, sorry, the total FI ownership is about, it shows up as 11%. But I don't know the breakup. Fidelity's got about just under 2%, but not very much else. Big move on this one.
This is one of the classic stories, and when Mr. Trump came in and he kept talking about drill, baby, drill, this is one of the stocks that we had explained at that point of time, Prashant, because if he's going to drill more, then he's going to transport more. And they have 25 to 30% of the market share with regard to pipes. With regard to the, the tariffs, they were not affected because they had their facility in the United States as well. And the biggest drag for them in terms of their business, it went through a period of 700 to 800 rupees for long because no orders came in from the United States. Once that came, just take a look at the stock. The stock has more than doubled in a matter of the last 1 year or so. And, the valuations actually had come down drastically. And now the kind of quarterly run rate that they're doing is phenomenal. And with the focus back on oil and gas, these guys actually are well placed. The domestic part is very small. Is smaller relatively in terms of the earnings. But the US part of their business is the one that's the big kicker.
Yeah, no, absolutely. There's one more angle to this, Nigel. And I'm just looking at the price, right? Guess where the rally started? It started exactly as soon as the US-Iran war started. Right? So that is the other part. I think a lot of investors, local investors, got excited that if there is, and by the way, since then the news has come through that lots of these Gulf countries who use the Strait of Hormuz perhaps will try and build their pipeline infrastructure to avoid the Strait of Hormuz. Like for example, Saudis have this east-west pipeline.
Right.
UAE is trying to build pipeline, and I checked some of the, we don't know who the orders will go through, but these are. And the build-out for some of this stuff will take years, actually, more than 10 years, according to a Reuters report. But, they're in that space, and they're very much present there. So, actually, I'm not exaggerating here, if there's one winner out of India, actually there are many, but of this entire conflict, at least perception-wise, we have to see ordering, etc., from that part of the world. Nigel talked about order in the US, but here in this part of the world, perhaps that's got to pick up.
They have a facility.
They have a Saudi facility.
A Saudi facility in the US. So Prashant, just to give you numbers, because I track the company very closely, at least on this one, they were doing close to around, 350, 400 crores on a quarterly run rate. That number's at around 600 crores. Visibility, they can move to around 4,000 crores of EBITDA number. Current market capitalization is 40,000 crores. They have no debt in the books. In fact, they have cash. And the facility is, once this capex comes on stream, that EBITDA number could be even higher. So put that together. It explains why. Ordering and all, we'll have to wait by, as you're saying.
No, I'm just saying that the trigger, perhaps, all this is all there. This is that, it's like the old saying, right? We know what's going to happen. We don't know when it's going to happen. And I think that is the beauty in markets and the suspense part of it as well. And for this one, it's turned out to be this conflict, which is focused interest in a sharp way on prospects for the company. Well, I think, that's Welspun Corp for you. Sirma, Dixon and Keynes are in focus as well. And I think stocks are higher by between 3 and 5%. And let's get Upasana in. There's some regulatory news flow, which I think is leading to this up move. Upasana, take it away.
Well, certainly the EMS stocks continue to remain in focus throughout the day. Now, government has extended the basic custom duty exemption on the key display assembly components till March 2029. Mind you, this is just an extension of the existing benefit and not a fresh reduction. Now, the exemption covers mainly 5 critical display components, which includes cell, flexible circuit assembly, backlight unit, frame, and even ACF. And overall, if we see the impact, this will certainly reduce the input cost for the domestic display assembly manufacturers. Now, on the back of this update, Equirus is of the view that this is certainly both positive for Indian EMS players, as there are 3 benefits to it. Firstly, it will lower the landed cost of the critical display inputs. It will also lead to a supporting of the value addition for the domestic players, and even it will improve the competitiveness of the manufacturers supplying display assemblies. Now, the key beneficiaries of this one would be Syrma SGS, Dixon, and even Keynes Tech. Now, Syrma also remained in focus today as HSBC has given a buy call with a target price of 1750. It believes that the company is a lead EMS player with an export mix, vertical integration, and even high value products supporting the company's margins, which will further aid going forward as well. The strong acquisition and JV tracks the record strength in its position going forward. So overall, if we see, all these stocks continue to remain in focus today.
Got it. Okay. All right. Thanks a lot for that, Upasana. Well, I think we have Mayuresh Joshi who's joining us on the show. Hi, Mayuresh. Good to see you in. Mayuresh, any view on these EMS companies? All of them buzzing. You have a tailwind that's coming from the government of India. And also you have some of these notes coming in from HSBC as well as Investec. What's the pick of the pack for you?
Afternoon, Nigel. No, I think the kicker also is that the PLI schemes that the government has announced also a step in the right direction. Add to that, I think the expectations for a whole host of these players in terms of actually moving up the value chain by improving their ODM component, which is the original design manufacturing component, which has better margins, obviously acts as a kicker as well. Out of the lot, again, I think Dixon has the Vivo JV with it, which can have a significant impact in terms of the volumes that they probably produce, the margins at the facilities that they're probably going to use, and expectations of value-added products. However, I think within the pack itself, Syrma SGS, I think is far more diversified in our opinion. I think the exposure that they've probably got, automotive is around 24%, industrial and consumer is close to 30%. Margins are extremely high at 12%, and they're doing pretty well. I think the 2 or 3 aspects in terms of growth avenues that the company has put forth. And the most interesting part in terms of the presentation has been the PCB market size. The import market size and the deficit that probably happens is still around 80,000 odd crores, which is a huge gap to fill. And if they are doing it very, very successfully, all these EMS players, I think better margin, execution, volumes, revenue, operating leverage, everything can probably play out along with the existing model that they probably got. Valuation sky high for the space as a whole. But I think Syrma probably remains top of the rack in my opinion compared to the rest.
All right, hold on to that. I just want to pull up Lodha. Interesting chart out here, Lodha. You should pull up the cash market as well as the future rates. There's a big difference that we're seeing currently out there. So you need to keep an eye out on that. That's Lodha. Just take a look at that. In the cash market, it's close to $1,200. In the future space, I think we should actually refresh that. It's at around 1,110 rupees approximately. So there's a big difference of close to around 80-90 rupees as we speak now on Lodha. In cash market, there's a big surge that we're seeing out there. And that's what we're seeing in terms of the futures. Let's pull up the cash market now. It's close to around 1,200 rupees. Big spike is what we're seeing on that particular one. So keep an eye out on that. We'll have to keep an eye out to see whether or not there are some names coming into this one as well. Volume's very, very large in the cash market, and there's a big difference out there. Mayuresh, real estate, if a word on Lodha or any other stock that you like?
So, Nigel, I think our topic has been Phoenix Mills for a long period of time. And as a disclaimer, I think we continue holding that stock in our global portfolios. The kind of growth that Phoenix has probably displayed across all its sub-segments, the retail component, the expansion from 11.5 million square feet, expected to be around 14 million square feet exit 27 and close to 18 million square feet exit FY30. Similar to their entire offices space from 5 million to almost 9 odd million over the next 4 years. The hotels are doing reasonably okay. The key additions are going to be significant over the next few years as well, from almost 588 keys to more than 2,000 odd keys as we go ahead. And the residential projects that they're probably doing are probably moving in this right direction as well. So the kind of EBITDA they reported, Nigel, in FY26, for all these segments combined together, around 2,600 crores. Retail was the biggest contributor at around 2,200 crores. The cash flows close to 2,100 crores. The net debt to EBITDA has probably come down. The margins have probably expanded year on year to 60% on the EBITDA front. And therefore, from a real estate perspective or a developer perspective, I think it is far more diverse in its offerings. And all its offerings are probably steady state and doing well. So again, Phoenix is something that probably stays top of the back. Obviously, it's meta target price as far as the research report is concerned, but I think the momentum in terms of numbers might still continue being very strong.
Okay, got it. All right, hold on and wait with us, Mayuresh. Earlier today we caught up with the management of SBI Funds Management. The joint CEO, Mr. Nifty Sensex, says clocking 5,000 crores on the top line is possible by FY28. Let's listen in to that conversation.
Assuming 25-26% growth, 5,000 crore net profits in FY28, which gets us a multiple of about 24 times. Is that the right way to look at is that the right multiple, Mr. Singh?
So many factors around it, but if we go by our past history, the way we have been growing, then definitely yes.
Okay.
But there are always in the markets, there are uncertainties. It could be more than this, it could be a little less than this. But the growth rate, the more and more financialization happens in the country. SBI Mutual Fund is at the forefront. We will get the maximum benefit. The moment today the biggest friction in growth of mutual fund business is the way KYCs are being done. These small players, the way it's a linkage between the remuneration for acquiring a customer and all efforts to be bring in. So that is not working. The moment that friction is over, which is likely to happen very, very soon, and once because all the bank accounts are now KYC compliant. The moment any bank account which is KYC compliant frictionlessly can part money in mutual fund, I think that will be the biggest revolution, and the number which is there today, only 6 crore investors, that will multiply like anything, and that the number could be anywhere. I'm not saying as much as number of bank accounts are there, but at least 20% of the bank accounts will be the mutual fund investors.
As your equities, which are actively managed, compound at 20-25% on an annual basis from here on, what would your blended yield look like going ahead, say 2 years or 3 years down the line?
I think the way to think about it is that today the best in class is close to about 44 basis point. I think we should come very close to that because clearly, as you see, the active participation going up. But at our scale, that's a difference. The blended yield for a smaller player at 40 basis point and at a 13 lakh crore player is a completely different way to think about it.
So we'll keep an eye out on that IPO that opens up next week. But earnings season begins today. TCS will be reporting their numbers shortly. Rima joins us to give us the key expectations. Rima?
Well, it's going to look pretty muted. Flat revenue growth in constant currency terms for the company in Q1. TCS is the IT bellwether and always the first to kick off the earnings season. So what they do, what they say is paramount to the entire sector. So constant currency revenue growth, as I said, would be flattish. The range we were working with was minus 0.1% at the lower end, going up to a plus 0.4%. In rupee terms, especially on a year-on-year basis, the numbers will look up on account of a very sharp currency depreciation. So you know what's happened in the current quarter? The INR, that's the rupee, has fallen against the dollar by nearly 2.5%, and year-on-year it's fallen by nearly 10%, which is why year-on-year numbers will look good. Now coming to the margin performance. Now in Q1, from 1st of April, the company doles out their wage increases to the entire employee base. So which is why Q1 margins are always depressed. Typically, they come down by 150 to 200 basis points. But this time, because of the foreign currency tailwind, it'll partly offset that impact, and the overall margin decline should be about 120 basis points down to 24.1%. Profits, according to our poll, should be down about 2%. There could be a one-time legal expense of about $70 million, and that could come in below the line. Now, this quarter is typically a seasonally strong quarter for the entire IT industry, but this time, because of AI deflation, companies are losing work on account of AI productivity benefits are getting passed on. And not to forget, there was a Middle East conflict as well. So there was some deferral in the deals, and they were not getting converted into revenues. Accenture had flagged off a $100 million impact in Q1, just purely on account of the Middle East war. So all that is hurting sentiment. I think consensus expectations and the way the stocks have reacted, TCS itself is down 35% from the start of the year. Valuations are closer to trough levels at 13-14 times forward multiple. Consensus expectation is that FY27 is going to be another washout year, fourth consecutive year of anemic growth. FY28 may not be as bad as FY27, but don't expect any growth. Maybe FY29 onwards, things will start improving. I think some key numbers to watch from TCS TCS, they had quantified their AI book at AI revenues at $2.3 billion in the last quarter. At what rate is that growing at? And secondly, what is, at what point will at least the industry start coming back to mid-single digit kind of a revenue growth from low single digits? So commentary is going to be very key in terms of numbers. Expectations are very muted.
Thanks a lot for that, Shrima. Well, time to slip into a short break. We continue our market talk with Mayuresh Joshi on the other side. Stay tuned. Welcome back. Well, just a minute to go, but Mayuresh Joshi has been having a positive stance on Welspun Corp. Mayuresh, what do? Book the profits and enjoy a party, or hang in there and you believe that they can get further orders, and the execution capabilities obviously has been very good in their line of business? You hold on or book out?
Nigel, as a disclaimer, we are still holding on to the stock in our portfolios. But the logic is pretty simple, and what you and Prashant were discussing. Order book seems to be reasonable as we speak at this juncture. There is expectations both from the Middle Eastern region, whether it's Iraq, Kuwait, UAE, or even Saudi Arabia. A large chunk of those orders might start pulling in as well. They're running at full capacities at the Little Rock plant as far as the US operations are concerned, and balance sheet remains cash rich. So I think no complaints. I think if we keep on delivering numbers, we might keep on holding on to the stock.
Okay, got it. Still holding on to that stock. Massive move is what we're seeing. I recall a year ago, we here at CNBC TV didn't explain the company at half the market capitalization with regard to the triggers as well. Another stock that we should pull up is Ganesha Ecosphere. Just pull up the chart for the last 1 week or so. It's moved from around 900 rupees to around 1,100 rupees, a stock that was actually 2,000 rupees. So Ganesha Ecosphere, one of those recyclers as well. Volumes have been picking up in the last few days. Keep an eye out on that name as well. Well, let's wind down the markets then. It was a day that the markets pulled back only some of the losses that we saw yesterday. The Nifty and the Nifty Bank, they ended in the green. The Nifty Bank was a relative outperformer. The good news is number of stocks outperforming, they outweighed the number of stocks declining. The top loser on the Nifty, well, was Dr. Reddy's. The fear of semaglutide supply fears, that's the one that weighed on that stock. So it was down 6%. But in terms of winners, Bajaj Finserv did very well. Bharti Airtel as well was up and about in today's trading session. Broader markets, couple of themes worked today. The EMS players, they did very well in today's trading session. So you had Dixon, Syrma, both those two stocks were up and about in today's trading session. While the jewelers as well did do well. Kalyan Jewelers waiting by for any details if there was a large trade today. But that stock in the last two trading sessions, it's up close to around 25%. It trades at a discount to the the big kingpin out there, which is Titan. But some argue, rightly so, and past performance does suggest that as well. Well, in terms of other stocks that did do well, you had Interglobe Aviation, one of the biggest casualties yesterday. It pulled back half of the losses that we saw yesterday because crude oil prices cooled off. Besides that, BPCL was another stock that bounced back. That as well got slammed in yesterday's trade. So safe to say, in the near term, the Nifty appears to be in this 400-point band. The good news from a portfolio perspective is the broader markets did better than what the headline index did do. We'll wrap up on this edition of Closing Bell. You don't go anywhere. The team of Markets Forward is waiting for you on the other side.
Market snaps its two-day losing streak, but ends sharply off the day's high. Nifty closes above 23,900. Mid-caps outperform.
Dr. Reddy's halts the supply of its weight loss drug semaglutide on discovering an issue with the bulk drug used in its production. The company indicates commercial supplies will resume only once this issue is resolved. The stock ends 6% lower.
The government extends the import duty exemption on key display components till March 2029 in a big boost for EMS companies like Dixon Technologies, Sirma LGS and Keynes Technologies. The stocks of EMS players woke up in trade.
You're with us here on Markets Forward, your go-to show where we get you all the key data points that you need to watch out for the next trading day and of course recap the day gone by as well. I'm Hormas Patakia. With me is Vivek Iyer. Vivek, good afternoon. Well, we did end higher today, but fair to say it was a pretty unconvincing recovery considering the fact that we slipped off the highs of the day.
That's right. Good afternoon, Hormas. So recovery, but not a very convincing one, like you said. But the good part, of course, Hormas, was the fact that today you saw the advanced decline ratio in the broader end of the markets are very strong. And that is something that the bulls will take a lot of hope for. But we have a lot lined up on the show. Let's see what we have in store for you today. We'll start with the top movers and shakers of the day with Sudarshan. We will also put the spotlight on Borosil Renewables, tell you why Eternal was soaring, and decode the fall in Dr. Reddy's. But not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. And now on to our first segment of the day. Sudarshan joins in from the big wall with all the top movers and shakers of the day.
So today's session, good part market breadth was firmly in favor of advances because of the outperformance came from mid caps, but Nifty has closed in the green but sharply off day's high. So top Nifty movers. So TCS ahead of its earnings closed near flat line. Bharti Airtel was one of the top Nifty gainers, closed with a gain of more than 2%. Indigo tracking the crude move after yesterday's big downtick. Today closed with a gain of 2%. And Eternal and Bajaj Finserv too continue to see buying. Today closed with a gain of 2% each. But one top Nifty loser was TCS, and that's because of the issue related to semaglutide. And at the end of the day, the stock closed with a cut of 6%. Now coming to some of the other stocks that have reacted to the news flow. So on top of the list is EMS companies, as Vivek was highlighting. Keynes Technology closed with a gain of almost 7%. Dixon Technology closed with a gain of almost 4% because of the customs duty related news that government has announced. Premium Energy is going to set up a facility related to solar module, and tracking that news, stock closed with a gain of more than 4%. And also government exempts customs duty related to lithium ion battery, and because of that Amara Raja moves sharply higher, closed a gain of 4%. Borosil Renewables, there was a news related to acquisition or strategic partnership, and that's the reason this stock too closed 10% higher. Some of the other mid-cap gainers, one name that has been buzzing off late, that's the Kalyan Jewelers. After yesterday's 15% move, today this stock gained almost 19%, and at the end of the day up more than 18%. Swiggy, following a similar move in Eternal, this stock too continues to see buying, closed the gain of more than 7%. Lodha Developers, there is a huge discrepancy in underlying and the future stocks, but in underlying, if you talk about the stock, closed with a gain of 8%. Choice International, there is a strategic partnership. They are getting an investor from outside for broking firm, and that's the reason this stock closed with a gain of 7%. Capri Global had a block deal of more than 1 crore shares, and this stock gained 8%. Lastly, talking about mid-cap losers, defense names were in the focus. Kotak Institutional Equities has come out with a note. Solar Industries sell call stock closed 3% lower. Mazgaon stock closed 3% lower, and United Space, after seeing a continued up move over the last few days, today closed 2% lower.
Sudarshan, thank you for summarizing the top movers of the day for us. To take this discussion forward, we are now being joined by Mayuresh Joshi from Markets with India and Ruchit Jain from Motilal Oswal Financial Services. Gentlemen, good afternoon. Thank you for joining in. Ruchit, to you first. Well, you had 24,150 in sight, but for a market that was at 24,500 just 48 hours ago, you could not sustain 24,150 either. Has the texture of the market changed after yesterday's sell-off, or do you expect this range-bound consolidation to continue going forward as well?
A very good afternoon, Hormas. Very good afternoon to everyone. If we see the market's reaction from this resistance of 24,500, especially yesterday and today's session in the last half an hour, it clearly seems that, markets the index at least is not in that kind of trended phase on the positive side, neither on the negative side. but it seems to be a consolidation phase that is getting continued. 24,500, 600 was much expected, but the 200 DMA resistance was there. The previous swing high hurdle was there. That has not been taken out, which clearly indicates that breakout is yet to come, and we are still into that consolidation phase. Now, the major support in this entire consolidation is coming around 23,600.
Well, Ruchit, we're just losing your connection a little bit over there. We'll come back to you for more updates as far as your views are concerned on the market. But Mayuresh, good afternoon, and thank you so much for joining us. Mayuresh, in some time from now, we'll see the results of TCS at the exchanges. The IT pack has derated significantly. What are your expectations going into this particular earnings season?
Afternoon, Vivek. No, I think very muted. And I think the expectation also from TCS to begin with is extremely muted as we speak. And therefore, I think the management commentary, specifically in terms of the air revenues that TCS posts in excess of $2 billion, what plan do they have in place? What is the current ecosystem looking like as we speak? And therefore, I think in terms of the growth vectors for the company going forward, what are the new levers that the management is probably looking at? I think that's going to be a common underlying thread that happens to most IT companies as we speak for this result season. So again, no great expectations from TCS or the sector as a whole as far as the earnings delivery is concerned.
Well, completely get your point, and the markets too are seeming to position themselves for no great expectations as far as IT companies are concerned, especially TCS that will come out with its results today. Well, the other stock that was in focus today was Eternal. The stock gained in trade at one point of time, was a top Nifty gainer. This was after the company went ahead and uploaded their latest shareholding pattern to the exchanges. So now the foreign headroom availability has now gone up above 25%, indicating, and quant analysts are estimating, that the stock could see a weight increase in the August review of MSCI as far as its position in the index is concerned. So analysts believe that MSCI could increase the weight of Eternal in the standard index, and they estimate inflows of close to $600 million on the back of this particular weight increase. Now, to give some perspective, remember, once Eternal had gone ahead and classified itself as an Indian-owned company, the company actually saw its foreign limit drop down to 49.5% from 100%, and this led MSCI and other passive fund managers to go ahead and cut the weightage of MSCI in the indices. This is on account of the fact that there was no headroom available. Now, with increased headroom, you will likely to see flows of Eternal go up in the upcoming August review. But moving on now, Rachna joins in. This is CNBC TV 18 exclusive. She learns from her sources that Borosil Renewables is in exploratory talks for a strategic investment. Rachna, over to you.
That's right. We've gathered from our sources that Borosil Renewables, India's first and largest solar glass manufacturer, is in preliminary and exploratory talks for a strategic investment. Sources tell us the promoters, the Kheruka family that is, holds about 59%. They may divest part or all of their stake if these talks proceed and fructify. While there's no guarantee or certainty that a deal will result, but the process has begun. Now, Borosil Renewables promoter Pradeep Kheruka declined to comment when contacted directly by us. Borosil is a strategic asset in India's solar manufacturing chain. The specialized glass it makes goes into every solar panel, and the company has been expanding capacity to meet growing domestic demand. One factor that's shaping the valuation conversation, sources say, is the anti-dumping duty on solar glass imports from China and Vietnam, which has been in place since December 2024. Now, the duty has supported domestic prices and is due to expire in December 2029, with renewal subject to government review. Sources indicate that the deal could value the company below its current market valuation, with the duty timeline among the considerations weighing on pricing. That's all we're learning from our sources. But as you saw, how the stock has performed through the day, up almost about 10%.
The stock was up and about indeed in today's trading session. Rachna, thank you for that update there. Mayuresh, you just heard Vivek also talk about the fact that Eternal might get a weightage increase in the MSCI next month. Is that the safest way to play the quick commerce theme? Because there are, of course, Zepto is yet to arrive, but Swiggy on its part has issues of its own. The quick commerce business not growing as fast as Blinkit is. It's bleeding as well, while Blinkit has already turned adjusted EBITDA positive. Eternal versus Swiggy.
Neutral on both. So almost I think what frankly we are looking at is I think the competition is intense, and it might intensify even more down the line with the major payment players like Amazon probably coming in. There are some plans that all of us are reading about on what Reliance Retail is expected to do. And even the bigger retail chains having their own delivery options probably being worked out. In this scenario, I think the two positive factors for both Eternal and Swiggy is that they've got plenty of cash loaded onto their balance sheet. They've been very, very aggressive in terms of the dark store openings. And therefore, I think as a first mover advantage, I think they are already there in terms of touch points as far as the delivery centers are concerned. However, I think from a balance sheet and an investor perspective, how much of an expansion does really take place in terms of margins, the profitable growth on a more consistent manner? Because I think these businesses are businesses where as competition comes in, you'll have to even pump in more money and probably sacrifice some of your margins from an immediate near to medium term perspective. And that is a cause of concern in terms of the valuations that they're already trading at. And therefore, we're carrying a neutral view these times.
Neutral on both for Mayuresh, both Eternal and Swiggy. But the one stock that was not neutral, that was in top gear today, was Kalyan Jewellers. As 18% up move that we have seen in today's trading session is the biggest move in a single day since it listed as a stock. So big moves on Kalyan Jewellers on very, very strong volumes as well. And it has now crossed the 100-day moving average and the 200-day moving average as well in just one session. Now, why the 100-day moving average is significant is because it has not managed to sustain above the 100-day moving average for a fairly long period of time. It broke below that level in August of 2025, and then it had to wait all the way until the start of this year to go back above that level. And from January the 5th, it stayed until around about the 12th or the 13th of January, and then it slipped below that level again, and then it had to wait for another 3 months, which is until April of this year. And then after breaking above the 100-day on the 8th of April, it slipped below that again on the 17th, and since then it continued to meander either around or below the 100-day moving average. And it is only today, after another 3 months, is when it has managed to cross the 100-day moving average and also the 200-day moving average, which was at 432. It has gone above those levels as well. More importantly, today's gain has come on very, very strong volumes as well. The stock had seen more than 10 crore shares were traded today on Kalyan Jewellers, the highest ever volumes seen on the stock on record. So the best single day gain, the best volumes as well. It will be interesting to see what kind of delivery data comes up later in the day, but a very, very sharp up move on Kalyan Jewellers in today's trading session. Ruchit, correct me if I'm wrong if the levels were a little awry, but the stock has moved above its key moving averages. What are the next levels that you're watching out for now on Kalyan?
Yes, definitely. We have seen all the important moving averages getting broken out. Now, the major difference that you mentioned when the stock moved April and this time is the volumes. This time the up move have been supported by very good volumes. This should lead to a continuation of the up move. On a positional basis, the major hurdle would come around the January 2026 highs, which were around 520, 530. So still a long way to go, I think, if one has a positional view on.
Okay, Ruchit, Kalyan Jewellers, what a strong recovery the stock has seen after the slip it saw post its quarterly update. But one stock today that was feeling under the weather was Dr. Reddy. It slipped over 5% after one of the semaglutide batches saw quality concerns as far as its API was concerned. Vinny Motiwala joins in with all the details.
Hi, so for Dr. Reddy's, actually they've flagged a quality issue in the semaglutide batches. So what does this indicate? Now some commercial supplies of semaglutide could become a delay temporarily for the company. They furthermore said that there was some issue that was that came out on some specific issues for quality. Some specifications were not matched, and this was an issue linked to the API supplies that came in, an API that was used in the product. So that becomes an issue, and that is why the commercial supplies now could be delayed temporarily for the company. The company furthermore said that they are still trying to find out the root cause and will go in detail to find out that root cause and investigate that. Obviously, they will take corrective measures, and then only they will start the commercial supplies once the product is up to the quality. But semaglutide was a big opportunity, weight loss drug, GLP-1 opportunity that everyone has spoken about. So because of that, we're seing the pressure coming coming in on the stock today. Apart from that, obviously the suppliers to Dr. Reddy's also are something that one should watch out for, whether it's OneSource Specialty or even Shelley Engineering are some of the suppliers that come in, right, or CDMO partners that come in here for the company. So let's watch out for that as well. But as of now, temporarily, this is a blip that comes in here. If it's resolved soon, then there may not be much of an impact that comes in for Dr. Reddy's. But if it goes on for longer, then it's an issue.
Vinny, thank you for that update there. Mayuresh, Dr. Reddy's, well, the stock hadn't done much this year anyway as an underperformer compared to a lot of its other larger or smaller pharma peers that are already at 52-week highs, but concerns of its own, a big opportunity, and now this has sprung up. Would you remain or would you look for better opportunities in the sector compared to Dr. Reddy's?
I think we remain bullish on Laurus. I think the targets have been achieved out there, Hormaz. And now I think we remain constructive in terms of SciLife within the mid-cap pharma space as a CDMO offering that SciLife has got, the kind of expectation that one really has in terms of the margins that they post next to 30%. I think extremely robust and continue to remain so. In our swing portfolios, we've got Newland Labs because our own sense is that the CSM portfolio that Newland probably has. And again, the margins that they work out at around close to 30-odd%, very, very strong balance sheet. And they've got almost 98 drugs in the pipeline, either in stage 1, 2, 3 in terms of clinical trials. So as monetization probably happens in key niche areas, I think a couple of these names out of the entire pharma space, in our opinion, the CDMO stroke CSM space, a tad bit more attractively placed.
Well, thank you so much, Mayuresh, for your views. Ruchit, within the pharma pack, how are the charts of Dr. Reddy looking, and what's your top pick in the pharma space?
Dr. Reddy seems would stay under pressure for the near term. We have seen volume-based selling today, and also on the weekly, monthly chart, it's still into a broad consolidation phase. So 1180, 1200 is where the major support for the stock is placed. So one should definitely avoid at current levels also. Within the entire pharma space, I think the outperformance can be seen from DVs now. We have seen that after a hat of high bottom structure, stock went into a consolidation phase for about 2.5 months. And now prices are showing signs of a breakout from there. So this should lead to a continuation of the longer term uptrend in DV. So the risk reward ratio over here, if one has to take any bet from pharma, then DVs looks.
Thank you so much, Mayuresh, as well as Ruchit, for joining in on the show, giving us your view on various sectors as well as stocks. Well, with that, it's now time for a short break. We will get you the top corporate voices along with the key market events to watch out for on the other side. Welcome back to Markets Forward. Well, it's now time for the top corporate voices of the day. The management of SBI Funds told CNBC TV 18 that the simplification of KYC norms through CKYC 2.0 could be the biggest growth driver for the mutual fund industry. The fund house said removing KYC friction will help expand the investor base, especially given that just 2% of SBI's 35 crore rupee KYC compliant customers currently invest with SBI Mutual Fund. It also said it expects blended yields to remain in the 40 to 44 basis point range, supported by a growing equity book and higher margin gold and silver ETFs.
And the management of Yash High Voltage also told CNBC TV 18 that new capex is expected to drive revenues of around 900 crore rupees and will be margin accretive. The company said that revenues from the expansion have already started coming in, with margins expected to improve further from FY28. It added that while working capital remains stretched due to supply side constraints, the cycle is expected to improve as the company localizes its supply chain.
And before we wrap this edition of Markets Forward, we will be bringing you the key market events to watch out for. Ria Bhatia is standing by the big wall with all the key events to focus for tomorrow's trading session. Ria, over to you.
Well, yes, in tomorrow's trading session, we will be watching out for the India Forex reserves data as well as the AMFI data, which will be closely tracked. We also have the earnings season that will be in focus. The results of L&T Finance, Elcon Engineering, Indian Bank, Just Dial Limited, as well as Bank of Maharashtra will be closely tracked. Also keep an eye out on PNB Housing, InSwift Laboratories, as well as Wheels India, which will be holding board meetings to consider fundraising options. And apart from this, Waterways Leisure Tourism, which is Cordelia Cruises, will also be holding a board meeting to consider a stock split. Apart from this, keep an eye on the Kusumgar IPO, which closes for subscription tomorrow. And in other news, Prime Minister Modi's last day of the Australia tour will be tomorrow before he heads to New Zealand. And these were the key events that will be tracked in India. But in the US, we also have two reports that will be in focus. The first one is the International Energy Agency monthly oil market report, and we also have the World Agricultural Supply and Demand Estimates report.
Ria, thank you for that update. Numbers from TCS are out. Let's go across to Rima for the fine print. Rima, over to you.
Hi, Thanks so much for that. I'm just getting the numbers actually as we speak. The company's net profit has come in at 13,349. This is largely in line with the CNBC TV 18 poll. Rupee revenue has come in ahead of expectations. It's a number of 72,275. Remember, numbers on a year-on-year basis were expected to look good on account of the rupee depreciation. The rupee had fallen by nearly 9.5% on a year-on-year basis, which is why the rupee revenue on a year-on-year basis has come in at 13.9%. The EBIT has come in at 17,317. Again, this appears to be largely in line with expectations, with margins coming in at 24%. There is a 130 basis points margin decline, maybe about 10-15 basis points lower than what consensus expectations was, but largely in line with expectations. The reason you're seeing a margin correction on a quarter-on-quarter basis is on account of the wage hike. The company had announced wage hikes effective 1st of April 2026, and typically in a wage hike quarter, margins get impacted negatively by 150 to 200 basis points. To some extent, was expected to be offset on account of a forex tailwind. Margins for the company have come in at 24%, a decline of 130 basis points. The company's growth in constant currency terms, they say, has come in at 0.4%. This is again largely in line, maybe at the upper end of the range we were working with. For us, the constant currency revenue growth range was about -0.1 to +0.4%. The AI revenue growth has come in at 13.6% at $2.6 billion. This number was at $2.3 billion in the prior quarter, but as the base is getting bigger, the company's growth rate there. I think net, just to summarize, there are lots of numbers that we're pouring over. Its numbers in line with expectations. Expectations were muted. The company has delivered 0.4% revenue growth on a quarter-on-quarter basis. I don't think this is going to negatively surprise the street. Margins have fallen by close to about 130 basis points on account of the wage hike. The deal wins signed by the company stand at $9.5 billion. This is lower than the deal wins signed by them in the prior quarter, but last quarter had the large Marks & Spencer's deal, and it's broadly within that $8 to $10 billion that they have been winning. The big deal this time was the SKF. So, okay set of numbers. The company's headcount stands at 593, which is a slight increase compared to the prior quarter, with attrition at 13.6% versus 13.7% that we had. So it's an okay, it's an okay set of numbers that I can see. The company's dollar revenue growth has come in at flat on a quarter-on-quarter basis, up 2.7% on a year-on-year basis. So let me just read out the statement that we're also getting in from K. Krithivasan, CEO, MD. Q1 FY27 reflects the continued growth momentum, strength of our strategic positioning. Despite the geopolitical macroeconomic headwinds, we delivered an order book of $9.5 billion, led by an AI transformation deal with SKF. The AI business now stands at $2.6 billion on an annualized run rate. As customers accelerate investments in AI, modernization, cybersecurity, TCS is positioned well to translate the opportunity into sustained growth. The headcount, as we were pointing out, Yusuf has just put out, has gone up by nearly 9,000 on a quarter-on-quarter basis. Sandeep Agarwal is now joining in on the show. Sandeep, you want to give us your first take? At least to me, prima facie, it looks like an inline set of numbers, and there at least doesn't appear to be any negative surprises.
So I think, the numbers are broadly in line, and the good part is that, they have given wage hike even in this quarter, and also the net addition number is good. So I think, nothing to read negative about it. As I have said that this quarter will be probably inflection point for all the IT companies, and from here on, you will see some improvement. And I think even the 9.3 billion deal win number is quite good. So I would say it is a decent set of numbers, no negative surprises. And I think people will read it accordingly, and probably, if the commentary is positive, I think things will look better from here.
Okay, you're saying the market should read these numbers positively?
I think so, yeah. I see the numbers quite positively, unless there is some negative commentary on the con call.
And there's negative commentary, okay. In terms of commentary, what would you be watching out for closely?
I will be more closely watching out that whether the deflation of the AI impact is broadly behind. Second, how is the deal win environment looking like going forward, and the uncertainty over deal, which people were talking about, is that receded or not? These are the three key points. And also on manpower, what is their plan for rest of the year? Because that will give you a good idea whether they are seeing deceleration in business or they are seeing acceleration, stabilization in business.
Got that. This AI annualized revenue at $2.3 billion, a growth rate, I mean, it's still growing very well, but on a smaller base. It's still perhaps, less than, I think it's, it's less than 10% of the overall revenues. So in that sense, do you think it should be growing faster?
No, so Rima, you have to understand that right now the resource availability and that space is very limited, and basically these companies are themselves training and deploying the people. So, it will take some time. So, that 10% scale up always takes maximum time, 10 to 15% or 20%. And then if you see digital also, initial 20% took a lot of time, and then it moved up very sharply. Because once resources will be available in the ecosystem, then growth will be faster. So I think I will not read too much into it, but I would definitely like to hear what management says on the AI side in terms of manpower, the training, and also the deployment. These are most key. I don't think that, any other number is relevant for this quarter. The manpower commentary and their training in AI is most important.
Okay. The AI revenue is approximately now 8.7% of the current numbers annualized. So that is what the AI revenue stands as a percentage of the overall numbers. Sandeep, you've been bullish on the IT space. When you try and say, go out there and buy a TCS, what's the pushback that you hear?
No, so I am not saying anyone to buy because I run a PMS, but I am personally, and we have started building up our position in IT for last 1 month since we became positive. So we became positive end of March, and since then we have been buying, although the index is down 8-10%, but we are doing good, and we are very confident that in next 18 months we will make significant amount of money once deployment for AI starts happening.
Okay. Thank you very much for joining in, Sandeep. Hormus, with that, it's back to you. TCS has delivered in a very low expectations quarter. No negative surprises. As of now, TCS's revenues have gone up by 0.4% on a quarter-on-quarter basis. Margins and expected lines have fallen 130 basis points sequentially on account of the wage hike. Year-on-year numbers are looking a lot better on account of the rupee depreciation. So we are seeing a double-digit growth when you look at the numbers on a year-on-year basis. But deal wins are steady at $9.5 billion. AI now constitutes nearly 9% of their overall revenues versus 7.5% in the prior quarter. So that is tracking up. And the headcount for the company has increased by nearly 9,200 employees on a sequential basis. So as I said, the company seems to have delivered in a low expectation quarter, and there are no negative surprises. And I think that in itself sometimes is good news, because the narrative around IT has been, and the mood around IT has been negative since the start of the year. TCS itself is down more than 35%.
Well, as they say, no bad news is good news. Maybe that might just be something that the market would be looking for when it comes to IT. As you mentioned as well, TCS down 35% on a year-to-date basis. It will be interesting to see how the ADRs of both Infosys and Wipro react to these numbers later this evening. And, well, an inline set of numbers for TCS. And it'll be interesting to see what the management has to say on the road ahead. And of course, when we hear from them tomorrow morning when they speak to us, it'll be an interesting conversation on the road ahead for the company. But from now, from Vivek, me, Rima, and the entire team, thank you so much for watching. And more news and updates continue on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. The US bombs Iran for the second straight day after Trump pulled the plug on the ceasefire agreement, which lasted about 3 weeks. The US president calls it retribution for bombing of ships by Iran. Tehran hits back, strikes American military bases and strategic centers in Bahrain, Kuwait and Qatar. Crude oil prices ease marginally, but Brent remains within striking distance of the $80 mark. Shipping traffic at the Strait of Hormuz grinds to a standstill after the fresh escalation. Sensex and Nifty end with marginal gains. Mid-caps outperform. Rupee strengthens against the dollar but remains above the 95 mark. TCS meets Street in the first quarter on the back of multiple AI transformation deals. Constant currency revenue growth in line. Margins fall slightly on the back of wage hikes. US Justice Department launches a probe into alleged fraud involving H-1B visas used widely by IT and tech companies to recruit Indian engineers. US Labor Department inspector says dozens of subpoenas have been issued and names cognizant. Indian government and industry to formally oppose the 12.5% tariff proposed by the US trade representative alleging forced labor practices. The hearings will kick off today and Indian authorities deny gaining any competitive advantage detrimental to US interests. Government extends customs duty concessions for several critical components used in electronics manufacturing till March 2029. The concessions are expected to lower input costs for manufacturers and encourage fresh investments in electronic sector. Telecom regulator dials the government, seeks powers to regulate caller ID apps like Truecaller and others. This comes after Truecaller CEO criticized the regulator's policy on spam calls. Monsoon takes 35 days to cover entire India, the slowest progress in 5 years. Red alert in Delhi as heavy rains cripple the capital. Surat and large parts of Gujarat flooded. 11 people trapped after garbage mound crashes into a building in Pune. LPG cylinders get washed away in Raigad. India and Australia deepen energy and defence ties during Prime Minister Modi's visit. India also secures deals for supply of critical minerals and uranium. France takes on Morocco in the first World Cup quarter-final match tonight. The Mbappe-led side has scored 14 goals so far in this edition of the World Cup, while conceding only 2. Mbappe himself has scored 7 of those and is in contention for the Golden Boot award. All right, let's start with the big story that we're tracking. The US bombs Iran for the second straight day as a 3-week-old ceasefire crumbles. Here are the latest developments. US forces attacked Iranian cities along the Strait of Hormuz, hitting 90 Iranian military targets, including over 40 small IRGC boats. US President Donald Trump claims the strikes were a retribution for alleged Iranian attacks on ships transiting the Strait of Hormuz. Iran said 14 people have been killed in these attacks over the last 2 days. Tehran has retaliated with attacks on US bases across the Gulf. Kuwait, Bahrain and Qatar all intercepted missiles and drone attacks and advised citizens to refrain from approaching sites of shrapnel resulting from the interception effort. Soon after the attacks, US President Donald Trump said that the option to return to a full-scale war remains on the table. He also claimed that Iran wants to make a deal badly. President Trump also referenced the US attacks and said, and I quote, "When they hit hard, we hit back much harder," end of quote. Tehran has also warned of further retaliation. In a social media post, Iran's chief negotiator Ghalibaf said, and I quote, "America still has not learned that bullying and breaking promises are no longer cost-free. If you strike, you will get hit," end of quote. In the oil market, Brent crude prices eased marginally and remain near the $78 mark. According to the International Maritime Organization, hundreds of ships with nearly 6,000 seafarers are still stranded in the Persian Gulf due to the West Asia conflict. This as shipping traffic through the strait has slowed to a near standstill. Here's what US President had to say on the fresh strikes and negotiations with Iran.
And I say we hit them 20 to 1. Every time they hit us, we're going to hit them 20. And we did it last night. It did a little something today, but it was really retribution for last night. They hit actually 3 boats, not 2. And when they hit, we hit back much harder. We have many ways we can win, but we've already won militarily. They have very little left, and they want to make a deal so badly. They called a little while ago. They want to make a deal so badly. I just don't know if they're worthy of making a deal. I don't know that they're going to honor the deal. That's the problem.
Meanwhile, US President Donald Trump flew out of Ankara after attending what was a fractious NATO summit. There was palpable unease among European leaders as Trump has repeatedly demonstrated against the continent for not doing enough to shoulder the burden of collective defense. His latest grievance, Europe did not show enough support for the US military operations in the Gulf. This time, Trump departed the summit claiming there was tremendous unity. Leaders of Lithuania, Latvia and Estonia said that the tone inside the room exuded positivity.
Tone in the room was very positive, very constructive, and we were discussing issues that really matter. 5% defense spending, we were discussing support for Ukraine, we were discussing what we can do in the Middle East, especially when it comes to Iran. We are discussing also about real capabilities. But to some extent, probably that's the reality of the 21st century, that you have two different realities.
The spirit of this meeting was very friendly, peaceful, constructive, and many colleagues have repeatedly emphasized the importance of United States, importance of the transatlantic bond, and me, as the president of Lithuania, a country which is probably the staunchest supporter of transatlantic bond.
At the end of the meeting, he was happy, maybe because he listened of all our positions and saw that everybody in Europe is willing to contribute more to the defense. That is probably that. And also, he was very positive about President Erdogan's and this meeting arrangement. So that was also his public statement.
All right, let's get you the latest as far as the day's market action is concerned. The market snapped the two-day losing streak with Nifty ending above 23,950. Mid-cap index outperformed and Nifty IT ended lower for the second straight session. Sensex gained over 230 points while Nifty Bank rose over 500 points. And the big corporate story, tech giant TCS has met street expectations in the first quarter. We have Rima Tendulkar joining us now to decode the numbers. Rima.
Thanks so much for that. So the expectations going into TCS's numbers were fairly modest, and the company has delivered on all fronts. So all in all, it's a steady-ish quarter. But again, to reiterate, the expectations were fairly muted. The company's revenues have come in at 0.4% quarter-on-quarter in constant currency terms, slightly at the upper end of the consensus expectations. Margins have fallen by 130 basis points to 24% on account of the wage hike given by the company effective 1st of April. The overall profits of the company have come in at about 13,350. They've seen a decline on a quarter-on-quarter basis, A, on account of the wage hike impact, so that's impacting the operating profit. But two, the company also spent about 668 crores to settle a legal claim. So there is that exceptional item at the bottom line. The numbers on a year-on-year basis, though, look a lot stronger on account of the INR depreciation. The rupee in the quarter gone by had fallen by nearly 9-10%. So if you look at the rupee revenue numbers on a year-on-year basis, they're up nearly 14%. I think the number that everyone's watching are the AI revenues, right? Because there is so much fear. There is AI deflation, which is eating away the industry revenues. So the company for the last couple of quarters, I think sometime in December, started giving out the AI revenues. And that on an annualized basis has hit $2.6 billion. And that is slightly less than 9% of the overall revenues. How has this AI revenue, trended over the last couple of months? In December, it was $1.5 billion. In January, it was $1.8 billion. In April, it was $2.3 billion. And now as we speak, it is $2.6 billion. I think maybe markets could quibble that the growth rate has come down. But again, now it's nearly 9% of the overall revenues. The deal wins of the company are steady, $9.5 billion. This is largely in line with the 910 that they've been tracking for the last couple of quarters. In Q4, you had 3 mega deals, including the Marks and Spencer. So the Q4 number looked very strong at I think about $12.5 billion. Compared to that, this quarter has come in at $9.5 billion, but nothing to complain about. Headcount for the company has gone up by nearly 9,300 people sequentially. That's always a positive sign. And attrition is steady at about 13.6%. All in all, the company has delivered on modest expectations in Q1 FY27. Back to you.
All right, thank you, Rima, for that. Shifting focus now, the U.S. Federal Reserve remains divided over the path of key interest rates. Minutes from the Fed's June policy meeting show that officials indicated that they will address persistent inflation this year with one interest rate hike. Now, the Trump administration has launched an investigation into the alleged fraud involving H-1B visas used by IT and tech companies to recruit Indian engineers. U.S. Vice President J.D. Vance has issued a fresh warning to what he described as foreign fraudsters. He's accused them of exploiting the temporary work visa program to undercut American workers. Speaking to Fox News, a U.S. Labor Department inspector has said that dozens of subpoenas have been issued and has also named Cognizant as one of the companies that have allegedly abused the visa program.
Today, I'm proud to announce that the Federal Department of Labor has started dozens of subpoenas and investigations into foreign fraudsters who are trying to take advantage of the H-1B visa program. Here's a simple principle. Ladies and gentlemen, American jobs ought to go to American workers and not foreign fraudsters, and the Department of Labor is fighting back against it.
We've already started to issue dozens of subpoenas. We are going to make sure that we track down every lead. We have whistleblowers talking about some of the biggest companies like Cognizant, who have been in chatter of issues with perm and H-1B visas. And we are going to work side by side with the President and Vice President's fraud task force to exhaust every lead. I'm going to take this exactly like I did when I was an NYPD detective, and I'm going to give and make sure my investigators and auditors have every resource necessary.
The U.S. President Trump said he'll ask the country's Supreme Court to rehear a case challenging birthright citizenship in the U.S. This comes weeks after the court struck down his executive order. The top court ruled that children born on the U.S. soil are automatically citizens under the 14th Amendment. The Supreme Court has not agreed to rehear a ruling of a case already argued since 1965. A billionaire, Gautam Adani, is due to file an affidavit before a U.S. court this week. The affidavit will address questions posed by the judge on the decision by U.S. authorities to drop charges of bribery against Adani. The Justice Department had earlier accused Adani of bribery in India, but it decided to drop the criminal case. U.S. officials have said Adani's decision to invest in the country did not influence their decision to drop the charges. The Indian government and industry will formally oppose the 12.5% tariff proposed by the U.S. Trade Representative, alleging forced labor practices. Indian authorities have denied gaining any competitive advantage detrimental to U.S. interests. Abhimanyu Sharma joins us with more. Abhimanyu, what are you picking up?
India is going to oppose the 12.5% proposed tariffs under Section 301 in the formal hearing before the U.S. Trade Representative. Now, two allegations were made under Section 301, not just against India, but also against several other countries, in which it was claimed that both forced labor as well as excess capacity by several countries were hurting the U.S. trade interests, and hence it was proposed that tariffs to the tune of 12.5% should be imposed on both these cases. Now, India has formally opposed any such levy of tariffs, not just by the Indian industry, but also by the government. And it has been submitted by India so far that the probe does not satisfy the legal requirements for the initiation. And there is no evidence to suggest that India's exports to the US confer any artificial advantage or burden or restrict US commerce in any way. Now, this hearing is on the issue of forced labor. It remains to be seen whether there is going to be any further hearing on the issue of excess capacity too. And more importantly, all eyes would be on what transpires out of this hearing, based on which any further levy of US tariffs is going to be decided. Now, for now, 10% US tariffs are in place, which are set to lapse on the 24th of July. Now, the IPA tariffs had already been done away by the US Supreme Court, and post the 24th of July, if there is no levy of tariff by the USTR, then only MFN tariffs are going to apply. So clearly, the tariff architecture is going to be decided possibly by these hearings, even as both the sides are also engaged in talks for a trade deal, in which both the sides have indicated that 99% of talks have already been concluded.
All right, thank you, Abhimanyu, for that. What we'll do is we'll take a short break, but coming up next, telecom regulator dials the government seeks powers to regulate caller ID apps like Truecaller and others. We'll tell you why when we return. Stay tuned. Welcome back. Telecom regulator has asked the government for powers to regulate caller ID apps like Truecaller and others. This comes after Truecaller CEO criticized the regulator's policy on spam calls. Ashmit Kumar has more. Ashmit.
Well, this is clearly something that has been high on the agenda of the TRAI with respect to checking for spam. And that, in pursuit of that, we understand that the TRAI has written to the Ministry of Electronics and IT. The reason for that essentially is that they're seeking powers under the IT Act. The TRAI is seeking additional powers under the IT Act. So far, the mandate and the sphere of influence, as far as the TRAI is concerned, is restricted to the telecom companies in question. However, in wanting to address this issue of spam, it now wants wider powers available under the IT Act. Under the IT Act, the TRAI is seeking to be designated as an authorized agent, and subsequent to that, that will give the powers to the TRAI to regulate call management applications such as Truecaller. Now, the bone of contention essentially is to streamline legitimate commercial communication. There were two series of numbers that the TRAI had launched. One was 140 series, the other one was 1600 series. Now, this is the bone of contention. The TRAI has asked Truecaller to allow for these calls to go through from these number series without being blocked, without being reflected as spam. Now, that is something that Truecaller has complied with, but essentially what Truecaller has been arguing is that this has led to a spike in the volume of spam calls. That is the position coming in from Rishad Jhunjhunwala, the founder, the CEO of Truecaller. Now, what we're given to understand is that MeitY has received this representation from TRAI, but sources within the ministry tell us is that this is an issue that will require some amount of consultation, some amount of deliberation between the two ministries. That's the MeitY on one hand and DOT on the other. So what we're given to understand is that there are consultations underway, and only after that consultation process is completed that MeitY will take a final decision on whether or not the TRAI can be designated as an authorized agent and can be granted additional powers under the IT Act.
All right, thank you, Ashmit, for that. Shifting focus to the monsoon now. Heavy rains continue to lash several parts of India. The Met Department issued a red alert for Delhi. Torrential rains triggered waterlogging and massive traffic jams across the city. Heavy rain and strong winds also lashed parts of Noida. A tree fell on a vehicle amid the downpour. Though there were no immediate reports of injuries, 3 people, including a woman, were rescued after being swept away while crossing a river in Uttar Pradesh. Schools and colleges have been shut across several states in North India. From Uttar Pradesh to Gujarat, torrential rains have battered parts of the state. At least 9 people have died in Surat. Over the last 2 days, heavy rainfall has been forecast at isolated places in Tapi, Narmada and other districts as well. One person died after a building collapsed at a waste management plant in Pimpri Chinchwad near Pune. The 3-story building collapsed after a massive mound of garbage belonging to company Antony Waste crashed onto the structure. Rescuers suspect that 7 to 8 people are still trapped beneath the debris. And around 3,000 LPG cylinders were swept into the Patal Ganga River in Maharashtra's Raigad. This after floodwaters entered HPCL's bottling plant, prompting the administration to issue a public safety warning. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18.
Hello and welcome to the Editor's Playbook. I'm Shireen Bhan. The war in West Asia has not just upended the global oil markets, but it's also brought the spotlight back on defense preparedness and defense spending. In India, the indigenization drive has been further accelerated post-Operation Sindoor. The Defense Acquisition Council has cleared 6.5 lakh crores worth of orders this year alone. Now, India is also looking at the defense sector as an area of global collaboration and exports. Defense exports have touched a record high of over 38,424 crore rupees, albeit on a very small base. On his visit to Indonesia and Australia, Prime Minister Modi has inked defense collaboration pacts, which have now become key to our bilateral deals. Even globally, the defense sector has seen plenty of action. The United States has announced a $1.5 trillion budget. Europe is looking to remilitarize, given President Trump's threats to NATO. Now, future battlefields will be defined as much by AI, autonomous systems and software as by traditional platforms, which brings us to the big question. Will higher defense capex unleash a new wave of domestic suppliers? Is the Indian private sector ready for the opportunity? And what will the defense PSUs, which continue to account for a significant share of India's defense production and exports, need to do to stay ahead? Let's welcome our usual suspects, Prashant Nair, Nimesh Shah, Sriram and Hormuz. Gentlemen, many thanks for joining us. I was just thinking as I saw that Rafael go past my head, that's probably the only time that I'm going to be in the midst of any kind of a fly past, even though I've grown up on Air Force bases. But, while we're talking about defense, it does make me uncomfortable that in 2026, governments around the world are prioritizing defense spending, defense capex. But that's a matter of another discussion and another debate. It is what it is. So, Prashant, to you to start with, as far as India is concerned, we are operating with three pillars. There is the indigenization pillar, which over the past decade, the government has been pushing very sure-footedly on. There is, of course, the modernization pillar, and there is now an export pillar. As we pointed out, 38,000 crores and counting, a record high as far as exports are concerned. Within this three-pillar strategy, let's talk about what this means from industry point of view, what it means from a market point of view as well.
Shireen, hi, and great to be back here. And I think it's a hot topic, right? Absolutely hot topic. I think all you mentioned, the three pillars and the three legs that you mentioned, at the end of the day, they all work for, from our prism, and we are looking at this from the prism of what it means for companies, prospects for these companies, order books, revenues, etc., right? It all comes down to the fact. I'll give you a simple example. There was 100 rupees being spent on defense in, say, FY20. And that budget has been growing at whatever, 12, 13, 14% every year. And what we are bothered about here, of course, is the capital expenditure part of the spend, because, and that is what goes to companies, right? Revenue expenditure is still the large part of what the government spends, but that is pensions and salaries, etc., OPEX. But what we are concerned about is CAPEX, right? That 100 rupees has kept growing at a steady pace. What has changed is what you mentioned right at the beginning, which is indigenization. I think that is the real, because, modernization would have happened, exports would have happened, but it's possible that all this perhaps would have been done within the public sphere. We could have continued to import, and we were importing most of what we consumed as far as capital expenditure is concerned. But I think over the last 10 years, actually a little over 10 years, what we've seen, and I think there are about 5 things that I want to mention here, and this kind of takes you through the journey of how we've got here. I would say the early versions of this Make in India indigenization happened during Trump 1.0. 2016 is when this started, and actually from 2016 to about 2006, beg your pardon, 2013 is the first phase where we saw make and buy Indian categories for the first time, which were introduced. 2016, which is Trump 1.0, is when the defense procurement policy, it's called DPP, now it's called DAP, that for the first time introduced buy Indian, but indigenously designed, developed and manufactured products. That is 2016, Trump 1.0. The real kicker and the big one happened in 2020, as we all know, which was DAP 2020 policy, which streamlined categories, raised indigenous content across weapon systems, the thresholds which are required, and a lot more as well. And then between 2020 and 2023, that is, in a 3-year period, we've banned imports of about 509 defense items. And according to government's own press release, PIB press release, these 509 items over the next, 5, 6, 7 years are about, the value of these components that India would have imported is some 8-9 lakh crores, right? We're looking at very, very large numbers here. And of course, the government then has also issued additional lists covering 5,000 plus items for indigenization. So what I'm trying to say here is that, industrial policy is a hot topic. And what does industrial policy mean? It means the state orchestrating what it wants to do. And I think in this case, a bunch of things came together to make all of this happen, which is security, reducing, spending less dollars. It's all dollars out, right? So I think that was the starting point. But I think, of course, it's moved on in many ways, in many directions from that on.
The Russia-Ukraine war had a significant impact also. If you look at the capital spending,
go ahead.
Spending by the government, every year we have only started meeting the budget allocation in the last 3 years. Until then, there would be a 40%, 30%, 50% shortfall in the capital outlay. FY23 onwards, we've gone from 2 years, we spent exactly what was budgeted, and last year we spent 8% more than budgeted. I think the government is really serious now, and I think to a great extent the Russia-Ukraine war would have had a...
The base has picked up. I was trying to lay the foundation of this, that it's at the end of the day, this is, we're going to spend anyway. You'll spend more because of Russia-Ukraine. But the point is how you spend it. You want to spend it here locally, make it here, or you want to get all this stuff in. That's the...
Yeah. So, Prashant, what you said about Indianization, there is a
there's a clear number which substantiate what Prashant is saying. The percentage of Indianization has gone up from say 54% in 2019 to 70% plus by 2025-26. So clearly there has been a big shift, and now the government is clearly focusing on Make in India product and Indianization. So clearly that theme is clearly playing out as far as the defense numbers are concerned.
In a way, this is the clearest sort of expression of what we call, almost in a way the government creating the industry, because the government is the buyer. I mean, who are you selling to, right? You're selling to the government, and the government's decided that we want to buy from you.
Exactly.
And we want to buy here, we want to spend rupee, we want to pay you in rupees and not send dollars out. And I think they've created this entire industry. And I think, you look at, I think Nimesh will talk more about this, what stocks have done, companies have done. It all started with that DAP policy 2020.
Absolutely.
And I think that's the move.
You're absolutely right, and the government is the procurer. In fact, even the procurement process in itself has also seen many changes to try and speed things up, remove the bureaucratic red tape, so to speak. We've also seen FDI changes coming in to try and allow strategic investors to come and participate in the India defense story in partnership, in collaboration with Indian entities. And of course, we've seen that emergence of the global supply chain as well, which will dovetail into the export story and into the global supply chain story in just a second. But Nimesh, let's talk about, where Prashant left things. What has all of this now meant as far as defense companies are concerned? What has this meant from a return on shareholders' wealth perspective of those who have believed that this is in fact a sector to bet on?
Absolutely, Shireen. So, from a numbers point of view and from a markets point of view, I would say, large part of what we discussed, the three pillars and the way the government has shifted the focus and all, a lot of things has got actually captured into the defense stocks and the defense names. And I'll show you why. The Nifty Defense Index from May 2022, the index, the total, the number of stocks which are there, the part of the index, that market cap has gone up by 5x. Okay, the combined market cap has gone up from 5 lakh crore to 12.5 lakh crore. So the market cap has gone up by 5x. In the same period, the revenue is only doubled and PAT has only doubled. So to some extent, a lot of the excitement is already in the price. A lot of this, many of these defense names are quoting at 80 times, 90 times, 100 times, 1 year, 2 year, 3 year forward earnings. So clearly from that perspective, I would say that market is already priced in to a larger extent the opportunity which was coming for the PSU defense. So that's one part of it. Just only by going by the numbers, I also looked at the top 5 multi-baggers in the PSU basket. Okay, Mazgaon Dock, that stock in the last 5-6 years is up 32 times. I'm not talking about 32%, I'm talking about 32% X is the return that this stock has given in the last 5-6 years. Garden Reach has gone up by 12x, BL has gone up by 12x, HAL has gone up by 11x, Bharat Dynamics has gone up by 8x, and Cochin Shipyard has gone up by 6x. This is the kind of return we've seen in the PSU defense names in the last 5-6 years. Having said that, I believe, and what all we are going to discuss as well, it's a massive opportunity that the government has created, not only for the PSUs, but now for the private companies as well. So my sense is what we saw in the first 8-10 years in the PSU names, maybe you'll see that happening in the private names as well in the next immediate future. So that seems to be...
Which ones?
So there are a whole host of companies which are part of the, Those numbers are staggering,
Staggering, right?
Now when you put all of them together, over 3,000% there as far as Mazgaon Dock is concerned, over 1,200% for some of the other names there on that screen. Those numbers are staggering, Nimesh and Prashant.
And if you can go back to the aggregate numbers, the first graphic which Nimesh was referring to, which is the total industry profit, total industry thing, and total market cap gain. I'll just make one point. The market cap bit is, you buy stocks, and this is and I think Bulls will like this point, that you buy something for not what it has done, but what it will do, right? For, as they say, not where the puck has been, but where the puck will be. Correct. So, and there I just looked at, the EBITDA growth expected between FY26, which is the last reported year that we have, to FY29. These are Kotak estimates. And I'm just looking at it, right? 20%, 15%, this is CAGR growth over the next 3 years, 26 to 29. 20%, 15%. BDL, Nimish, 107%. Right? There is Cochin Shipyard, which is, by the way, I think you would point out, Cochin Shipyard earnings have underperformed.
Yeah.
Right?
In the last 8 years, it has underperformed.
Yeah.
It
So
has not delivered.
my numbers are 2.5% EBITDA CAGR for the last 5 years, but 24% for the next 3 years.
But a lot of BDL shareholders will tell you that they have also been disappointed who entered later
So
because
again,
of the execution
listen,
issues.
one thing, defense is kind of cyclical as well. It's there is a bit of lumpiness as well. The government orders come, they get delayed, execution gets delayed. So there are a lot of challenges in this sector. Having said that, my limited point was, Prashant, that a lot of market has already priced in a lot in the PSU names. So from a market perspective, should one look at the private names as the next big theme? Because this theme is going to be a decadal theme. That's something everybody's been writing about.
Let's address that. The private sector basket, the private sector opportunity, and link that to the fact that this is also now likely to go beyond being just indigenization story to much more of a global supply chain and an export story as well. And we'll get Hormuz to come in on that. But let's talk a little bit about what this private sector basket looks like now today.
Sure. So I've identified a lot of names. I'll start with the first name, which is Apollo Micro. Small company, but I picked up this because this is in the news. We are going to hear a big acquisition in the defense space itself. There is a company which is having a board meeting today, so it probably get announced. We broke the story as well. So again, now even the private players are adventuring, doing M&As, looking for acquisitions and growing the defense pie. So that is one name. The second name is Solar Industries. Let me ask all five of us if anybody knows the promoter of this company.
I know it because you told me.
Because I told you. But if I mean, I've been in the market for
but
more
I
than...
really Googled him after that. He's a Padma Shri winner.
Shireen, Solar Industries promoters, Satyana and the other two promoters combined own 73% of this company. Today, at current market cap, their value, is more than 1 lakh crore. We normally relate to this kind of market caps being generated by JSWs of the world or Adanis of the world. I can remember one individual who's created bigger wealth than this is Radhakishan Damani of DMart. I mean, I can't recollect of any other individual name.
Money, I was going to say that, yeah.
So that's one name which is very, very much, familiar. But otherwise, it's very rare to figure out that a defense company has created such a market cap that the owners are now worth more than 1 lakh crore.
There will be a lot more from the startup space in the coming years. We'll talk about it in a bit.
We'll talk about that. But so that's one. Then there is Bharat Forge who's aggressively getting into it. Adani Defense is something who's looking at getting into this business as well. A lot of companies, right from data patterns to Zentech to even MTAR. We keep talking to their management quite often. So, and all of them have created their own niche in some sense or the other. So my sense is we saw a big rally in the PSU defense name in the first 10 years. Maybe the next decade could be for the private names. And watch out for the private sector stocks which are going aggressively in the defense side.
Whether it's 2030 or 2031, I think that graphic page on your screen is an illustration of the kind of entrepreneurialism that we are starting to see within the defense sector with the opening up, so to speak. Yeah, go ahead, Prashant.
I was just remembering, I don't know if you remember or not, you interviewed Shireen, I think it was the McKinsey Global it was one of our events at CNBC TV 18, and he basically told you, he said, and it stuck with me, he said, well, just look at what the government is doing and follow the government. And just in terms of, their focus and, the industry that they want to create.
It was at the launch of CNBC TV 18 Prime, TV 18 Prime, and he said, look at what the government is doing and investors should follow the government. And I think in many ways...
True. The government's focus was on EMS. Look at the kind of wealth creation happened in the EMS companies, the Dixons, Embers. Everybody's created so much of wealth from
story, right? Indigenization,
make in India, and
electronic
export
imports was the number one item for us, right?
Absolutely.
So you want to spend less, make that industry.
So in the last 5 years, if you followed the government, you would have made more money.
And not the market experts.
Best analysts are sitting in the parliament.
Harmaz, let's talk about the export story. And, small base, yes. But we've seen, especially in the last 2 years, very significant momentum.
Significant indeed, and what possibly could be the biggest achievement of this government is the fact that they've managed to turn India from just reliant on other countries for arms and ammunition into somebody who's manufacturing the arms for themselves, and not just for themselves but also to supply to other countries as well. Yes, we may still remain the 5th largest exporter or importer or the 4th largest importer, yes, but from being just an importer, we are being an exporter as well now, and that possibly could be the next big opportunity for a lot of these defense companies to grow as well. Yes, as both Prashant and Nimesh also said, that the government has laid the groundwork now. They've taken the horse to the pond. At the end of the day, the horse has to drink the water. The execution capability has to be theirs. But if you take a look at this as well, right, last year defense exports were at record highs. The contribution of the defense PSUs has gone up 151% from FY25. The private sector has done its bit. They have continued to do their bit. Yes, the defense PSUs, the contribution has gone up 151%. Even the number of firms who are exporting abroad, that has gone up 13% as well. So now we have 145 firms in the country who are exporting equipment abroad. And that could be anything for that matter, not just finished equipment, also the supply chain bit, also parts and a lot of other things, even technology for that matter. Now look at the projections that the government has made. They are targeting 50,000 crore by FY30. That's a big projection. We are almost at 40,000 crore. And that might just end up happening well before the stipulated timeline, because we are almost at 40,000 crores already, considering the fact that we are already signing a lot more agreements with a lot of other countries as well. Prime Minister Modi was in Indonesia. They have signed the BrahMos missile agreement. He's now in Australia. There is a defense pact that has come in as well. Of course, we'll get to the contours much later, but there is another pact that has been signed. There are countries, of course, US is of course the biggest export market, yes, but they don't necessarily export the finished product. The finished product goes to countries like Armenia and a lot of others. They bought the Akash missile as well. They bought the Pinaka rocket launchers in 2023. France is also in talks to acquire the Pinaka rocket systems as well. So this is possibly one big opportunity for this to grow. Exports right now might be a small fraction of what these companies are earning in terms of revenue right now, but going forward over the next 4 to 5 years, that might just be a significant part of what their businesses are.
And I think, Srini, that's an important point, the export point, because from an investor's prism also, you want to own a business where you're not dependent on one client, which is the government of India, right? You have other buyers as well, which in this case is other countries, where you can export as well. I was just wondering, and maybe we will have time to talk about this, but I think the US-Iran latest, and I think we're in the midst of it once again, this flare-up. I think it's really showed, and we discussed it when we did this defense discussion earlier as well. It's really showed, where the spending will go to. I was just thinking, right? I mean, the government, I'd covered drones as a sector. I did a couple of deep dives a few years ago, and the number one thing that I heard back then was, it's too lumpy. We don't know when the next set of orders is going to come. We'll make one lot, we'll ship it, and then what? Then we're waiting. All the capacity is free.
Lowest hanging fruit.
Correct. But now the government has said, I think it happened in March or April, Shriram, this year, they said that they gave visibility 20,000 crores. We are going to order drones worth 200. The order size is going to be 2,000 crores each. 20,000. So that visibility is also now sort of, come through. But that is one area.
Trump in Ankara at the NATO summit, once again reiterating that, look, you've got to do your part. The US has done the heavy lifting, and this brings up the larger issue of Europe's remilitarization, and therein the opportunity for Indian companies that could look at shipping into that supply chain finished products or even components, and that seems to be a big focus area as well, and getting kind of done at a bilateral level as well, but also let's look at it from a private sector point of view.
Yeah, no, and he also brought up F-35s, right?
When does he not?
But that's the thing, right? It's a F-35. I think they started developing the F-35s. I think in 2001, 2000. It's like a 20+ year kind of program. They've spent, I think, about $1.5 trillion. That's the total project cost, right? And now but that's the thing. Things are advancing so fast. I mean, warfare. I mean, for us,
Fighter jets are like smartphones. Fighter jets are also getting
no,
smaller.
for India, spending on Air Force is still the largest component. I mean, out if you look at Navy, ship, land and air. Air is still the most expensive. But the point is now, even aerial warfare has changed. And by the time you do something which is very expensive, which is like this marquee platform, and by the time it comes
the
to
stuff
the market,
that we actually import, right, for the user's benefit. So from Russia, we get fighter jets, submarines, missiles and tanks. Same with France. From Israel, we get missile systems, radars and drones, the Heron drones and UAV systems. US gives us aircraft, helicopters, maritime and surveillance platforms. So these are our primary imports, and this is where we need the indigenization. So therefore, the reason why I'm pointing out is for the users to say which are the companies that can make this. So you can do your own R&D a little bit.
Yes, well, that R&D, I'm sure, is happening. But guys, before we wrap things up, I want to go back to the point that Nimesh was making. Is it now all in the price as far as the PSUs are concerned? And is this then an opportunity to see some sort of a sectoral shift towards the private sector companies, Prashant?
I remember last time we did Defense 1.0, the first part of this discussion, it came, that also came up. I think this was the first time we did it was around the Operation Sindoor, around that time. Just look at, I'll just look at the price, right?
That's right.
There was I think the high was made for the Nifty Defend Index in 2024. 24?
24, mid 24, early 25, yeah.
What we've done now, there was a lot of concern that maybe this is and we went back to that level a couple of months back, I think 2 months back, and there was a lot of discussion whether this is the double top, which then we've taken that out. We're at new all-time highs, and so I don't think this is the end. The only point is there are lots of smaller companies, Shireen, right? In the so as solar industries and the BELs and the BDLs and the HALs, they will do well, but they are now large caps. So can you expect outsized returns from these companies? Maybe, maybe not. But there are lots of smaller companies which are serving niches, which are serving and selling into these large caps. I think that is, according to me, there is still a very large opportunity. And I think we'll.
So one company that we haven't spoken about, and obviously with all the disclaimers that are due. So let's start with what we need, right? So we spoke about. What we need is a satellite systems with inbuilt AI data centers. This is where we are spectacularly behind US and China. Strategically, this is the next leg of defense, the next generation of defense systems that need to happen. And this is where Geo Platforms is an important player because they are planning to, he's evaluating a SpaceX equivalent of that. And here, so the US has about 40 to 50 SATCOM satellites. India has about 5 to 7. China has over 400 overall satellites, and before they launched the 20th one in March this year. In last year, we did about 5 space launches. China did 93. So this satellite, Shireen, in the next generation of weapon systems, so many of ancillary things are going to get merged, right? Whether it is satellite, whether it is telecom. Telecom becomes a defense play because the government will now have to unlock a lot of faster frequencies, a lot of safer frequencies, so that this communication between satellite and the ground can happen in a seamless way without getting hacked, right? So therefore, that becomes an important place. So it doesn't remain in the realm of defense and parts manufacturing, but technology, telecom, satellites, so many things sort of converge into the defense theme, and that is going to happen. And interestingly, in the last couple of months, some spectacular strides have happened in the startup space, not just in the listed space. One of which, Shireen, you interviewed Skyroot when they became a unicorn a couple of months ago, right? And it's an interesting thing. Why is it the first space unicorn in this country? Because they are essentially providing the platform for everything else to happen, right? All the launches that are going to happen, Skyroot is going to go make. Agnikul Cosmos, doing some spectacular work, with the rockets, 3D printed rockets, etc. Right? So the space becomes an interesting frontier, which is where the next, because we need to serve, it needs, the technical term is ISR, intelligence, surveillance and reconnaissance. So that becomes a sort of a, what do you call, a deterrent of sorts.
You know, through the examples that we've just spoken of, I think what is very, very clear is that this is an inflection point. We're starting to see the unleashing of entrepreneurialism in a sector that is regulated, in a sector that is complex, in a sector which has gone through, many cycles and has largely been government dependent. But within that sector, in many, many ways, we're starting to see the rise of a new set of entrepreneurs. And that was a wonderful story that you gave us, Nimesh. And in fact, I think a profile is in order of solar industries, as you just spoke of. But there's lots more to discuss here, and there's lots of shifting parts. There's lots of moving pieces. But it is very clear that clarity and direction has been provided at a policy level. It now boils down to execution, and you are seeing returns being generated by the companies that are being able to deliver on that. So we will keep this pot boiling, and we will keep the conversations flowing. But Prashant, Nimesh, Hormuz and Sriram, for this afternoon, many, many thanks for joining us. We will be back on the Editor's Playbook with a lot more and a lot more meaty conversations. Till then, goodbye. Thanks for watching.
Hello and welcome to this special show on West Asia tensions. I am Ashmit Kumar. Now, after 2 consecutive nights of US strikes on Iran, Tehran says it has retaliated by targeting US bases and strategic centers in Bahrain, Kuwait and Qatar. Now, Bahrain has urged residents to stay indoors as air raid sirens sounded across the country, while Qatar has condemned the attacks on ships passing through the strait. Now, the claims come after the US carried out strikes on around 170 locations across Iran over the last 48 hours, killing more than 10 people and injuring over 70. Now, while Iran says its attacks were in retaliation for the US strikes, US President Donald Trump has accused Tehran of violating the terms of the MOU by attacking the strait and breaking the ceasefire. Now, Trump said that Iran wants a deal badly, but warned that a return to full-scale war remains on the table. He warns that Iran, saying that US will hit Iran 20 times harder if Iran strikes. Now, Iran's chief negotiator, Mohammad Ghalibaf, reacted, saying that America still hasn't learned the repercussions of bullying and breaking promises. He added that if they strike, we will strike back. Now, Iran's foreign ministry has accused America of launching fresh strikes across several locations in Iran under the pretext of responding to what it called were false attacks on ships transiting the strait. Now, the latest attacks in the strait have brought shipping to a near standstill, pushing oil prices to their highest level in nearly 3 weeks. Meanwhile, in Iran, the coffin of late Supreme Leader Ali Khamenei arrived in the holy city of Mashhad ahead of the burial. Now, Iranian state media said that the funeral was delayed due to massive crowds. An air flight carrying Khamenei's coffin landed in Mashhad, his hometown, after being flown from Iraq, where millions of mourners attended funeral ceremonies.
And I say we hit up 20 to 1. Every time they hit us, we're going to hit them 20. And we did it last night. It did a little something today, but it was really retribution for last night. They hit actually 3 boats, not 2. And when they hit, we hit back much harder. We have many ways we can win, but we've already won militarily. They have very little left, and they want to make a deal so badly. They called a little while ago, they want to make a deal so badly. I just don't know if they're worthy of making a deal. I don't know that they're going to honor the deal. That's the problem.
Well, joining us now on the show to take this discussion ahead is with us former Foreign Secretary Mr. Kanwal Sibal. Also joining us, political analyst Dr. Wael Awad. Also joining us shortly will be former Ambassador Mr. KP Fabian. Mr. Sibal, let me come to you first. Thank you so much for joining us. First question, help us do a deep dive as to what has led to this escalation by the United States. Is there a broader geopolitical framework strategy at play here? Is there a strategy that we can't see? Or is the explanation as simple as perhaps Donald Trump felt slighted when he was in the midst of his allies in Ankara and therefore felt the need to compensate for the attacks on the shipping tankers in this way by attacking Iran, by attacking 170 locations targets inside Iran?
Well, the way I see it is that this interim deal, this framework deal, was extremely vulnerable to so many factors, and it is not surprising that it has begun to unravel. If you look at the key components of the deal, already this has been violated essentially by the Americans. In the framework deal, it was agreed that Iran would have a role in terms of shipping through the Gulf of Hormuz. Now, they have laid down certain protocols. Now, if a ship has been attacked by Iran, as it may well have been the case for not following the protocol, it's not an attack on the United States per se. And the United States has reacted, as you just brought out. And Trump himself has said that they've hit back 20 times stronger and will continue to do so. I was a bit amused when he said that we are not sure that Iran will honor the deal. I think Iran is, and the rest of the international community can never be sure if Trump will honor any deal that he enters into. That is one part. The second is, if you recall, Trump himself has said that he had to agree to this ceasefire because there were only 30 days of reserves left, and therefore it was very necessary to ensure that oil supplies were not interrupted and allowed a 60-day reprieve to Iran to export its oil. Now he has announced that that waiver has been withdrawn, and Iran cannot not only export any oil. Trump is now threatening to take over Kharg Island, and he said that I told my military to attack all the installations in Kharg Island, but not the pipelines, and that if they want to, they can take over Kharg Island at any time. Now, a couple of things, if you recall, which motivated Trump, which compelled him to agree to a ceasefire. One, of course, was his concern that the Gulf countries would be attacked by Iran, and that could actually lead to a very serious situation with regard to the future of the economy of these Gulf countries if there was an all-out attack by Iran on vital installations in the Gulf countries. I have, on fairly good authority, information that the Saudis are particularly keen not to create conditions for a restart of the of a war. They feel very, very vulnerable. UAE, of course, is much stronger in its resolve to counter Iran, but Saudi Arabia, in particular, is very worried that if the ceasefire breaks down, they could find themselves in very serious trouble. And Qatar also feels the same way. Now, if Trump was compelled to agree to a ceasefire because he understood what the implications would be for the Gulf countries, then I can't see why he wants to continue the conflict and create conditions where Iran is compelled once again to attack the Gulf countries. And they've already done that, as I understand from news. They've attacked Bahrain, they've attacked Kuwait, etc., etc. So he's playing with fire. Now, the last point I want to make is that despite all his rhetoric, it's not very clear if the negotiators who were working wherever they are working in Switzerland or whatever, whether those negotiations have broken down or not. It's not clear from what Trump says. I think it is his usual tactic that he will have a double-edged strategy. He will hit Iran, he will punish Iran, and this thereby put pressure on Iran to make concessions which he wants from Iran. And at the same time, not say that there are no more negotiations or the negotiators have gone back to their home countries and that's the end of the story. I think he left the door open. It's a double strategy that he is following. It's a failing strategy. It will not succeed. And there is no concern in the United States and in Trump's mind about the repercussions of this, not only on the Gulf countries, but the world at large, including India. Extremely self-centered, highly destructive thinking and approach of Trump. And one is surprised. And the last point is that Israel remains a very, very uncertain factor. There is a view that actually all this talk recently really said that the Iranians are scum, they are cancer, and etc. It is actually, in a way, to reach out to Israel, Netanyahu, and the pro-Israeli lobby in the United States that is also now speaking very harshly about Iran after having agreed to a ceasefire. So it's a kind of a double game that he continues to play. He has not many options, but he blows hot and cold, thinking that this way somehow he'll muddle through.
Sure. Let me also get Dr. Awad in on this conversation. Dr. Awad, two very valid points being made by Mr. Sibal. I'll get your thoughts on the first of them, which is, has a door been left open? The communication coming from either side is that if there is another attack in the future, we will respond with the overwhelming force. That's the nature of the statement coming from both sides, indicating that they've had enough for now. Does that indicate to you that there is some kind of backdoor conversation still underway between the two sides?
Well, I believe there is already a plan, meticulously being planned, that there should not be any kind of an escalation to a full-fledged war at this stage. So it's the tit for tat. Having said that, I would say that the United States president, he was buying time. He never wanted this deal. And in fact, when he signed the MOU with the Iranian for 60 days truce, this framework, he signed it bitterly. And he understood that America is gathering its own forces in the region. He is going to Turkey. He started rallying behind him, the NATO forces. Turkey itself is now taking active part to the United States in the new plan of attacking Iran, because the main reason for the United States, in fact, is to take control of the Strait of Hormuz more than the issue of the nuclear issue of Iran, because they know that it is the countries have been affected quite badly. Is the European, the Asian has suffered enough. Now it is the European feeling the heat. So this is the only bargaining chips at the hand of Iran is the Strait of Hormuz. And it is very clearly in the point that they have signed the number 5 even included that it will be monitored for the next 60 days by Iran. And that is the main message that the Iranians have been telling to the United States. You signed the deal, you have to adhere and to honor your commitment, because the American tried to maneuver. If you, Marco Rubio immediately went to the Gulf country and he started sending the ships through the Muscat, Oman shore. So when they are trying to surpass the Iranian, especially at the time of a war, this is Iran have the full right to control, because the United States never had in its own agenda of disintegrating Iran, even arming the civilian demonstrator. You remember when President Trump was saying that we send arms to the through the Kurdish population in Iraq, but they have never given them this arm. That means an indication that the America was selling to the rest of the world, that there are public opinion and there are public resentment against the government of Iran, and Iran killing the civilian. When we noticed that he was arming, and he himself admitted that. Having said that, I would say that the meeting in Ankara have changed the perception of the President of the United States, putting an extensive pressure on the NATO forces to increase their military budget and forcing them to take part in the war against Iran, where we have seen the President or the Secretary General of NATO, he himself admitted that more than 5,000 planes have taken off from the European NATO countries into Iran, attacking Iran. So if that is the case, then I believe an escalation is not very far, and this fragile peace process is going to fall back, and it will be back into the quagmire square one of this war.
If we're looking at further escalation, Dr. Awad, let me ask you another question, another point that Mr. Sibal had made, which is with respect to response coming in from the Gulf countries. Saudis, incredibly worried. So are the Qataris. We've seen attacks on Bahrain, Kuwait as well. Tell us, is this the new normal that the Gulf states will now have to adjust to, acclimatize to, that there will be limited engagements, limited operations between either sides, where the Gulf states will be the ones bearing the burden?
While I echo Ambassador Sipil's point of view, but I would like to add here that none of the Arab countries, GCC country, give any consent for the United States to allow it using its military bases against Iran. In fact, America went into this war using the military bases in the Gulf country without the consent of those countries, who went and appealed to the American president prior to this war not to go for a war. So they are paying the price. They are feeling the heat. They are having the brunt of the attack by the Iranian, who have obliterated more than 13 military bases of the United States. And while we are talking now, Jordan, Bahrain, Kuwait, Qatar, military bases of the United States start to be attacked again by the Iranian. So I believe the American bases in the region become now more Ashmit of a liability for this country, who was supposed to have the protection of the American. Now they are protecting the American military bases. And I believe the security architecture of this region will definitely change after this war, because none of these countries now have really full faith in the United States that these military bases were meant to defend them. And I think the United States wanted finally to make sure that the Arab countries, especially the GCC, A, they pay the bill, B, they go in a direct confrontation with Iran, which till now they are resisting and reluctant to be part of any American adventure.
Mr. Sibal, let me take that thought across to you. Now, the entire strategy, the way it's been presented to the public, has been one where the U.S. is aiming for some kind of knockout blow as far as Tehran is concerned. Is that even possible? We've seen the first round of fighting. We've seen the decapitation of the Iranian regime. That didn't help the situation. Subsequently, we saw staggered strikes between the two sides. There's some kind of knockout blow that Washington's aiming for. Is there one to be had at all, given what we've seen with respect to Iran, the sheer mass of the country, the strategic significance and the control they have over Strait of Hormuz? Is a knockout blow even possible?
I don't think so. I mean, if United States want to go all out and bomb Iran back to the Stone Age, whatever that means they'll have to unleash a massive military campaign by air and try and destroy the infrastructure of Iran. Theoretically, it's possible. But on the other hand, Iran has, for the last, God knows how many decades, prepared for this eventuality. They have dispersed their assets all over the country. It's a very large country. It's a very mountainous country. And they have also decentralized their command structure. Physically, there is just no way that the Strait of Hormuz can be forcibly opened without a massive physical assault on Iran, which would be extremely expensive for the United States and certainly not guaranteed to succeed. And Trump will not risk it, especially before the November midterm election. So that option is out. And then the final dissuasion with regard to any adventurism of that kind is Iran attacking vital installations, energy installations, water salination plants of the Gulf countries, which will mean, therefore, that the oil prices will absolutely explode. And the societies in these countries will face a cataclysmic situation. In India, of course, would suffer very grievously. So against this kind of machoism that we are a very strong military power, we control the airspace, and therefore we can do what we want, he has to balance so many other considerations. Right. And therefore, I don't think that, to answer your question, that he can do what he wants. Now, what he really wants to do, because he's caught in a very difficult situation, he doesn't know how to walk out of it. He's caught in a trap. The only thing he can do is to keep punishing Iran, destroying their infrastructure here and there, bombing them, making all these absurd statements about the Iranians being scum and cancer and stuff like that. Right. But his options are strictly limited because, after all, at the end of the day, what does he want to do in the West Asian region? What does he want to do? He has allies in these countries. These are countries which sit on huge energy resources. Instability in this region can actually cause instability all around. So what does America have in view in terms of their own position and the future of their presence in this region? They have to have a construction. At the end of the day, construction protects their interest. And I don't think that Trump is capable of thinking long-term geopolitically, and his advisors naturally pander to him, flatter him, and don't give him the right advice.
Right, Mr. Sibal. Again, limited options, if any, as far as Washington is concerned. On that note, let's slip into a very short break, but don't go anywhere. We'll continue this conversation on the other side. Welcome back. Still with us, former Secretary, Mr. Kanwal Sibal, as well as political analyst, Dr. Wael Awad. Dr. Awad, let me come to you now. The very genesis of at least the recent skirmishes that we've seen between the two sides comes from alleged attacks by Iranian forces on 3 tankers taking the Omani route as far as the Strait of Hormuz is concerned. Given the control that we've seen Iran exercise over the Strait of Hormuz over the last 90-odd days, is this perhaps a future that, at least in the near future, that the Gulf countries, that the world economy will have to make peace with, that there will be Iranian control, there will be some kind of Iranian fee levied, and that is the way to restore normalcy, at least in the near future?
I don't think so. I believe Iran maybe made it very clear that the conditions and for Strait of Hormuz after this war will be different from the previous one. That could be some kind of a new arrangement the Iranian wanted to do with the Omanis, because the maritime international water pass through these two countries, which have the sovereign over the passage, and they have to control and responsibility to ensure the safety passage of the ship. But I believe the Iranian have already told the United States that within the 60 days, they will allow all the shipment who get monitored by Iran and passing it through with the prior notice that the Iranian will give the consent and they will move. And there is no question of disturbing the flow of the shipping. And in fact, if you remember, there was more than 72 ship passed in one day. And the next day, the United States sent Mark Rubio into the region and infuriated the Iranian by trying to surpass their commitment of making this monitoring. And they went into Oman and allowed the ship to pass through the Oman. And that's where Iran retaliated and the American attacked, and the shipping fall down from 72 to 40, then to 30, and now to total blockage. So it is the United States responsible for the mess they have created. And the Strait of Hormuz condition, Ashmit, is nothing but the consequences of the American and the Israelis' attack on Iran. And now it is a time of war. Iran does not trust the United States. United States regrouped, rearmed, controlled itself, brought some new allies, brought the NATO into the attack, wanted to re-attack Iran in a full-fledged war. And if that is the plan, Iran definitely will not allow any American warship to escort. Having said that, I would say that the American attacking Iran from 1,000-kilometer distance. So you cannot win a war from the sky unless until you put a foot on the ground. And they wanted to take the last bargaining chips from the Iranian hand, when then they can talk and destroy Iran. But Iran understands the game plan, and that's why they are monitoring, and they are doing it in a very delicate manner, not to go for a full-fledged war.
Sure. Mr. Sibbal, I just want to bring in another dynamic here. These attacks over the last 48 hours have come at a time when when Iran is putting their former supreme leader, Ayatollah Ali Khamenei, to rest. The funeral proceedings are underway. And this, of course, comes on top of the language that Donald Trump has used: liars, scum, cheats. Will this strengthen the hands of the hardliners within Tehran? Will this make the cause for peace that much harder as far as the two countries are concerned?
I think so. I think so. Look, from a very human angle, if you just look at it from that angle, when Trump kills the supreme leader and his family, his one-year-old son and his daughter-in-law and what have you, and Trump boasts that they decapitated the top leadership and the second tier of leadership and the third tier and the fourth tier and this and that, how can they actually not only trust the United States, but have any stake in any relationship with the United States of America? Add to that what you just again repeated, the kind of language that Trump continues to use. Mind you, if there are still negotiations going on, those people sitting and talking to each other are registering what the highest decision-making authority in the United States is doing. So he's actually cutting the ground from under the feet of his own negotiators who may be talking to the Iranian side. That's one. The other is that as I understand, that there is a division of opinion in Iran about talks with the United States. There is Ghalibaf, who is now the interlocutor for the Islamabad channel. But Qatar, naturally, and I can understand from the Arab point of view that on an issue which concerns the Arab Gulf countries and Iran, which is a West Asian issue, bringing in a country, external country like Pakistan into such a critical role is in a sense a slight on the Arab hold over their own future. Therefore, Qatar has been active in trying to insert itself into negotiations, and the Americans trust the Qataris more. And as I understand, that the Americans told the Qataris that, look, Islamabad channel is very slow because we have to go to the Pakistanis, and the Pakistanis have to go to the Iranians, and we want a quick channel and a quick way of dealing with Iran, and therefore can you persuade the Iranians to position someone in Qatar so that they can actually have very quick interaction with the Iranian side? And that channel is under the control of Waidi, who's the head of the RIGC, who's a hardliner and doesn't have much time for Ghalibaf.
Right.
So there is this complication also in the negotiation process. I don't think the Iran will buckle under. They know that the future of their country is at stake. They have seen what the Americans have done and are capable of doing. And therefore, I'm pessimistic about the future. And of course, and I'll end with that, the Israeli factor has not yet been properly addressed.
Right, Mr. Sibal. Clearly, many unanswered questions there, but those questions will persist, at least short of clarity coming in from either Tehran or Washington. I'd like to thank both of our panelists for sharing their time and perspective, but that's all the time that we have on this edition. It's a wrap on this special show on West Asia tensions. More news and updates will continue right here.
Hello and welcome to IPO KYC. This is a special one. Rima and I are here at the offices of SBI Funds Management, the company behind what all of us know as SBI Mutual Fund. I think needs little by way of introduction. And we're sitting right here, the heart of, the offices, a lot of hustle bustle around it. It's a special time. SBI Funds is going the public way. It's a formidable entity, the largest asset management company in the country, 30 lakh crores in terms of assets, 6 lakh crores in terms of equity assets, 3,000 crores in net profits, the last reported number that we have. And it's going to list pretty soon. So we're going to ask the trajectory, the roadmap, and what does it mean for you and me as investors into SBI Funds Management? We've all, of course, had SIPs running with the SBI Mutual Fund. Now, of course, you can be an investor in the company too. And to discuss all of this, we have Mr. DP Singh. He's Joint Managing Director and Deputy CEO of the company. Srinivas Jain is Executive Vice President at the company as well. Gentlemen, thank you very much, both of you.
Thank you.
Appreciate it. So between the both of you, it's about 50 years at SBI Funds.
I'm not so old.
Yeah. I mean, how does it feel?
It feels very, very great. I remember when me and Srini started the journey in SBI Funds Management, it was a 2,500 crore company.
Yeah. 2,500 crore AUM?
Yeah.
Wow, 30 lakh crores now.
Yeah, it's a big franchise. We're very proud to be part of this growth journey.
Part of the growth journey.
Yeah.
And, let me just get to the valuation. I mean, we got the price band earlier today. At the upper end of the price band, at about 574, the valuation is about a little less than 1.2 lakh crores. And, you can take forward projections and, assuming 25, 26% growth, 5,000 crore net profits in F5 28. which gets us a multiple of about 24 times. Is that the right way to look at the? Is that the right multiple, Mr. Singh?
So many factors around it, but if we go by our past history, the way we have been growing, then definitely yes.
Okay.
But there are always in the market there are uncertainties. It could be more than this, it could be a little less than this. But the growth rate, the more and more financialization happens in the country. SBI mutual fund is at the forefront. We will get the maximum benefit. The moment today the biggest friction in growth of mutual fund business is the way KYCs are being done. These small players, the way it's a linkage between the remuneration for acquiring a customer and all efforts to be bring in. So that is not working. The moment that friction is over, which is likely to happen very, very soon, and once because all the bank accounts are now KYC compliant. The moment any bank account which is KYC compliant frictionlessly can part money in mutual fund, I think that will be the biggest revolution, and the number which is there today, only 6 crore investors, that will multiply like anything, and that the number could be anywhere. I'm not saying as much as number of bank accounts are there, but at least 20% of the bank accounts will be the mutual fund investors.
As soon as this KYC is that big,
whenever that happens. That's big, because lower level, middle level, nobody is servicing today.
Yeah. So just to close the loop on that, I'm not wildly inaccurate when I say 5,000 crores in net profits, 24 times earnings, which is actually quite reasonable as compared to some of the other listed peers, which I think I'm sure is a conscious decision. Srinivas, you want to just point, come in on that KYC and, that big leap that provides?
What are the two factors today driving the growth of this business, right? One is, of course, education. We talked about the 100 crore bank accounts, 5.5 crore customers in mutual fund industry. So obviously, there is some gap. That means that needs to be driven through either education. With mutual funds IA and such campaigns have really been helpful building that. As that moves, you now need to remove friction also. I think the way eKYCs have now come on board, the friction is kind of come down, but still it exists. Today, if you're a bank customer and you've done every KYC that's there, why do you need to do another KYC when you do a mutual fund? There's new KYC 2.0, which is CKYC 2.0, what they're calling as One Nation, One KYC. If that comes in very quickly, this friction point also goes away.
Do we have any timelines for it?
My understanding is that they are fairly advanced and ready from a technology point of view. We've also been talking to both Protean, CKYC team and all. SEBI chairman actually made a statement saying you should expect that very soon, because he's kind of spearheading this particular debate. So one of the things that we at SBI Group have about 55 crore customer base. And even if you take all those Jan Dhan accounts and others away, we have a 35 crore investors who are KYC'd in the bank. And that's like 55 lakhs today with us from already KYC'd SBI mutual fund customer. The headroom for us to grow, this friction that is going to go away is going to make it a big...
35 lakh accounts, 35 crore KYC'd.
35 crore is the target audience. And 55 lakh is the audience today.
Where you are right now.
It's 2%, right? So from 2% to, even if I were to go to 10%, DP's number, which we are talking about 20 is a little far. Even if I go to 10%, that's a huge number. That's like 5 times our business that we are today with the bank. That's 2.5 lakh crores is what State Bank of India's AUM is with us. So think about it. That's a huge business.
It's a huge headroom to grow. So let's just understand about SBI Mutual Fund and the scale today.
Right.
So Srini, 30 lakh crore in terms of an overall AUM. Right. Break that up for us in terms of categories and the kind of profitability that you make on each.
Yeah, I'll come to the profit, but let me explain the business to you. I think there's a different franchise we have been able to build. One, of course, is the bread and butter mutual fund business, which today, as we speak, about 13 lakh crore plus assets under management, making us the largest asset manager with almost 15.5% market share. We also have a very large ETF pool, which we are our largest passive provider. We have roughly about 4 lakh plus crores of ETF assets. I went 30% market share there. But one of the big business that we do is on the institutional side of the business. We have a very large 16.5 lakh crore worth of business that we do on the pension funds management. A large chunk of it is coming from EPFO. It's roughly about 9 lakh crores of that business. It's a fixed income mandate, but it's a very prestigious mandate. We do impact 11 lakh crore investors who invest through EPFO In a way, it's a nation building capability that we have. While that business is not a very large revenue pool business, there is also a pool of business in the PMS, which is our international operations. We have a fairly large international client base, roughly about $4.5 billion worth of assets that we manage for global investors, our own joint venture, Amundi. So that's a very revenue generating kind of numbers. So the piece of business that's well known is the bread and butter mutual fund business. That gives me the highest revenue pools. And the second piece of business that we have is the management fee coming out of our portfolio management services business, which has both the EPFO and the other fixed income mandates, plus the money that we get out of our international business.
So in that 13 lakh crore of mutual funds, what is the contribution of equity, debt? And then if you could tell us the yield that you make on each of these and including the ETFs.
I mean, so it's all in the public domain, but I can tell you we are about 6.5 lakh crore worth of active equity out of the 13 lakh crore that we have. Equity is a fairly profitable, very profitable business for every asset manager. For us too, it's upwards of 60 basis point is what we make on that pure equity assets. But then we also have, the scale kind of comes down. We have hybrid products, we have, fixed income products, we have money market products, and then we have ETFs. In ETF also, there are 3 varieties of ETF. The one we manage for the Nifty and Sensex, which are extremely low yield but very high volume business. But we also manage a gold ETF and silver ETF, which are fairly large margin businesses, which are even closer to active equity kind of margin. So it's widely diverse, the pace of business, and it also widely diversified. That means thanks to hybrid business, it's also not very volatile thanks to mark-to-market impacts that we have. We also have a fairly large fixed income pool that we manage. So our business margin moves from 2 basis point to a 65 basis point kind of spread.
Okay, on a blended basis, you would be at 37 basis?
Yeah, in fact, that's an interesting story there. Absolutely. Absolutely. That's a very interesting story. I think one of the things that have happened to us is that passive overhang that we had as 40% plus market share is kind of averaging out, and we are actually building a strong equity book. As you see, our SIP book is now 4,000 plus crores every month. And that's actually improving our active mix. Last 3 years, we've grown almost 32 to 42%. And that's a very steady growth. And I see that growth continuing.
That 6 lakh crore, which is active equity, where will that number be? I mean, what should we expect in terms of growth here?
You want to answer that, please?
No. See, what happens in the 6.3 lakh crores exactly. Today we have got a SIP book of 4,000 crores, out of which 3,800 crores is for this category only. So that itself is beginning 48,000 crores as today's number. If we grow by 10%, it will become 60,000 crores. Then net sales also happen across the country, 50-60,000 crores. And if I take 10% mark to market year on year basis, of course not in a straight line manner, but if we are talking about 3 to 5 years, so if we take an average of 10%, so the 1 year itself it should grow up by 2 lakh crores. This is 6 lakh crores business. And the other is the ETF, etc. Mark to market will come there as well at the stock level. Even if you say incrementally I will get 26% flow. But the stock which is there, which came at a higher level of 75-50%, that is there with us, the mark to market. So the equity book, which is 10 lakh crores today, will grow by 2.5 to 3 lakh crores in 1 year, going by these back of the envelope calculations, and the multiple of that in next 2 to 3 years. So this is going to continue. This is what I'm saying. I'm considering this number is net sales number.
And this is persistency an issue? I mean, across
accounts? Our persistency is better.
It's better. And there is another unique thing also, which of course we've been, it's been a part of our design, that we've been trying to get very long-term SIPs only as part of our. So we've always incentivized to get what we call perpetual SIPs, those 30 years NPCI mandates that are there, which has actually helped us to build a 98% of our SIPs are very long-term SIPs, which is a very good thing, because we don't have to go every year or alternate year to renew them or ask them to top up their SIPs or sign up on new things. So that's a unique business model we've been able to build, and we have like 1.6 crore SIPs today. Last year alone we added about 40 lakh SIPs to the book. So it's growing at a very fast pace.
So as your equities, which are actively managed, compound at 20-25% on an annual basis from here on, what would your blended yield look like going ahead, say 2 years or 3 years down the line?
I think the way to think about it is that today the best in class is close to about 40-44 basis point. I think we should come very close to that because clearly, as you see, the active participation going up. But at our scale, that's a difference. The blended yield for a smaller player at 40 basis point and at a 13 lakh crore player is a completely different way to think about it. So we are probably one of those few very large asset manager because of this active mix going up.
Your operating cost, I believe, is also the lowest in the industry.
Yes. We run a very tight book. In fact, our cost-to-income ratio is like 20%, which is probably one of the most attractive, not just in India, globally, for any asset manager.
So you should get to 44 basis points, which is best in class.
We don't want to predict that number because that's like very forward-looking. The better way to think about it is that we want to come closer to an average of the industry, despite having an extremely high book. Size of our book. So that's the way to think about it.
The reason we ask is because the total expense ratio rules also changed effective 1st of April.
Right.
Has that had an impact, and are you passing on the impact to distributors?
No, we have already we are through that, and we have actually neutral to that, revenue neutral.
Revenue.
We have passed on this also. There were some things where we got some benefit as well, and the biggest barometer is if you look at our direct plan expense ratios. If those are remaining intact, that means my management fee is intact. As simple as that. And we have not changed that. Our revenue is continuing.
What is the split between like direct and sort of distributor-led sales now?
It's around 22-23% direct. And the remaining is distributed. That's how this is.
Is this also like a...
This is going up.
It's going up.
This is going up.
Yeah, there's a move towards direct anyway. That's been going on for almost a decade now. Yep. It's picking steam, but at the heart of it, we are a distributor-driven organization, whether it's State Bank of India or third-party distribution. Yeah. Very focused on it, but we also see a very large trend of self-service investors coming to us. We built an app called Invest App, which is the biggest app among asset managers out there, 4 million plus users, and we get 12% of our SIP book out of that. So it's built a very strong, B2C case also. But at the core of it, we are a B2B company.
Absolutely. Any pressure on yields? I mean, from anywhere, regulatory-wise or anything else? And I mean, we've spoken about this shift to passives
Prashant, I think
globally. Is there...
worst is behind us now.
Okay. Whatever had to happen regulation-wise.
Has happened. Okay. At least for next 3, 4, 5 years, nothing is going to happen. That's one thing. And this also has happened because it was already going on. It was work in progress, so they had to do it. They have done it.
This global shift to passives, do you think that will play out here in India?
I mean, not really. If you look at the data, other than maybe 1 year that was post-COVID, active managers have done extremely well. And even when you look at dispersion of returns across asset managers, even the worst asset manager has been able to beat index significantly. Not across the board, but largely. So India continues to have a very active management space, and I think for a while it will be there. But maybe at some point of time that shift will happen.
Well, I have a long list of questions, and I'm sure Rima has more as well. But I think this gives investors a fair bit of sense of what the IPO is about. Not that they needed, an introduction to SBI Mutual Fund. I think we all know it. But we wish you all the best of luck, Mr. Singh.
Thank you, Prashant.
Thank you so much. Thank you for coming here. Thank you.
Well, we'll take a quick commercial break. We'll see you on the other side. We are still right here at the SBI Funds Management offices in BKC in Mumbai. The IPO, of course, a fair bit of excitement around it. It's, of course, one of the largest asset managers in the country. And now we are sitting down with Mr. Debashish Mishra, MD and CEO at SBI Funds Management. Mr. Mishra, great to have you with us here.
Yeah.
Thank you very much for joining us. You know, mutual funds say has become a mantra and has done so well. Done wonders for the industry. It's done wonders for SBI as a leader as well, SBI MF as a leader as well. What gives you the confidence, the next leg of growth? Because India's sort of, savings, financial savings are still largely in, deposits with banks and real estate and all kinds of things. Equity is, I dare say, still a newer asset class in that sense. What gives you the confidence that this share will structurally keep growing?
So, we have 1.4 billion people. Guess what is the number of bank accounts? 950 million. We are roughly reaching to 80% of the citizens for banking transactions, thanks to PM, Jandan, Jam Trinity, thanks to the inclusions by banks and NBFCs. But you look at the number of customers having investment accounts, or folios, we would say in parlor terms, only 53 million. So that gives us a lot of confidence that in future or in today, we have enough to move around, and there's a big road ahead for all of us to cover. My second point is, today's investor is not the one you think of believing in going to the bank or sitting across the counter. Digital delivery is the key, the buzzword for all the investors today. Youngsters, they would like to see the Facebook, maybe the Twitter, maybe the social media to find out who is investing, where is investing, and what is required. Number three, even if we take the last 5 years journey of financialization, there has been a move from saver to investors. The whole financial assets creation is increasing 11% of CAGR, whereas mutual funds have grown by 41%. Yep. So there is an increasing trend to bring these people from the saver to investor world.
So within the SBI ecosystem, right? I think SBI bank accounts are 530 million.
Yeah.
In that, the ones who have a YONO account, 120.
Yeah.
But you're saying only 5.5 million of those invest money with SBI mutual fund,
yes,
right?
unique customers.
Unique customers. That's a very small number. So now, say in the next 3 years, what would you like that number to go up? And other than, fixing the KYC issue, are there any other friction points that you'd like to solve?
So, KYC is one, of course, it is going to resolve, I'm sure. Now it is in the hands of SEBI and Government of India. We are now going to solve it through digital integration. So we have got an app called Invest app, which is an AI-based app. We are going to now seamlessly integrate the YONO, so that any YONO customer can go to invest in SIP, in lump sum, in any investment product, digitally, seamlessly. So that work in progress. We are already having the integration done. KYC thing comes up, we fix it, and it's done. We're also trying to have increasing our base in B30 centers. So we have now 270 branches of SBI AMC. We're going to make it 50 branches more in this financial year. So we're reaching out to people directly also for solicitation, for clarifications, for any doubts, for any grievances. Our own people, my own people will be there. We're also trying to train our SBI employees with the NISM certification to reach out to people. As for regulation, you can't sell a mutual fund product if you don't have a certification. So as of now, there are 13,000 employees of State Bank of India who are qualified to sell. We are trying to make it maybe 30,000 in coming 3 years.
So what will this 5.5 million number go up to?
So I answered your question, double. So we are trying to make it, we'll make it 10 million in 3 years' time.
So 12 out of 10 basically will be on it.
Yes.
That's going to be a big number, right?
Yeah.
I mean,
So
and that's the thing. You don't need to look elsewhere for growth. You've got this captive large base in that sense.
I have a supplementary answer to this. In addition to SBI, our other side of channel is also equally good and great. I have 130,000 IFAs, individual financial advisors, who are advising to more than 40% of my asset base, or AUM base. See, SBI, although it's a parent bank and we have got a shareholding and all, but they constitute only 23 to 25% of the business. So we have got a large chunk of business in the hands of AIFs, institutions, PMS. Also, we are into alternates. Every sector we are increasing our footprints.
I have a question, slightly maybe offbeat, but Mr. Mishra, you were a career banker at SBI. You've done so many roles across, right? and now you're at the helm of this organization as it goes public. What will change at SBI Funds Management? I mean, when it goes from a private financial institution in that sense to like a listed public company now with minority shareholders, what should investors expect?
That's a good question. I expected this to come. See, the priorities for me as a senior management in State Bank of India is only three. Customer centricity, value creation and governance. Here also same three. So I have to look at my investors. Now I have to add my shareholders. And I have to look at governance because we will be listed. So we will be more governance oriented, disciplined and value creation. So my investment team, which is creating value, I'm sitting with them. My first interaction with them is only after coming here to understand the whole gamut of investment and fixed income and derivatives, equities, everything. See, overall, in the bank, we understand customer is the key. So as long as I believe that and carry on in my whole activities, then whether it is AMC or bank or anywhere, it's all the same game.
Well, we wish you all the best of luck, Mr. Mishra.
Thank you.
It's a momentous occasion.
Yeah.
And I'm sure this is the first of many interactions right here on CNBC TV.
Absolutely.
Thank you.
Thank you.
All the
Thank you all.
best. All the best.
Hello and welcome to this special broadcast on CNBC TV 18. I'm Shivani Bazaz. The Indian automobile industry is at an inflection point. Demand in the mass market has moderated. The rules of mobility are changing with electric vehicles and alternative fuels. And in the recent weeks, few issues have generated as much debate as ethanol blended petrol. Yet, amid all this disruption, one part of the market continues to grow with remarkable consistency, the luxury automobile segment. What is driving that resilience? Is India's premium customer behaving differently from the rest of the market? How quickly is electric mobility changing the business? And what should every car owner know about E20 and ethanol blending? Over the next half an hour, we'll put all those questions directly to the leaders of India's two largest luxury car makers. And let me begin by introducing my first guest from Mercedes-Benz India, which has reported its highest ever first half sales, retailing 9,768 cars in the January to June period. Joining me right now, Santosh Iyer, Managing Director and CEO of Mercedes-Benz. Santosh, thank you so much for joining us here on this special broadcast. Let me begin with this. The market, Mercedes-Benz has reported its best ever first half, retailing close to 9,800 cars. Yet growth has moderated, Santosh, to 9%. What do you make of these numbers? And has the luxury market now entered a more sustainable phase after a few years of surge that we saw? Or do you still see room for another phase of strong growth from here on?
No, I think firstly, thanks for having me, Shivani, and glad to be here on the channel. If you see the way the total market has developed, it has grown significantly after the GST rate cuts. One of the things which has been hindering the luxury car market is also the constant increase in prices, not led by profit-led pricing, but more led by cost-led pricing. The input costs have gone up. The euro to the rupee, we all know how rupee has depreciated, and that meant that we had to subsequently increase pricing. So even after the GST cut, which resulted into a net 6 to 8% reduction for customer, today as we speak, we had to already go back to pre-GST level. So these are some of the headwinds. On the other side, if you look at the macroeconomic factors, there is GDP growth, per capita income is rising. You can also see the way the West Asia crisis was managed. The fuel prices hadn't gone up as significantly as in other parts of the world. So inflation was controlled, exports were there. So I think to our customer segment, the sentiments were on a yo-yo basis, and we could also see that in our monthly, quarterly numbers as we were steering the business. But on the other side, overall, if you look at H1, I think a strong, the quarter two was almost double digit, and on an H1 basis, a 9% growth is still great because the base is itself close to 9,000 plus cars, and we have grown significantly on that base. So quite happy with the outcomes. This was our prognosis at start of the year. And also, this growth is also led by product launches. We had the new CLA in the entry segment. We had the new V-Class in the top-end segment. We had the GLS Maybach, which we decided to localize in India. So if you look at the new product launches, that also excites customers and helps us to drive this growth. Future, yes, to expect a hockey stick kind of an environment, I think may be a fallacy, because I think, again, it's as good as also the external environment being stable is a fallacy. So things will be disruptive, and our expectation is we should continue to grow this market, and we should, the critical factor to note is the structure. We grew 28% in the top end, 20% in the top end segment. 28% of the cars we sell in India today are cars costing more than 1.4 crores. So that shows the structure is improving. Premiumization is all-time high. Even the entry segment cars like the CLA today around 60 lakhs, that clearly shows how the market is shifting more and more towards premiumization for Mercedes-Benz.
Well, Santosh, one of the biggest shifts that we are seeing in India is the transition to EVs, and your EV penetration has, according to these numbers, doubled to 14% in the second quarter. Yes. What would you make of that number, and when do you see electric mobility now becoming a mainstream business for Mercedes-Benz rather than, fast-growing niche?
No, first of all, if you see in the segments we operate, let me say in the top end segment that we were discussing, the share of electric there is 25%. With one model EQS SUV, we have been able to reach there. In the entry, we never had a car line. It's only in the last quarter we had the new CLA, and today you see the overall share has gone up to 14%. Now, if you compare this with the mass market, they are still at 6 to 7%. So already, I think luxury customers, because they have charging infrastructure at home or office, they have multiple cars in their household, their affinity to buy an EV is much higher. Having said that, it's still, even in luxury segment, it's a TCO argument. Why should I buy an EV? Why not a diesel? Why not a plug-in hybrid? And there we would like to leave the choice to the customer. Unlike certain brands and portfolios, we have all the cars. We have the entire portfolio of EVs as well. Many of them, or all of them, most of them will make its way to India. So for us, we rather allow the market to decide the pace of transformation than pushing one specific car line, because the customer driving patterns are different. And today, let's also accept the charging infrastructure is not the same across India. The residual values of EVs are still developing. We give guarantees to customer, but still the real market, when the customer goes after 5 years, 7 years, may be different. So I think let the customer decide. Our job is to give the right products, great value, latest technology, best pricing, and in across portfolio, and let the customer then decide the pace of transformation.
But Santosh, what do you think is the single biggest hurdle today in this EV transition from an industry standpoint? Is it the charging infrastructure? Is it the consumer confidence still? Is it the affordability, or is it something else?
So I think the first and foremost is there are not enough products. If you look at our portfolio, we are selling today 11 locally produced cars in India, out of which one of them is an EV. So if you see from a portfolio perspective, we still are only 10 to 15% of EV compared to the balance still is combustion engines. And out of that portfolio, 14% of sales are EV. So technically, I think first and foremost is let's ensure that across segments, entry, core, TEV, we have enough and more offerings to the customer. The second, of course, is based on the use case, the charging range anxiety, as we call, which is not as much in luxury cars, because in our case, we have cars going up to 800, 900 kilometers on single charge. So maybe we can take care of the range anxiety. But charging still, not only availability of charging stations, but if you reach there, is the charger working? Is it operational? How easy is the payment mechanism there? And so these are, again, nagging concerns. It's a leap of faith. That's the reason we got a plug-in hybrid as well. So somebody wants to drive 100 kilometers pure EV range on an S-Class, can do. And then there is also a combustion engine to back it up if you are not able to find a charging. So all these solutions will emerge. It's no doubt that the end goal is basically decarbonizing the industry. To reach there will be different paths. We have also seen a significant increase in diesel share, for example, in the last few months. But the residual value also, which I touched upon, is one big impediment for consumers to shift. So these are the negatives, but there's a lot of positives. Low TCO, low maintenance, environment friendly, plus depreciation benefits, etc., etc. So it's a balance. I think every consumer looks at the economic value, balances the buy, and therefore you can see a different consumers offering or preferring different powertrains.
Okay, Santosh, let me now turn to the issue that has dominated headlines over the last few weeks. And a straight-up question, do Mercedes-Benz owners have anything to worry about when they fill up E20 petrol in their cars?
The simple answer is no, not at all. Cars which we have sold from 2020 are anyways certified materially compliant. Even 23, 24 onwards, they are also even emission and range compliant. So I think customers don't have to worry anything about the older cars as well, which are manufactured and sold after this period. Even before this period, I think the cars will be able to run. There may be certain compromises, slight efficiency drop. But, it's not that overnight the government has put 20% ethanol. These cars have been running on 15% ethanol any which ways for many years, and they were also running on this. So it's only a 5% increase that we are seeing in the last couple of months, and that should not have any significant impact to our customers, and we stand by them. There's a lot of queries at our dealerships, and we are able to answer them. I think one of the bigger problems that emerged in this crisis, in this entire debate, is a lot of adulteration is still happening in fuel pumps, which also means it's not E20, maybe somebody's filling an E30 or something else, and in terms of the fuel mix. And that is maybe causing problems to one of the other consumers as such. But a good amount of education and also, as I said, for us, we have already launched the E25 car. We introduced a new S-Class plug-in hybrid in Mumbai last 2 weeks back, and that's already E25 compliant. So we are always ahead of the curve, and our customers need not worry on this topic.
Santosh, what about the cars that were manufactured before 2020 from your stable? Would you say that they also have nothing to worry about? Of course, the mileage drop you spoke about. Other than that, the corrosion over the years that people are asking whether or not that will be an impact on the cars. Are you worried about that? What would you have to say about that?
Not really, because as I said, the cars have certain tolerances anyway inbuilt into them. These cars have been running on E15 fuel also for so many years. So we don't see a fundamental issue even for those customers driving these cars.
Okay, and so you spoke about adulteration, and customers everywhere in India have the same question. How does one know that this is an adulterated fuel, and how does one know where to go when such issues arise? Talk to us about that. How big is the issue and the problem?
So, first of all, you only come to know when the car is talking to you in terms of some issues that's propping up in the car, the engine light going up. And I think no better than the dealership. If you go in, they are able to take out the fuel and test it. There are enough testing agencies where fuel can be tested once the fuel is taken out of the tank. One also needs to see the state of the fuel tank. In some cases, there is rust and corrosion in the tank. And now, basically, because of higher alcohol content, these particles also sometimes comes and clogs the fuel filter in the fuel pump. So there are many reasons, but I think the most, if at all somebody faces a problem, there is no better than the authorized dealership who can really do a technical diagnosis and even share the fuel sample transparently and check in terms of quality and adulteration. But I would say the onus of this should be more on the authorities to ensure checking randomly the fuel pumps in many pockets, and they should then check whether the quality of fuel dispense is as per the norms that's laid out by the government.
Santosh, last question. You spoke about the new launches being E25 compliant. So if the government decides to move beyond E20, would you say there will be challenges for the auto sector, for the existing cars? What's the worst case scenario that you think?
I think what this entire discussions and debate has come up is we have to be cognizant of the current car park. So our view is always that if at all the government decides to go for E25, first and foremost, they should think what happens to the current car park, the older cars, maybe because now you are increasing the threshold significantly. So enough science-based studies needs to be done. And then if at all there is a risk, then let's continue the E20 and also give E25 as an option fuel to the customers who are buying newer cars. Second, there should be enough time given to the industry to shift and migrate because, as I said, a couple of our cars are already compliant, but to make every car line in India compliant may take some time. So enough guidance, enough roadmap should be given for auto industry to do it. And last, not the least, allow the customer to decide. Maybe if you are blending more fuel and if there is an economic benefit, let the customer decide how they want to. And that's where I'm a big proponent of put the market forces to decide if they really want to pay much more expensive fuel and they are okay with it. Let them decide on rather than we or anyone imposing that this is the only kind of fuel that can be used. So, but we wait for the policy. At this stage, what we hear is E25 is not on the top agenda of the government. Right now, they're still trying to clear doubts, apprehensions on the E20 fuel itself.
Okay, Santosh, thank you so much for joining us on this special broadcast. Thanks a lot for joining us on CNBC TV 18. Now we take a short break. After the break, we continue our special discussion on India's luxury automobile market with the BMW Group. Don't go anywhere. We'll be back soon. Welcome back after the break. You're watching the CNBC TV 18 special. BMW Group India has also reported its highest ever first half performance, retailing 9,075 cars in the first 6 months of the year, a growth of 17%. Joining me now, Hardeep Singh Brar, President and CEO of the BMW Group India. Hardeep, thank you so much for joining us here on CNBC TV 18. Let me begin by asking you, BMW has reported its highest ever first half sales, growing 17% at a time when the broader passenger vehicle market has slowed. What's driving this divergence, Hardeep?
So Shivani, we have 5 key reasons which is really working for us. The number one is the portfolio. We've launched 11 new cars in the first half of the year, and we announced that we will be launching 25 plus models this year. So that has really given us a lot of momentum, a lot of noise around the brand emergence. So that is number one. Number two, the narrative around electrification is really gaining momentum because of the West Asia prices. The fuel prices have gone up recently, so that has really pushed the demands towards the electric vehicles. And we have one of the strongest portfolio in EVs today in the market, and that has really helped us. Number three, we moved towards the long wheelbase product portfolio in the recent past, and people are loving the space in the BMW. So that is point number three. And last but not least, we are doing a lot of these brand immersion for our customers. And, we did our golf events across 9 cities last year, and we are taking it to the next level of cities, the M Drift Academy, some art fair events, and also the Oberoi Concours, which is the latest one in our portfolio. So all in all, there's action on each and every front, which is really giving us a very, very strong momentum in the recent past, and I am sure it will continue in the second half of the year as well.
Hardeep, one of the interesting numbers that I could see from the numbers that you've shared is that 1 in every 4 BMWs you sell today is electric. Has luxury EV adoption in India reached an inflection point, or is this still largely an early adopter market?
I would say, if your package is great, people don't mind going for EV. I think this is an apprehension that people don't want to go for EVs. I think if your packaging is right, to give you an example, we have 2 cars of the 7 Series, which is top of the line, and second is iX1, which is the entry level. In both the cars, the EV penetration is 60%. So 60% EVs and 40% ICE. So if the packaging is right, the pricing is right, and you give everything that the consumer wants, I think people are willing to go for the electric vehicles.
But from your perspective, what are the biggest hindrances in the full transition that we are expecting? Policies there, government is pushing for the EV transition. We want cleaner mobility, specifically after the West Asia crisis and the petrol price hike. Hardeep, what do you think is the most important challenge that we need to focus on from a policy perspective, from an infrastructure perspective, that will actually lead the transition for us?
I think both OEMs and government, they have to work together. So from OEM perspective, 2 big factors, how do we bring the price parity between an electric vehicle and ICE vehicle? Till now, the price gap used to be about 20 to 30%. Now it is coming down to 10% and lower. And in our case, both our petrol and EV vehicles are at par. So that is giving a huge flip. Number 2, what OEM needs to do is increase the range. So all our cars are today 500 kilometers plus range, and the next generation will be hitting almost 800 kilometers on a single charge. On the government side, I think what is needed is how we can really speed up the charging infrastructure, especially on the highways, because your anxiety is not inside the city. It's when you hit the highway, when you have to cover 300, 400, 500 kilometers on a single day, how quickly you can take that pit stop and recharge your car to maybe 50% or more than that. And that's where you need the charging infrastructure, which is charging at a very high speed. And I saw that in this year budget, government has allocated 700 crores towards the charging infrastructure, which is very, very critical. Last but not least, which again, I think OEMs have to play a role, is the anxiety around the resale price. And we have brought in the assured buyback program for the electric vehicles, which is also one of the key factors why people are loving the BMW cars, because we tell them that this is a short value that you will get at the end of the tenure that you go for.
Hardeep, let me now turn to the debate that is raging all over social media, and it is concerned with the automobile industry, the ethanol debate. Consumers are looking for straightforward answers. Let me ask you this straightforward as well. Should BMW owners have any concerns about using the E20 petrol in their BMW cars, whether they be old or new cars?
I don't see any problem with that. We haven't come across any issues in any of our workshops so far as E20 is concerned. The new cars are all E25 compliant, so everything is sorted for now.
And how about the older cars? Would you say that probably fuel efficiency or any kind of corrosion could happen over a long period of time?
As I said, we haven't come across any concerns for the old cars using E25. Yes, there is a mileage drop to maybe 5 to 7%, but no problem so far as the engine maintenance, etc. is concerned.
So you're saying that the newer cars are compliant for E25, which is higher than E20. So if India moves beyond E20 in the years ahead, would you say that BMW is already, in the run, and you're all already compliant with what is going to happen? And can today's vehicles adapt, even the E20 vehicles adapt to that higher ethanol blends eventually?
So as of now, we are compatible with E25. But in future, if this blend is going to increase in favor of ethanol, we would need a very clear guidelines and timelines when it is going to increase and by what percentage. That is very, very important so that we can tune up our cars according to that.
And about the concerns that are raised on social media, a lot of people are concerned about what it does to their car and whether higher blending should be there. People of India, citizens on social media are asking for the choice to choose their own fuel. Would you say that that should be the way to go forward for the government?
I think, we need to listen to customers. If there are issues which are found out in other cars, naturally, they need to look at that. But as I said, for our customers, there are no concerns. But if it is coming out and it is coming heavily, that needs to be investigated. Also, there are concerns whether it is happening because of the fuel adulteration. Or so that is what we really need to see. Well, how much is contributed by adulteration and how much is contributed by ethanol. So I think the investigation is required for that to come to the solution. What exactly is the issue, so that you can really pinpoint and not create narratives which may not be correct.
Well, thank you so much, Hardeep, for joining us here on CNBC TV 18 for this special broadcast. So the luxury automobile market continues to chart its own course even as the broader industry adapts to changing consumer behaviors, evolving technologies, and an ambitious policy on ethanol roadmap. What is clear from both the conversations is that the future of mobility will not be defined by growth alone. It will also be shaped by how quickly the industry can build consumer confidence, whether that's around electric mobility, cleaner fuels, E20 and beyond, or the technologies that power the next generation of vehicles. That's all on this CNBC TV 18 special. Thank you for watching.
India be creator of AI model? The answer is no. India will be a big user? The answer is yes. The next 400 million users on the internet, they would be the biggest beneficiaries.
The question then becomes about monetization. So how do we address that?
We have a company called Cuckoo FM. Cuckoo has grown 70x in 4 years. People are paying subscriptions in hundreds of rupees from tier 2, tier 3 towns to be on their platform.
Now, I'll ask you this in the context of Big Basket.
Yeah.
You know, do you believe that you didn't read the signals right enough?
Absolutely. You may be a leader for a very long time. If you are slow to react, then you lose market share points.
Do you think you exited too early in Red Buzz?
Possibly. Every exit feels early in India because there is so much compounding going on.
Where would you not sell today?
Make my trip. We are a 4 trillion GDP and we have increased digitization. So 10 billion is now not an outlier. And India can be a great source of FDE, forward deployed engineers. If you were to build a $100 million company, they can probably get to the same level with about 100 people. I am fearful of where is the next guy going to come and disrupt my most promising priced company. And what I like is we are in the right country at the right time.
Years, 6 venture funds, and some of India's most iconic startup success stories. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. From backing category-defining companies like Make My Trip, Red Bus and Big Basket in the early days to helping build one of India's first homegrown venture capital firms, Helion Venture Partners, and later creating one of the country's first dedicated Series B scale-up funds, Fundamentum with Nandan Nilekani, my guest today has had a front row seat to the evolution of India's startup ecosystem. At a time when AI is reshaping the venture landscape and India's scale-up story is entering a whole new chapter, Fundamentum has announced Fund 3 targeting 2,200 crore rupees, including a 400 crore rupee green shoe option. Now, this marks Nandan Nilekani's largest bet in a venture capital firm. The focus remains clear: backing the next generation of tech companies as they scale across consumer tech, fintech, and AI. So what separates startups that scale from those that stall? Where will India's next generation of AI winners emerge, and what does it really take to build companies that last? Joining me now is Sanjeev Agarwal, the co-founder of Fundamentum. Sanjeev, it's great to have you back on Young Turks. And speaking of build to last, I mean, we really have lasted, haven't we? We've been speaking to each other for a good...
Forever.
For 20 years plus. In your avatar as an entrepreneur, then as an investor, what do you miss about being a founder yourself?
I think, Shireen, as a founder, you pretty much have it under control because most variables you are responsible for. While as an investor, I think leadership is quite diffused, but accountability is not. You still want to make sure that you deliver great returns to the investors that you took money from. So I think that is one aspect. And two, the feedback loop is very long. Typically, when we invest for 7, 8, 10 years.
Yeah.
And so many things change within those periods that till the end, you really don't know where is this headed. And then you don't know whether it was luck or skill. So you can't even compliment yourself too heavily for the good things that happen to you. Because by so many times you are just in the right market.
That's correct.
Yeah, so I think I miss the buzz of entrepreneurship, but I like the intellectual stimulation of working across multiple industries and spotting the next winner.
Over the last 20 years, and we've seen many cycles in the Indian startup ecosystem, many have mirrored what has happened globally as well, and many have had roots in domestic changes, in domestic inflection points. As we sit here in 2026, where do you believe we find ourselves? Are we at the start of an AI-driven cycle even here in India?
Just the way internet democratized distribution, AI is doing that to logic and intelligence. And all the prior cycles, whether it was mobile or whether it was internet or whether it was client server, they're all enablers for AI. So for example, internet is a big source of content for AI. So I do feel that India as a destination for applications for AI is at a very, very good sweet spot because of the talent that we have. And India can be a great source of what is called FDE, forward deployed
engineers. What is this new entity? This has become the buzzword across IT companies. Now everybody's saying, don't worry about engineers, even though they're not going to be coding that much anymore, but they will all transform themselves into FDEs. What is a forward deployed engineer?
So forward deployed engineer is a very unique breed. It is almost like a unicorn. Or think of it like a 10x engineer who can go into a company, put together a solution architecture, code it with the help of AI, and connect it to all the current systems that the company has. So it's like an on-site engineer come a product manager who sees things both from business angle and from engineering / technology angle. And if you were to build a $100 million company, typically in the IT services world, you'd probably need 2,000 people, 2,500 people. We were doing a math. We met one company which is using FDEs. They can probably get to the same level with about 100 people.
Okay. What happens now to the jobs that these companies, the Infosys, the TCSs of the world were creating? And B, what happens to this entire business model? Can it be FDE'd?
My sense is that India will become the FDE factory because we have a very strong training infrastructure. We have a lot of domain expertise. These 20, 30 years that IT services companies have been in business, they have learned all the different industries, whether it is telecom or financial services or healthcare. So do we have the opportunity to make this transition? The answer is yes. Will this lead to job loss? Possibly. But my belief is that the work will also expand. Now you will have more demand, because now everybody can write a code. So there is more code in the world than it was the case when there was a programmer doing the coding. So I think there is going to be some impact on the jobs, but we'll be in a much more productive, efficient world.
So growth positive.
Growth positive, absolutely. And growth positive and also margin positive. The gross margins can be as high as 70, 80, 90% versus 40, 50% that you will have in a typical business services business.
Let's talk about spotting the next set of winners now. And that's the hope with the new launch from Fundamentum, the third fund as part of Fundamentum that you're going to be taking to the market. The kinds of companies, the kinds of founders that you're hoping to back, hoping to support and bet on through this fund, what is the investment thesis? How different is it going to be from the previous two funds?
I think, Shireen, our fundamental belief is that India is a high growth economy and digitization compounds it. So any business which is built at the cross section of high growth and digitization is a very good sweet spot for us. We grow at about, let's say, 7% GDP.
Right.
And digital penetration for most industries, whether it is retail, transportation, logistics, is still in single digit. So groceries, you are seeing a strong battle going on between many players. But the digital penetration of groceries still is single digit. So a lot of India has to get digitized. And that digitization is getting compounded by AI because it's happening in a very friction-free way. So we will continue to participate in those themes of consumption going digital, financial services going digital, and enterprises adopting digitalization in their workflows. And AI would be an amplifier. So AI, think of AI like a horizontal. So for example, in lending, you can collect better, you can review your loan very, very quickly. If you are an insurance company, you can do claims processing in a humanless way. So we feel that AI is cutting across all consumption-oriented businesses. And that would mean, as we just said, higher growth rate, better profitability, and I think stronger GDP growth, because the friction for GDP to go up through this digitalization and AI embedding is going to be much lower in times to come.
The problem in India has been that everybody talks about this large market, but the difference between the large market and the paying market, that has, that we haven't really seen that divergence lessen as much as one would have expected. So the question then becomes about monetization. So how do we address that?
Shireen, you'll be surprised. We have a company called Cuckoo FM, which is the micro drama, the new form of content.
Yes, storytelling.
Storytelling, which is bite-sized, snackable content rather than the long-form content. People are paying subscriptions in hundreds of rupees from tier 2, tier 3 towns to be on their platform. And during their lunch break, they are glued to Cuckoo FM platform.
Also heading to Dalal Street, have just filed their papers.
that is for them to decide. But the point is that now the cost of distribution is coming down so rapidly that you can reach the last mile that you couldn't reach before. So AI will do exactly what you were talking about, that my ability to access that 400th million user because of the technology, because of internet and AI sitting on top of internet. So I would say between mobile phone, which was the Geo, and then the payment system, which is the entire DPI, and now AI, this layer is actually compounding. And
this gives the India stack a whole new meaning.
Yeah, absolutely.
But
yeah, this is, I think, sitting on top of India stack.
What has been the experience across the Fundamentum funds so far as you launched your third fund? What has positively surprised you?
Yeah.
What has perhaps been the one disappointment?
I think what has positively surprised me is the exit markets. I think the way the terminal values have exploded. Earlier, when we were investors in Make My Trip,
Yeah.
I think we listed on the NASDAQ at 1 billion valuation. Today, Zomato is 25 billion, 30 billion, give or take.
Yeah.
So one is that the terminal value has increased and time to scale has reduced. Zepto has, I think, in 4 years, almost become a decacorn. So the aspiration of founders and the efficiency of the ecosystem, size of our markets, for example.
Yeah.
When we were doing investing from Helion, it was very hard to find a scalable market which can help you create a unicorn. Now, actually, there are many $10 billion, $100 billion markets. And if you take 5 to 10% market share, you can create a $10, $20 billion market. So I would say in most cases, entrepreneur quality, aspiration, friction in the economy, India stack, listing opportunities, most of the things are accretive, to be honest with you.
You know, one thing that I thought you would talk about is the fact that there's been this unlock as far as domestic capital is concerned.
Yes.
You know, that's been a big part of the evolution of the Indian startup ecosystem and the startup story in the past decade as well.
You know, when we were raising money at Helion, all the capital had to come from
the
US, largely US university endowments. But now in Fundamentum, we have so much capital coming from domestic institutions, entrepreneurs. Entrepreneurs are some of the biggest funders of venture capitalists. So you're absolutely right that capital, talent, market, India stack, there are so many enablers. I think market is also a lot more competitive. If I were to look at one negative, as the markets, a good example is quick commerce. Quick commerce has 7, 8 very well-funded, well-backed incumbents.
Yeah.
So that is probably one negative.
You know, if you take a look at the quick commerce business, I mean, the lion's share is with Blinkit, part of course, Eternal.
Yeah.
And then you've got the Zeptos and Swiggy, Instamart, etc. And I'll ask you this in the context of Big Basket.
Yeah.
You know, do you believe that you didn't read the signals right enough, didn't make the moves as quickly as you ought to have, because you had the clear advantage. You know, you had the brand, you had the trust of the customer, you had the balance sheet with the Tatas coming on board. Did you not read the market right?
Absolutely. I think Hari Menon, who's the CEO, has been quoted many times in the press and in private that we missed the bus. And we could never believe that quick commerce is relevant for your weekly groceries, because that was a typical customer who would buy groceries worth 4,000, 5,000 rupees for the entire week. Now typical customers order 7 times in a day.
Yeah.
Earlier he used to order once in 7 days.
Yeah.
So that is a point I was making, that you may be a leader for a very long time. And which disruptive force is coming from where? You have no idea. So that's the negative that digital businesses need to watch out for. That just the time when you were getting your economics right, having figured out the scale and customer experience, here comes a competitor who's demonstrating a new business model. And if you are slow to react, then you lose market share points. So you're absolutely right.
Are we at that inflection point where we are going to now see not the one-off decacorn.
Yeah.
But the new class of decacorns being minted here in India on the back of some of the trends that we just spoke of.
Absolutely. Because the friction in scaling has come down. We have all the talent. We have AI enablement. And most importantly, we have the market. We are a 4 trillion GDP. And we have increased digitization. So 10 billion is now not an outlier. When we are underwriting a transaction, very often we are underwriting for a 5 billion, 10 billion outcome. While in Helion days, when we underwrote, it was 200 million, 300 million.
And you know, people don't realize this wasn't that long back.
Yeah, this was only about 15
years ago.
Yeah,
So the change has been dramatic from not being able to see companies go past 200-300 million to now saying that, you know, we're underwriting only if we see potential of 5 to 10 billion.
Yeah, we were celebrating Redbus exit many years back. And I think that was 150 million.
Yeah. Do you think you exited too early in Redbus?
Possibly. Every exit feels early in India because there is so much compounding going on. But then as VCs, we have to also return money.
Yeah.
So I think we can't be there for an infinite period.
Going back to founders and what you've seen change, where these founders are coming from, I mean, that's again been one of the most interesting stories of the last 20 years, hasn't it?
Back in the day, they were all coming from tier 1 cities. But now you get them from nook and corner of the country. But they have so much of fire in the belly, the point that you and I were discussing before we came online. That, for example, this founder was telling me that he wants to build a company that will last for 100 years. So that's called ambition and audacity.
Yeah.
That in a world where companies come and go, he's saying that he's going to build a company that is going to survive for.
But that's the thesis of fundamentum, of
Yes.
backing companies that are built to last. Are you seeing visible signs of companies that will last 50, 60, 100 years? Or do you believe that era of 50, 100-year-old companies is perhaps behind us?
See, the data point that I have, Shireen, is one data point is Make My Trip. Now, Make My Trip is about 25 years old company.
Yeah.
And the common characteristics are leadership in a large market. If you have gotten these two things right, and given that India's GDP growth is a secular trend, I do feel that there are companies that will last for long, but there are going to be disruptions along the way.
You know, doing fundamentum with Nandan Nilekani, and we were talking about this, that Nandan wears many hats, you know, started with the entrepreneurial hat at Infosys, has done the India stack, Aadhaar, so on and so forth. This business of context switching, you know, that ability, that quality, how significant is that for success in the world that we live in today?
I think you are a perfect example. That you switch so many contexts, so many areas that you guys cover. But you are absolutely right. I think whether you call it context switching or you call it learning agility, that has become a very important dimension of our lives because of the technology life cycles being very short. And what's coming next, you can't tell. So I do feel that being learning agile, context switcher, like what Nandan does so effectively, is a great attribute.
So when the two of you chat and you meet once a month
Yeah.
to evaluate and assess opportunities,
Yes.
you know, as you look into the horizon, what are you most fearful of and what are you most optimistic about?
You know, I am fearful of where is the next guy going to come and disrupt my most promising
Prized company.
priced company. So that is what I am most fearful of. And what I like is we are in the right country at the right time in terms of market, GDP, talent, technology, digital infrastructure. So many ducks have lined up. That is actually unusual. When we were growing up, there wasn't this much opportunity. So this is a great time for us to be investing or working with founders in building great companies.
Well, of the portfolio that you have as part of Fundamentum, you know, is there a unifying quality? Is there glue that holds them all together?
Yes, the founders. And the founders who are very humble, founders who are institution builder, and who put organization before self. I think we all have to put food on the table, but doing more to your institution than to yourself, if you go with that perspective, you will get more than what you deserve. So I think org before self, customer centricity, culture, humility, these are the typical jockeys that we back.
Sanjeev, it's been an absolute pleasure. Thank you very much for joining us here on Young Turks Reloaded. And it's great to have you back on the show and look back at the last 20 years, but also look ahead at what the future holds.
And next time you're calling me not after 10 years, but 5 years.
Yes, no, absolutely. It hasn't been 10 years. We've spoken several times, I think, in the last 5 years. But thank you so much, as always, for joining us. With that, it is time for us to wrap up this edition of Young Turks Reloaded. As always, send us your feedback and your comments. We'd like to hear from you. Till next week, from all of us here on the team, goodbye. Thanks for watching. Welcome back after the break. You're watching the CNBC TV 18 special. BMW Group India has also reported its highest ever first half performance, retailing 9,075 cars in the first 6 months of the year, a growth of 17%. Joining me now, Hardeep Singh Brar, President and CEO of the BMW Group India. Hardeep, thank you so much for joining us here on CNBC TV 18. Let me begin by asking you, BMW has reported its highest ever first half sales, growing 17% at a time when the broader passenger vehicle market has slowed. What's driving this divergence, Hardeep?
So Shivani, we have 5 key reasons which is really working for us. The number one is the portfolio. We've launched 11 new cars in the first half of the year, and we announced that we will be launching 25 plus models this year. So that has really given us a lot of momentum, a lot of noise around the brand emergence. So that is number one. Number two, the narrative around electrification is really gaining momentum because of the West Asia prices. The fuel prices have gone up recently. So that has really pushed the demands towards the electric vehicles. And we have one of the strongest portfolio in EVs today in the market. And that has really helped us. Number three, we moved towards the long wheelbase product portfolio in the recent past, and people are loving the space in the BMW. So that is point number three. And last but not least, we are doing a lot of these brand emotion for our customers. And, we did our golf events across 9 cities last year, and we are taking it to the next level of cities, the M Drift Academy, some art fair events, and also the Oberoi Concours, which is the latest one in our portfolio. So all in all, there's action on each and every front, which is really giving us a very, very strong momentum in the recent past. And I am sure it will continue in the second half of the year as well.
Hardeep, one of the interesting numbers that I could see from the numbers that you've shared is that 1 in every 4 BMWs you sell today is electric. Has luxury EV adoption in India reached an inflection point, or is this still largely an early adopter market?
I would say, if your package is great, people don't mind going for EV. I think this is an apprehension that people don't want to go for EVs. I think if your packaging is right, to give you an example, we have two cars, the 7 Series, which is top of the line, and second is iX1, which is the entry level. In both the cars, the EV penetration is 60%. So 60% EVs and 40% ICE. So if the packaging is right, the pricing is right, and you give everything that the consumer wants, I think people are willing to go for the electric vehicles.
But from your perspective, what are the biggest hindrances in the full transition that we are expecting? Policies there, government is pushing for the EV transition. We want cleaner mobility, specifically after the West Asia crisis and the petrol price hike. Hardeep, what do you think is the most important challenge that we need to focus on from a policy perspective, from an infrastructure perspective, that will actually lead the transition for us?
I think both OEMs and government, they have to work together. So from OEM perspective, two big factors, how do we bring the price parity between an electric vehicle and ICE vehicle? Till now, the price gap used to be about 20 to 30%. Now it is coming down to 10% and lower. And in our case, both our petrol and EV vehicles are at par. So that is giving a huge flip. Number two, what OEM needs to do is increase the range. So all our cars are today 500 kilometers plus range, and the next generation will be hitting almost 800 kilometers on a single charge. On the government side, I think what is needed is how we can really speed up the charging infrastructure, especially on the highways, because your anxiety is not inside the city. It's when you hit the highway, when you have to cover 300, 400, 500 kilometers on a single day, how quickly you can take that pit stop and recharge your car to maybe 50% or more than that. And that's where you need the charging infrastructure, which is charging at a very high speed. And I saw that in this year budget, government has allocated 700 crores towards the charging infrastructure, which is very, very critical. Last but not least, which again, I think OEMs have to play a role, is the anxiety around the resale price. And we have brought in the assured buyback program for the electric vehicles, which is also one of the key factors why people are loving the BMW cars, because we tell them that this is a assured value that you will get at the end of the tenure that you go for.
Hardeep, let me now turn to the debate that is raging all over social media, and it is concerned with the automobile industry, the ethanol debate. Consumers are looking for straightforward answers. Let me ask you this straightforward as well. Should BMW owners have any concerns about using the E20 petrol in their BMW cars, whether they be old or new cars?
I don't see any problem with that. We haven't come across any issues in any of our workshops so far as E20 is concerned. The new cars are all E25 compliant, so everything is sorted for now.
And how about the older cars? Would you say that probably fuel efficiency or any kind of corrosion could happen over a long period of time?
As I said, we haven't come across any concerns for the old cars using E25. Yes, there is a mileage drop to maybe 5 to 7%, but no problem so far as the engine maintenance, etc. is concerned.
So you're saying that the newer cars are compliant for E25, which is higher than E20. So if India moves beyond E20 in the years ahead, would you say that BMW is already, in the run, and you're all already compliant with what is going to happen? And can today's vehicles adapt, even the E20 vehicles adapt to that higher ethanol blends eventually?
So as of now, we are compatible with E25. But in future, if this blend is going to increase in favor of ethanol, we would need a very clear guidelines and timelines when it is going to increase and by what percentage. That is very, very important so that we can tune up our cars according to that.
And about the concerns that are raised on social media, a lot of people are concerned about what it does to their car and whether higher blending should be there. People of India, citizens on social media are asking for the choice to choose their own fuel. Would you say that that should be the way to go forward for the government?
I think, we need to listen to customers. If there are issues which are found out in other cars, naturally, they need to look at that. But as I said, for our customers, there are no concerns. But if it is coming out and it is coming heavily, that needs to be investigated. Also, there are concerns whether it is happening because of the fuel adulteration, or so that is what we really need to see. Well, how much is contributed by adulteration and how much is contributed by ethanol. So I think the investigation is required for that to come to the solution. What exactly is the issue, so that you can really pinpoint and not create narratives which may not be correct.
Well, thank you so much, Hardeep, for joining us here on CNBC TV 18 for this special broadcast. So the luxury automobile market continues to chart its own course even as the broader industry adapts to changing consumer behaviors, evolving technologies and an ambitious policy on ethanol roadmap. What is clear from both the conversations is that the future of mobility will not be defined by growth alone. It will also be shaped by how quickly the industry can build consumer confidence, whether that's around electric mobility, cleaner fuels, E20 and beyond, or the technologies that power the next generation of vehicles. That's all on this CNBC TV 18 special. Thank you for watching. Hello and welcome to this special broadcast on CNBC TV 18. I'm Shivani Bazaz. The Indian automobile industry is at an inflection point. Demand in the mass market has moderated. The rules of mobility are changing with electric vehicles and alternative fuels. And in the recent weeks, few issues have generated as much debate as ethanol blended petrol. Yet, amid all this disruption, one part of the market continues to grow with remarkable consistency, the luxury automobile segment. What is driving that resilience? Is India's premium customer behaving differently from the rest of the market? How quickly is electric mobility changing the business? And what should every car owner know about E20 and ethanol blending? Over the next half an hour, we'll put all those questions directly to the leaders of India's two largest luxury car makers. And let me begin by introducing my first guest from Mercedes-Benz India, which has reported its highest ever first half sales, retailing 9,768 cars in the January to June period. Joining me right now, Santosh Iyer, Managing Director and CEO of Mercedes-Benz. Santosh, thank you so much for joining us here on this special broadcast. Let me begin with this. The market, Mercedes-Benz has reported its best ever first half, retailing close to 9,800 cars. Yet growth has moderated, Santosh, to 9%. What do you make of these numbers? And has the luxury market now entered a more sustainable phase after a few years of surge that we saw? Or do you still see room for another phase of strong growth from here on?
No, I think firstly, thanks for having me, Shivani, and glad to be here on the channel. If you see the way the total market has developed, it has grown significantly after the GST rate cuts. One of the things which has been hindering the luxury car market is also the constant increase in prices, not led by profit-led pricing, but more led by cost-led pricing. The input costs have gone up. The euro to the rupee, we all know how rupee has and that meant that we had to subsequently increase pricing. So even after the GST cut, which resulted into a net 6 to 8% reduction for customer, today as we speak, we had to already go back to pre-GST level. So these are some of the headwinds. On the other side, if you look at the macroeconomic factors, there is GDP growth, per capita income is rising. You can also see the way the West Asia crisis was managed. The fuel prices hadn't gone up as significantly as in other parts of the world. So inflation was controlled, exports were there. So I think to our customer segment, the sentiments were on a yo-yo basis, and we could also see that in our monthly, quarterly numbers as we were steering the business. But on the other side, overall, if you look at H1, I think a strong, the quarter two was almost double digit, and on an H1 basis, a 9% growth is still great because the base is itself close to 9,000 plus cars, and we have grown significantly on that base. So quite happy with the outcomes. This was our prognosis at start of the year. And also, this growth is also led by product launches. We had the new CLA in the entry segment. We had the new V-Class in the top-end segment. We had the GLS Maybach, which we decided to localize in India. So if you look at the new product launches, that also excites customers and helps us to drive this growth. Future, yes, to expect a hockey stick kind of an environment, I think, may be a fallacy, because I think, again, it's as good as also the external environment being stable is a fallacy. So things will be disruptive, and our expectation is we should continue to grow this market, and we should. The critical factor to note is the structure. We grew 28% in the top end, 20% in the top end segment. 28% of the cars we sell in India today are cars costing more than 1.4 crores. So that shows the structure is improving. Premiumization is all-time high. Even the entry segment cars like the CLA today around 60 lakhs, that clearly shows how the market is shifting more and more towards premiumization for Mercedes-Benz.
Well, Santosh, one of the biggest shifts that we are seeing in India is the transition to EVs, and your EV penetration has, according to these numbers, doubled to 14% in the second quarter. Yes. What would you make of that number, and when do you see electric mobility now becoming a mainstream business for Mercedes-Benz rather than, fast-growing niche?
No, first of all, if you see in the segments we operate, let me say in the top end segment that we were discussing, the share of electric there is 25%. With one model EQS SUV, we have been able to reach there. In the entry, we never had a car line. It's only in the last quarter we had the new CLA, and today you see the overall share has gone up to 14%. Now, if you compare this with the mass market, they are still at 6 to 7%. So already, I think luxury customers, because they have charging infrastructure at home or office, they have multiple cars in their household, their affinity to buy an EV is much higher. Having said that, it's still, even in luxury segment, it's a TCO argument. Why should I buy an EV? Why not a diesel? Why not a plug-in hybrid? And there we would like to leave the choice to the customer. Unlike certain brands and portfolios, we have all the cars. We have the entire portfolio of EVs as well. Many of them, or all of them, most of them will make its way to India. So for us, we rather allow the market to decide the pace of transformation than pushing one specific car line, because the customer driving patterns are different. And today, let's also accept the charging infrastructure is not the same across India. The residual values of EVs are still developing. We give guarantees to customer, but still the real market, when the customer goes after 5 years, 7 years, may be different. So I think let the customer decide. Our job is to give the right products, great value, latest technology, best pricing, and in across portfolio, and let the customer then decide the pace of transformation.
But Santosh, what do you think is the single biggest hurdle today in this EV transition from an industry standpoint? Is it the charging infrastructure? Is it the consumer confidence still? Is it the affordability, or is it something else?
So I think the first and foremost is there are not enough products. If you look at our portfolio, we are selling today 11 locally produced cars in India, out of which one of them is an EV. So if you see from a portfolio perspective, we still are only 10 to 15% of EV compared to the balance still is combustion engines. And out of that portfolio, 14% of sales are EV. So technically, I think first and foremost is let's ensure that across segments, entry, core, TEV, we have enough and more offerings to the customer. The second, of course, is based on the use case, the charging range anxiety, as we call, which is not as much in luxury cars, because in our case, we have cars going up to 800, 900 kilometers on single charge. So maybe we can take care of the range anxiety. But charging still, not only availability of charging stations, but if you reach there, is the charger working? Is it operational? How easy is the payment mechanism there? And so these are, again, nagging concerns. It's a leap of faith. That's the reason we got a plug-in hybrid as well. So somebody wants to drive 100 kilometers pure EV range on an S-Class, can do. And then there is also a combustion engine to back it up if you are not able to find a charging. So all these solutions will emerge. It's no doubt that the end goal is basically decarbonizing the industry. To reach there, there will be different paths. We have also seen a significant increase in diesel share, for example, in the last few months. But the residual value also, which I touched upon, is one big impediment for consumers to shift. So these are the negatives, but there's a lot of positives. Low TCO, low maintenance, environment friendly, plus depreciation benefits, etc., etc. So it's a balance. I think every consumer looks at the economic value, balances the buy, and therefore you can see a different consumers offering or preferring different powertrains.
Okay, Santosh, let me now turn to the issue that has dominated headlines over the last few weeks. And a straight-up question, do Mercedes-Benz owners have anything to worry about when they fill up E20 petrol in their cars?
The simple answer is no, not at all. Cars which we have sold from 2020 are anyways certified materially compliant. Even 23, 24 onwards, they are also even emission and range compliant. So I think customers don't have to worry anything about the older cars as well, which are manufactured and sold after this period. Even before this period, I think the cars will be able to run. There may be certain compromises, slight efficiency drop. But, it's not that overnight the government has put 20% ethanol. These cars have been running on 15% ethanol any which ways for many years, and they were also running on this. So it's only a 5% increase that we are seeing in the last couple of months, and that should not have any significant impact to our customers, and we stand by them. There's a lot of queries at our dealerships, and we are able to answer them. I think one of the bigger problems that emerged in this crisis, in this entire debate, is a lot of adulteration is still happening in fuel pumps, which also means it's not E20, maybe somebody's filling an E30 or something else, and in terms of the fuel mix. And that is maybe causing problems to one of the other consumers as such. But a good amount of education and also, as I said, for us, we have already launched the E25 car. We introduced a new S-Class plug-in hybrid in Mumbai last 2 weeks back, and that's already E25 compliant. So we are always ahead of the curve, and our customers need not worry on this topic.
Santosh, what about the cars that were manufactured before 2020 from your stable? Would you say that they also have nothing to worry about? Of course, the mileage drop you spoke about. Other than that, the corrosion over the years that people are asking whether or not that will be an impact on the cars. Are you worried about that? What would you have to say about that?
Not really, because as I said, the cars have certain tolerances anyway inbuilt into them. These cars have been running on E15 fuel also for so many years. So we don't see a fundamental issue even for those customers driving these cars.
Okay, and you spoke about adulteration, and customers everywhere in India have the same question. How does one know that this is an adulterated fuel, and how does one know where to go when such issues arise? Talk to us about that. How big is the issue and the problem?
So, first of all, you only come to know when the car is talking to you in terms of some issues that's propping up in the car, the engine light going up. And I think no better than the dealership. If you go in, they are able to take out the fuel and test it. There are enough testing agencies where fuel can be tested once the fuel is taken out of the tank. One also needs to see the state of the fuel tank. In some cases, there is rust and corrosion in the tank. And now, basically, because of higher alcohol content, these particles also sometimes comes and clogs the fuel filter in the fuel pump. So there are many reasons, but I think the most, if at all somebody faces a problem, there is no better than the authorized dealership who can really do a technical diagnosis and even share the fuel sample transparently and check in terms of quality and adulteration. But I would say the onus of this should be more on the authorities to ensure checking randomly the fuel pumps in many pockets, and they should then check whether the quality of fuel dispense is as per the norms that's laid out by the government.
Santosh, last question. You spoke about the new launches being E25 compliant. So if the government decides to move beyond E20, would you say there will be challenges for the auto sector, for the existing cars? What's the worst case scenario that you think?
I think what this entire discussions and debate has come up is we have to be cognizant of the current car park. So our view is always that if at all the government decides to go for E25, first and foremost, they should think what happens to the current car park, the older cars, maybe because now you are increasing the threshold significantly. So enough science-based studies needs to be done. And then if at all there is a risk, then let's continue the E20 and also give E25 as an option fuel to the customers who are buying newer cars. Second, there should be enough time given to the industry to shift and migrate because, as I said, a couple of our cars are already compliant, but to make every car line in India compliant may take some time. So enough guidance, enough roadmap should be given for auto industry to do it. And last, not the least, allow the customer to decide. Maybe if you are blending more fuel and if there is an economic benefit, let the customer decide how they want to. And that's where I'm a big proponent of put the market forces to decide if they really want to pay much more expensive fuel and they are okay with it. Let them decide on rather than we or anyone imposing that this is the only kind of fuel that can be used. So, but we wait for the policy. At this stage, what we hear is E25 is not on the top agenda of the government. Right now, they're still trying to clear doubts, apprehensions on the E20 fuel itself.
Okay, Santosh, thank you so much for joining us on this special broadcast. Thanks a lot for joining us on CNBC TV 18. Now we take a short break. After the break, we continue our special discussion on India's luxury automobile market with the BMW Group. Don't go anywhere. We'll be back soon. Welcome back after the break. You're watching the CNBC TV 18 special. BMW Group India has also reported its highest ever first half performance, retailing 9,075 cars in the first 6 months of the year, a growth of 17%. Joining me now, Hardeep Singh Brar, President and CEO of the BMW Group India. Hardeep, thank you so much for joining us here on CNBC TV 18. Let me begin by asking you, BMW has reported its highest ever first half sales, growing 17% at a time when the broader passenger vehicle market has slowed. What's driving this divergence, Hardeep?
So Shivani, we have 5 key reasons which is really working for us. The number one is the portfolio. We've launched 11 new cars in the first half of the year, and we announced that we will be launching 25 plus models this year. So that has really given us a lot of momentum, a lot of noise around the brand emergence. So that is number one. Number two, the narrative around electrification is really gaining momentum because of the West Asia prices. The fuel prices have gone up recently, so that has really pushed the demands towards the electric vehicles. And we have one of the strongest portfolio in EVs today in the market, and that has really helped us. Number three, we moved towards the long wheelbase product portfolio in the recent past, and people are loving the space in the BMW. So that is point number three. And last but not least, we are doing a lot of these brand immersion for our customers. And, we did our golf events across 9 cities last year, and we are taking it to the next level of cities, the M Drift Academy, some art fair events, and also the Oberoi Concours, which is the latest one in our portfolio. So all in all, there's action on each and every front, which is really giving us a very, very strong momentum in the recent past, and I am sure it will continue in the second half of the year as well.
Hardeep, one of the interesting numbers that I could see from the numbers that you've shared is that 1 in every 4 BMWs you sell today is electric. Has luxury EV adoption in India reached an inflection point, or is this still largely an early adopter market?
I would say, if your package is great, people don't mind going for EV. I think this is an apprehension that people don't want to go for EVs. I think if your packaging is right, to give you an example, we have 2 cars of the 7 Series, which is top of the line, and second is iX1, which is the entry level. In both the cars, the EV penetration is 60%. So 60% EVs and 40% ICE. So if the packaging is right, the pricing is right, and you give everything that the consumer wants, I think people are willing to go for the electric vehicles.
But from your perspective, what are the biggest hindrances in the full transition that we are expecting? Policies there, government is pushing for the EV transition. We want cleaner mobility, specifically after the West Asia crisis and the petrol price hike. Hardeep, what do you think is the most important challenge that we need to focus on from a policy perspective, from an infrastructure perspective, that will actually lead the transition for us?
I think both OEMs and government, they have to work together. So from OEM perspective, 2 big factors, how do we bring the price parity between an electric vehicle and ICE vehicle? Till now, the price gap used to be about 20 to 30%. Now it is coming down to 10% and lower. And in our case, both our petrol and EV vehicles are at par. So that is giving a huge flip. Number 2, what OEM needs to do is increase the range. So all our cars are today 500 kilometers plus range, and the next generation will be hitting almost 800 kilometers on a single charge. On the government side, I think what is needed is how we can really speed up the charging infrastructure, especially on the highways, because your anxiety is not inside the city. It's when you hit the highway, when you have to cover 300, 400, 500 kilometers on a single day, how quickly you can take that pit stop and recharge your car to maybe 50% or more than that, And that's where you need the charging infrastructure, which is charging at a very high speed. And I saw that in this year budget, government has allocated 700 crores towards the charging infrastructure, which is very, very critical. Last but not least, which again, I think OEMs have to play a role, is the anxiety around the resale price. And we have brought in the assured buyback program for the electric vehicles, which is also one of the key factors why people are loving the BMW cars, because we tell them that